software that can complete multi-step tasks for users without supervision. Amazon's launch puts it up against other AI agents by rivals like Anthropic and OpenAI. Amazon has been investing heavily in AI software to maintain an edge over its competitors in the market. That's what's happening here in the U.S. Back to you in Mumbai.
An extremely choppy session there on Wall Street. The final update on our global markets come from Europe, and the indices there ended the session lower yesterday. As you can see, the French CAC ending 1.5% lower. The DAX also ending lower by almost 1.25%. The FTSE no different, 0.9% in the red. The pan-European stock 600 index was also down 1.5%, and this was the first negative month of 2025 for the stock 600 index, which is the pan-European index. Of course, all the European indices have been outperformers in comparison to the US markets, and most of the automakers in US ended lower yesterday, be it Volkswagen, Mercedes-Benz or Renault, all of them ending with losses in yesterday's trading session. But that was all the global market action that we have. How will all of these overnight cues impact our own markets? Our research team joins in with the trade setup, the stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. First up, Vamakshi joins in to get all the market cues we need to watch out for today. Vamakshi, good morning. A gap down starts in the offing, but what are the other cues you're watching out for today?
Well, absolutely, Hormaz. Last week when we look at the, how the markets panned out, it was a good week overall because we ended in the green. Sensex and Nifty both were up somewhere around 1%. But the Friday's trading session was, not such a good one for the benchmark indices. They failed on to hold on to the opening gains. The mid-cap and small-cap indices as well, saw some profit booking at some higher levels. As far as sectoral indices are concerned, the IT index was also down. The IT stocks, in fact, dragged Nifty lower. HCL, Tech, TCS, Wipro, all of these counters were trading lower. Auto stocks too were largely lower ahead of their monthly sales. Financial heavyweights on the flip side did quite well in the trading session. Kotak Bank, ICICI Bank, all of these counters were up and away in trade today. But, there were jitters ahead of the April 2 tariff rollout. We'll continue to see that unfold as well. The FIIs also, interestingly, net sold approximately 4,350 crores in the cash market. This is after they had been net buyers for the previous 6 trading sessions. So that is something that we'll be watching out for. As far as the US markets are concerned, there was the closing was a bit mixed. When we look at the Dow Jones, that was up 1%. The S&P 500, which is the broader index, was also up nearly 0.5%. On the flip side, the Nasdaq closed with a mild cut of almost 0.1%. As far as the cues today are concerned, we'll be keeping an eye out on economic cues like the Eurozone CPI, US S&P Global Manufacturing PMI will be another important cue to watch out for. Key levels for the Nifty, there is a strong support at 23,400. On the upside, we might see some resistance at 23,700, 23,800 zone because this is a key resistance. As far as the GIFT Nifty is concerned, it is indicating a gap down start to the trading session today.
Indeed, gap down start is what is in the offing. Vamakshi, thanks a lot for that. And lastly, Sudarshan joins in with cues from the F&O space. Sudarshan, good morning. Well, 23,500 was the important level, but now considering the gap down, what are the setup on the F&O side looking like?
Good morning, Hormaz. So as far as GIFT Nifty is concerned, it's indicating that we are going to start, Nifty is going to start much below 23,500. Currently, GIFT Nifty is down around 170 to 180 points. It's on the back of weak global cues because today we'll be reacting to 2 days of global cues because we were shut on Monday. And as far as Friday's session is concerned, after a healthy session for last few days, we saw on Friday that market closed with minor cuts. And as far as flows are concerned, FIs have sold almost more than rupees 4,500 crore, but it was offset by DIs, which I bought more than rupees 7,000 crore. Even on the derivative side, we saw FIs selling more than 3,100 crore in the index futures, more than 19,000 crore in index options, and more than rupees 2,300 crore in stock futures. And they have reduced long positions by nearly 2,800 contracts and added short positions by almost 16,000 contracts. And with this, FI's long exposure now reduced to 35%. Talking about the option front, 3 calls that were very active. One was 24,000, then 23,800 and 23,600. On the put side, 23,500 and 23,300 have seen healthy addition. So on the downside, it looks like 23,300 is protected as of now. And on the upside, 23,850, that is the resistance for Nifty. Talking about the stocks in focus, keep an eye on all the IT stocks because in the last 2 days, one sector that has seen like downward trend, that was IT, and majorly IT heavyweights will be in the focus like Infosys, TCS and Wipro, and also keep an eye on few stocks that will react on the basis of news flows like Vodafone Idea, Indus Towers and all the city gas companies.
Oh yes, I tell you what, Vodafone Idea and Indus Towers will be the two to watch out for this morning. Sudarshan, thanks a lot for that. We take a short break. On the other side, the government, as I just mentioned, Vodafone Idea will be the one to watch out for because the government has decided to convert now almost dues worth nearly 37,000 crore rupees into equity shares. More on this on the other side. Stay tuned.
We will build an independent future for our country stronger than ever.
Welcome back. Now, the Union Cabinet has approved a production-linked incentive scheme with an outlay of 23,000 crore rupees to boost domestic electronic components manufacturing. Now, this is a little more than half of the 40,000 crore rupee outlay that the industry had sought. Now, here is Union Minister Ashwini Vaishnav on the PLI scheme and its potential impact.
It's actually not a PLI scheme. This is a very comprehensive scheme in which a lot of passive components which go into electronics manufacturing will be supported. If you look at, let's say, this entire motherboard, in this motherboard there is a PCB, then there are non-SMT components, then there are SMT components which are basically installed on this PCB, right? Then there are semiconductors, then there are multiple things, right? So with this scheme, we'll be able to support a large number of components which go into manufacturing of the finished goods, and that will increase the domestic value addition. Most important is the employment potential of electronics, which is already 25 lakh. We are now aiming towards 60 lakh employment potential. In the last 10 years, electronics manufacturing has grown 5 times. Exports have grown 6 times. And now electronics is among the top 3 exported items.
So quickly, one word about what this does for value addition here, and in terms of growth of the electronics sector. The Prime Minister has set a very tall target, $300 billion by 2030. What does that look like in this journey?
This will really help in value addition because many of these components which will be manufactured in India will basically be used in the same final products. But we are also having a thought process that we are not just looking for import substitution, we are looking at export-led growth.
Sure.
We are looking at export-led growth so that large-scale manufacturing of these passive components will be basically for the entire world.
And one final question, sir. You said that going beyond the PLI as well, you'll be looking at an overhaul of the regulatory framework as well to encourage the industry. Just a word on that.
Electronics manufacturing is a very different industry compared to other factory setups. Very clean environment is there, air-conditioned environment is there. So we need to have a different type of regulation. Secondly, the number of people which get employed in one single unit is very high. There are factories which have 60,000 people, 40,000 people working at one place. And that requires a different set of regulations. So we are working with the Labour Ministry as well as the state governments for this. Thank you.
Well, now in a bid to provide financial stability, the government has decided to convert Vodafone Idea's outstanding spectrum dues into equity. Now, this move comes after the cabinet rejected the Telecom department's proposal for a partial waiver of the company's AGR dues. Reema is joining in with more on the implications of this. Reema, good morning. Tell us more.
Hi, good morning. As you pointed out, the government has announced that the company has intimated to the exchanges that the government will be converting part of its spectrum dues into equity. The government stake in Vodafone Idea rises from the current 22.6% to 49%. The company will be issuing shares worth 36,950 crore rupees to Government of India at the face value of 10 rupees. But this is at a 47% premium to the current market price of 6.8 rupees. Even though the government will have a 49% stake and they will be the largest shareholder, the operational control of the Vodafone Idea continues to remain with the existing promoters. Now the news is a positive for Vodafone Idea. For starters, their debt comes down by nearly 37,000 crore rupees. Liquidity in the company goes up. The company has been trying very hard to raise 25,000 crore of bank debt funding, which they can use for rolling out their capex, getting 5G, on a nationwide basis. That has been delayed for a long time. Now that the government has backed it, perhaps the company will be able to go ahead and get that much needed bank funding. It's also a positive for Indus Stars because Vodafone Idea is now, in a much stronger position. Now, the debt on Vodafone Idea's book, though, is very large. It's nearly 2.3 lakh crore rupees. Of that, only 37,000 crore is going to get converted into equity. But in the near term, for the next 2 or 3 years, the amount that the company has to pay to the government comes down. Those are the numbers that IFL has put out. So, once the moratorium comes to an end, the company had to pay nearly 43,000 crore worth of annual payments to the government. That number comes down materially to 23,000 crore in FY27 and 33,000 crore in FY28. That said, a lot of analysts believe that in the near term it's fine, FY26, FY27, maybe even FY28. But thereafter, making those hefty payments of 33,000 crore, the reduced amount also because it's so significant, will be difficult for the company. According to IFL, they expect that the government will need to further increase their stake in Vodafone Idea at a later date. Vodafone Idea will remain a distant number 3 player, not a very competitive one. Continued dilution in Vodafone Idea shareholding will cap the upside for existing shareholders. And hypothetically, if the government were to convert all its dues into equity, its holding would stand at 81%. Back to you.
Wow, 81%. That's something that a number that we watch out for as well. The stock reaction in particular this morning. Rima, thanks a lot for that. Now, India and the United States will start sectoral expert level engagements for a bilateral trade agreement in the coming weeks. Now, this decision follows 4 days of negotiations between senior officials from both nations in New Delhi. The Commerce Ministry has said that it aims to finalize the first tranche of the bilateral trade agreement by the end of this year. Abhimanyu Sharma is here with more on this. Abhimanyu.
India and the US have reached some sort of an understanding with respect to the next steps towards signing off a bilateral trade agreement, which is going to be mutually beneficial for both the sides. Now, sectoral expert level engagements are expected to take place in the next few weeks, in which officials from both the sides would connect virtually to discuss on the issues of trade pertaining to both the countries. Also, issues pertaining to tariff barriers, non-tariff barriers, as well as market access would be taken up, possibly in the first round of negotiations, which are yet to take place. Now, 4 days of deliberations had already taken place in New Delhi. It would be followed by further rounds of talks based on which both the countries are aiming to increase their bilateral trade and they are aiming to sign a bilateral trade agreement by the fall of 2025. It remains to be seen what are going to be the key asks from both the sides and what is going to be agreed upon, more importantly, as both the sides are seeking duty cuts on several goods. As far as the US is concerned, they are seeking duty cuts on wines, automobiles, and several other industrial goods, while India is likely to seek duty cuts on labor-intensive goods like textiles. It remains to be seen how early the engagements are going to finish, what is exactly going to be the contours of the agreement which is going to be signed between both the countries. Also, earlier, we had reported that there were concerns expressed by the Indian industry before the government about the possibility of the impact of reciprocal tariffs which are going to come into effect from the 2nd of April. It remains to be seen what is going to be the immediate impact from these tariffs.
Abhimanyu, thanks a lot for that update. We take a short break. Up next, we get you cues from the commodities market. Stay tuned. Welcome back. Now getting you the latest on developments related to Donald Trump. We have Dia joining in our special segment, Trump Watch.
US President Donald Trump said on Monday that he will be very kind to trading partners when he announces further tariffs this week. He said reciprocal action is required since the world's largest economy has been ripped off by every country in the world.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday, you're going to see. And they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us. And we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Donald Trump on Monday said he expects Russian President Vladimir Putin to fulfill his part of a deal to end the Ukraine war after voicing doubts over Moscow's commitment. Meanwhile, Ukraine is working on changes to a draft agreement with the US over preferential access to Kyiv's natural resources, a senior Ukrainian official told AFP on Monday. This after Trump warned Kyiv not to reject his proposal. President Trump also hinted on Monday that his close ally Musk may have to go to running his companies full-time and that the tumultuous mission of the OGE will have been accomplished after firing tens of thousands of government employees.
I think he's amazing, but I also think he's got a big company to run, and so at some point he's going to be going back. He wants to.
You want to keep him around?
But I'd keep him as long as I could keep him. He's a very talented guy. I love very smart people. And he's very smart, and he's done a good job. Doge has, we found numbers that nobody can even believe, like 400 billion, 500 billion. It could be close to $1 trillion by the time they end on different things. And he's led the charge, and you've seen a lot of his people. And these are people that joined up. I would say the high IQ people. I like high IQ people. And they've done a great job.
Lastly, the IMF and the World Bank are making their case against a potential breakup with the US under President Trump. The sister institutions are bracing for impact from Trump's massive makeover of international relations and pitching the administration on the value they bring to its transactional America First ethos. That's all for today. Back to you.
Yeah, thanks a lot for that. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. It comes as no surprise that it's another record high for gold, but oil prices are on the upward swing as well.
Oh, well, absolutely. The gold, there's no stopping that until we've seen the reciprocal tariffs and we've seen how the other countries are going to retaliate to that. So until you see some death settle in some sense on all of these tariffs, there is no stopping gold, really. So all-time highs, yet again, yes, dollars announced now. We've seen 18% of gains in the first quarter of 2025, and this comes in on the back of 28% of gains in the previous year as well. And you have global banks and brokerages putting very higher numbers going forward because there are concerns about U.S. slowdown now creeping in as well. So when you look at the gold prices, well, while we continue to be on the higher side, you have Goldman Sachs talking about 3,300 and 4,500 as well under extreme scenario. That's exactly the kind of language you have seen coming from HSBC, Bank of America, UBS, Citi, etc. Talk about copper, and well, we've seen finally some profit taking onto this one. It's trading at a 2-week lows after hitting those all-time highs for the last 3 weeks there. But as you mentioned, well, yes, the limelight also is on the crude oil prices. 2% of gains overnight. It's trading at a 5-week highs. The U.S. could impose more tariffs on Russia. It could possibly attack Iran. The Kurdish oil exports also have hit a snag, and there also are concerns on Venezuela exports. So various areas and supply disruptions is what is supporting the prices as of now.
Plenty of cues that are coming in for the commodities as well. Manisha, thanks a lot for that. Gold prices making a record high. Oil prices are also making a new oil prices too are on the upward swing as well, and as you can see now 3170 is what the June futures of gold are currently trading at. Is where they are. The Asian markets too as of now holding on to gains comparatively, because the Nikkei too is still trading with gains of around about 0.5%, 0.6% higher on the Nikkei. The Kospi though has extended gains now, 1.75% higher there as well. The Hang Seng 0.7% higher, but the GIFT Nifty still continuing to indicate a gap down start for our own markets. But with that, it's a wrap on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call takes the action forward.
Total size of the global pharma industry is $1.5 trillion, and we are still.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Fresh new week, 4-day week, with one being, of course, a holiday coming out of it, 3-day weekend. And it is a pivotal, important week for a variety of reasons. Number one, of course, top of mind is tariffs coming in from President Trump tomorrow. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, hi, good morning.
Morning. So much news flow. So much news flow over the weekend.
Well, that's right. And we kickstart a new fiscal. Hopefully, this is going to be a little better than the last one. To be fair, we managed to eke out some gains. But guys, yesterday was a holiday. Everyone was happy. I think market participants were very happy because Asian markets were in the red and global markets are in absolute dizzy. So not a bad day to have a week off. Good times.
Absolutely. And today is April 1st, right?
I was wondering whether to go for it, but I said I'll hold on.
So as they say, fool me once. Tomorrow is April 2nd.
Fool me twice.
But anyway, we will touch upon, the 2nd of April in a bit. Actually, not in a bit. We'll sort of touch upon it all through the course of the next 2.5 hours or so. So let's just quickly run you through how we start. And we start on a risk-off kind of mood, risk-off start to the week. And it was like that yesterday. in a very severe way. So Friday actually was the big cut. And I'll not refer to day-on-day changes, but I mean consolidated. Reciprocal tariff announcement up ahead, which is tomorrow evening essentially, which is, the 2nd April morning in the US. Markets, of course, also on edge because of data which we got on Friday, which once again showed that growth is coming off and inflation is rising. At least inflation expectations are rising, and that brings in that word stagflation into the conversation once again. So it's tariffs plus slowing U.S. growth, all of it combined. Now, overnight, what we saw was pretty healthy. The S&P was down 1.7% at one point. From being down 1.7, we actually ended about 0.5% higher. The Nasdaq ended almost unchanged, about 0.14 plus. And at one point, the Nasdaq last night was down 2.5%. So, big reversals on the day. But if you look at consolidated two-day change, which is Friday's session, to which, Asia was deep in the red yesterday, etc., and last night's session as well, and the changes will come up on your screen. The S&P over the last 2 days is down 1.4%. The Nasdaq is down 2.8%, almost 3%. The 10-year yield has sold off 15 basis points. That is very, very severe in a very short time span. Gold prices are up 3.5%. We are now past $3,100. Actually, those were the only signs of classic risk-off. Equities down, bonds going up, and gold actually rising sharply. Dollar index and oil prices not so much if you sort of combine the last two trading sessions. They've been largely flattish in that sense. Now, this is, of course, what we've seen already. I'll start with the silver lining. The silver lining is very simple, that there are no, in that sense, there could still be a big negative surprise, but largely the news on the negative side is now well known in terms of reciprocal tariffs, about the economy slowing down, etc., etc. But as Goldman Sachs pointed out on Friday, they're saying that they expect average US tariff rate to rise 15% in 2025. This is about 5 percentage points higher than their earlier estimate. Remember, we had Sunil Kaul of Goldman Sachs just 4-5 days back with us, and this is after that. So, as you're going into the event, you've got some big banks in the US actually raising their expectation of what to expect. By the way, Goldman has also cut their 2025 GDP growth forecast for the second time in a month. And that the cut this time is by another 0.5% or so. And I think now the growth expectation for the year by them is about little over 1% or so. So, this is, and of course, they've lowered their S&P targets as well by the end of 2025. We'll get to all of that in just a bit. The only reason I'm mentioning that is that there are those who believe that tomorrow could still surprise on the negative side if the tariff announcements actually come. And markets will have to see it to believe it and then react on the negative side. And I think it is possible we actually can see that. And of course, if the world slows, etc., that, as we've been saying, the impact on India is through the rest of the world in that sense. The world slowing rather than direct sort of impact because of tariffs imposed on India. I'll just leave you with levels here. The Nifty supports, and I'm just putting out supports as I did on Friday as well. And Friday, the markets did come off by close actually quite sharply. Supports are 23,142. It's a little away from where we are, but that's the first retracement of the recent bounce that we had from the lows to the recent high. So 23,142. For the Nifty Bank, support stands at 51,230, which is the 40-day exponential moving average. And then the first retracement of the same bounce that we saw on the Nifty, which is 50,259. GIFT Nifty will come up on your screen. I think we're down about 30, 40 odd points if you're able to get away. Okay, I beg your pardon. My mistake. 170 lower on the GIFT Nifty. So actually, with this kind of a start, those levels start to come into view sooner rather than later on the downside. We'll see how things pan out, but there's no reason to be adventurous to try longs. Obviously, one should not ahead of this big event that we have lined up tomorrow. That is, of course, the reciprocal tariffs. Surabhi.
Yeah, absolutely. I guess that, GIFT Nifty implied open is factoring in the Monday sell-off as well. In the actual market trading, whether we fall to that extent, let's see, because Friday, in any case, we were fairly weak. We ended on a softer note. So, hopefully, fingers crossed, it won't be as severe as what the implied open is indicating right now, because Asian markets have pulled back, Wall Street pulled back. Monday was the day of carnage, which we sort of escaped. To what extent, we will find out when we open up. Maybe buyers come in, maybe open gap down, and then the buyers come in. Very quickly, so Asian markets largely up and about. I'm looking at most of them on the screens. The gains are about 0.5% of the Nikkei. Hang Seng's up about 1%. Shanghai is mildly higher as well. Singapore is still down. On Monday, the Japanese market sold off 4%. I mean, it was one of the worst performers on the tariff uncertainties. Even the other regional markets were down anywhere between 1% and 3%. There's the unemployment data out of Japan this morning, which is looking pretty decent. The unemployment rate has come down to about 2.4% versus 2.5% in the previous month. But it's been all about risk off in the last 2 trading sessions or so. And an evidence of that, obviously, is usually the yen. Remember, when we left trade towards the middle of last week, the yen had weakened to, almost to 151 to the dollar. All that has changed. And we're looking at levels of below 150, 149, give or take, 149.77 on the screens, as we can see. And again, because of the flight to safety, gold has been soaring. It's making new records every day. And while we were not trading on Monday, the levels were even higher than what you're looking at the screen right now. It was 31.60 almost on gold. So from that level, it's come down a little bit. Tomorrow is all about reciprocal tariffs. On Friday, it's going to be about the jobs report. It's a pretty heavy week. And not just that, on the geopolitical front as well, there were not such nice headlines, because Mr. Donald Trump went on to say that he's very angry and quote-unquote pissed with Putin, because Putin has been seeking perhaps a regime change in Ukraine, a new leadership to take the ceasefire talks forward. The Kremlin has responded, trying to downplay that comment, saying that we're still working with the US. So let's see. All of this has meant that oil started moving higher, because what Donald Trump said, that he will impose up to 50% more sanctions on any country that's buying Russian oil, and that includes us, India. So that's a big watch point for us. Look at that, 75 on Brent right now. That's not a great cue for us for sure. Very quickly, lots of macro numbers for us here as well. 2 are good, 1 is not so good. Current account deficit has come down, fiscal deficit has come down, but the core sector growth has slipped quite sharply in February. In fact, it's at a 5-month low. We're looking at a number of only 2.9%, which is a worry. It was about 5% just a month back. But the fiscal deficit, like I'm saying, it's come down quite sharply. We know that government spending has been weak. So for the 11 months of the year, there's a decline of about 10%. Current account deficit has come down very sharply year on year and quarter on quarter. That's because the remittances that are coming, the wages that are coming in are much higher. Though in that quarter, there's a lot of FPI selling, but Indians have been, or NRIs have been repatriating a lot of money, and that has supported the CAD number, which is at about 11.5 billion. Very quickly, speaking of fund flows and, the dollars moving in and out, they were actually moving out on Fridays. So this was a bit of a bother after a couple of great days in terms of positive FII numbers. There was a net sell of about 4,300 crores on Friday. Domestic institutions bought a lot, 7,600 crores, so that wasn't bad. And by the way, if you think global headlines are the only thing you need to worry about today, no. There is such a ton of corporate news flow that our team will get into it. Just a quick glance, Vodafone Idea is the biggest headline. Guess what? The government of India is now owning 49% of this entity. It'll have ramifications. We'll talk about that as we go forward, because they've converted dues, a lot of the dues, into equity. ITC has acquired the Aditya Birla Group's paper and pulp business. It's a big deal, 3,500 crores. BSE, the bonus share announcement is out. We'll tell you more about it in just a bit. And lots of big order wins. HAL, the order announcement is 62,700 crores for these light combat aircraft, the Prachand helicopter as it's called. HBL Engineering has been winning Kavach orders as well. And GMR, if you're flying in and out of Delhi, international or domestic, not such great news for passengers, because that user development fee has gone up. So it's a packed day, so much news flow, but we have to navigate this implied open first, Nigel, which is showing a weak start.
Well, that's right. And the hope is that the FI net selling doesn't resume, right? Because we had a few sessions of buying and suddenly that has resumed as well. But I'll tell you what, we'll need a fresh negative to come in from President Trump to derail our markets. Till then, things are pretty okay. But let's celebrate March first. I remember at the start of March, everyone was talking about the Nifty on a 5-month losing streak. Guess what? The Nifty has bounced back in the month of March. Not just that, we have actually outperformed what the globe has done, because the Nifty clearly has outperformed both the Chinese market, various emerging markets, as well as the US markets. So good bounce back is what we have seen. Yes, we got hit very hard in the previous 5 months, but I like to see something like that. Well, moving to what about the broader markets? Well, they as well did a relative outperformance, because the mid-cap and the small-cap indices were up 7 and 9%. However, your portfolio is still not feeling very good, because year-to-date, still those indices are sharply lower. And the hope is, if the Nifty can stabilize, see some kind of green, and the broader markets then can outperform. which will make your portfolio look much better. So that's the important point. For the Nifty, we are flat year to date, but can the mid-cap and the small-cap index gradually move towards that level? What did the FIs do in Friday's trading session? Well, they added short positions, they unwound some longs. The net short positions are at around 65%. And if you just put that together, you pull up the positioning, the FI net short positions, well, they increased. They increased by close to around 19,000 contracts or thereabouts. I'm not too worried about this. I like some shorts in the system. And at 30,000 net short contracts, well, you wanted some more shorts in the system. That's what you got. What about the clients? Well, they were net long, but not too much. Now they've added onto some long positions, and this is perfect to the script. The FIs had shorts, and the clients, they had the net long positions. And as we've been saying, the clients, well, they have been getting this right. Pulling up the options data, then we got a couple of active strikes in trade, the 23,600 call, 23,400 put. So putting in the options data, putting in some technical levels, the Nifty ended around that 100 DMA. So the crucial zone that you're tracking is on the downside, around that 23,350, that's important. And the recent high, which comes in at around the 23,750, 23,800, becomes the important mark out there. Till the 20 DMA is holding out, you'll say that yes, this uptrend will continue that we have seen, this pullback rally. That's a line in the sand. For in the near term, this is the broad range that you're looking at. The Nifty Bank, we mentioned this on Friday as well. If the Nifty needs to fight back, that needs to outperform. And that's what it did in Friday's trading session. And if the Nifty needs to fight back from those lows that we're seeing today, I'll keep an eye out on the Nifty Bank. We'll have a fresh breakout once it gets past that 52,000 odd mark. While on the downside, that 51,000 is where the 200 DMA is at. Finally, plenty of news flow. Vodafone Idea, the government is going to be a larger stakeholder out there. If you want to play that, maybe Indus Stars could be the better play out there. So I'll keep an eye out on Indus Stars on the back of the government of India going ahead and converting some debt into equity. Could be the stock of the day.
Okay, all right, got that. Absolutely. So lots to watch out for. Let's kickstart proceedings then with the equity call of the morning. Lawrence Belanco of CLSA says, running into Trump's D-Day, global markets have seen a pickup in selling pressure after a brief reprieve early last week. He says while price action into April 2 could set up a capitulation low, providing a pivot point for a recovery, with the key US indices in the S&P 500 and the Nasdaq 100 falling below the resistance provided by their respective 200 DMAs late last week. The risk of a waterfall decline cannot be ruled out. He says their focus remains on buying pullbacks in China and Hong Kong and also in India after its March 20 breadth thrust buy signal. So he remains positive, but he says April 2 is big and a waterfall decline across markets cannot be ruled out.
Who knows, right? But it's just so every day. I think we have some sound bites from President Trump today, and we should be able to put them up. He says we'll be kind,
lenient, kind, sometimes flexible, sometimes I'll tax all equally.
Just open a dictionary and look for adjectives of. It's just the amount of things being thrown at the market, quite a bit. Actually, our producer is telling us that we have that sound bite. So why not play that out and we'll bring in Jeffrey Dennis.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday. You're going to see, and they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us, and we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
We'll be nice and we'll be kind. I have absolutely no idea what that means.
And suddenly he's saying he has a world obligation. What a statesman-like comment.
Have you heard the domestic traders, what they're calling this? The Trump tamasha.
It is a tamasha and, a high-stakes one at that, right? Jeffrey Dennis is with us, independent emerging markets commentator. Jeffrey, good to have you with us here. Thank you very much. Nice, kind, lenient, harsh. All kinds of words right into the word salad, as I don't know if that's the right way to use this. But what's your sense, Jeffrey? Will tomorrow turn out to be a bit of a shock event, even though we know what's coming in one sense, or it's going to be the classic sell on rumor and maybe not sell off too much on news?
I think it's more likely to be the latter, frankly. it's just so confusing, and I'm smiling to myself while you're saying how much commentary there is, how much news flow there is. I tend to believe that it will be a sell the rumor, buy the news type of event. We just don't know, though, and until we do know, we're not going to be able to make some major calls here. And even if we do get something predictable or indeed unpredictable on Wednesday, who's to say that? Who's to say that that's the end of it? I think what's disturbing to me about all of this, which makes me nervous about the markets long term, is now the breadth of the action that Trump is threatening across so many countries and so many sectors. And the threats keep coming. One thing that I keep an eye on and keep a hold of, if you like, is the fact that if you look at the 10 countries with the biggest surpluses, bilateral surpluses against the US in 2024, 4 of those 10 countries were the 4 biggest emerging markets: China, India, Taiwan, Korea. So our big markets in EM, including India, are going to be in focus here until Trump decides to put the tariff weapon away.
And hi, Mr. Dennis, and I guess we don't know when that happens, right? It's all about wondering whether the worst is over on the second, but a lot of people do say that this perhaps doesn't get completely sorted out in one day. Whether these negotiations continue or not, who knows? But in the interim, given these uncertainties, how would you look at the emerging market complex? I mean, the US itself is faltering, so I guess money managers are looking for newer avenues. Would a market like India be in the reckoning?
I think India would be more of a sort of low beta play on the emerging markets generally. I think it's very interesting how India in the last few days has behaved like a contra trade. So India's obviously had a very good time, as you mentioned in the intro, in March so far, and yet today it's under pressure again, and that's because, as far as I'm concerned, one of the reasons anyway is that China started to rebound. So there's this China-India thing that you and I have talked about many times before. Now, I think the issues for EM are the following. First of all, if we get a full-fledged recession in the US, which I think is a growing possibility, I think you'll find that equities worldwide do poorly. I think EM will do poorly, even though the weaker dollar is helping EM at the margin. And in that event, I think India will be a relative safe haven. I say relative safe haven. And that's obviously something we have to keep an eye on. And frankly, I think the risk of US recession is being heightened. At the same time, of course, these tariffs are going to push up US inflation, makes it very hard for the Fed to do very much, at least in the short term. So I think net, we are still probably going to be on something of a negative trend for equities over the next several weeks, even if the short-term news is partly priced in. But within that context, I think India's rally in March is a good sign because it suggests that some of the selling is over, at least for now.
Hi, Dennis. Good to see you, Ben. Dennis, it's anyone's guess what President Trump is going to do next, but what are you expecting from the Fed? You know, the probability of them cutting rates has actually gone up because the economic data is not as strong as, say, 3 months or so ago. So what are you penciling in 2025?
I've said all along, including at the beginning of the year and before all this tariff, the breadth of the tariff story really gained strength. 2 rate cuts this year, that's what the Fed thinks. I think that's probably about right. I just don't think it's as simple as it was last year. It's not just a question of how far does inflation come down, when does it come down? Because inflation is kind of stuck, if you like, around 3 or maybe slightly below 3. So I think at the margin, the drivers of Fed interest rate policy are going to be, does inflation fall further at the margin? But more importantly, what does the US economy do? And are we at real risk of recession? And therefore, for me, a rate cut in June and one in the second half of the year is the base case. And I think if it's not that, I think it'll be more than that. And that would be in the event the US economy is very weak. I'm very worried about the US economy, frankly, now. And that makes me think you could get more than 2 rate cuts. And that would be the risk to my call.
All right, Jeffrey, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thanks indeed for being here with us today. Well, we'll take a quick commercial break here, but before that, let me quickly run you through what's lined up, because a lot is over the next 2.5 hours or so. So we'll talk about that big defense order. 8:35, Harshit Kapadia of Elara Capital will talk to us about that large aircraft order. 9 o'clock, Rahul Jain of Goldman Sachs talks about what's happening in the banking space. Lots of attention around that Uday Kotak tweet. 9:20, Sanjeev Prasad of Kotak Institutional Equities will be a market master of the day. 9:30 a.m., Borosil Renewables Management, as they've settled their dues with its German step-down subsidiary. Arun Jain of Intellect Design Arena will be chatting with us at 9:40 with what's happening in the sector outlook. 9:50, Sanjay Kapoor, former CEO at Airtel, and the analyst at IIFL Securities talk to us about what's happening with Vodafone Idea, what it means for you. And of course, later down we have Somshekhar Vemuri of CRISIL Ratings and Sachin Gupta of CareEdge Ratings. We also have K. Ravichandra of ICRA to discuss credit quality trends as we've wrapped up the last quarter.
Time to slip into a snappy break, but we've got a lot of stock-specific action tracked for you on the other side. For the time being, I give you a sneak peek into the list. We're looking at Vodafone, HAL, ITC, AB Real Estate. We have GMR Reports, NCC, and L&T Tech. All of them will be reacting to positive news flow, while we have 3 stocks that will be reacting to negative news flow: IGL, MGL, Gujarat Gas. Stay tuned. We'll get into further detail on all of these names.
Six lakh crores in terms. So it is still very small. So I am quite positive that over the next 5, 10, 20 years, this industry has a lot of leg. We are still dependent on China for basic stuff like solvent, starting material. When all of that shifts to India, which I think will happen in the next 3-4 years, because see, if you are a global major and if you are placing your bet on India, India is still sourcing those material from China. So that to that level, your cost competitiveness is not.
Welcome back. So the global markets have stabilized. The question is whether we'll have to make up for our, absenteeism on Monday. It was everybody was thanking their stars that we weren't trading on Monday, but then is there some payback? Because that's the global picture. It's looking actually very, very decent and very stable. But the implied open, when you pull that up, last time we checked it, we were down about 170, now 150. Maybe it's not going to be that severe. Let's see. Lots and lots of stocks to track. So let's straight away dive in to our CNBC-TV18 list of top stocks to watch. Our entire team is standing by. Guys, good morning and happy Monday to all of you. First of all, Rima, you take away the top honor. So the government of India now owns 49% of Vodafone Idea.
Indeed. So over the weekend, Vodafone Idea intimated to the exchanges that the government will be converting part of their spectrum dues amounting to 36,950 crore rupees into equity. The government's stake in Vodafone Idea rises from the current 22.6% to 49%, and this equity conversion will take place at the face value of 10 rupees per share, which is at a 47% premium to the current market price of 6.8 rupees. Now the news is positive for Vodafone Idea. One, the company was struggling to raise the bank debt funding of 25,000 crore rupees, which it wanted to use for its capex, the 5G rollout. Now with the government backing, this bank debt funding should be now possible of 25,000 crore rupees. So that adds to the liquidity. Secondly, the company's annual payments to the government were substantial after the moratorium came down. It was about 43,000 crore rupees. Now, because of this part conversion of dues into equity, that amount comes down. And these are the IIFL estimates. They're saying in FY27, the dues will come down by nearly 20,000 crore rupees. From 43,000, it comes down to 23,000. FY28 onwards, it comes down by 10,000 crore rupees. But more importantly, analysts say the better way to play it perhaps is via via Industars because Vodafone Idea emerges stronger. Citi says that they've opened a 90-day upside catalyst watch list on Industars and Vodafone Idea. But according to IFL, that even though in the near term it's a positive, the company will still fall short of making its annual payments a little later, maybe FY28 onwards. And therefore, according to them, it's possible that the government will need to convert further dues into equity, raising their stake, and that will cap the upside for existing shareholders. And they say that if the government were to hypothetically convert all its dues into equity, the government's shareholding in Vodafone Idea would stand at 81%.
Well, this is a very interesting topic which we will focus on in greater detail beyond, of course, the stock reactions, etc., which will be important. But was this always in that sense? Not always, but at the margin to many, this was kind of the end game where this would end up. Well, let's move on. We'll come back to Rima for more. HAL is the next one in focus with this big order which has been announced. Upasana is here. Upasana, morning.
Good morning. Well, Defence Ministry signs 2 contracts with the company worth 60 to 700 crore. These contracts are mainly for the supply of 156 light combat helicopter, that is Prachand, which is 90 for Indian Army and 66 for Indian Air Force. Mind you, this is the biggest procurement by Ministry of Defence from HAL till date, is what the company has highlighted. It has also reported its FY25 provisional numbers. Company has reported a revenue of 30,400 crore, which was up nearly about 2% on a YoY basis. While if we compare to the FY24 growth, it stands nearly about 10%. So 2% in this FY25 is much lower. This is mainly because of the supply chain issues and delivery delays of light combat helicopters. Now, company's order book stands strong at 1.84 lakh crores. Company is saying that it is gearing up for a robust FY26 with supply chain issues stabilizing, new orders and enhancement of new capacities. So HAL will be in focus and I expect the stock to open in green today.
Green on that one. Thanks, Upasana, for that. But there are 3 stocks that will be reacting to negative news flow. And Sudarshan joins in to tell us why. Sudarshan, morning.
Good morning, guys. So it's negative for very immediate term because government has announced that it will be increasing APM gas price that companies like ONGC and Oil India supply to city gas companies, and that APM gas price is increased by 4% to $6.75 per MMBTU, and that is for the next 6 months, that is from April 2025 to September 2025. Now the question is this hike that has come as a surprise? The answer is no. If you remember in 2023 April, Creed Parikh panel had recommended certain recommendations related to gas prices. In those recommendations, there was a provision of increasing APM gas price after 2 years. So the answer is government had just followed those recommendations and announced an increase of 4%. So just for very immediate term, it can be taken negatively, but there is nothing major negative.
Yeah, I guess this is just, it's a calendar setting. You just have to adjust as the formula goes and then reprice the commodity. That's how it goes. Got it. Sudarshan, thanks very much. So your price hike coming in for gas. Let's move on to the other important stock in news, and that is ITC and also AB Realty. So ITC is just given a big shot to its paper and pulp business, Manglam.
That's correct, so with all the news over the weekend, FMCG said, why should they stay behind? ITC on, Monday evening itself, just as the weekend was ending, informed the exchanges that they've gone ahead and bought the Century Pulp and Paper business, which was erstwhile from Century Textiles, now part of AB Real Estate, for about 3,500 crore rupees. It's a good deal for ITC and AB Real Estate, and here's 3 reasons why. 1, it increases ITC's paper capacity immediately by 60%. So that's a positive. Secondly, the acquired company's revenue is close to 3,000 crores with EBITDA of close to 500 crores. So it's EPS accretive from year 1 of the deal itself. And thirdly, paper business has been on a bit of a cyclical downturn over the last 3 to 4 years. So making an acquisition at attractive valuations at the lower end of the down cycle is always positive because it brings, higher returns and when the cycle turns itself. ITC on its own part has given 3 synergy targets, 30 to 40% EBITDA per ton increase on account of this business, high teens ROCE in the medium term, and they can increase the capacity over and above what they've acquired as well. So positive for ITC, positive for AB Real Estate because 1, their non-core business goes out, they get 3,500 crores in cash, and that gives them enough balance sheet strength to do well for their real estate business, which is now the mainstay.
All right. Thank you very much, Bangalam, for that. GMR Airports and NCC are the next two names we want to focus on. Vivek is here. Vivek, morning.
Well, good morning. Well, an important update coming in for GMR, something that it's been anticipated for quite a while. Remember, in January, the AERA, which is the Airports Economic Regulatory Authority of India, had issued a consultation paper, and this was to decide the tariffs for the period between April 1, 2024 to March 31, 2029. This is the tariff order for Delhi Airport, and this is for the fourth control period. So what is the final decision that has been taken? There has been an increase of 148% in the existing aeronautical tariff. The nominal yield per passenger has increased to rupees 360 versus the existing 145. This is as per largely in line with what the street was anticipating and also what the consultation paper had thrown up in terms of the recommendations that were made. Now, what is it that Jefferies is saying? Jefferies is saying this improves visibility on profitability. They expect FY26 EBITDA to grow almost 40% on a year-on-year basis, and they expect the company to turn profitable after many years. Now, coming to NCC, now company yesterday gave an update to the exchanges. They have received orders in various divisions, totaling over 5,700 crore. The order split is between the transportation division, building division, as well as the water division. And as per our analysis, the likely order inflow for FY25, taking into account all of the orders that the company has announced so far in Q4, it now stands at almost 27,000 crore, well in excess of the guided band of 20 to 22,000 crore that the company had given at the start of the year. So expect a green tick in both GMR as well as NCC today.
Thanks, Vivek, for that. Well, let's hop across back to Rima. She's here to tell us about L&T Tech. Rima?
Thanks so much for that. So the company has announced a 50 million euro deal win from a European auto company. Analysts say a large auto deal win at a time when there's so much uncertainty is a big positive. And anyway, LTTS was doing pretty well. Even in Q3, the company had reported record deal wins. They had said that their deal pipeline, even after reporting deal wins, record deal wins, was very robust. And mobility is about 32% of their revenue. But in a nutshell, the key takeaway is the company has won a large deal, $50 million deal from a European auto OEM, which analysts are happy because there is so much uncertainty surrounding the entire automotive space.
Okay, all right. Rima, got it. Thanks very much. So those are our top 10 stocks to watch today. Let's quickly recap the list. The ones that have positive news flow around them include Vodafone Idea, Hindustan Aeronautics, ITC, Aditya Birla Real Estate, GMR Airports, NCC and L&T Tech. Stocks with negative news flow around them would be the gas players, IGL, MGL and Gujarat Gas because of the hike in gas prices. Okay, so that's the equity list for the morning. Let's look at what's happening in the world of commodities and how's the commodity universe gearing up for Liberation Day, as it's being called. And it's a flight to safety to gold, Manisha, isn't it? Good morning.
Oh, well, absolutely. In the morning when I woke up and saw gold, it was trading at 3130. It's trading at 3145 right now. So in a matter of a few hours, you're looking at $10, $15, $20 of a move. So, well, yes, it's another record high that we've seen in the Asian markets right now. And as you said, yes, there are concerns on the U.S. reciprocal tariffs on 2nd of April, and then how the other countries would retaliate to that. So this dust doesn't seem to be settling anytime soon, and that safe haven money absolutely is going into gold. So the first quarter of 2025 has seen 18% of gains in gold, and this is after 28% in the previous year as well. And, interestingly, there is a Goldman Sachs report which says that by the end of this year, you could be looking at gold prices at 3,300. But they also say that under extreme scenario, you could be looking at gold going to 4,500 as well. I mean, that's the kind of number that you have seen coming from various banks and brokerages now. Well, that's about gold, and that's unending. But I also want to touch upon crude oil prices because we've seen 2% gains overnight, and crude is trading at a 5-week highs right now. There are supply concerns also coming in from crude, from Russia, from Iran. Kurdish oil exports have hit a snag. Spanish company Respol license to export from Venezuela has been revoked by U.S. There are various factors here as well. So the crude oil price is also in focus right now as we edge towards that 75 mark.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. We're going to come back. Amnish Agarwal of PL Capital for some fundamental stock conversation coming right up.
But Prashant, this is all work in progress, in my opinion, and we are in the right direction.
I think it's very important to see this as one of many important milestones because this will just be a starting point. Tariffs are only one form of industrial policy.
Welcome back. You're tuned in to Bazaar Morning Call. Well, as promised, we have Amnish Agarwal, Director Institutional Research at PL Capital, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Well, let's talk about ITC as well as AB Real Estate. They managed to put that deal. It looks like a win-win for both because ITC, we've been hearing this for years. Finally, that pulp and paper business gets out of their books, and they can focus on on their core business. And in fact, for AB Real Estate, in fact, it gets out of their books, so they get the capital, they can deleverage themselves and focus on the core business. For ITC, it appears like a positive. How do you see things pan out for both these two?
Yeah, hi Nigel.
Hi.
So if you look at say ITC as of now also it's the largest player in the Indian paper and paperboard market. However, due to the pressures on the pricing as well as the raw materials, the company has seen actually significant decline in profitability in the last couple of years. Now, I think this acquisition, first of all, it bolstered their capacity. Secondly, it consolidates their position in the writing and printing paper because ITC, the current capacity of around 8 lakh tons. So bulk of that capacity comes in the value-added paper and paperboards. Whereas Century will be more, you can say, a mix towards the writing and printing paper and other you can say segments in the paper industry. So to that extent, I think ITC's overall positioning in the paper industry improves. That is one. Secondly, now currently I think we are at the bottom of the cycle. Maybe say another couple of quarters, the things might not be that smooth because of the lot of dumping from the countries where there is very, you can say there are free trade agreements plus the raw material issues. But I think post that, I think the things will start looking up. And if you look at the current margins of say ITC, your EBIT margins have literally halved from the peak. So I see that after subsuming this acquisition with an EBITDA of say around 400 to 500 crores, I think over the next 2 years post first half of FY 25-26, I think over the next 2-3 years, the EBITDA of ITC from the current levels in the paper and paperboard business can easily double. So to that extent, I think it will be adding a lot of value to ITC. In terms of, you can say, if you value ITC on, you can say SOTP, I think it will be accretive. But as such, paper is not a very, very big contributor. But having said that, directionally very positive, good move. And there is not going to be any burden given the fact that ITC is a cash-rich company. So it has got a lot of, you can say, money on its disposal. Now, as far as your AB Realty is concerned, I think it will become a much more focused player. We don't have a formal rating on AB Realty, but I think directionally things are looking positive on the company. The balance sheet will get deleveraged, and some of the, you can say, the real estate launches of the company, they are in a very high density and very high value markets. So to that extent, AB Realty could be an interesting company to watch out for in the next 2 to 3 years.
Okay, so an eye on ITC and AB Realty. By the way, just want to point out that while obviously this is business-wise, it's good news for ITC today. One of the brokers, JP Morgan, they've actually lowered their EPS estimates for ITC for the next 2 years, and that's because of the cigarettes business. I mean, just adding that input because they're pointing out that ITC is unable to really push through price hikes in cigarettes. It's a cash cow. That's on a side note. Anyway, Amnish, hi, morning. Let's talk about HAL. I mean, it's a huge order. We know that, 62,700 crores. Now, the stock has already rebounded about 35% from the lows that it hit, the lows in this correction. So now the valuation question will start popping up again. What's your thought?
You see, as I have been voicing that when you look at the company like HAL is a very classic case. For example, all the defense companies, if you look at their CAGR earnings might not be say more than 10-12%. And some of these orders, they may be executed over the next 5 years, 7 years kind of a number. But given the fact that we have got a huge backlog, whether these are, you can say, your defense helicopters, whether these are your aircrafts like Tejas Mk1, etc. I think there's a huge backlog and the country needs HAL to increase the capacity significantly over a period of time. So to that extent, I think HAL will continue to give you very steady growth. Yes, valuation will continue to crop up from time to time, but anyone who is entering HAL has to take a very, very long-term kind of a view. So I think if one takes a long-term kind of a view, one can still make money. But yes, having said that, as the stock has, you can say, risen by 30-35% from the bottom, so the returns now should be taken into account with a slight pinch of salt.
Okay, so a little cautious on HAL. Let's in fact, press that point further and get in one more view. Harshit Kapadia, who tracks defense stocks and companies very carefully, is now joining in with some thoughts as well. The news flow, of course, as we've been telling you, is this big order win. Over 150, I think 156 is the total count of the light combat aircraft Prachand, that is the helicopter. And they will be supplying it both to the Indian Army as well as the Indian Air Force. So the news flow is fantastic. Obviously, it's a moment of pride, fully indigenous, etc., part of the Make in India drive. But Harshit, the question is that with these kind of massive orders, the headline announcement is fantastic. Now, what is the kind of revenue growth, EPS growth, the execution that you are factoring in for HAL, say in FY26, FY27?
Morning. So with the order book of close to now 2 lakh crores, we are factoring in close to a revenue CAGR of close to around 15% and an earnings CAGR of around 17% for Aeronautics at this point in time. We have 3 major orders delivery which will happen starting from next year as in FY26. Which is LCA Mark 1A. There is also Su-30. There are engines which will also get delivered. So these all things are coming to, in a single year. So that will see, the execution being sharp. And capacity, as you mentioned, capacity is right now at around 24 numbers for LCA Tejas. As far as for helicopters, which is Prachanda, they have around 60 numbers and they will be soon expanding it to 90 numbers per annum.
Harshit, good morning. These orders, were you factoring this in? Were they part of your estimates?
So I was factoring in Prachanda in FY26. It just came a day earlier, that is in FY25. So no material change as far as estimates are concerned. We have been looking at these numbers from last 1 year back, but it has been only delayed because of engines for certain things on LCA specifically. That has been the only change.
What's your price target valuations on HAL?
So on valuation, definitely if you see the peak has been close to around 40-45 times when the capex cycle was up. Last 6 months, the stock has corrected. Right now, it's around 35 times on my FY27 estimates. If I add this, and I'm building in an EBITDA margin of very conservative around 24 to 25, it can even touch 26% given the execution ramp up will happen. They will get an operating leverage benefit. So there could be some upside to my earnings estimate, maybe another 10% on the earnings side, which could add.
What is the current target price you have?
Sorry?
Harshit, your current target price, what is it on HAL? And if you could tell us, what is the order inflow you're working with for FY26?
So my current target price is 5160 for Aeronautics. I am looking at an order inflow of close to around 80,000 crores in FY26 with one large order for LCA Tejas Mark 1. Additional 97 numbers may come up in first half of FY26.
Okay, so target price is 5,160. You mentioned possible margin expansion as execution ramps up. The top line you told us, 15% CAGR, EPS growth about 17% CAGR. What would that expansion be? I'm not quite sure about the last, the Q3 margin. But if the margin goes up to 26%, that's an expansion of how many basis points? 150, how much would it be?
For me, it will 150 basis points.
So 150 bips expansion in margin is possible by FY27 or FY26 itself?
FY27.
Okay. Final question. 35 times, that's where the stock is right now. With the kind of metrics that you described, top line margin, EPS, you think this is still sort of best case valuation considering defense stocks have not really been too cheap in the last couple of years?
No, I think there is still a room for expansion because the pipeline is getting much stronger. In FY26, another 80,000 crore. FY25, we have seen close to a lakh crore kind of an order inflow. So in FY26 end, we'll see order book of 2.5 lakh crore. That's the number that we are looking at. So that could be a huge multiplier effect, and all things are getting gathered till FY30. So the execution will continue to even go at 15% till FY30. So that will demand you to raise your earnings multiple, which can even touch to 40 times.
I just want to say one thing. Defense absolutely a fantastic area. Spending, etc., is going to be high. HAL within defense is top tier. There's
top
no
of the
question
line,
about it.
Yeah.
But I think as a market, we are no longer in a stock goes up because there is an order announcement.
Yeah.
It is
which is why I was quizzing on the metrics on the execution.
That market is behind us. I think that market is now it is about execution. And I think as both Amnish and Harshit also said, pipeline is bulging. But how much can they really execute and churn out those planes, etc. We'll have to watch out for. Harshit, thank you very much for joining us. It's a pleasure and good conversation coming through on HAL and of course the defense pack. Amnish is still with us. Amnish, you heard, of course, we heard your views as well. 10% is what you said, revenue growth. I think Harshit said they're now expecting about 15% revenue growth. Let's talk about the other stocks as well out here. And let's just talk about tariffs tomorrow. Sector, we will see what comes, etc. But now that we are really close to it, any particular sectors in focus? Textiles comes to mind as a bit of a disappointment for many investors who were kind of hoping that this is going to be a big one, a wealth creator, etc., etc. It's not panned out that way. And if you look at India's exports to the US, it does sort of feature prominently if they decide to do reciprocal tariff sector-wise. Any thoughts?
See, textile, Prashant, if you look, say, last, maybe say, year and a half in particular, the hope was mainly banking. It was banking upon that now Bangladesh is in some sort of a trouble. Okay. Now there are two angles to it. One is your apparel and garments, and the second is home textiles. Now, as far as apparel and garments are concerned, in that particular segment, Bangladesh was very strong. And India was on the receiving end because of the duty-free access which Bangladesh had to that particular country. So the relative competitiveness of Bangladesh was far more, and it was hoped that now with the, you can say, economy in some sort of a turmoil and unrest in that country, the Indian company will start getting orders from more players in US and Europe who would not like to take that risk of sourcing from Bangladesh. Now, but the bigger part of Indian exports, they always came from the home textiles, which included your bed linen, terry towels, and stuff like that. So there, I think Bangladesh was not that big a player, and if any reciprocal tariff comes there, I think on one hand it is directly going to increase the consumer cost in US, but on the other hand, it is also going to pressurize Indian companies to some extent, in my view, because textiles, for example, you look at say all the leading players. It is not what you can say. You have got very limited pricing power when it comes to, you can say, you're negotiating with whether it's a Walmart or Target, JCPenney, players like that, etc. So to that extent, one will have to keep wait and watch on what exactly transpires, because at the end of the day, this is going to push the US consumer inflation up for sure. But at the same time, till the time there is a clear-cut sort of a clarity on that, I think it puts definitely some sort of a question mark on the profitability and incremental growth for many of the textile companies in India.
Amnish, I wanted to ask you about the two-wheeler pack. And Eicher Motors, they've just reported their numbers for the month of March that's uploaded on the exchanges. And these numbers look good. For the month of March itself, the total number of bikes they've sold is 1 lakh units, 1.01 lakh units, which means it's a growth of around 34%. And, in the models exceeding 350 cc, on a lower base, that's up by close to 49%. What's your view on the thumping Royal Enfield from here on? Do you think it has more scope to go?
You see, if you look at, say, the entire auto pack in the last, say, even I would say 2-3 months or so, I think iShares is one company which is doing well. And I think if you look at the directionally, if we are looking at some sort of an increase in the disposable income, particularly of the middle class and upper middle class due to tax cut and some of the other factors. So I think iShares Motor, it perfectly fit into that place because in my view, it is not the bottom end which is going to benefit immensely from the tax cuts. So to that extent, iShares seems to be very sweetly placed. The only thing is that if you look at the past 6 months or so, as against many of the auto two-wheeler stocks which have become range-bound to weak, I think iShares has rallied quite a bit from something like 4,300 levels to the I would say current prices. So to that extent, I think in terms of the immediate run-up, say for sure. But definitely, as far as numbers are concerned, I believe that the stage is set for iShares to do far better in terms of, say, whether these are sales numbers or otherwise over the next 2 years than what we have seen in the past.
Amnish, let's also discuss really the news of the day. I mean, in terms of just the headlines. Vodafone Idea. Now Government of India owning 49%. I guess in some sense that was the last option remaining, right? With the AGR relief being struck down. But the conversion price is very interesting. 10 rupees versus the current market price of about $6 on Vodafone. What do you make of it? Would you take a play on either Voda Idea or Indus? What would you advise investors to do? Is it anything beyond a quick short-term tactical trade?
You see, usually what happens is that no one will take it, say, for example, if it is government or some strategic investor, no one would like to price below, say, issue price, which is a face value of ₹10. Now, the main thing is, as an investor, what should one do? Because if you look at past 4 years, it is more like a sinking ship. You are putting more money and the weight is only increasing over there. So to that extent, I think if you can say reduce some pressure on Vodafone Idea by this. And I have not gone through the details whether these AGR dues and all, I think they are being converted into equity over here. But what happens to other players? Because the others also had, you can say, some dues over there. So if there is some, you can say, leeway which comes on the side of Airtel and also, I think they will benefit. But definitely, I think all these measures, they are just, you can say, some stopgap arrangements, and Vodafone Idea is far, far away from being profitable or being clear of its survival and growth in the longer term. So I think going by the volatility in the market, I won't advise anyone to just take a punt on, you can say, all these issues. If one has to play a telecom, you can say, cycle and the long-term story over there, I think your Bharti Airtel seems to be the stock to watch out for.
All right, Bharti could be a stock to watch out for if you really want to play Telecom here. Amnish, thank you very much. Good speaking with you. It's a pleasure having you here on CNBC-TV18. There's 8 minutes to go for market pre-open. We'll have a technical analyst join us to take you through what to do in terms of indices, in terms of specific stocks. Sudarshan Sukhani and Mitesh Thakkar with that in just a bit from now.
You have many other forms of industrial policy which are not possible today because people are worried about the World Trade Organization. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult.
Okay, welcome back. There's 7 minutes to go for the pre-open session. Sudarshan Sukhani and Mitesh Thakkar are with us. The pre-open indication is about 150 points lower. Gentlemen, good morning. Good to have both of you here. Thanks very much. Coming out of a 3-day weekend. Mitesh, what's the sense? We start with a gap down, but what after that?
Good morning. Last few days I've been calling that the markets might consolidate, and
try to build a base at higher levels after a good rally. And today's gap down in that sense will be very interesting because we will immediately test or open just below 23,400. So 23,400, 380 is the zone which I was looking at as a lower end of the range. We'll open there. And then I think, in case the market does not continue its decline, then I think we are in for a strong bounce back. But if we don't capture this 23,400, 410 zone again in the next 30 to 45 minutes to an hour, then I think I'll be slightly worried and look for a slightly deeper kind of a pullback. This still doesn't look like a start of a negative or a bearish move. But yeah, I think the choppiness after that big rally looks like, it will try to find some levels where some base building can be done. And I was hoping it will be 23,400, but that answer, I think we'll get it today.
No, got that. I think it's important. And by the way, this current up move, if you guys remember, also started when the market here rejected a big crack on Wall Street on that Friday. I think this was early March. I mean, markets had sold off in the US, and here actually on that day we ended positive. So we'll see, maybe a bit of a test here. But Sudarshan, good morning. What about you? How are you looking at things?
Yeah, good morning. Well, today is a very different day. I think the gap down today should be bought into. Let's see what the US markets did. The US markets opened with a gap down yesterday and closed at the highest point of the day. The chances are we may mimic that action, open with a gap down, and then end up, going throughout higher throughout the day. That's the scenario I'm assuming. And for that, I would say that in the gap down today, in the expected decline in the morning, there is a buying opportunity for the Nifty.
Okay, all right. Buy the dip. That's the call coming in from Sudarshan. Sudarshan, you go ahead and tell us what about stock calls?
Well, assuming that all the stocks are coming at lower levels, I would be a buyer on all sides, starting with Tata Consumer. Buy Tata Consumer with a stop at 980. Voltas, buy Voltas with a stop at 1430. Glenmark, again a buying opportunity here to stop at 1500. And IGIL with a stop at 200. So essentially, I have an all buy list.
Okay, all right. What was the last stock, Sudarshan? Missed that one?
IGIL,
Inpus, IGL. All right. And the target out there?
That's I don't have a target. I usually have stop losses. 200 is the stop loss.
200 is the stop loss. IGL, let's get that up for you on the screen. Mitesh, coming across to you. What about your individual stock calls?
Good morning, Nigel. I have, in fact, two stocks which are common with Sudarshan. IGL is one of them. It's a buy about 205. So I think with the gap down, in case the stock recovers, manages to go past 205, buy with a stop at 200 for a first target of 215 to about 218. Then I have a buy on Glenmark as well, which is another stock matching with Sudarshan. That's a buy with a stop at 1520 for targets of 1585. The other calls are a buy on Muthoot Finance with a stop at 2350 for targets of 2445, and one sell call. Ashok Leyland is a sell stop at 208 for targets of 196.
Okay, all right, gentlemen. Thanks a lot for that call on the indices as well as the individual stock calls. We'll come back to you all for your 9-10 call. For the time being, we'll slip into a short break. We'll be back. We'll get the pre-open rates. We'll also be joined by Rahul Jain of Goldman Sachs to talk about the banking sector. Stay with us.
We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion. So it's like 0.1 to 0.2% of GDP. Now for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Right?
Okay, welcome back. There is about 16 minutes to go for the pre-open session. The clock is ticking, as you can see out there on the screen. So just counting down now. Rahul Jain is head of APAC Financials and India Equity Research at Goldman Sachs. He's with us now with this call on financials. Rahul, great to have you with us here on the program. Good morning. Prashant here. I think that tweet from Mr. Uday Kotak over the weekend got a lot of traction, got a lot of attention. And we'll have that tweet up in just a bit from now. What did you make of it? And how to read it how did you read it as a banking analyst?
Prashant, good morning and good to be back on your show. Look, I guess, before I specifically get into your question, let me just paint a broader picture for your viewers. At the market level, I think we are seeing the stock market kind of bottoming out, and there are opportunities that are opening up, and even banking sector, which has outperformed in the last couple of weeks in particular. But the fundamentals are still looking a bit like a muddle through scenario at this point of time. And liquidity is an important area where I think while the RBI has been trying to do a lot more, but the banks are still looking to raise money at an expensive rate. There has been a rush to raise the year-end deposits. So we have seen a significant activity in the certificate of deposits, and some banks even offered higher interest rates there. And I guess the point that you're referring to is on the margin about the incremental profitability that you're making on incremental borrowing. So I think it kind of allows me to also segue into my overall view on the sector. And there we see the muddle through scenario to continue for the banking sector. We have seen the latest data points coming out of the RBI, which suggests that the credit growth continue to decelerate across different segments, be it the unsecured loans or mortgages or the industrial loans. So there is a deceleration of activity, which does not augur well for the EPS. We have been making a point to our investors that EPS growth could face some challenges, and it'll be at least a quarter or two phenomena before EPS growth starts to get bottomed out. The EPS cuts start to bottom out. So that's the scenario we are in, and that's what you're referring to through this point of the tweet that you just talked about.
All right. Hi, Rahul. Good morning and good to see you, Ben. I think the point that he is making is that NIMs will be under pressure. It's debatable when he talks about the home loans because that's for a longer tenure. But that's the point that he made with regard to the borrowing cost as well as how he sees NIMs to continue to remain under pressure. Rahul, the credit growth has slowed down. I think it's come down to around 11% or thereabouts. What kind of a number you're working with, for FY26, the first half? Do you expect it to be in these early teens itself?
Thank you, Nigel. And that's a very good point. Yes, I think credit growth would remain sluggish for the year fiscal 26 and even could take time to recover even in fiscal 27. So we are working with a range of about 10 to 12%. And this actually would be true across the board. We've already seen, for example, I just talked about unsecured moderated. Mortgages moderated. One of the credit bureau's recent report also suggested that the incremental originations are down. And that is something which won't really be good for the sector credit growth, at least in the near term. I think though the respite could potentially come from the rate cuts and the income tax cuts that the government has rolled out from this year. We'll see how it plays out over the next couple of quarters, but definitely those are the good starting point from the policy makers. And that's what we are asking our investors that, look, the harder the things gets, the policymakers would come out to support. And we have seen that's been happening from both the Government of India as well as the Reserve Bank of India. So that should provide some support. But I think at an overarching level, we should work with about 10 to 12% kind of a growth assumption for the next year and a half.
Oh, that's quite sobering, Rahul. Hi, morning, Surbhi here. So just 10 to 12% credit growth, that suggests that things will not start flying immediately. You are more cautious. So then take us through sort of how to play this, what to buy in the sector, because a lot of people are betting big on financials finally recovering and maybe even leading this market higher. But the numbers that you're talking about don't entirely support that. So how should an investor play the sector?
So look, I guess it's the confluence of multiple factors that shows up in the EPS. So credit is one of the factors. And as Nigel earlier talked about, NIM's also going to be in pressure. Credit costs will take a quarter or two. But look, I guess the sector starts to bottom out, any sector, whether it's banks or otherwise. starts to bottom out, if you start getting the visibility on the EPS cuts getting bottomed out, which in our view is going to be most likely by the September quarter, I think whatever has to be reflected in the earnings, be it the elevated credit cost or a lower margin, should by and large get reflected. Plus, we are seeing the policymakers supporting the sector. That should bring down the risk premium on the sector. That improves the cost of equity. And that's what you've seen in the last month and a half happen. Some of these banking stocks have done well. From here, we clearly believe that the names which can provide visibility on the earnings growth or have better optionality on the asset quality. So we've been favoring the commercial retail theme in general, or segments which are likely to bottom out first. For example, credit cards. On your show, we debated this last time. Those are some of the pockets where where things will start to look better over the next few quarters, and investors will be buying into these names. So for your viewers, I think we would really stick with the names where the EPS growth looks healthy, and the ROAs also looks predictable. I think those are the names that are likely to do well over the next few months or few quarters.
Yeah, I don't know. I guess you can't talk about those specific names, but we have them flashing on the screen, so let's put them up. So the preferred Goldman Sachs picks are HDFC Bank, Kotak Mahindra Bank, AU Small Finance Banks. And in NBFCs, the names are Chola Finance, SBI Card, like Rahul just mentioned, that credit card business is likely to bottom out, Shriram Finance, Aavas, and L&T Finance. On diversified NBFCs, what would be your order of preference? I don't see too many consumer financing giants here, but however, you have a SBI card, so credit cards is there. I don't see housing finance names here. So just what's your order of preference on NBFCs and why?
Yeah, so look, I guess the commercial retail theme looks quite appealing to us because that's a theme that will recover the fastest as the GDP starts to recover. Our house view is that this at best a cyclical slowdown and not a structural one. And with the measure that the RBI, the government is taking, should help revive the GDP growth. We've already seen that crossing the 6% mark. And next year, our assumption is north of 6% in terms of real GDP. And that should actually work out very well for the commercial retail names. So those are the names within the NBFC that we like. To talk specifically about, let's say, housing, I earlier alluded to this point that the originations are lower versus last year. And there is a pricing pressure. I think there are a segment of players who are offering very competitive rates in that segment. So that segment is continue to face some sort of a pressure on the margins. But commercial retail is a theme that should bounce back faster and should print good EPS numbers in our view.
Rahul, just one last quick point. Out of, I think you like HDFC, as Surbhi said. HDFC, by the way, has quietly moved up about 20% from 1600 levels to where it is now. Kotak, I think, is also something you like. Out of the lot, since you said it's a bit of a muddle through for a couple of quarters, you think Kotak, just because, I mean, the size is still relative to ICICI, HDFC, etc., is small, and they've got new leadership at the top. They're present in pretty much all segments. So the room, I mean, in a way, it's like where ICICI was 4 or 5 years back. The balance sheet can grow faster. I mean, the room to grow is in that sense higher. Would you be willing to bet on something like that? What's your sense?
Without getting into the specifics, Prashant, I think the setup for any stock to do well is about the predictability of the earnings. And clearly, some of the names where you have the runway of growth being better over the next few years, with some of the pockets which are starting to do well or would do well as the government looks out to support the broader economy, should technically do well. So I would just leave it at that. But clearly, I think it boils down to the earnings growth, or how long of a cycle that you can grow at. And some of these names have in particular done well over the last few quarters. So the market should reward, as the earnings growth start to come in.
Okay. All right. Rahul, we'll leave it there for now. Thank you very much for joining us. Appreciate it here on CNBC-TV18. I think Vodafone Idea will come up on your screen as one of those new stocks, 10% higher and in the pre-open. And we should also look at the Indus Tower stock, because a lot of brokers had written about Indus as well. So 10% on Voda, and Indus is up about 5%. 350 is where Indus is now at. Well, let's get you 9-10 calls. Sudarshan is back with us. Sudarshan, what do you have?
have Voltas. Consider buying Voltas with a stop under 1430.
I mean, Voltas is a pick. And, a little later we'll talk about IMD's summer forecasts, which, of course, are more severe every year. And it's the same this time around as well. Mitesh, what about you? What do you have?
I'll go with the buy on Glenmark for targets of 1585.
Okay, Glenmark is the next one from Mitesh. Gentlemen, thank you very much, both of you, for joining us. Mitesh, sorry, just one thing. Indus Tower, do you have a view? Do you have a call? Stock starting higher.
I think very clearly there's positive news flow. But if you look at the last, many months, starting from November of 24, the stock is doing a range of about 320 to about 365, 368. I think it will do that, and for the timing in the short term, it will head towards the upper end of the range.
Okay, all right, got it. By the way, the pre-open is absolutely spot on, in sync with what the implied open was telling us when we began the show at 8 o'clock. 178 down on the Nifty. So indeed, we do have to weather a bit of the Monday volatility and fall as well, at least at the start, and then let's see how it goes. Bajaj Auto, by the way, is down about 3%. Infosys, these are some of the names. HDFC Bank, a lot of heavyweights, Reliance, TCS. Basically, all of the big boys are knocking off between 1 to 3% right now. All right, more stocks and news. GMR Airports. Let's quickly rewind and look at the user development fee hike that it has announced for the Delhi airport. Vivek.
Well, that's right. So AERA, which is Airports Economic Regulatory Authority, has gone ahead and issued the tariff order for Delhi airports. This is for the fourth control period from April 1, 2024 till March 31st, 2029. So there has been an increase in the UDF for the aeronautical tariff by close to 148%. The nominal yield per pax thereby increases to 360 rupees per passenger from the existing 145. Now remember, the consultation paper was issued in January, and the recommendations or the final tariff order is largely in line with what the consultation paper was indicating. Jefferies has written on this particular development. Jefferies says that the tariff order improves visibility as far as profitability for GMR Airports is concerned. They increase their FY26 EBITDA estimates by almost 40% on a year-on-year basis, and they expect the company to turn profitable after quite a few years.
All right, Vivek, thank you very much for that. IGL is the next one. Sudarshan is here with details. Sudarshan, morning.
Morning, Prashant. So along with IGL, all the city gas companies will be in focus after government has announced an increase of 4% APM gas price. And this APM gas price is all these city gas companies get from companies like ONGC and Oil India on a priority basis. Now the current price, that is price for April to September 2025, would be $6.75 per MMBTU against earlier price of $6.50. Now this price is as per the recommendations that Kirit Parikh panel had made in 2023 April. So it should not be taken surprisingly. Just on an immediate basis, it might be a minor negative, but for a long term, this price hike might be passed on by all these city gas companies.
All right, thank you very much. So Mitesh, IGL, MGL, any thoughts here? Gujarat Gas?
I've been liking all this stock. In fact, IGL was also a recommendation, and I said if it starts getting past 205, which is where some pivots are placed, then I think the stock will get into a first target of 215, and then eventually I'm looking at 225. So positive chart over here, though I think the short term or the immediate chart news flow is slightly negative. But wait for the stock to clear 205. If not today, then tomorrow, maybe day after. The stock should do good. Similarly, the breakout pivot on the upside for MGL is 1400, 1405. I think once the stock starts climbing above that, look for at least a 80-90 point kind of an up.
Okay, all right. Got that, Mitesh. Thanks a lot for that. Well, let's go focus on the big story then. Vodafone Idea, Government of India going ahead and increasing their stake out there. What it means for the stock, what a brokerage is saying, and there's a positive rub-off on Indus Towers. Rima, take it away.
Thanks so much for that. So let me start with IFL, where they say the government stake conversion postpones Vodafone Idea's problem because the company's cash flow will still be short of covering the annual government payouts. And therefore, they see a likelihood of the government continuing to convert their outstanding dues into equity over a period of time. And they say that if the government were to convert its entire dues into equity, the government's shareholding in Vodafone Idea would stand at 81%. And if that were the case, that if the government were to keep converting its dues into equities, there will be further dilution for existing shareholders. That would be a negative. Reduced call by IIFL on Vodafone Idea. Motilal Oswal also kind of concurs that this is just sort of like a delaying a move. Another lifeline for Vodafone Idea, pushing the can further down the road. Stabilization of the subscriber base because Vodafone Idea is losing its subscribers. Long pending debt raise and a further relief on AGR dues remain vital for Vodafone Idea's long-term survival. They've got a sell rating on the stock, though they've raised the target price to 6.5 from 5 rupees because the government is converting equity at a premium. They've also got a neutral rating on Industars and they would use any bounce to reduce their exposure. Ambit, on the other hand, is taking a more constructive view. They say the government has reaffirmed their support to the industry. So the industry will continue to have, 3+1 players. And the government has only converted its spectrum dues into equity. They've left AGR untouched. And according to them, this gives the government or leaves the government scope to further consider relief with respect to AGR dues. So that's an important point that they're making. But Vodafone Idea remains suited only for high-risk investors. They've got a buy call on the stock. Citi has opened a 90-day catalyst watch list on both Vodafone Idea and Industars. The premise on which they've opened it for Vodafone Idea is that one, the company's 5G launch has taken place in Mumbai. Plus, they will be able to hopefully raise that bank funding, which will further enable their capex and rollout plans. So they're looking at Indus and Vodafone Idea. Back to you.
All right, Rima, thank you very much for that. So Indus and Voda Idea on Ambit's kind of watch 10% today. At least 4-5% in the pre-open, Indus as well. Just a couple of seconds and we'll have prices come up. So first rates are going to be lower, 0.6, 0.7% down, 23,385 on the Nifty. The Nifty Bank is down about 0.5 odd percent. So in line, I think, largely with what the pre-open, etc. was indicating. Small cap index is down, but down small, just 0.15 lower to begin the day. I think 0.4 now. The mid-cap index will also come up on your screen. Advanced decline, at least straight out of the gates, 1:1, up and down. So equally matched at this point. But it's 120 odd point lower start, which is 0.5%. 23,400 is where we stand at, which is actually not bad, given, the turmoil that we've seen in global markets over the last 2 trading sessions, so as to speak. So the heat map up on your screen. It's more down than up. About 13-14 names are higher and the rest of everything is starting lower at this point in time. Surabhi.
Absolutely. 100 down on the Nifty. Actually, before I get to the Nifty stocks, just because we have such heavy news flow today, let's look at Vodafone Idea and Indus. They are the stocks of the morning. 10% circuit on Voda Idea. Indus is up about 7% and HAL with that massive order is up about 5% as well. So the news flow stocks are still finding green, despite the fact that it's a bit of a shaky start to begin with. On the Nifty, what is weaker? Actually, large financials and IT, both are down and out. Infosys 2% lower, Tech Mahindra about 1.5% on the lower side, HCL Tech, TCS. All the tech names are weak. There's some weakness in large financials like Shriram Finance, HDFC Bank, Axis Bank is on the lower side. L&T, Reliance, these are big stocks which are all on the red side of the screen, at least as of now. So then what's up or what's fighting for the bulls? Trent is seeing some bargain hunting, 3% up on that stock. ONGC is up about 2% as well. Power Grid, some PSU names, NTPC, Coal India. Actually, PSUs are doing pretty well, must say that. Eicher Motors and Hero, 2 stocks from the auto space. Even Bajaj Auto, actually. The two-wheeler makers are doing well. PSUs are doing well. But IT and financials seem quite weak at the start. Still down about 87 points, but it's better than that 170-point gap down that the pre-open was indicating.
Well, that's right. Good recovery, in fact, in the first few minutes it sells from the low. So that initial dip has got bought into. Stocks that are moving around, Punjab and Sindh Bank on rather high volumes. That stock is down close to around 15% or thereabouts. Remember, the free float is very, very limited. But that one is down. Punjab and Sindh Bank should come up for you on the screen. Bajaj Hindustan Sugar, they're close to default. That's the word that's coming in from Care Ratings. They are warning on that front. They say that it could turn into a non-performing asset, as they had to arrange close to 270 crore rupees by March 31st. So that's the reason why that one's down close to 5% on large volumes. Vadilal Industries, the promoters of the ice cream maker, they have settled the spat between the promoters and they're looking to rejig the firm's management. Because of that, that stock in fact is flying away. That's up close to around 10% or thereabouts. Volume's not very, very high, only around 30,000 shares that have got traded. HAL, as you all said, that's flying away. HBL Engineering up 7%. Industars, we were talking about this earlier this morning. then Vodafone Idea could gap up. And probably another way to play this entire theme could be via Interstars, because Vodafone Idea continues, then in fact you'll have a positive rub-off on that one as well. So fairly okay start to trade. We have come off the low point of the day. The Nifty is 100 points off the day's low. The mid-cap index, that's the one to look at, has underperformed in the last 6 months or so, pulled back a little bit in March, and starting off April with a wee bit of a positive tick. Prashant, looking good?
It's looking good, and the initial dip has been bought into, but this is just the start, so we'll have to see. Just a couple of other names. It's all news, right? HAL, Indus, HBL, all news-related names, right on the top of the volume-led gainers list this morning. And Trent is coming up as well, about a 4% gain on Trent, about 5,500 plus. Fortis has been doing well. Last 3 days, it's come up from about 640 levels to about 720. And I think Friday was a big day for Fortis as well. The hospital company Kim's is up 4%. But, beyond that, nothing in terms of volumes. It's a pretty thin day if you want to look at price action in conjunction with volumes. So yet to pick up in any meaningful capacity. I think Nigel mentioned Voltas, right? Voltas is down 3.5. So 1407, 1408 on Voltas on the other side. And it's coming up with volumes, almost 300,000 shares coming through there. The IT names, Infi, TCS, HCL Tech, they are taking a bit of a knock between 1 and 2.5%. So large cap IT is not doing very well. There is Amber, which is down about 3%. K Fintech is down 4%, a capital market play. Lupin is starting lower. AG's Logistics is down about 2%. I can spot Telecom as well, along with the other 3 IT names that I mentioned. So that's the lay of the land. We're down about 100 points on the Nifty. 23,420 is where we start. Najib?
Just one word on Trent. The reason that the stock is outperforming today, they put a disclosure up that as per their update in Q4, they've operated 248 Westside stores and 757 Zudio stores. And the street has taken that update very, very positively. Why is that? Because for Westside, the store addition is close to around 10. That's in Q4. That follows up the 12 that they added in Q3. Remember, in the first half, there were some net closures. So there is an addition that we're seeing on Westside. And on Zudio, they have net added close to around 120 stores in Q4. This is much higher than various estimates. So because of that, the total number of stores that they're operating is higher on both counts, Westside as well as Zudio. The street likes that, explains why that stock is bursting away up close to around 4%. And a few sessions ago, we highlighted that the stock was doing a relative outperformance. It had protected various, support zones as well. So keep an eye out on that one. For the time being, that's the stock of the morning from the Nifty pack.
Absolutely. It's come off the lows over the last couple of weeks as well. About 4% this morning on decent-sized volumes. Sanjeev Prasad is with us, Managing Director and Co-Head in Kotak Institutional Equity. Sanjeev, good morning. Great to have you back on the program. Prashant here. What has been your assessment of things, Sanjeev, on the recovery that we've seen? Do you think it is sustainable? Underlying in terms of what your interaction and your team's interaction with corporates, companies, are things turning at the margin a little bit? RBI seems to be focused on, doing what it can to revive growth. I don't know if the fiscal thing will happen. Tax cuts, of course, will take effect. But what's your overall sense?
Okay, so I think we're still, I would say, somewhat cautious on the market. We have seen some recovery, but that's more led by the banks, actually. It's not as if the rest of the market has really participated in the recovery. The market is roughly about 5% in the last month or so. But at the same time, we are also seeing earnings downgrades. So we've seen about 2% earnings downgrades in the last fortnight, more linked to cuts in the consumer sector space, in IT services, and also oil, gas, and consumer fuels on lower oil prices. So as far as the fundamentals are concerned, nothing much has changed. If anything, on the earning numbers, we have seen some downgrades. Coming to the economy and the company's commentary, I see nothing much has changed, I would say, since we last spoke. There's still some talk of rural recovery, but nothing beyond that. Urban is still looking very slow based on the commentary from the company. If you look at the investment part, still looks really slow. You have seen the numbers for the government for the first 11 months. basically flat on a YOY basis. So no real excitement as far as the capex cycle is concerned from the government side. Housing cycle, we'll have to wait and see. Things have been good for the last 3-4 years, but I think given the big increase in prices in the last year or so, you could possibly see some slowdown. And we are not seeing any real recovery in the private caps part. And we put out a big report on the whole investment cycle and somewhat cautious view over there. So both on the consumption investment side, we're not seeing any real recovery, I would say. So that's where we are. The market is not cheap enough, for us to get terribly excited. Market not super expensive. Also, if I look at the large cap Nifty 50 index, about 21 times, not too bad, I would say. But on an individual basis, it's a struggle to find ideas. Most consumer-related sectors are still fairly expensive. Investment stocks are still expensive, especially in the context of the slowdown that we are seeing in government spending and no recovery on the private capex part. Yeah, so I would say no real excitement at this point in time.
Got that. Sanjeev, hi. So I just want to understand how you're thinking about financials right now. Relatively, I think large financials is something that you've still liked. But the issue is, I was just looking at the Nifty Financial Services Index. It's already almost back at the all-time high because a lot of money has been going back on the BFSI side. Even the Nifty Bank, I mean, I'm just checking numbers. Let's get these indices up on the screen if we can. The Nifty Bank is also 11.5 to 12% off the lows. And now it's about 5% away from the all-time highs. That's Nifty Bank today. Let's pull up longer-term charts if we can. This index is 5% away from the peak. And the Nifty Financial Services Index is practically back at the all-time high. So, Sanjeev, the question is that then what's really left to play? Because there's still some concern about a pickup in credit offtake and whether growth can come back. Your thoughts?
So if you break down the entire financial services into the banks, NBFCs, and insurance, as far as the banks are concerned, again, you have to break it down between the frontline private banks, the second-tier private banks, and the PSU banks in general. The valuations still seem okay. I mean, if you look at the private banks, the frontline ones, yes, they have gone up. Maybe not much more scope of relating from where we are. If you look at an ICICI Bank adjusted for the value of a non-bank business, it's about 2.5 times. So maybe the scope for relating is limited. But the bank is doing extremely well, checking all the boxes, delivering about 15% ROE. So at best, you can hope, for maybe, if not some relating, ROE-linked returns from the stock. And I would think maybe HDFC Bank in a similar boat as of now, given, again, the relating which has happened over there. Look at the tier 2 banks, they have some challenges over there. If you look at an Axis, for example, 1.7 times price to book on a 12-month forward basis, possibly some scope of relating. If some of the concerns which have, arisen for Axis also, unfortunately, as part of whatever we have seen in IndusInd Bank, once hopefully those concerns get addressed, maybe you could see some relating over there. PSU banks still look interesting, still cheap, 0.8 to 0.9 times most of them, barring SBI. And I think they could probably hold up better in this environment, assuming the market is okay. If the market comes off, then all bets are off in that case. But given that they don't have much of exposure to, let's say, the MFI loan book, which has what has plagued some of the small finance banks and MFI and BFCs, and they would probably be better off in the rate cut cycle which we have entered, given the fact that more than slightly 50% of the loan book is MCLR loans, which don't get affected that much. So they may be in a slightly better position compared to the private banks on the NIM part. On the asset quality part, yes, there are still concerns out there. Hopefully next 1 or 2 quarters, if we don't see anything bad coming out on the credit cycle as far as the PSU banks are concerned, maybe there is some scope of rating in the multiples over there. So that's as far as banks are concerned. NBFCs have seen a terrific run linked to the rate cut cycle. Valuation looking reasonably full, I would say. We have been quite positive on the Bajaj, Twin, Shriram, etc. All of them have done quite well. Maybe not much scope for rating, but the companies can deliver quite solid numbers. On the insurance, valuations are still quite attractive. Some of the regulatory / policy-led concerns seem to have finally been addressed. Hopefully nothing more negative coming over there. And lastly, the capital marketplace, again, they will more depend on what's happening in the market, right? They're entirely exposed to the whims and fancies of the market. Valuations are, high over there, but I guess people are taking a longer term call despite the short term blip that you are seeing in trading volumes, etc.
Hi, Sanjeev. So you're sounding fairly cautious, but you're still working with Nifty EPS growth of around 13-14% for the next two fiscals. Is there a downside risk even to that?
I would assume so. I think there's some downside risk in autos for sure, given what is happening on the global side, and even domestic demand environment is not looking very good, especially on the four-wheeler side. So possibly you could see some downgrades, and we'll have to anyway wait and see, how this whole tariff issue plays out, how much of the Indian government open to further competition from, imports, etc. And what does it mean for the domestic OEM companies? So that's one risk still out there. I think the margins are still on the higher side over there, and given the run-up in raw material prices, both aluminum and steel off late, you could possibly see some margin pressures in a weakish demand environment. Otherwise the companies could have been in a position to pass it on, but it will be slightly challenging given the current environment. I think consumer names mostly would probably still see some downgrades. The demand environment is still looking fairly weakish. And lastly, coming to the IT sector, the hopes of recovery keep getting postponed. We have seen some earning downgrades over there. But if things continue the way they are, in the sense that companies themselves not in a position to take too many decisions. And when I say company, I'm talking about the customers of the IT services companies, given the uncertainty which has been created because of the policies of the Trump administration. A lot of decision making could possibly get postponed. Yeah, so possibly some downgrades there too. Yeah, so 14%. That's what we are working with currently, but I don't rule out 1 to 3% over the next 1 or 2 quarters. This quarter will give you some more sense in terms of how things are looking, what kind of management commentary come. But the earnings are not the problem. The problem is the valuations. You're looking on a bottom-up basis, sector by sector, stock by stock. In most cases, valuations are higher than pre-pandemic levels, and that's where I struggle honestly. Given the fact that global interest rates are meaningfully higher compared to pre-pandemic levels, risks have definitely gone up given geopolitical issues and so on and so forth. And 3, disruption risk across sectors and companies have gone up meaningfully. So to give the same multiples, higher multiples versus pre-pandemic levels for lower growth and far higher uncertainty with respect to cash flows, likely lower profitability, that simply doesn't gel with me.
I know, absolutely. Point taken. Sanjeev, I'm not arguing that maybe if global interest rates come down, as the US administration very clearly wants, the focus is on bringing down interest rates, devaluing the dollar, etc. It can't be a catalyst or an argument to buy something in terms of stocks. But it is a factor in the overall scheme of things. You said, interest rates are far higher than pre-pandemic levels. At the margin, how much of that is a factor when you look at valuations?
Should be logically, right? Ultimately you're working on some cost of equity, and if your risk-free rate is higher, logically your cost of equity should be higher. But these are all theoretical concepts. People can ignore it, but it's a fact of life, right? Your bond yields are much higher. Your opportunity cost is a lot better. And the bigger issue is, risks are far higher now compared to what they used to be. If you look at any sector, you have a nice, market structure, 2-3 players, not much of competition. But across sectors, that has changed dramatically now. A lot more competition. So A, volume growth will split across more number of players, and B, profitability could be under pressure. And we are seeing that in several sectors, right? More and more announcements coming from companies to enter that sector. Wherever you're seeing higher levels of profitability or returns, companies are, making plans to enter those sectors. So those high levels of profitability will not sustain. So it is pointless, using the same framework as what we have used in the past. Everything has changed, right? So your risk-free rate is higher. Your risk premium should be higher given far higher levels of disruption and macro risk. So logically, the cost of equity is higher. Multiples should be lower to factor in the extra, risk that one is carrying currently. But yeah, I guess, theoretical argument aside, market has its own way of looking at things. But you are seeing that challenges coming through ultimately, right? You have seen massive derating in multiples of several stocks. You have seen several sector stock not doing it for the last 2-3 years now. So yeah, so some of these, concerns which we've been highlighting for not today. We have been highlighting these points for the last 3-4 years. They're eventually playing out. More competition is a given now across sectors. That seems to be a norm. Profitability is coming under pressure. Returns are coming under pressure. Now to the market to decide how to treat.
Sanjeev.
Yes.
Sanjeev, you have highlighted quite a few concerns, but do you think on the headline index, the downside risk could be limited at least, give and take everything?
Yeah, I mean, given the composition of the Nifty 50 index, yeah, the downside may not be 5-7%, I would think. Again, these are assuming normal situation, but we're not living in a normal time, so keep that, risk factor in mind, of course.
All right, Sanjeev, we'll leave it there. You've published a big anchor report around the CRDMO opportunity in pharmaceuticals, and next time you're on, we'll kind of sort of deep dive into that. But thank you very much for joining us with that perspective on markets. Nigel.
Well, that's right. And as we're having that talk with Sanjeev, just take a look at the Nifty. We're almost in the green. That's giving you some kind of indication about the mood of the market as of now. Post the big dropping that we saw a pullback in March. And now it appears that the street wants to buy into that dip. So let's see how that pans out. But the first 20 minutes or so have been good. IndusInd Bank, that's the top gainer. That's up close to around 5%. Trent as well as higher. And Bharti Airtel has done a U-turn, started off in the red. That's moved well into the green. A larger weight on the index always helps when that one recovers. But let's get our first corporate on the show. We have Borosil Renewables. They have settled dues for its German step-down subsidiary, JMB. To help us out with what does this mean and how do the books look now, we're joined by Mr. Pradeep Kheruka, the chairman of Borosil Renewables. Hi, Mr. Kheruka. Always a pleasure having you on the show, and good to start off the new fiscal with you itself. Now, this appears like a good move done for your subsidiary. Could you tell us the total quantum of the loans that were taken by JMB? What is the remaining debt post these repayments you've made to HSBC as well as HDFC Bank? Please go ahead, sir.
Good morning. So thank you. It's been this has reduced the overall debt exposure to the group, and we're down to a little over 300 crores now. Also, the sort of sword which was hanging over the head of GMB has been removed. So we are the noises coming out from the European Union and from Germany in particular are very positive for domestic production of solar modules and all its components. So it's a matter of time. I think that they will be announcing policies which are going to spur growth of local production, which means good business for our subsidiary. Of course, none of this is yet in hand, and we are waiting patiently and with bated breath, and hopefully we will see good times there. But we don't know when. That is the question.
So the debt has come down to 300 crores, right? That's at the group level
right.
for the...
Yes, for the group, at the group level.
Got it. Right. What about the problem has been with regard to the operations? And as you're saying, there are a lot of factors at play. The commentary has been a little bit better in the recent past. But how do you see the subsidiary turnaround? How do you expect the performance to pan out, say, in the first half of this fiscal and in the second half?
You mean the anti-dumping duty, or when you use
the overseas subsidiary? Let's talk about the overseas subsidiary.
Yes.
Yeah, yes.
So last year, the European Union saw installations of 65 gigawatts, which is huge, and there is no question it's visible around the world. Now the people themselves, meaning the markets and businesses, have latched on to renewables in a very big way. We've seen a robust growth in India. We're seeing robust growth in Europe. And now if by the 1st of January, 2026, it is law in the European Union that 30% of all installations must come from products that have been made within the EU, using components which have been made within the EU. So therefore, there is no escape from that. You will not be able to install a module which is imported from anywhere. It has to be made in the EU up to the extent of 30%. So I think that the writing is writ large on the wall, and we would definitely see good times ahead for the German subsidiary based on these indicators.
It was operationally loss-making, right, as of the last count? Do you expect it to turn profitable?
It was operationally loss-making, yes, that's true, the last quarter. We had cooled down the furnace on the 31st of December in order to stop the losses, and there was nobody to buy the glass, so we wouldn't know what to do with the glass once we had made it. So for that, we had large stocks which we have processed and sold in the meantime. So at the moment, it is quite lean, and we are exploring different options. And as soon as we see the sound of a new policy coming out, we are ready to light up the furnace and start. That way we have the workers in place. Everything is in place. So,
when do you see it turning profitable, sir? This particular German subsidiary?
The moment the production starts, it would start at a profit, I would believe.
Okay. All right.
Yeah.
Just before we talk about the overall business, just a final hygiene question out of the way. Apart from this subsidiary, are there any other entities, your subsidiaries, where you have such a standby letter of credit facilities where you might have to make payments apart from this German subsidiary? Okay.
Nothing.
None others. None others. Got that. Now let's talk about the recoveries, what you were earlier alluding to, because we've been speaking so frequently in the last 1 year, right? And finally, that anti-dumping duty, the countervailing duty, all of that protection did come in. So what has been the impact on ground? Have glass prices started moving higher? What's happening? Because you had guided that maybe Q4 should be much, much better. What's the recovery and where are we right now?
The recovery is at hand, which means that our selling prices are near the MIP, and we are manufacturing at 100% of our capacity. We are selling everything that we make. So I would say that it is functioning well, and all the portents are good. The demand is very high. There is, I must say, the decision by the government of India to impose ALMM, which has mandated the use of domestic modules for nearly every application here, has been a game changer for the entire industry. So I see module manufacturing rising. We just had the inauguration of a new cell manufacturing facility on Saturday, perhaps India's largest, and people are very buoyant, full of hope. And
so EBITDA break-even, sir? I mean, I'm going by what you said. It's a very important statement that now your prices have at least come back to parity at the MIP level, the minimum import price. So does this mean operations are positive at an EBITDA level now?
Operations are at a decent positive.
Okay.
Yeah. So
All right.
we have. So we see all the signals are positive as of now, and we do not see anything on the horizon which might turn it, any other way. So it looks like a good runway going ahead.
Okay. All right. And we look forward to chatting with you and getting further details at the end of the Q4 numbers once you report it. But before we let you go, we have to talk about President Trump, right? He's talking about tariffs. Do you see any indirect impact on your business? Do you have any direct exposure to the United States? If you could fill us in with a few details, because tomorrow is supposed to be Liberation Day as per the way he has termed it. We'll hear about tariffs. The tamasha hopefully comes to an end. But tell us, what is the current exposure you have to the US, and could there be any kind of indirect impact on your business?
The indirect impact, if any, could only be positive. So there is a manufacturing ecosystem in the United States for solar modules. And it's no longer possible to import solar modules in the US from China, because there is the possibility that some of the cells may have come from Xinjiang province, and that is absolutely forbidden. So modules are coming into the US. They are being made in the US. We were one of the sellers of glass for those modules. If there is a stringent duty on imports from China and there is none from India, then we stand to gain. I really don't know where solar glass features in the list of the items which are subject to tariff. So if similar tariffs are imposed on India and China, then we are at par with China. In case they are imposed selectively on China, then we stand to gain. But we have nothing.
Solar glass definitely.
Any downward. I don't see any downtrend anywhere on account of any tariffs in this case.
We'll find out. Thankfully, though, solar doesn't get mentioned too much. What gets mentioned is coal and oil and all the other rest of the stuff. We'll see. Thank you very much. And I think it's an important point, right? I mean, if China, that's the other second-order impact, which you are very familiar with. And that is what many across industries fear. If China gets tariffed more, they may look elsewhere to sort of, in a way, dump excess capacity out of China across a lot of industries. And I think we've been discussing that as well. So we'll see how we respond to that. So it's a pretty dynamic kind of situation, not just, in your sector, but across the board.
I can say straight away that with a minimum import price in place, there is no question of any impact that any Chinese sort of adventure would have on us. As a matter of fact, the minimum import price has done something very good for the Chinese solar glass industry. I'm told that their prices are up by 20%.
Oh, wow. Wow.
So therefore, that is bringing our MIP has brought a ray of hope for the Chinese.
For the Chinese. All right. Thank you very much, Mr. Kiruka. It's always a pleasure. And we'll speak again once we know the details of this, the tariff business tomorrow. We'll take a quick commercial break here. We have the management of Intellect Design Arena, Arun Jain, with us on the other side. We'll be speaking with them about how the outlook is kind of sort of moved since we last spoke to Mr. Jain at the beginning of the quarter. Stay tuned. Coming up.
That's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I would once again request that people must not extrapolate what has happened post-COVID in terms of return, in terms of finding multi-bagger opportunities where money has gone from 10 to 100.
Okay, welcome back. The markets recovered and recovered nicely. We're up about 20 points. And on the Nifty, that is 23,550 on the index. But more importantly, look at the broader market. 4:1 advanced to decline ratio. And I think now with 30-40 minutes behind us of trade, it's a good time to look at this. 0.5% on the mid-cap index, and I think the small-cap index perhaps doing a little bit better now. Let's welcome in our next management. Intellect Design is the company that I'm talking about. Stock's been under a bit of pressure this year, along with the rest of the space, down about 25% or so. Now, the management of Intellect Design was expecting Q4 to be a better quarter. I mean, they didn't give out a specific explicit guidance, but, the statement when we spoke with them at the end of the last quarter, beginning of this quarter, did indicate, now I should say it's the 1st of April, the beginning of the last quarter did indicate that it's going to be a healthy one. But have things changed since we last spoke? Project sort of approvals, etc., are they getting elongated? Have conversations turned a little lengthier now before a deal is struck, before orders are handed out? That seems to be the general sense because of all the uncertainty in the world, especially in the US. Mr. Arun Jain is CMD. The company is with us now. Mr. Jain, good morning. Great to have you with us here. Appreciate your time. Prashant here. So that's exactly my question, sir. Do you stand by the broad picture that you painted for us about Q4, which is that it's going to be a good quarter?
Yeah, so since Intellect trading window is closed now, so it's a quarter is closed. So today is the 1st April, so I cannot comment on it, but it's in the right direction. So that's what I can comment on it. So today, the idea was that so much changes are happening in IT industry, and you wanted to talk about the witness prospect of IT industry, which is the impact of AI in IT industry or the way service industry is getting impacted. So that's how we can establish our dialogue on the direction of Intellect in next Intellect 3.0. We are entering into 3.0 now in this financial year. Last 4 years was Intellect 2.0, where we build up disruptive technology, eMAG.ai, and move the focus to Europe and America. That's what I spoke to you last time. and that our Europe and America business should be
fair
over
enough.
50. Yeah.
Fair enough. I won't press you on numbers, etc. Completely understand. You said the right direction. But could you talk, because it's so fast-paced changes, right? Could you describe the environment for our viewers?
That's right.
Yeah, go on.
So I'll describe two ways. One is services industry, then product industry, and then AI industry. So all are interlinked. AI industry is bringing significant amount of productivity gain in software engineering processes and services. So definitely services industry will be under pressure unless they closely come to the AI. Intellect as a company, we invested into AI way back 2017. In last 8 years, we built up a platform called Purple Fabric, which I mentioned in separate investor call on 18 December, that this is a platform which has a potential to grow 1,000 crore to 5,000 crore kind of a new revenue from the AI platform. This is the first kind of platform from India, which we call business impact AI. A lot of foundation models are coming on the ground level, but they are not translating into business impact. And a lot of business impact in operations, in sales, in service, in risk and governance, the four major areas which financial institutions are looking at. We build up a complete guide rails and guardrails to drive high acceptance of AI platform, which will be launching in this coming quarter. So that's one point I want to mention, where we are very bullish about what many things in America are not able to do on business impact AI, which our teams are able to do it. And we announced a large deal in February, which is more than 200 crore deal on AI platform. It's on the ground of this platform, not just a product, but on which multiple products can be built. So that's a very, very positive side for us, which is giving us Intellect 3.0 journey of 3.0 to be exciting.
Mr. Jain.
Sorry, Mr. Jain, just one thing. Purple Fabric, what you said, enterprise AI, you said revenue potential could be 1,000 to 5,000 crores.
That's right, in next 5 years.
This is new revenue, or this is revenue which you would have already earned, but it kind of now...
It's a new revenue. This is a completely new revenue.
Okay.
Okay, so that's the AI opportunity, and that's great to hear, Mr. Jain. But I just want to come back to the opening question that Prashant kind of put out to wrap our heads around this. And I know you can't talk specific numbers on Q4. I'm not asking for that. But in general, if we talk about FY26, then the guidance or the indication that a lot of companies have been giving, including yourself, I mean, you were talking about 15% growth earlier, perhaps improvement in margins. Is all that at risk right now because of what's happening in the US?
What are the indications we have in our planning and design of the business of 3.0 to do a double-digit growth or 15% growth is intact. That's what we want to look at it because of our product nature of business. The EMAC, which is zero-waste architecture, we are giving a significant benefit of choosing Intellect technology with finite thinking and first principle thinking. It's really gelling well in today's circumstances. US, Canada is a good market for us. UK is a good market for us. France is a good market for us. So these are the markets. So our dependence on US alone is not so high. But US, the technology that we built over US in insurance sector is very, very differentiated. Complete AI underwriting workstation is full end-to-end technology, which is gaining momentum in US.
So 15% revenue growth aspiration for FY26, that remains intact, right?
Yeah.
Okay, good to know.
All right. Hi, Mr. Jain. Don't want to push you for a number, but at the end of Q3, you indicated that Q4 will be strong. And the number you indicated was closer to around 700 crores is possible. The last many quarters you have done in the vicinity of around 560 crores to around 620 crores, very, very approximately. So without getting into numbers, that guidance you had given, that stands, right?
Yeah, you are putting in different words, but I am under regulatory compliance, so that's the issue. Otherwise, I would have shared.
Okay, all right. But it will be a far more improved performance in Q4 in comparison to the early quarters, correct?
That's right.
Got it. Great. What about decision making? You had spoken about this, that it's got a little bit elongated. From the time, we talk about the pipeline to closure, I think it was taking close to around 12 months or so. You had indicated about this the last time around. Has that improved? Has it got a little bit worse, or is it as bad as it was earlier?
I will not say good or bad. I will say that process of selecting any technology or any product which is going to make significant business impact, and the cycle time because of signatures, regulatory signature, which can go up to 10 signatures to 14 signatures, that's still intact. That doesn't change. But now we understand that we need to build up more pipeline from bottom up to ensure that we can have a annual predictability. Obviously, we can't have a quarterly predictability. We all told you last time also. But on annually, if we can have it some good quarters and some not so good quarters. So quarter is not the metrics. Last 12 months could be the metrics. So that's what we are trying to look at it. And so we are preparing ourselves to meet that delay in the signature cycles.
So at least the decision-making cycle has not got more elongated, correct?
That's right. It's not more elongated, but it's remained 12 months.
It's as long. Got it. You've given us a rough revenue guidance. For Q3, I think you did close to 20% of margins, and you were indicating maybe sometime in FY26 you could get closer to around the mid-20s. The exit for FY26 should be around 25%?
Yeah, so I think if you look at I will comment on business model. Our business model of product company is basically our cost. Last time also I spoken about the cost around 500 crore a quarter. That is not going to go up substantially because it's not service business. So any growth which is coming up is a profit accretive. So what you are estimating for the investor, they can calculate themselves. If I'm giving sustaining the same thing, that product business is not cost accretive, and our counterpart like FlexCube or Oracle Financials, their margins in last 15 years grown up because of the non-linear cost increase. So that is where the trajectory over the next 4 years of Intellect will be visible to all of us.
Okay. All right. So good luck with all of those plans. And of course, we look forward to connecting with you. We'll do that shortly after the fourth quarter results are out. Thank you for joining us this morning. Okay, before we move on to our next discussion, just a quick glance at the market, and green is the color. Look at this. So all of the negativity which the market has sort of had to digest. Monday's global fall, that has been digested. The market's moved into positive territory. It's looking really good. And the mid-cap index is actually even better than the Nifty. The index there is gaining about 0.3%. So green for the time being. Let's now put the spotlight on the big news of the day. The government is all set to convert Vodafone Idea's outstanding spectrum dues into equity shares worth 36,950 crore rupees. This will mean that the government owns 49% of the company. To talk more about this development, we have with us Sanjay Kapoor, former CEO of Bharti Airtel, and Balaji Subramaniam, Vice President of IIFL Securities. Gentlemen, thank you so much for joining in. Mr. Kapoor, I'll start with you. I guess the second lifeline, right? And a lot of people would say they saw it coming because the AGR relief was struck down by the court. I mean, it was just not going through. Now, the question is, I mean, from a government's perspective, they will really want to see this cash work. The previous installment that came in February 23 was the first infusion or the first conversion. That was about 16,000 crores. The government is already sitting on a loss on that investment. And now there is this one. What are the chances of success now that this overhang, at least the dues overhang, is out of the way for now?
So good morning to you and the viewers. Yes, of course, in the short run, if you see, it's clearly an indication both from the government and VIL that these efforts are towards business continuity and keeping it a going concern. That's what is exactly happening, and that is good for the customers in the market as well. But let me unfold and peel the onion a bit, because there are multiple stakeholders in what has happened. First, let me stick to VIL. VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here, because in March of 26, they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows are not good enough to take care of their capex requirements in the immediate future. So, they're not completely out of the woods. But from a business continuity perspective, a good sign in the short run. Now let's come to Indus Towers. Indus Towers, the second stakeholder in this, which I'm sure was getting discounted because of the uncertainty around Vodafone. And I think with this, probably the discounting might get reduced a wee bit at one end. But if they pump in more capex into their business, then Indus Tower gains definitely, because they'll get better tenancies and they will also get newer towers with that capex. And the last stakeholder is Bharti Airtel and Jio. They are stakeholders to this as well. Contrary to many beliefs, my belief is that a stronger VIL is better for both those companies than a weaker VIL. For a simple reason that a weaker VIL will resort to pricing and discounting, whereas a stronger VIL will not move towards discounting. They will compete more on improving their network and giving a better experience. Though, let's get down to the global scenario. In every single market of the world now, and I'm observing market after market, the third operator and the fourth operator is finding it very tough to survive for a simple reason that the capital cycles have shortened, and it is becoming very difficult for the third operator and fourth operator to be pumping in the same amount of capital as the first and the second operator. So markets are by and large moving towards duopolies in many parts of the world, on a pragmatic basis, on a profitability basis. And therefore, being a distant third operator will always keep that question mark to say, how long? Is this enough? Will there be another downfall? Will there be another uncertainty? So they're not completely out of the woods, but a welcome move.
That's an interesting observation, sir, on global markets as well, that globally the business is moving towards duopolies. But just to go back to that point, that, okay, this is, a reprieve at least. It's a lifeline, but it's just the first step. In terms of additional funding that VI will have to secure, debt funding, I don't know if there'll be equity funding. That's also a question. Would you expect the promoters to also look at further equity infusion? They did one round last year. How much more money does VI need? They're losing subscribers. They have this AGR, due coming up in March, like you're saying. To what extent would they need additional funding, whether it's equity or debt?
Well, for the right reason, this is one industry which guzzles up a lot of capital. And with the capital cycles becoming shorter and the longevity of the technology reducing, capital is never going to go away. We are still pumping in money in 5G as VIL is catching up. The 6G will be around the corner before we realize that we've not even got the returns for 5G. AI is something everybody wants to invest behind, stay relevant to the market. So I guess the amount of money that they require right now, their cash flows are not going to be generating that much money to be pumped and take care of their capex. So they'll need to borrow money. Will the promoters put in money? I have my doubts, because they are, I think, reconciled now to the fact that they are happy to dilute, right? And they've gone below 26% now. And I don't think, as long as they're running the company, if it was to go down a wee bit further, I think they wouldn't mind that. But pumping in more money doesn't seem to be what I anticipate. I think they'll borrow money, and this might give them a little bit of headroom to go to the market and borrow some money.
Do you see them selling out? Is that an option at all? I know it's a completely wild question to even ask, but for the reasons that you mentioned, that you don't see them adding more money and adding more equity. Competition Commission of India concerns aside, that's a separate matter, but could we actually look at only two-horse race with this entity coming into either fold, Airtel or Jio?
Tough one according to me, because world over, the third and the fourth operators, given a choice, would find somebody at the right price and walk away. But that is not happening, because the investors are cautious that the third and the fourth operator, especially when they are distant third and fourth operator, are not easy to revive. On what basis? Because the top two operators are not going to relent at all. They're fully capitalized. They can borrow as much from the market. They can get more equity into the business. So they're not going to relent any space to the laggards anymore. So I think, given that scenario, where will an investor come who will invest in the third and the fourth operator?
Okay, all right. Got that, sir. Well, let's get in Mr. Balaji as well into the conversation. Hi, Balaji. Good morning. Thanks a lot for joining in. From an investor perspective, what do they do? there was that hope, right? Post the rights issue, there's something going to happen. They'll get that 11 rupees. They'll make big gains out there. Their fingers have got burned. What do they do right now? Would you advise investors to hang on? There is a possibility that the Vodafone Idea, shareholders make money, or do you think that it's a sell on rise?
Morning. Thanks for having me on the show. So my view is that with the last weekend's development, the government is firmly behind the telco, and they are signaling that they would like to have a 3+1 market structure. So I think that Vodafone should continue as a going concern. They still have cash flow problems even after this equity conversion by the government, because this only takes care of spectrum dues for the next 2 odd years. They have the AGR dues, still which they have to pay, which is around 16,500 crores, starting from 31st March of 2026. So they do have their cash flow constraints. So my sense is that I wouldn't rule out further equity conversion by the government, maybe 18 to 24 months down the line. So that would mean that even though Vodafone will continue as the third player, from an existing or a new shareholder standpoint, there is still meaningful dilution risk. So as you said, FPO happened, and one of the expectations was that there will be some relief on the AGR burden, but unfortunately the Supreme Court turned it down, and that is one part of the recovery plan that has not really worked out the way which Vodafone Idea and its stakeholders would have wanted to. So that remains an overhang.
So Balaji, you say that it can be good for customers because you'll have the other player that will function, but for a shareholder, maybe not.
Yeah, so I would believe that for a customer, yes. From government receipts also, yes, the firm will continue. Especially for Indus, it's a positive because there is visibility on improved cash flows of Vodafone Idea and business continuity as well. So I think it is positive for Indus. I would probably prefer to play this development by buying Indus rather than Vodafone Idea itself. Of course, the stock, Vodafone Idea stock might, move up as it has moved up today based on these positive developments. But, fundamentally, as Sanjay was saying, the company is still not out of woods.
Your target price on Indus, Balaji? Today it's 357 CMP.
My target price is around 445. So that is, factoring in a successful debt raise completion by Vodafone Idea and, the CapEx program of 55,000 crores over FY25 to FY27 going as planned.
Okay, 55,000 crores of capex and huge debt raise ahead. Can they pull it off? Gentlemen, thank you so much for joining in and weighing in on big developments in the telecom space. Interesting. I don't know, to that point that they made, that maybe Balaji said that maybe there will be another round of this conversion from the government, but there will be a moral hazard to that as well, right? Would the government want this entity to become a PSU? Would it want to be holding on to a telecom company which is loss-making? So I don't know. Political, moral.
Think BSNL, Surabhi.
Which is what I'm saying. So, do you really want to go back to the past?
Well, let's, welcome in Mitesh now, who's with us with what he's making of things. Markets, of course, in focus. And it's, very, very sharp recovery from the lows. We were up about 30 points. We're down 40 now, 50, 23,472. So chopping around. Mitesh, your view on the price action so far is early, but what would you do?
Morning again, Prashant. I think it's very encouraging given the fact that we've immediately bounced back off from the gap down opening. And in fact, for a brief while, we did see the indices in green as well. So my sense is that it's okay. I think, we're basically holding on to the lower end of the range, and therefore in a day or two, a good chance that we will make an attempt towards the upper end of the range. On the stock side, Trent is a buy for me with a stop at 5,500 for targets of around 57.10, 57.20 on the upside. And the other one which I like
that's NMDC, which is a buy with a stop at 68 for targets of 72.
Okay. All right, Mitesh, thank you very much for that. We'll come back to you as the day progresses. Still some volatility on the screen because we turned positive. Now it's again about 50 points lower on the Nifty. Let's put the spotlight on a couple of stocks and news. Upasana, of course, is back with HAL. That stock's been holding up on a slightly weak day of trade because of the big order win. Upasana.
Well, Defence Ministry has signed 2 contracts with the company worth 60-700 crores. This contract is mainly for the supply of 156 light combat helicopters. Prachan, for Indian Army, it's 90 and 66 for Indian Air Force. Now, mind you, this is the single biggest procurement by Ministry of Defence from HAL till date is what the company has highlighted. And it has also reported its FY25 provisional revenue at 30,400 crore with a growth of just about 2% on a YY basis. Now, if we look at the growth of FY24, it was double digit. It saw an uptick of 10% on YY basis. And this year, the growth was lower. It is mainly due to the delay in the delivery timeline and also supply chain issues that were going on at the company. Now, company's order book stands strong at 1.84 lakh crores, and company says that it is gearing up for a robust FY26 with supply chain issues stabilizing, capacity enhancement, and also new order wins. So all in all, this stock remains in focus. And also UBS has given a buy rating on the stock and raised the target price to 5,440. It says that this award win, Prachan, is a positive surprise for the street. And LCA Mark 1/8 Aegis delivery is likely to drive P&L ramp up over the next 3 years, is what the brokerage has highlighted. So all in all, the stock remains in focus and we can see it surging in trade today.
Okay, all right, Upasana, thank you very much for that. That's Hindustan Aeronautics in focus today. Let's also talk about real estate companies, specifically the Maharashtra-based companies. On the state's ready reckoner rates have been hiked. Let's go across to Vinny to understand the math around this. Vinny, tell us, what does it mean?
Hi, good morning. So in terms of this rate increase that we're seeing from Maharashtra government for the state in terms of ready reckoner, on an average basis for the state, it is a 3.9% increase. Now, we're not seeing any rate change coming in the last 2 years. In the urban areas, this increases as much as 5.95%. Mumbai, specifically, we're seeing the ready reckoner rate increase by 3.4%. And obviously, for the Mumbai region, it's the lowest compared to other regions in the state of Maharashtra. Now, what does it mean? Higher ready reckoner rate means that we would see impact coming in terms of stamp duty because everyone will have to pay higher stamp duty. So that increase in terms of prices on that front comes in. And, you know, it is not going to be easy to pass on this to the consumer from a developer's point of view because the rates in Mumbai are already at a premium valuation in some parts of the city. So that is going to be something that we have to watch out from individual developers or individual companies as well. Higher stamp duty is something that we are watching out for now. So that is why a bit of a negative impact that has come in on Borosil Realty, Godrej Properties, Macrotech developers, which are specifically, you know, have a higher portion in terms of their developments in the Mumbai region. Keep an eye out on this one. And obviously this rate change, we'll watch out for more clarity coming in from analysts, but some of them are highlighting that this is a negative given that it's not going to be easy to pass on this increase.
Okay, all right. Thank you very much for that, Vinny. Appreciate it. We've got L&T, more orders coming their way, orders in the range of 2,500 to 5,000 crores for power transmission and distribution business. I mean, it's a bonanza. It has been a bonanza of orders, at least, for a lot of companies, L&T, HAL, and the like, largely in the industrial space. We'll take a quick commercial break here. We focus on commodities. Manisha will be here, and I suspect gold is in some focus. Stay with us.
Because the lows were so drastic, the returns were fabulous, right? So I don't think that we must expect those kind of returns. Having said that, I am not in a camp that the bull market is over and this is the beginning of some bear market. In my view, 15 to 20% kind of return is still in these markets.
पड़े।
Welcome back. Let's put the spotlight on the commodity markets now. We have Manisha joining in. So Manisha, how are your markets gearing up for Liberation Day? April 2 is almost here. Well, I'm dressed in that color and my background is that color and it's unstoppable. That's the kind of rally that we've seen in case of gold. There's such strong safe haven buying coming in. If you look at the previous quarter, well, we've seen dollar index decline by more than 4% and you have seen gold prices gain up quite strongly. And you know, it's not just about US where we are trading at around 31.45 right now, but the gold prices have hit an all-time high in US, in India, in China, in Japan, Australia, Europe, and I could just about continue there because we're looking at very strong buying continuing here in various countries there. Well, the markets have seen very strong buying also when it comes to on a quarterly basis. It is all about concerns over the US reciprocal tariffs on April 2nd. The markets also seem to be believing that this is just the beginning, this is not the end, and you will see other countries retaliate and US again talking. So this is going to go on and gold will take support because of that. So after nearly 28% of gains in the previous year, you have seen gold prices gain up by 18% in the first quarter of 2025. And the way the all-time high that we are trading on today as well, it marks 20 days of all-time highs in 2025 till time. Well, the focus is going to be on tariffs going forward. And it also is about China, where many of the insurance industry is now coming in for gold. Remember, out of the 10 insurance companies, 4 insurance companies already have started allocating money in gold in the previous week itself. And that is the kind of gain that you're seeing because of that. Also, the kind of gold flows that we have seen in COMEX have surged, and these numbers will tell the story because in November 2024, it was at around 17 million ounces, and we're looking at nearly 43.3 million ounces on 31st of March. So that's the kind of run-up that we've seen in sense of US as well. Also, COMEX gold stock now equals nearly 5 years of US consumption. And the markets do believe that if the tariffs do not bother so much, then you will see this gold come back in case of UK and Europe, and the prices could see some profit taking. But at this point in time, the banks and brokerages do not believe that. If you look at Goldman Sachs, and that report really came in the previous week itself, they see 3,300 by the end of this year. But they also say that if the scenario is extreme, then you could be looking at gold prices going all the way to 4,500 also. Similar statement from Citi, 3,200 is base case and 3,500 in cents if the investment goes higher. You have Bank of America talking about higher prices in cents of gold. They're talking at about 3,350 in the next year. And then it is also about Bank of America suggesting that the prices will surge if only investment demand increases by 10% in the next 2 years or so. But ANZ, you have De Beers, Macquarie, UBS, those numbers should come in on your screens. And everybody is talking about further all-time highs. $3,200 to $3,500 an ounce by end of this year is what you can expect in sense of gold.
All right, Manisha, thank you very much. So absolute, ripper, 3.5%, 4% in the last 2 or 3 trading sessions, and continues to make all-time highs. We'll take a quick commercial break here. We come back and we will, as the quarter ends, as the financial year is ended and we enter the next one, we'll take stock as far as what the credit quality trends are looking like with CRISIL, CARE and ICRA. That conversation comes up in just a bit.
Welcome back. So let's talk about India Inc.'s health from a credit profile point of view. Now, according to ICRA, FY25 marked the fourth consecutive year of improving credit profiles. CareEdge says that these upgrades have been driven largely by strong domestic consumption as well as government spending. Meanwhile, CRISIL also remains quite positive on the credit outlook for FY26. So to talk about all of this, we have with us Somashekar Vemuri, Chief Criteria Officer and Senior Director at CRISIL Ratings, Sachin Gupta, Chief Ratings Officer at CareEdge Ratings, and we also have with us K. Ravichandran, Chief Ratings Officer at ICRA. Gentlemen, thank you very much for joining in. Somashekar, if I could start with you first, just tell us, what is expected, this improvement that we've seen in credit profiles all throughout FY25, do you expect it to last in the new financial year as well?
Thanks. Just to look at what has happened in the second half of last year, we had 423 rating upgrades and 160 rating downgrades, resulting in a credit ratio of 2.64 times. The upgrade rate was about 12.2%, downgrade rate was about 4.6%. And in terms of sectoral breakup, largely, you see the infra and infra-linked sectors turned out to be fairly buoyant and hence, contributed a lot of upgrades. On the other side, the export-oriented sectors such as specialty chemicals, agrochemicals, they saw a little bit of pressure. And going into fiscal 26, we continue the credit quality outlook also to be favorable, given that we expect a spur in the consumption demand on account of the announced budget tax breaks, the easing inflation, as well as the expected rate cuts. In addition, the continued thrust from the government side on infra spends will augur well for the infra and infra-linked sectors as well.
Gentlemen, morning. Thank you very much. Sachin, if you want to come in, what is your own kind of perspective? Domestic, yes, things perhaps may look a little better after the last 2-3 quarters of sluggish growth and earnings downgrades, etc. At least that's the hope. But suddenly the global environment is looking, a little dimmer. Over the weekend we had Goldman Sachs, which for the second time within a month has lowered their growth forecast for the US, and that's been the big growth driver. What is your sense, Sachin?
Yeah, thanks for having me. So if we see the last 6 months, there also the downgrades which have happened has been to a large extent for the sectors which are export dependent. Wherein there were pricing pressures because of Chinese dumping in a lot of markets, including India, and therefore the profit margins kind of got impacted. Now, what we fear is that we will see the more of the same in the coming year, especially because of the whole the tariff war which we are expecting to kind of blow up. We are all waiting for 2nd of April, that is tomorrow, to see what kind of tariffs, reciprocal tariffs are levied. But it is safe to assume that it will certainly have impact on certain sectors. Which sectors and how much is something that we will have to see. But the overall environment will be, very, very nervous. The growth also would be tepid. You're right. US is also looking at a, impact on the growth. So we in India, considering that we are largely, domestic and not so much external facing economy, the impact would be less. But nonetheless, there will be sectors and there will be companies which will get impacted on that count.
Okay. So Sachin, do you want to expand on that point? Which sectors or segments do you think are at maximum risk for any possible deterioration on account of the global headwinds?
Yeah, so, if we were to just isolate the risk on account of the tariffs, now, well, we don't know what nature and form they will come in. But some of the sectors where India has a high share of exports, if you see the top 4 would be your textiles, your pharma, your gems and jewelry, and, these would be the big ones. And electronics as well. Now, in the recent past, we've increased the share there. Now, there we believe more benign would be something like pharma, because that is non-discretionary and wherein India has, a right to win because of the cost competitiveness. So there, if there are tariffs, most likely they will be passed on to the consumers in the US markets, and therefore there is not likely to be any impact on the demand per se. Whereas if I look at the complete opposite, will be say something like gems and jewelry, which is basically your cut and polished diamonds. There the impact could be slightly more, because if the tariffs are levied and if those are passed on to the consumers in US, as such, the demand has been a little weak. And in addition to that, if there is an increase in the cost of buying, diamonds in US, that could also impact the demand. Similarly, on electronics, we believe while India has been increasing the share, but we may or may not really have a cost advantage as such, as compared to other some Southeast Asian nations or China. So, it will be a play of discretionary spend versus India's cost advantage that will really decide. So we are also very, keenly watching how it really pans out.
Yeah, absolutely. A very, very uncertain environment. Let's also get to Mr. Ravichandran for his view. He's from ICRA. So what about you? So let's talk about the FY26 outlook. Which sector do you think could show the maximum improvement in credit profiles? I'm sure there will be a domestic-facing sector or segment. And like we were just asking Sachin, which external-facing sector is at maximum risk because of these global tariff issues that we're talking about?
Yeah, so with regard to the outlook for FY26, I would think consumption should come back, especially with this recent tax cut, that will come into being from the current financial year. And more importantly, we're expecting interest rate reductions in the current year, at least 50 to 75 basis points with the fall in the inflation. That should lead to lower mortgage rates, and that should lead to further pickup in consumption. And parallelly, RBI has done a lot of work with regard to easing the burden on the NBFCs, especially liquidity, and reducing the risk rates on some of the unsecured loans and so on and so forth. All that should lead to lower cost of funding for the NBFCs, and overall availability of credit also should be going up. I would think one of the reasons for the slowdown in consumption has been the curbs on this lending. So with the better availability of credit, consumption should stage a comeback, the way I see it. Second lever would be, the continuing capex momentum from the government side as well as the private sector side. While private sector capex was subdued the last financial year, I would think that should come back in clean energy sectors, especially data centers and electric vehicles and renewable energy and so on and so forth. So overall, capex should also see good momentum. That should lead to better credit growth, and a better outlook for those sectors. Otherwise, with regard to the the sectors where one should be concerned, chemicals is one space where we are continuing to be cautious. While margin trajectory is improving, but still there are pricing pressures. To the extent one has to be watchful. In addition to that, we are quite concerned on the the power distribution per se. Overall, while there has been improvement in pricing discipline, payment track record has improved for the IPPs and other developers, but still we are concerned about the the cash losses being suffered by this discount. So that is another area we are watchful. Otherwise, a lot of investments are happening in the hope that eventually payment discipline will continue. That's the key thing to look at.
No, absolutely. And, these are important factors which we will have to look out for. Mr. Ravichandran, Sachin, Mr. Vemuri, thanks all of you for joining us. A shorter conversation today, but I hope you will join us again once we have more clarity on what comes our way in terms of tariffs, which I think is going to be the big talking point, one way or the other. By the way, the market has taken a dive and we are at fresh lows for the day. 23,325. The earlier gap down was 23,340, and now we've completely reversed, and how in a very, very dramatic kind of way. Market breadth is still positive. It was 4:1 in favor of advances. It is still very healthy, but about 2.5:1 in terms of advances to decline ratio, although that is also coming off a little bit. We will take a quick commercial break here. It's a wrap on Bazaar as well. Chartbusters is coming up, and that'll take up all the action in just a bit.
Our government has chosen to face global challenges the Australian way, helping people under cost of living pressure while building for the future. Because of the strength and resilience that our people have shown, Australia is turning the corner. Now, on the 3rd of May, you choose the way forward.
Vodafone Idea is locked in 10% upper circuit after the government of India converts its spectrum dues worth around 37,000 crore rupees to equity, raising its stake to 49%. Shares will be issued to the government at 10 rupees apiece, which is a significant premium in comparison to the last close price.
Shares of Eicher Motors rally as Royal Enfield's sales in March significantly beat estimates at over 1 lakh units versus expectations of about 90,000 units.
Shares of HAL surged close to around 3% after the Ministry of Defence issues orders worth around 62,000 crore rupees for attacked helicopters. Brokerages, CLSA, JP Morgan and UBS, they're all bullish on the stock.
Shares of ITC and AB Real Estate trade with gains as ITC buys Century Pulp and Paper business for about 3,400 crore rupees, increasing its paper capacity by 60%.
GMR Airports rallies 2% as the aeronautical tariff at the Delhi High Port is hiked by nearly around 150%. Brokerage Jefferies predicts that FY26 EBITDA growth of close to around 40%. They expect the company to hit profitability after many years as well. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and just a few minutes or so ago, the Nifty was trading more or less flattish. But if you look at the top of the screen, all the frontline indices, they have taken a bit of a nosedive. The Nifty is at the low point of the day. The Nifty Bank as well has seen some selling pressure. Though the one positive is the breadth of the market still has more number of stocks that are advancing than declining. So not so bad in that sense.
Not so bad in that sense. It will be very interesting to see where we go from here, largely because, the VIX has also spiked as we speak. If you look at the intraday chart of the Nifty, it's taken a sharp nose down, whereas the VIX, the India VIX comes up for you. It's been a sharp spike up around 7.5%, 8%. So we'll keep an eye out on how this pans out. Obviously, there have been worries around the globe, etc. How much of that would impact our markets in the medium to near term will be something that we'll be most definitely tracking. But in the very near term, of course, it'll be the Q4 updates that will come by from across the board that will impact the market as well. But the RBI has raised loan limits for NBFCs disbursing loans for housing needs. Brokerage DAM Capital also has a bullish view on Aadhar Housing Finance in the back of its peer-leading granularity and sourcing channels. Who's the MD and CEO, Rishi Anand of Aadhar Finance, now joins us to discuss this itself. Thanks a lot, Mr. Anand, for joining in, and happy new financial year to you. RBI increasing loan limits for housing. How do you view this? What does it spell for you? What's your average loan ticket size? And how does this increased limit change for your average, in terms of business prospects?
Great. Very good morning, Mangalam and Nigel, and happy new financial year to you guys too. So one clarification, RBI has not revised limits. RBI has revised limits of priority sector lending. Erstwhile, if you recall, the breakdown was between metro and non-metro, metro being up to 35 lakhs, non-metro being up to 25 lakhs. Interestingly, this time around, they have linked it to the population size. So cities with population greater than 50 lakhs, the revised priority sector limit now stands at 50 lakhs. 10 to 50 lakh population moves to 45 lakh priority sector limit, and population size below 10 lakh becomes 35 lakh. So it's an interesting move. I think it's a long pending request that the industry has been posing to the finance ministry and to RBI, and finally we've got it. So it is going to be interesting as we move ahead. The impact of it will come over a period of time, because now, for example, in the previous Avatar, loans in Bombay, Delhi kind of locations up to 35 lakhs were allowed under priority sector, and we had those limitations on as a housing finance company. Now I can go up to a 50 lakh loan and it will qualify under priority sector limits. So it's an interesting move, while the impact will happen over a couple of quarters.
All right. Hi, Rishi. Good morning and good to see you, Ben. Well, I'm looking at a DAM capital note, and they are quite positive on your prospects and the prospects of your company. So that's good on you. Let's get a few more details out of you. Currently your AUM, I think, is around 24,000 crores. What kind of a growth trajectory, say if you give an average for the next few years, what should be the rough number we should be looking at? And also, if you could tell us in terms of your mix, your average ticket size currently is around 10 lakh approximately. And also, if I look at the mix, housing accounts for around 75%. How do you see the mix changing going ahead? Ticket size as well as mix, and what is the AUM growth we should work with?
Great. So good morning, Nigel. Yes, you're referring to the DAM report. Let me give you some further insights. In terms of growth, given our book size, we are 24,000 crores as last reported numbers. We've always indicated that in the short term, when I say short term, it is 0 to 3 years, we will grow at the rate of about 21-22% on AUM, and we maintain that stand even as we speak today. 3 years hence, when our book size becomes larger in size, I think the right number to look at will be 18 to 20% on larger book. So that is the kind of growth trajectory we are speaking about. You spoke about 75-25 being our home loan and non-home loan. What the regulator allows you is a principal business criteria of 60% on the balance sheet. If I translate that into pure, home loan, non-home loan, it stands at about 65-35. But we don't want to be closer to the breach point. Hence, this 75-25 in the short to medium term will be maintained. Now, let us say I incrementally source more non-housing loans, then we have a mechanism of doing direct assignment under the priority sector limits to the larger banks and larger housing finance companies. So at the loan book level, Nigel, I will maintain 75-25 even as we move ahead.
What does that mean for your spreads? Right. So what does that mean for your spreads, NIMs, as well as yields? Because the mix remains the same. There is expectation of a rate cut by the RBI. How does all of this impact your spreads and yields?
Okay, so before I move to spreads and yield, Nigel had a question on my ticket size. My current ticket size on the AUM stands at 10 lakhs, Mangalam, and as we move ahead, my incremental ticket size today on the disbursement that I would be doing quarter on quarter is 12.5 lakh, and I don't see any reason why there should be a substantial jump in ticket size. Whatever inflation-related jump and cost of construction increase jump would happen, which will be linked to inflation. So that is the kind of increase in ticket size that we see. We don't foresee change in segments or moving to higher, greater ticket size. Now coming to spreads in the rising as well as in the falling rate scenario, the good part at Aadhar Housing Finance, Mangalam, is that almost 70% of my asset side and almost 69-70% of my liability side. So, sorry, if I can change the number, it is 80%, 79-80% on the asset and the liability side is floating in nature, which effectively means that whatever comes in, which eventually passed on to my consumer on both northward as well as southward. So will my spreads and NIMs get impacted? No, they will not be impacted at all.
So what band should one work with over the next near to medium term? Because you do give us growth trajectories for 0 to 3 years and thereafter. And now as we speak, what is the rough spread band that we should be working with?
I think today at the book level, we are at 5.8% spread, and I don't see any reason why it should fall. But at a stable state comfort level, anywhere between 5.6 to 5.75 is the spread that we would be wanting to maintain.
And NIMs, that would mean NIMs would hover around 9%?
Yeah, hover around 9%. That's right, Nigel.
Okay, all right. Since you as well have had a brief look at the DAM capital note, they are talking about your ROE staying in the vicinity of around 16 to 17% for the next 2 years. That's till FY27. And then they're saying it's a possibility it goes to around 19%, 18% or thereabouts. You agree?
Completely agree. I think if you look at pre-raise, pre-IPO, we were already touched 18.5% ROE. With the capital coming in, obviously the impact of capital, we are at about 16% now. And 2 years down the line, we should be back to 17.5%, 18%.
What about your capital consumption? Would you, at the current growth rate that you're at, require to raise any capital from the market?
I don't foresee any capital raise as we go ahead, at least 3 to 4 years, Mangalam. But maybe 3 years down the line, we will have to take that call. For now, the kind of capital adequacy ratio we are sitting on, I don't think 3 years we would need any capital at all.
And a comment on asset quality, because credit costs are, about 25 to 27 basis points, nothing really to worry out there. Do you foresee any stress, or do you believe that this will maintain?
If I were to look at the last quarter reported number, 1.4%, and every year March is the critical quarter for the financial services, for the housing finance industry. As I have already indicated a couple of times on your channel, 1.1% kind of GNPA numbers is comfortable, which will translate to about 25 bips of credit cost. I don't see any reason why there should be an increase in asset or deterioration in the asset quality at all.
Okay, all right. Thanks a lot, Rishi, for joining in. You're sounding reasonably optimistic about business. AUM growth in the ballpark of around 20%. Spreads at around 5.6 to 5.8%. NIMs at around 9%. And you don't require to raise any more capital for the next couple of years. You're adequately funded, with the ROE scaling back to around 17.5 to 18%. Thanks a lot for joining in. We look forward to having a chat with you at the end of your Q4 numbers as well.
Yeah. Good day to you.
Good day to you as well. Well, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu of moneycontrol.com joins us to talk about a stock that he's tracking closely. Anubhav, over to you.
Thanks for the opportunity. So today I wanted to talk about Syngene, which is the leading CRDMO player. It has recently announced the acquisition of its first biologics site in US, which is equipped with multiple monoclonal antibody manufacturing lines. Now, this is the company's first investment for a facility in the US. This, in a way, tweaks the business model and brings in proximity to key innovation hub. So globally, more than 50% of R&D spending is done in 9 select pharma hubs, and hence it is rewarding to have a presence in one of this location. Global CRDMO players like Wuxi and Pharma have immensely gained from such kind of setup, wherein there is proximity to the innovation hubs in the US and Europe, supported by a delivery setup in China. Now, that said, this site would also support the growing animal health segment for Syngene, in which a US site is often a key client requirement. In addition to that, a facility acquired from Stelis Biopharma would be ready next month, and this would triple the biologics manufacturing capacity of Syngene. So capacity headroom and improved biotech funding should help the company to execute China switch strategy. Lastly, in our opinion, valuations are fair given the growth runway ahead.
All right, with that, we'll take a short break. On the other side, we have the management of AGI Greenpack joining in after they've announced a 700 crore rupee container glass capacity expansion in Madhya Pradesh. Sandeep Sikka, who's the group CFO, will join in after this short break.
Quarter of a century, zillions of designers, and orders of style later, Lakme Fashion Week is back to rock the ramp. This year's collection promises to showcase modern sophistication with effortless elegance. The showcase is set to be bold, reflecting a connect between beauty and style. Let's take a look at the showcase straight from the runway.
How do you think beauty and fashion empower young women like you in today's world?
So I think beauty and fashion, if you have fun with it, can be very, very empowering. Like me, I like dressing very casually. I like being very chilled out. I don't play too much with like colors and stuff. And that makes me feel very empowered and very beautiful. So I think it can be used as a tool to enhance your strengths rather than cover up your weaknesses.
Who are you working for, and tell us about your inspiration?
Still sitting with about a 200-point cut on the frontline index. The mid-caps actually have recovered a little bit from the lows from the time when we started the show itself. One stock on our radar is AGI Greenpack. Has seen a strong run in March, but after having, fallen about 33% in this year so far, despite the rally that we've seen in March, the stock is doing well today because the company's announced a 700 crore rupee capex plan for their container glass plant in Madhya Pradesh. Sandeep Sikka, who's the group CFO of the company, joins in now to discuss the company's prospects going ahead. Sandeep, a two-part question. I remember earlier you had said that, if HNG was acquired, then you would have to invest 700 crores in that, and that would lead to about 3,000 crores sort of revenue potential. But now we need to know what the update on that is. Is that done for good, or are we still awaiting some, announcement on HNG acquisition? And secondly, whether or not that happens, what's the asset turnover on this 700 crore investment that you're making in Madhya Pradesh?
So we got Honorable Supreme Court order in January 2025, and that verdict came 2:1 against us. We have filed a review petition with the Honorable Supreme Court, which is still pending. But we are not sure how much more time this whole litigation relating to the acquisition, despite being the highest bidder, will take. In the interim, since company has been waiting for almost 3 years to do this acquisition, so the board has decided that now we should look forward to, other organic and inorganic acquisition opportunities as they may come through. And this is the first step towards that we are implementing a 700 crore capital expenditure plan in state of Madhya Pradesh to have a state-of-art, container glass facility. With this investment of 700 crores, we feel that this should lead us to at least one-time sales turnover to start with. But as we move forward, the opportunities to expand at that site also, is not ruled out.
All right. And what about the mode of funding, Mr. Sikka? Good to have you on the show as always. You're saying that that acquisition is taking too long. Might as well go the organic route for the time being and see what happens with regard to the courts. So 700 crores of revenues. But how do you fund this 700 crores?
So generally, we do with the long-term financing. So we'll be looking at around 60-70% debt. Our current debt is at a level of around 330 crores, which should get paid off in next 12 to 18 months. So this will be a new debt by the time the project comes in. The EBITDA would have grown, and the market opportunities would have grown, and the existing debt would have paid off to almost large extent. So we'll fund it right now with the debt equity of somewhere around 60 to 70, and balance will come from the internal accruals.
Will this plant do the same EBITDA as you're doing currently, between 24-25%, or do you think you can extract better EBITDA from here?
We feel that to start with, because furnace has a cycle, to start with the first 2 years, EBITDA should be somewhere around 20%. But once it is stabilized, it has capability to do even better EBITDA than what we are doing in the existing furnaces.
And, what would your cost of funds for this be? Because we recently also, saw some rating upgrades coming in from CARE. Your long-term rating has been upgraded. Your short-term rating has been reaffirmed. So what is your cost of fund? And the 60 to 70% that you will raise of the 700 crores, at what cost would that be?
It should be somewhere around 8 to 8.5%, and looking at a debt which is around 6 to 7 years debt. With an average maturity, we are confident. I think banks should lend us somewhere around 8 to 8.5%.
Just since you said that the initial capex would get one-time asset turn, but I think you hinted that maybe if you do brownfield capex over here, then the asset turn could be better. Would that be correct?
Since this is a greenfield project, so a lot of money goes into land acquisition, land development, and creating auxiliaries, or the plant paraphernalia. So when we do a brownfield incremental capex, the ROIs on that are much better than the the initial greenfield part. But this is a first step towards expanding our geolocation. Right now, we are more focused in the state of Telangana, and this is our first step towards expanding to the other states in the country.
Okay, what do you end this year with? 9 months, you have done close to around 3% of revenue growth, as well as I think margins have been in the vicinity of around 26%. What do you end this year with? And on that sort of a base,
I think
what
we
can you
should
guide
close
for
this year somewhere
FY26?
around 4 to 5%.
Yeah, go ahead, sir.
We feel that we should close at somewhere around 4 to 5% growth as compared to last year. Although the profitability has been higher, and next year onwards, based on internal, capacity debottlenecking, which we have done, we feel 8 to 10% growth is feasible for the next financial year. And this new capex will overall give 25% growth. So there are other plans which we are evaluating, but not yet approved by the board. I think once approved by the board, we'll definitely come back and explain them also.
You briefly hinted at inorganic plans as well. Now that organic plans are something that you're going ahead with. And you had that long-term target which you had spoken about last year. So maybe 3-4 years from now, you had that $1 billion revenue target. Is that still on track, whether or not HNG happens?
So I'll be candid here that we missed around 12 to 18 months as a part of the plan because of pretty long litigation which happened relating to the acquisition under the IBC process. But right now, management is looking the mix of both organic and inorganic. But definitely there are a number of things to be sorted out, especially on the inorganic side. But we are successful. We feel that in next 24 months, we should be able to expand our capacity by around 50 to 60% from the base of what we have in FY25.
That includes this 700 crore or over and above that?
This excludes 700 crores. Like 700, this new capex will come in 2 years from now. But I'm giving guidance that in 2 years, we should be able to build additional capacities up to 50%. Right now, we are at 2,000 tons per day. So incremental 1,000 tons per day, we should be able to add.
That's organically.
In a span of 18 to 24 months.
That's organically.
Organic and mix of both.
Okay, we will await any of those details coming in. Thank you so much, Mr. Rika, for joining in and giving us all those details. The street likes what you've said. Stocks moved to the high point of trade after seeing a drubbing on account of the uncertainty. Candid conversation coming in from the management. They've lost 12 to 18 months of sales on account of the uncertainty around HNG. Still to await any clarity coming in from the review petition that they filed. But in the meanwhile, the company has gone ahead with organic expansion plans as well. With that, let's move on. Let's talk about a big programming note. The future belongs to Bharat and the Rising Bharat Summit 2025, where visionaries show us how to lead it. Get inspired by Arvind Srinivasu, the co-founder and CEO of Perplexity, the AI disruptor, redefining how the world searches for knowledge. Gain transformative insights from Vivek Wadhwa, who is the CEO of Bionics Biosciences, acclaimed academic, entrepreneur and author, on how India can lead the next wave of breakthroughs in artificial intelligence, science and innovation. You can join us at Bharat Mandapam, New Delhi on the April 8th and 9th for a powerful exchange of ideas shaping the nation's next leap. Book your passes now.
So I am walking for AKOK, I'm walking for Anamika Khanna, and I'm wearing her silver collar collection. And I think the inspiration around it is just warrior princess, something to make women feel very powerful, very strong, very modern, very cool. That's her inspiration, I'm assuming. I'm just channeling that.
The opening night showcased designer Anamika Khanna's designs that celebrated bold, ambitious women who own their space, lead with confidence and inspire with their individuality.
It's been 25 years of Lakme Fashion Week. What is in store and what can we expect?
As you can imagine, it's the most emotional, sentimental moment for us. 25 years of all of us together. It's going to be a spectacular celebration and I'm so looking forward to it.
Can you tell us on what the collection is all about?
This collection, it's called the Silver Collar, and as the name suggests, it's about elevating workwear for women and the very fact that we don't really follow rules anymore. Everybody is bringing that power to the workspace, but they also bring that emotion, the gentleness and all of that. So it's just about elevating workwear to another level.
One message that you would like to see.
Welcome back. Well, the markets continue to remain under some pressure. We're down close to around 200 points, but I don't think it's yet a cause of worry. The Nifty is down, but otherwise various segments of the market are actually doing quite well. The Nifty Bank, well, that needs to hold on to that 51,000 odd mark. That's where the crucial technical support level is. So you want that to hold on. Trent is the one that's bursting away. That's up close to around 5.5%. But otherwise, pockets of the market have come in for profit taking. Bajaj Finserv, Bajaj Finance, both of them at the low point of the day. And Axis Bank as well has slipped a little bit more.
Absolutely, Nigel. Just keeping an eye out on Info Edge, though, before, slipping into that short break here. Info Edge has suddenly taken a knock. It's down about 4% as we speak right now. It'll be very interesting to see where this goes from here on. Remember, some of their investments in Zomato as well would have to be marked down because of the price correction that we've seen in Zomato. So how much of that is on account of the decline that we've seen here? And the other one I'm looking at is a big up move that we've seen on Atul Auto. Typically, we see moves in auto companies, these stray auto companies ahead of the monthly sales data that has come by as well. So 11% up move on Atul Auto is something that I'll most definitely keep an eye out on. But with that, we are out of time on this edition of Chartbusters. It's a wrap. Stay tuned. Trading Hour comes up next.
On these young, empowered women wearing your collection?
I feel like if my collection can give you a sense of freedom, I've done my job. And that's what I want to do. I want to make people feel free.
From legacy designers to fresh voices, Lakme Fashion Week continues to redefine not just trends, but the business of fashion. In Mumbai, Zenia Baria.
Did you know Tirupati's Lord Venkateshwara temple is all set to earn an annual revenue of 1,729 crore rupees for FY26? And we're talking just revenue from collection boxes alone. This means that one of India's holiest and most culturally significant temple sites will see its annual revenue from collection boxes far exceed the total net worth of A-grade celebrities and cricketing icons much like Sachin Tendulkar, Virat Kohli, MS Dhoni and Amitabh Bachchan, even as the temple is all set for a bumper FY26. In its recently released budgetary estimates for FY26, the Tirupati Devasthanams, that's the management committee entrusted with running the Tirupati shrine, has laid out a budgetary outlay of 5,259 crore rupees, which is a testament to the cultural, historic, religious and even the financial significance of the Venkateshwara temple. Now, the TTD, which is of course the abbreviation for the Tirupati Devasthanams, has been in the news late for matters pertaining to the running of one of India's holiest shrines. In a recent announcement, the TTD said it would sack all non-Hindu employees of the temple itself, thereby ensuring that only individuals who practice the Hindu faith will be involved with the conducting of sacred rituals within the temple itself. The budget session also saw the TTD make an announcement for the formation of a special committee to oversee the protection of all TTD-owned lands across the country. However, the 1,729 crore rupees by way of collection box revenue isn't the only revenue source for the managing committee, which of course is independently run, remember. The total of 600 crore rupees by way of income from the sale of prasadam also makes for a significant revenue source, even as nearly double of that, that's 1,310 crore rupees, comes by way of interest.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and markets have weakened considerably. We had briefly turned into the green, but from the day's high, the Nifty is down more than 300 points. The benchmark indices have lost about 1.5% down on the Sensex, and the Nifty right now is below the 23,250 mark, inching towards a near 300-point cut, while the Sensex has stumbled more than 1,000 points. The sell-off has come in only in the last 45 minutes or so. The mid-cap, small-cap indices also in the red, down 0.5%, though the advanced decline ratio, so far at least, is holding up in the green. So that stands at close to about 2 stocks advancing for 1 in the red. The problem pockets, the pain pockets are realty. The Nifty Realty Index is down 2.5%, while financials and IT, which constitute a bulk, maybe 50% of the Nifty weightage, both of them are down about 1.5%. Hi.
Good morning, Reema. Absolutely right. So especially, post 10 a.m., in fact, if you look at the Nifty post 10 a.m., we were in the green till 10 a.m. The last 1 hour, we've seen a significant sell-off. Like you mentioned, banks and IT. In fact, banks have seen the majority of the selling pressure come through. Some worries about whether banks can maintain NIMs at elevated levels. So look at names like Axis Bank, ICICI Bank, HDFC Bank. All of these stocks are seeing quite a bit of selling pressure in today's trading session. But the stock that's standing out is actually one from the banking pack, and that is IndusInd Bank. It's the top Nifty gainer today. Remember, the PwC report as far as IndusInd Bank's derivative issues are still awaited. But despite that, that stock is up over 5% to start of the month of April. The other stock in focus is HAL. Whole of last week, that particular stock was doing very well on the back of order inflow cheers. Another very large order inflow. That stock was up over 2.5%. Tariff hike for the Delhi airport, something that had been a bit of an overhang for GMR airports has come through. The stock has cooled off from the day's high, but that stock is doing quite well. And Voltas, this particular stock, there doesn't appear to be any news flow as far as Voltas is concerned. But despite that, that particular stock, one of the top laggards as far as the F&O space is concerned, now down almost 6%. So Voltas, despite all of the positive news flow for the company in terms of brokerages pushing, sell-side analysts talking about the heat wave leading to higher AC sales, Voltas today is down 6%. It'll be interesting to see whether there is any news flow around that particular name, Reema.
Okay, that's the news on individual stocks right now. We've got so many big movers. On top of the list is, of course, Vodafone Idea, and that's the big news of the day because the government will convert Vodafone Idea's outstanding spectrum auction dues into equity, and this is worth close to about 36,950 crore rupees. Stocks are higher in trade. We've got about a 10% gain coming through on Vodafone Idea, while Indus Towers too is holding up in the green with a gain of close to about 6.5% right now. The government stake in Vodafone Idea will increase to 49% from 22.6%, and they're planning to issue shares at a price of 10 rupees per share, which is at a 47% premium to where the stock closed on Friday. Now, the news is positive for Vodafone Idea because, one, it raises the prospects of the bank funding. The company was looking to raise debt funding of 25,000 crore rupees, but that was getting delayed. So that money will hopefully come through, which will help the company with its capex, its rollout, and that will help in stemming the subscriber losses that the company has seen. And secondly, the conversion will also help reducing Vodafone Idea's annual payments to the government for spectrum. Those numbers from IFL will come up for you on your screen. In FY26, Vodafone Idea would have earlier owed the government 29,000 crore of annual payments. That comes down to 18,500. FY27 and FY28, earlier the payments were about 43,000 crore rupees, and that comes down by about 20 and 10,000 crore respectively. So, it should help in terms of the cash flow, meeting these regulatory payments. The move is also seen positive for Indus Towers, as you can see on your screen, because it's a stronger Vodafone Idea, and the government is now committed to a 3+1 player. Now, let's quickly run through what the brokerages are saying now. IFL saying the government stake conversion postpones Vodafone Idea's problem. According to them, the company will not be able to meet all its regulatory payments, and therefore they see the possibility of the government converting more dues into equity 18 to 24 months down the line, and that will cap the upside for new and existing shareholders. And if the government were to hypothetically convert all their dues into equity, the government stake would stand at 81%. Motilal Oswal also concurs, because they are saying this conversion, it's a lifeline for Vodafone Idea, but it's pushing the can down the road. The issues for the company are stabilizing its subscriber base, long pending debt raise, and further relief on AGR dues. They've got a sell call on Vodafone Idea, target price at 6.5. Ambit, on the other hand, is keeping the hope alive. They're saying the government has not touched the AGR dues, and therefore there is scope for the government to provide relief on AGR dues. But again, it's a very high risk kind of a trade, but they've got a buy call on Vodafone Idea, and Citi has opened a 90-day catalyst watch list on both Vodafone Idea and Indus. Indus is their top pick. Vodafone Idea, again, high risk. Stock target price at 12, but their premise on watching Vodafone Idea is 5G rollout. They've already kickstarted it in Mumbai, and then progress on the bank debt fundraise. So that's some of the brokerage views, but let's get in Axis's view also. We have Gaurav Malhotra, Executive Director of Axis Capital, on the show now. Gaurav, first, give us your initial take on this story.
Yeah, hi. Good morning, everyone. See, the way to think about is that, the moratorium was coming to an end in September 25. At which time the payments of spectrum would need to be kickstarted. So this has come at a fairly opportune time. And the way we think about it is that, at least for the next 2 years, which is FY26 and FY27, the cash flows would sort of match, right? And I say cash flows, I mean the cash EBITDA versus the amount of payment needed to be paid for AGR dues and the spectrum dues. There will be a little bit shortfall in maybe FY26, but sort of manageable. But come say FY28, again, the cash flow mismatch sort of again moves up. So we'll have to see how that thing goes. But at least for 2 years, the situation is fine. And obviously with this equity conversion, the probability of the long overdue debt raise also improves. And that obviously will help the company, fixing its network, which should help in stemming the subscriber loss, in helping it the 5G rollout, etc. So those are positives, but we'll have to see the benefit of that, going forward.
Right. Gaurav, so, you've highlighted two very important points, after analyzing this particular development. Number one, long overdue debt raise. Do you think all the decks are now cleared for banks to get the comfort to lend to Vodafone? And number two, you've spoken about arresting subscriber decline. How do you think, debt raise can help achieve that?
Yeah, see, the thing is, this issue, the way to think about it is that, it's not as if all the issues have been resolved. It's just that the next 2 years, at least the next 2 years, cash flow issue has been sort of fixed for now. And I think so the banks were trying to get some clarity on, what happens to the AGR dues, what happens to the spectrum dues. So at least part of that has been addressed. So that should increase the probability of the debt raise. Now, the company obviously has been fairly aggressive in its capex plans, post the equity raise. They've already launched 5G in Bombay. They're going to launch it in a few other circles in the coming couple of quarters. So fixing of your 4G network, rolling out 5G, things which should have happened, say, over the past few years, but were not able to do it because of cash flow mismatch. That sort of is restarting, and that should help the company in stemming the subscriber loss.
But you're saying the cash flow will be matched. The company will be able to repay its dues for FY26, FY27. What happens FY28 onwards? Is there a risk of more government conversion into equity?
That is a likely scenario, right? Because the AGR of around 78,000 crores has not been touched, right? So every year you are paying around 17,000 crores over the next 6 years, right? There is also residual deferred spectrum liability, which still needs to be repaid. So FY28 onwards, some more will have to happen. Yes.
Will that not keep investors and new shareholders at bay? Because this dilution risk will stay. Anyway, the FPO price was so much higher than the current market price. So some investors, retail shareholders have already burnt their fingers.
See, the thing is, as per the norms, the conversion cannot happen less than the face value, and the face value is 10 rupees. So irrespective of where the share price is, the minimum the conversion price had to be was 10 rupees. And like you rightly said, we have a reduce on this name.
Understood that. Gaurav, going forward, have you gone ahead and baked in any price hikes across the sector for Vodafone? And any kind of sensitivity analysis that you have in terms of the spectrum payments due and how a price hike can benefit?
Yeah, so see, for us, for all the stocks in our coverage, we have assumed a fairly decent output take on the back of tariff hike, subscriber premiumization. So when I talk about the cash flow matching for FY26-27, it assumes an ARPU uptake on the back of these two. And for example, for Idea, we are assuming like a 15% growth in top line for FY26 and a 20% growth in FY27. So yes, those numbers are being built into our estimates for Vodafone and also for Bharti and Jio.
Okay. And a view as far as Indus Towers is concerned, clearly a beneficiary, but can you quantify how it benefits? Is it higher dividend payouts or higher requirement for tenancies, given the fact that there could be some capex coming in from Vodafone?
Yeah, see, obviously for Indus, it gives visibility. Whatever gives visibility to Vodafone to expand its network obviously helps Indus. But at least in our numbers, we have given Indus the benefit of what guidance Vodafone has given in terms of its network expansion over the next 2-3 years, which is premised on equity plus debt fundraise of roughly around 45,000-50,000 crores. So at least from a sentiment, it is positive. Now, in terms of the reinstatement of dividend, it obviously does increase the possibility. But we do feel that maybe the actual debt raise will have to happen before we see an actual reinstatement of dividend happening at Indus.
Gaurav, you've got a reduced call on the stock. Can you give us the financial position of Vodafone Idea in terms of numbers now? Just give us the key numbers in terms of the regulatory payments going ahead. How much has it come down by, and therefore the shortfall, according to you, by your estimates? Are you assuming a tariff hike? Just give us the key numbers to track.
Yeah. So the way to think about it is that there is an AGR dues of roughly 17,000 crores every year. There is on top of that, there is a spectrum dues over the coming years. The way the spectrum dues will move is for FY26 is going to be roughly around 13,000 crores, which will move up to 26,000 crores from FY27 onwards. So the total will be 30,000 crores in FY26 and around 42,000 crores in FY27, 28 and 29, right? Against this, we have a relief of around 37,000 crores. So and that will be sort of, most of it will come through in FY26 and 27, right? So versus 30,000 crores, the actual payment will be 90,000 crores now for FY26 versus a 42,000 crores. Again, it will be roughly 19,000 crores of payments, right? So FY26, 27 is where most of the benefit comes. Come FY28, the payments again versus 42,000, you will have to pay around 40,000 crores. So that is where I was saying that, look, at least for 2 years you are sort of sorted, but from FY28 you need to see what happens from a cash flow mismatch perspective.
Gaurav, lastly, very quickly, your pecking order in terms of which are the telecom stocks you like, Airtel, Jio, Idea, and any view as far as Indus Towers 2 is concerned?
Yeah, so for us, we have buys on Bharti, Airtel, and Reliance. Obviously, Jio is not a standalone stock, but we like Reliance from Jio perspective. We have an add on Indus, and we have a reduce on Vodafone.
Gaurav, thank you very much for joining us on this important day and sharing your perspective. We'll get into a break. On the other side, we'll discuss commodities. Manisha Gupta joins in on the other side.
₹18,000 crore of Tirumala Tirupati Devasthanam cash that lies in fixed deposits in several banks across the country. Insofar as cost heads are concerned, the major one totals to around 1,773 crore rupees by way of quote-unquote HR payments, which translate to salaries that will be disbursed to all employees of TTD, even as a total of 769 crore rupees has been earmarked as a cost head towards expenses pertaining to material costs that will be used for reconstruction or renovation purposes across the temple itself. But for the moment, that figure of 1,729 crore rupees by way of collection box revenue is making heads turn, even as it underlines the Tirupati shrine's significance as India's holiest, most culturally significant and richest temple site.
One is timelines, but what about costs? I mean, how much does it cost to put out a drug in the market today?
A little over $4 billion per drug.
$4 billion per drug.
Just before you make one sale. Yeah. So it's hugely expensive and complicated and slow. So on average, the industry takes about 14, 15 years. We're about half of that, but we spend about the same as others. And that is a function of both, I think, two big trends. One is hard to change, which is that science builds on itself. Mm-hmm. And so each new drug has to demonstrate benefit over everything that came before it. So we actually have to make those comparisons.
Welcome back to Trading Hour. Well, the pressure across equity indices continues and markets continue to make fresh lows. But we'll now shift focus to the commodity space. Manisha joins in, and today we are focusing on crude.
Thank you for that, Vivek. Well, yes, overnight was a great market for the crude oil prices, where we saw 2% of gains. And with that, the crude oil prices hit a 5-week highs. In the Asian markets, there's a bit of a pressure coming in right now because all of these markets are concerned about the tariffs that would come in tomorrow. But even with that, there are a lot of supply disruption concerns which seem to be supporting the crude oil prices right now. One is that U.S. could be imposing more tariffs on Russia. The U.S. President Trump has been releasing a lot of statements, even suggesting that you could be looking at 25 to 50% of tariffs on Russia if they do not toe the line. The second important thing is that the U.S. could also be possibly saying that they can attack Iran if things do not fall in place. That has been adding premium to the prices. And then Kurdish oil exports also have seen a snag being hit via the Kurdish-Turkey pipeline there. So various supply disruptions, as you can see. To add to that, the Spanish company Respol also has seen export from Venezuela, that license being revoked. And then China manufacturing activity came in the best in the last 12 months. So that demand really seems to be going higher. So various factors which have led to premium into the prices. Now, the only thing that you haven't seen 75 take on the higher side is that the markets are looking at the tariff concerns and how that in turn can impact the demand going forward. The other thing to watch out also is the US dollar index, which we have seen slip down or fall the most in last 1 month, and that in turn also has been supportive for many of these dollar-denominated commodities. Well, remember, the dollar index fell by more than 4.5% in the previous quarter, and that in turn has been supportive. The markets do believe that the crude oil prices now for the month of April could be trading anywhere between 72 to 78 on the higher side.
Thank you very much for that, Manisha. Moving on now to the financial sector. Uday Kotak, in his latest tweet, warns of a significant deposit crunch threatening banks with margin erosion. He said, and I quote, "Leading banks are taking one-year wholesale deposits at 8%. Translates to a loaded marginal deposit cost of 9% plus after CRR, SLR, deposit insurance priority sector. Excluding OPEX, low-cost retail deposits are showing muted growth across the system. Yet, banks are issuing home loans at 8.5% floating rate, borrowing at 9%, they're lending at 8.5% at a 0.5% spread, and repo rates are likely to drop. What about OPEX, credit costs? If deposit tightness persists, it's a challenge to the banking business model." That's the warning coming in from none other than Uday Kotak, and that to some extent has spooked the financial sector today. All the large private sector financials are weak.
Absolutely right. The entire pack is at the day's lowest points. Kotak Mahindra Bank, HDFC Bank, ICICI Bank, all of the top names today under significant pressure. In fact, we spoke to Rahul Jain, head of Asia Pacific Financials and India Equity Research, Goldman Sachs, for his views on the issue and what it means for the sector. Let's listen in.
I think we are seeing the stock market kind of bottoming out, and there are opportunities that are opening up. And even banking sector, which has outperformed in the last couple of weeks in particular. But the fundamentals are still looking a bit like a muddle-through scenario at this point of time. And liquidity is an important area where I think while the RBI has been trying to do a lot more, but the banks are still looking to raise money at an expensive rate. There has been a rush to raise the year-end deposits. So we've seen a significant activity in the certificate of deposits. and some banks even offered higher interest rates there. And I guess the point that you're referring to is on the margin about the incremental profitability that you're making on incremental borrowing. So I think it kind of allows me to also segue into my overall view on the sector. And there we see the muddle through scenario to continue for the banking sector.
Well, that's the word coming in from Goldman Sachs. But moving on, let's take a short break. Up next, we'll discuss market fundamentals with Pratik Parekh from Nuvama Group.
Of course, as a multinational company, global industry, we're not really for tariffs. We think actually both non-tariff and tariff trade barriers should fall everywhere so that everybody can enjoy the benefits of products, and we have global competition that's balanced and fair. If there are tariffs on pharmaceuticals, I understand what's being discussed is more of a general tariff situation. For us, that has limited impact because we have very regionalized supply chains already. We can move things around, and our cost of goods is not so sensitive to the end price. I think the big thing in healthcare people are watching is the generic industry, where the cost of producing the medicine is much higher compared to innovative. Our biggest cost is R&D. Yes. They don't have R&D. So that might affect medicine costs in the US or in other countries, and that would be that would not be good, I think.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back. It's April and it heralds the start of the earnings season, and first of the block is always TCS, and this time TCS comes out with its numbers on 10th. Okay. Which is a market holiday. So, that's next Thursday when we'll get to know more. But, expectations going into the earnings season are quite low. Just pull up the UBS numbers. They're expecting constant currency revenue growth to be negative for all the large cap IT companies. And even the guidance for FY26 is likely to be very conservative and soft. So CLSA is anticipating Infi to guide for a 2 to 5% kind of top line growth, HCL Tech at about 3 to 5%. The macro has gotten a lot tougher. So let's talk about, the India domestic story, the IT earnings, the overhang from global weakness. Pratik Parekh from Nuvama Group is joining in to talk about individual sectors and markets on the whole. Pratik, thank you very much for joining in. Before we get to the market, you all have recently downgraded the IT sector to an underweight. Take us through the call and what you expect and how you expect IT to perform.
Yeah. Hi, Rima. Thanks for having me over. So yes, IT was one of our anti-consensus overweight last year. It gave us a very good alpha last year per se. So I think when we started the year, we did move IT lower to neutral, and now we have moved to underweight. Our rationale for the same is that in IT sector, we were hoping for margins to see further improvement and growth to come back, because the US recession concerns or US corporate profitability, which was under big pain point last year, had seen an improvement. Why we have changed the call is because valuations have reached their post-COVID peak. CC growth, constant currency growth still remain on the lower side, and margin stabilization owing to very high attrition that was there. I think that tailwinds are behind. And as a result, given the current circumstances where IT companies' starting point of valuations, both absolute and relative, are on the higher side, growth concerns are dominating and fresh uncertainties have cropped up, we have moved the sector to underweight per se, Rima.
Pratik, within the IT pack, is it all-round underweight stance, or do you have a preference within large cap and mid cap names? Or do you think mid cap can fare better this year?
Yeah, that's a very good question per se. because what's been very unique about post-COVID recovery is the rise of mid-cap IT. Mid-cap IT companies have really grown up the scale and have delivered, very well on the growth front. Even their capital allocation decisions to some extent have been better, where they have been more aggressive on acquisitions and getting the right strategy in place. So I think obviously, if growth is a concern, then I think even mid cap and large cap both will take a hit. Mid cap valuations are on the higher side, but so far they've been delivering better growth. So I think right now we are cautious on the entire pack itself per se. But I think we'll get more clarity on whether mid-cap IT can continue their outperformance, once we move in the later part of the year or once the dust on the current uncertainties potentially settles down.
So that's the call on IT. Meanwhile, you'll have also upgraded your assessment on consumer. What's it premised on?
So I think consumer stocks, we have, moved our weights, not entirely because we are very bullish on the overall consumption revival, but it's owing to 2 or 3 factors. One is that consumer stocks have underperformed, so to that extent, the starting point is better. Second, whatever the government policies are incrementally more focused on supporting the consumer rather than the capex, whether be it income tax cuts, whether be the welfare schemes of the states, so on and so forth. And the third factor is that if there is, global growth turmoil, which seems quite likely, in that scenario, you generally see commodity prices cooling off, and also Nifty earnings weakening. In that scenario, consumers typically provide a good hedge against the drawdowns per se, Reema. So I think it is more of a relative call rather than necessarily absolute call. And given in the current context, we think that is more favorably placed.
Pratik, any specific view on pharma and any favorites within the pharma pack? Tomorrow is a big day for the entire space. Reciprocatory tariffs is something that we're talking about. So how are you positioning and how are you advising clients position themselves ahead of this particular tariff announcement?
Yeah. So I think clearly tomorrow, yes, the whole world is looking up to tariff announcement. Now, tariff announcement has 2 parts. One is the micro and the second is the macro. What I mean by that is the micro is the which sector, how much tariffs is imposed. And the macro is what it means for the overall demand, capital flows and the risk appetite. I think predicting micro impact is very difficult because even if you impose, let's say, tariffs on pharma sector, there are multiple second round, third round impacts involved, and the knee-jerk reaction may perhaps be misleading going ahead. I think what we need to look out for is the macro impact, which is that if there are meaningful tariffs imposed, then you are likely to see retaliation coming from global partners as well. And the big takeaway is going to be the weakening of global growth, which has already been weak. Now, this has very meaningful implications for BSE 500 companies' top line, because a large part of our top line is globally tradable. And if global growth weakens, especially at a time when domestic demand is probably not in the best of the health, I think you can see earnings disappointments. So I think for our advice to clients is focus on the macro rather than micro, and global growth impact and risk appetite, I think, will be a bigger point to look for rather than necessarily what is impacting which sector per se, Reema.
Pratik, you're also overweight private financials. You would have seen that Uday Kotak tweet which went viral, where he's cautioning or warning, how banks could get impacted because of low deposit accretion. What are your thoughts on banks, and what is the driver behind this overweight call of yours?
Yeah. So I think private banks clearly, they have been have been through a very big deposit lull phase for I think 2-3 quarters now. In our view, the main driving force of deposit lull has been the tight liquidity situation. The banking sector liquidity or overnight LAF has been under deficit for now more than 2-3 quarters. Initially, it was because of government cash balance, ramp up. And second, in the last couple of quarters, it was mainly because of RBI's heavy forex interventions, which drained the domestic liquidity. Our view is that the worst of that is possibly behind because RBI has been injecting a lot of liquidity per se. Although material improvement will still need global support and global capital flows of sorts, but at least we think the worst of that is behind. our rationale for overweight private banks is, that these are very quality franchises and who have demonstrated across cycles, resilience in their business models and their profits per se. Second, what we are more optimistic on private banks is that if you look at in F23 and F24, private banks' core operating profit, or PPOP as they say, that has slowed down materially despite loan growth being very strong. Because all these guys opened up a large number of branches, did the capex, which is the right thing to do in a rising credit cycle. And now we think that at least the capex part of it is behind. So there are cushions on the cost front, which are there to offset some of the top line slowdown per se. And that's where we think private banks fits in the category where low growth is currently in the price, and there are more chances of it stabilizing or potentially even improving rather than worsening of sorts per se. So it's a category where low growth and low valuation and things are moving directionally, at least I would say, not deteriorating and moving perhaps on the brighter side.
Okay, got that. What about the market? I was going back and seeing some of the notes. In August of 2024, you had said that India's valuations, absolute breadth and relative, are at extremes. The market cap to GDP is at 150% at an all-time high. And the previous peak was in 2007. And at that time, too, the market cap to GDP was 150%. And soon after, the correction ensued. But now that we've seen a correction of 10-15%, what is the call that you're making on the markets?
Yeah. So again, that's a good question, Rima. So I think on the markets, our main point is that for markets to turn around, you either need very strong earnings revival or you need very large policy easing or rates being lower. Absent both, markets can remain range bound or move lower. In FY24, while interest rates world over, both in US and India, remained elevated, what we got was a very big improvement on the earnings front, mainly led by margin tailwinds. In F25, what we have seen so far is that the earnings have slowed down. Interest rates, on the other hand, if you look at it, while central banks have cut rates, but you still have the 10-year bond yields being very elevated. So in some sense, we are having a phase where valuations have cooled off from their peaks, but are still on the higher side. Earnings momentum remains weak, and even the outlook perspective, we don't foresee a big improvement on the earnings front, and interest rates are elevated. In this combination, it is very difficult to be constructive or to have a very meaningful gains over a next 1 year perspective. Our view is that going ahead, policy support is trickling in, but I think the pace of that is more important. It's only when you have policy rate cuts being very meaningful that you typically get a turnaround in markets. And at least in our view, we think this is still some distant away. And to that extent, we are still on the cautious side on the markets per se, Rima.
Thank you so much, Prateek, for joining in, sounding a very cautious note as far as FY26 is concerned. With that, let's slip into a short break. When we return, we will discuss market technicals with Mitesh Thakkar and also discuss his top trading bets.
Effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. from chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 20.
Welcome back to Trading Hour. Well, as promised, we say Mitesh Thakkar now joins in for a quick technical check on the market. Thank you so much for joining us, Mitesh. First up, there's been a significant sell-off from the higher levels as far as the Nifty and Bank Nifty are concerned. Are you worried that there could be further selling pressure? Mitesh, I think you're on mute. Could you unmute yourself?
Apologies. I think, the Bank Nifty structure is one which I'm watching very, very closely. The reason being, the Bank Nifty is the most strongest of the index, and that still hasn't gone negative or deteriorated. I think as long as the Bank Nifty is above levels of 50,670 to about 50,750, I think good chance that we will see some kind of recovery. If not today, maybe, today later in the evening or tomorrow or day after. But the structure will remain positive as long as the Bank Nifty does not break this. Yes, there have been some negative events, and in fact, especially on the Nifty Realty Index, that's where some breakdowns happened. But overall, this could mean that some sectors will do well, some will not do well, and the market might, try to find a base at higher levels and do some kind of range-bound activity. So that's the outlook in the near term.
Mitesh, hi. Morning. What about individual stock calls?
On the individual stock side, I have a sell on Oberoi Realty. I think I was just mentioning that the real estate index is the one which is turning negative. So Oberoi Realty is a sell with a stop at 1600 for targets of 1500. Similarly, DLF is a sell as well. Keep a stop at about levels of 667, look for targets of 635.
Mitesh, have you had a chance to look at Voltas today? There appears to be significant price damage over here. No specific news flow. Could you have a look whether there's further downside?
See, Voltas, I think, if you look at the price movement, I think, it had a very good rally from 1160, 1170 to about 1500 plus levels. And now some kind of a decline has kicked in. In fact, today is a minor breakdown on the hourly and the 2-hourly charts. My sense is that we might see the stock possibly correct a bit more. 1320 to about 1300 is the support area. I think that's where the stock is heading.
Thank you so much, Mitesh, for joining us, giving us a view on the markets, individual stock picks, and get you soon on the show once again. Let's now shift focus to the auto sales for the month of March. Sudarshan is here with more details.
So 3 major companies have reported auto sales for the month of March, and till now all the companies have reported sales much better than estimates. So we'll start with Eicher Motors, which has reported sales for Royal Enfield, and for the month of March, Royal Enfield has seen sales of more than 1 lakh units, and that's much higher than our estimates of around 91,000 units. It's up 34% year on year. Even domestic sales have increased by more than 33%. But for two-wheeler sales, one thing has to be factored in, that is OBD norms, that is on-board diagnostic norms, that is basically for emission standards, which has come into effect from today, and that was the reason which led to pre-buying for the month of March. So in the last week of March, most two-wheeler companies have seen a much increase in their sales. That's the reason you will see higher sales for most of the two-wheeler companies. Now coming to Escorts Kubota, that has also reported numbers which are better than estimates. Total tractor sales have increased 15%. Even domestic sales were higher by 15%. Exports too have risen 12% year on year. Now company says start of Chaitra Navratri festival in March has led to a good demand, and it expects momentum to continue even in Q1 of FY26. Now coming to M&M, it has reported both auto and tractor sales. Both the segments have reported sales better than estimates. Auto sales were led by SUV segment, for which numbers were higher by 18%. In the tractor too, sales have come in 34% year on year. And here also company says delivery momentum picked up in last week of March, and this momentum is expected to continue in Q1 of FY26.
Thank you for that. Numbers are good, but stocks are under pressure given the entire market mood right now. Let's talk about HAL, Hindustan Aeronautics, a very large homegrown order. Stock is up 2.5%. Upasana joins in with the details.
Well, Defence Ministry has signed 2 contracts with the company worth 62,700 crores. This contract is mainly for the supply of 156 light combat helicopters, Prachand for Indian Army 90 and 66 for Indian Air Force. Now this is the biggest single day procurement by MOD from HAL till date is what the company has indicated, and company has also reported its FY21 provisional revenue which stands at 30,400 crore with an uptick of 2% on a YoY basis. Now if we look at the FY24 revenue, it stands at double digit, that is 10%. This year the revenue came in lower. This is mainly because of the supply chain issues and also delay in the delivery timeline. Now, if you look at the order book of the company, it stands strong at 1.8 lakh crores, and company says that it is gearing up for a robust FY26 on the back of supply chain issues stabilizing, new capacity enhancement, and also new order wins. Now, on the back of this, UPS has given a buy rating on the stock and has also raised its target price to 5,440 per share. It says that this award is a positive surprise for the street, and LCA MK1A Tejas delivery is likely to drive P&L ramp up over next 3 years is what the brokerage is saying. Hence, the stock remains in focus. We can see it surging high in trade today.
Thank you very much for that. Get into a break, but before that, it's that time of the year. The News 18 Rising Bharat Summit 2025 is here, bringing together the biggest names shaping India's future. Don't miss your chance to be a part of it on the 8th and 9th of April at Bharat Mandapam in New Delhi. Scan the code, get your passes now.
Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at
Welcome back. Inching towards the 23,200 mark. Things are looking ugly now. It's a 300-point cut. The sell-off started close to about 10% and we've lost about 350 points from the day's high. So there's some nervousness perhaps ahead of April 2nd and what will come out in terms of reciprocal tariffs. Though today at least, Asia is holding up pretty okay. At least the morning, the screen, the color on the Asian market screen was green. And even right now, Hang Seng is up close to about 1/3 of a percentage point. Shanghai is holding up in the green. Taiwan is up nearly about 2.8%. Nikkei is flattened out, but generally Asia is a lot more upbeat. But on Monday, Asian markets were deep in the red. But there is nervousness ahead of the all-important 2nd April bill. And now even the mid and the small caps are correcting sharply. When we started the show at 11 o'clock, the mid and small cap index was down about 0.5%. And now it's down close to about 1%.
Rima, we spoke about the bank seeing quite a bit of selling pressure emerge. Now, what's also transpired is the fact that the entire NBFC pack, all of them have actually seen selling pressure. So look at names like PNB Housing, Shriram, Cholafin, all of these stocks are seeing significant selling pressure. But it's now an important exclusive news. Sudarshan joins in with details he's picking up on the Karnataka mineral bill case.
So if you remember that we have been reporting regarding Karnataka mineral rights bill, now there is an update on that. Just 2 months ago, Karnataka governor had sent that bill back to government, and Karnataka governor had made certain recommendations. Basically, he had asked to make certain changes. So now in states, what happens, a governor has an option to reject the bill once. But if the government decides to send the bill back to governor is left with no option but to approve the bill. But now, in this case, what governor has done, he has reserved the judgment and has sent the bill to president. Now, when the bill is state bill, if the bill is sent to president, so now president will decide if she has to withhold the bill or approve the bill. So she will direct the governor to send the bill back to government, and now government will have 6 months time to reconsider or make those changes. Now in those 6 months, if government sends the bill back, it will go back to president. Now president, if decides not to approve the bill, that bill will become null and void. And unlike governor, president has right to just make the bill null and void and not approve. So it's very important for all these companies, NMDC especially, because more than 30% of its revenue mix comes from Karnataka. Now, anyhow, this bill now is getting postponed at least by more than 6 months for now. Now, because president's decision will depend on what center does. Center has already been against this bill. Even steel minister had a meeting with states, and he had made certain reservations regarding the bill, because he has been saying that if this bill is approved, it will impact negatively to companies like NMDC, JSW Steel, Vedanta and Sandur Magnets, especially NMDC. So now, once this bill is sent to president, it's very unlikely that this bill will go through, and that's the reason it's positive for companies, especially NMDC.
Thank you so much, Sudarshan, for joining in, explaining to us, what is the latest development as far as the Karnataka mining bill is concerned, as well as what could be the likely impact on all of the listed players. But moving on, there has been significant news flow coming in as far as the real estate space is concerned, especially in the state of Maharashtra. Winnie joins in with more details.
Yes, good morning, Vivek. So we have updates coming in on this front, where the government of Maharashtra has increased the Mumbai's ready reckoner rate by 3.4%. This is in Mumbai region, while overall for the state averages are around somewhere around 3.9%. Urban region, this is an increase of around 5.95% that is coming in, and that is obviously under the Municipal Corporation of Mumbai that we are watching out for. Let's not forget that, in the last 2 years, we've not seen any increase coming in these ready reckoner rates. So that is interesting to watch out for. And this could help increase the government's revenue by 10,000 crore for FY26. What is the impact of this? This means that there could be an increase in terms of stamp duty that will come in, as well as the property prices that could see an increase. But this will be more in terms of a specific on different areas as well, where there's a present, because each of them will have different rates. And most of them currently, what we understand is coming in also that some of the places are already at a higher rate compared to this ready reckoner rate. So that impact will not be there. So individually, each company is something that we'll have to watch out for. Anarock is highlighting that this hike is actually very acceptable, as most transactions were taking place as a higher rate in terms of the market rate that was going on. So that impact could be a bit lower. It will be individually depending on each company, and obviously keep an eye out on those Mumbai-based companies, real estate developers. Well, as of now, they're all down between 4 and 5%. But thank you very much, Vinny, for joining in. So Anarock says the increase in ready reckoner prices are par for the course. Let's find out what the opinion is from Knight Frank. Gulam Zia, Senior Executive Director at Knight Frank India, joining us on the show. We also have Ashutosh Lime, Regional Director of Strategy Advisory and Valuations at Anarock Group, joining in. Gentlemen, thank you very much for joining in. Gulam, let me start with you. First, for our viewers who may, not be very clued in into what ready reckoner rates are and how they impact real estate developers, give us a brief overview, and why is it negative for real estate companies?
Well, ready reckoner rates are nothing but what exactly are the market rates going on in the transactions that happen in the market. And the government needs to keep track of all those transactions, so that the revenue that it collects on all the transactions has to be in line with that, because if there's a large gap between the two, then the chances of cash transactions actually shoot up. So it's imperative that the government keeps a proper tab on ready reckoner rates. These ready reckoner rates are simply the market realities, just mirroring what's happening in the market. And that is why when the government is changing, in fact, in my view, it should be very dynamic. It should actually reflect the market realities completely, instead of changing it once in 3 years, etc., etc. They should do it at least once in a year, which used to be practiced earlier. So reflection of the market is the key. So a buyer or seller actually depend on this rate, because the government says that you have to pay the stamp duties and other transaction costs based on the ready reckoner value. If you are doing a transaction at a higher value, you have to pay the stamp duties at that value. But if you're doing it at a lower than market ready reckoner value, then you have to pay stamp duties minimum on that ready reckoner rate. So that is the reality. So in my view, making any changes into ready reckoner is only reflecting what market realities are. Over to you.
Thank you so much, Gulam. We'll get back to you soon. But Ashutosh, let's get you also in on this particular discussion. First of all, could you explain to us the linkage between the ready reckoner rate? Will there be an appropriate or likely similar sort of increase as far as TDR is concerned, as well as the premium rates that companies will have to pay? Today, we are seeing a lot of the Mumbai-based real estate companies take a hit. Is market reading that there could be an pro rata increase both in these two rates as well?
That's correct, because the premium FAR or TDR rates are directly or indirectly linked with the ready reckoner rates. The premium FSI is directly linked and as it is defined, whereas TDR is a market commodity. However, it indirectly gets impacted by the ready reckoner rates. So any increase in ready reckoner rates will have an impact on the premium FSI as well as the TDR, but more so on premium FSI because there is a direct linkage.
Ashutosh, for a property buyer, things have gotten that much more expensive, right? Close to about 4%. In any way, say for Mumbai-based real estate, properties, it was already quite exorbitant, the kind of prices. What kind of impact will this have on the prices in Mumbai? Will they go up by a commensurate amount? Do you think the real estate developers may pass on the entire amount, or will they try and buffer it by taking a hit on their margins? How does this typically work?
Well, the increase in ready reckoner rate is not the increase directly to the buyer, because ready reckoner rate at the end of the day decides the stamp duty. In all these markets, Mumbai, Thane, Navi Mumbai, Pune, the rates in last 2 years, the market rates were already much more than the ready reckoner rates, and the trades were largely done at the market rate. So while the stamp duty the buyer has to pay has gone up because the ready reckoner rates have gone up, the impact on the overall outflow for a buyer is not directly the 4% or 3% ready reckoner rate increase. It is much lower than that because it is the stamp duty increase that the buyer has to now bear, the additional amount. Given that the market rates were anyway higher than the increase that ready reckoner rates have been subjected to, I don't see much impact in terms of the buyer's outflow. But for the buyer of a value housing, where the property price of affordable housing or a low ticket size, the buyers are sensitive. But by and large, the market, the impact will be quite small.
Understood that. Gulam, let's get you back into the conversation. Especially when we're looking at the rates on the outskirts of Mumbai, they are very price sensitive. In this particular case, especially, just a couple of years back during COVID, we actually saw stamp duty rates getting cut in MMR region to go ahead and ensure that there was sufficient demand. Do you now feel that there could be a significant drop as far as demand is concerned, especially with the increase in the RR rates?
Once again, I'll go with what Ashutosh just explained, and try to give some numerics to you. When you're talking about 4% increase in ready reckoner rates, the stamp duty is paid at the rate of some 6%, not more than 6%, and which is also an additional percent levied in a year and a half. Maybe the government will pull that back, but 5% is on an average that you're paying on that 4% rate increase, which is very, very minimal. But coming back to what you're talking about, specifically focusing on affordable housing markets, well, you're right, the sensitivities are higher over here. But then you would be surprised that when you talk about the top 7-8 cities of the country, the metro cities, the number of affordable housing sales in Mumbai is the highest across all the 7 cities. Almost about 40% of the transactions that happen below 1 crore ticket size market, which is the peripheral markets that we are referring to. So while it is sensitive, but the impact has not been felt. In fact, what we also going forward, we are expecting is that with interest rate cuts, where we already started seeing the cycle turning and interest rate cuts are expected, the most important factor for affordable housing market is the interest rate at which they're taking the home loan. And with that reprieve coming in, and we are expecting in times to come in next 2 or 3 quarters, we shall see more reduction in home loan interest rates. We shall see this more or less subsidized or cornered or balanced. So in my view, there shall not be much of an impact on affordable housing. However, affordable housing currently is suffering because of lack of supply, because most of the developers have shifted their focus on catering to mid to upper end because the margins are much higher and low hanging fruits theory. So here we need to really see how do we get the developers back to create more inventory, very less inventory there, and that is what shall have a problem in price rise. Whenever the demand bounces back, we shall see a problem on the prices because more demand and less of supply.
Ashutosh, which areas of Maharashtra or which micro markets will see the greatest impact of these rate hikes, and which are the developers which have a presence in these areas?
No, I think while the most of the urban areas, the property price is already higher than the ready reckoner driven prices. I think it is the extended suburbs of large metropolitan areas which are just starting to get developed as urban centers. These are the sensitive areas. And in tier 2, tier 3 towns, cities like Sambhajinagar, Kolhapur, Nanded, etc., where they are at a cusp of transforming into a district headquarters to a kind of a urban metro, that kind of a stature. There, the increase in ready reckoner rates could be felt more. But in big urban centers, I don't think it's going to impact much. When the news comes, a day or two, the market reacts, but I think it will get normalized very soon.
Thank you so much, Gulam, as well as Ashutosh, for joining in and helping us make sense as far as the impact of the increase on the ready reckoner rate is concerned. In most cases, like you've mentioned, it's more of a catch-up that the state has done. But as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Weeknights at 7 p.m.
Today, my cabinet colleagues and I met to discuss Canada's response to the latest developments in the trade crisis. Yesterday, in the latest salvo in his trade war, President Trump again imposed unjustified tariffs on our nation in violation of our existing trade agreements. We will respond forcefully. Nothing is off the table to defend our workers and our country. And our response to these latest tariffs is to fight, is to protect, and to build. We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. The road ahead will be long. There is no silver bullet. There is no quick fix. The old relationship we had with the United States, based on deepening integration of our economies and tight security and military cooperation, is over. It's my solemn promise that when President Trump threatens us again, we will fight back. We will fight back with everything we have to get the best deal for Canada. We will build an independent future.
Welcome back to Trading Hour. Well, one particular stock that actually opened off trade on a very weak note was Bajaj Auto, but there's been quite a bit of a sharp recovery as far as Bajaj Auto is concerned. The stock is now up almost 1%, cooling off a little bit from the day's highest point, but actually saw quite a bit of a negative reaction at the start. But the other stocks that are seeing quite a bit of selling pressure continuing. Number one from the auto pack is Eicher Motor. That particular stock has seen quite a bit of a negative downtick. Some stocks from the IT pack, remember names like Persistent Systems, these are stocks that are seeing significant selling pressure. And the entire Pharma pack, remember the entire Pharma pack is now worried, and there's the impending overhang of tariffs. So look at names that Pharma index, as you can see, is down almost 1.3%. Names like Lupin, names like Zydus, Aurobindo Pharma, all of these stocks have cooled off quite significantly from the day's highest points. And Lupin, as you can see, is down 3.5%. Rima, tomorrow is a very important day, especially for the Pharma pack, especially for the export-oriented sectors. These are names that could see significant volatility come through.
Indeed, and that brings us to a close in this edition of Trading Hour. From the entire team, thank you for watching. Don't go anywhere. Halftime report is up next.
Stronger than ever.
Benchmark indices have seen a sharp cut, but the advanced decline ratio is exhibiting a positive bias, keeping the market trend muddled. Realty, IT and financials are the big drags, while telecom stocks have gained. The government will convert nearly 37,000 crore rupees of Vodafone Idea spectrum dues into equity at 10 rupees a share, raising its stake to nearly 49%. The move is expected to help the Telecom raise funds to meet its liquidity needs. The stock jumps, as does that of vendor Indus Towers.
The stock of Hindustan Aeronautics perks up after it bags two orders totaling to almost 63,000 crore rupees. The wins swell its order book to well over 1,80,000 crore.
ITC is set to buy Aditya Birla Realty's paper business for nearly 3,500 crore rupees, and the deal is expected to significantly add to its paper revenues and be earnings accretive from the word go. Aditya Birla's realty arm also gets a non-core exit.
Noted banker Uday Kotak flags the negative spreads for banks are seeing on loan books backed by wholesale deposits. He sees a threat to banking business model if deposit intake does not improve.
It's not the start to a year or a quarter that you would be expecting based on what the market screen is showing, but that's what it is. We are watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Fatakia. With me as always is Manglam Malu. Manglam, good afternoon. Well, the benchmark indices are seeing a bit of pain, but the advanced decline ratio is fairly okay. It's not compared to what the benchmarks are showing up.
I don't think anything you said, made it to the air, because I think your mic is off, Hormas. No, it's not. It was an April Fool joke. But anyway, having said that, it's 330 points down on the Nifty, below that 23,200 mark. Yes, we've seen a rally already. There is uncertainty over the globe. But does that worry domestic investors? Perhaps not. In the very near term, we have a lot more other domestic cues to track. The most notable of them in the next week itself will be the RBI policy outcome. Thereafter, we will get updates from companies on the fourth quarter sales and profitability, etc. as well, leading up to the result season. So all those factors would be a lot more important to track than just the near-term uncertainty around Trump's tariffs. But let's talk about some of the stocks which are buzzing around, and this on the back of strong ordering that has come by. Remember, all of last month we saw a lot of orders pick up across the board, and this time around it continues as well. And this one from the defense space. HAL is the one which is gaining out. It signed a near 63,000 crore rupees contract with the Defense Ministry. Upasana joins in with more details. Upasana, the stock higher in today's trading session, outperforming the otherwise wobbly screen.
Certainly, Mangalam. Well, Defence Ministry has signed 2 contracts with the company worth 62,700 crores. Now, these contracts are mainly for the supply of 156 light combat helicopters. Prachand, for Indian Army, it's 90 and 66 for Indian Air Force. Now, this is the biggest procurement by Ministry of Defence from HAL till date, is what the company has indicated. And it has also reported its FY25 provisional revenue, which stands at 30,400 crores with an uptick of just about 2% on a year-on-year basis. Now, if we look at the FY24 growth, it stands at double digit, that is around 10%. And this year, the growth was lower. This is mainly due to the supply chain issues and also delay in the delivery timeline of LCA. Now, order book of the company, it stands strong at 1.8 lakh crores, and the company says that it is gearing up for a robust FY26 with supply chain issues stabilizing, capacity enhancement and also new order wins. Now, on the back of this, UBS has initiated a coverage and given a buy rating and increased the target price to 5,440 per share. It says that this award of order, that is 156%, is a positive surprise for the street. And LCMK1A Tejas delivery is likely to drive P&L ramp up over next 3 years, is what they have said. Hence, this stock remains in focus today on the back of this.
Oh, absolutely. HAL was the stock of the month of March, the best performer on the PSE index. Was almost 35% in the month of March, and it was also the best monthly performance that the stock had seen in 5 years. So good going for HAL, with also analysts expecting price targets of anywhere close to around 5,000 rupees. But the big development of the day has to be related to Vodafone Idea, where the government has decided to convert its outstanding spectrum auction dues into equity shares worth 36,950 crore rupees. Rima is here to tell us more. Rima, a very, very strong reaction on Vodafone Idea.
Indeed, because their dues come down by nearly 36,950 crore rupees. The government is going to be converting 36,950 crore of spectrum dues into equity. This will happen at a price of 10 rupees, which is the face value, at a premium of 47% to where the stock closed on Friday. And the government stake in Vodafone Idea rises from the current 22.6% to 49%. But the operational control will continue to remain with the company, with the promoters. Now, it's a positive for Vodafone Idea because, one, it increases the prospects of raising 25,000 crore from the banks via debt funding, which has been delayed. Secondly, and this money, will help in, the company rolling out their capex, their 5G, which will arrest the subscriber losses. Also, the company's, dues which it owes to the government for, spectrum, once it comes out of the moratorium, comes down quite substantially. So IFL has done the math, and they're saying that in FY26, before, Vodafone Idea would have owed the government 26,000 crore of annual payments. This comes down to 18,500. FY27, 43,000 crore of annual payments will come down to 23.5, and FY28, that number comes to 33.5. So in that sense, matching, the liability of annual payments has reduced. It's also a positive for Indus Stars because Vodafone Idea is now stronger for the next few years, and the government has shown its commitment for a 3+1 market construct. Now let's get to the analyst view. IFL says the government stake conversion is a positive, but it postpones Vodafone Idea because the company will still not be able to meet its regulatory payments later down the line. Maybe for 2 years it will, but third year, fourth year onwards it will be difficult, and therefore we could be in a situation where the government will need to convert further dues into equity, thereby raising the stake, and that means dilution for the existing shareholders. So they've got a reduced call on the stock, and they also go on to say that if the government were to convert all their dues into equity, then the government would be left holding 81% of Vodafone Idea. Motilal Oswal says it's another lifeline for Vodafone Idea, but again, it's pushing the can down the road. The problem is stabilization of the subscriber base, relief on AGR dues. All these are important for the company's long-term survival. They've got a sell rating on the stock, target price at 6.5 rupees, neutral on Indus Stars. Ambit, though, is a bit hopeful, and what they're highlighting is that this time the government has not touched the AGR dues, because of no relief from the spectrum. But maybe in the future, there is scope to provide some relief on AGR dues. But again, it's a very high-risk trade, according to them. Ambit, it's only suited for high-risk investors, so they've got a buy call. And Citi has opened a 90-day catalyst watch list on both Vodafone Idea and on Industars.
All right, Rima, thanks a lot for that. So that's about Vodafone Idea. High risk indeed. A big mover in today's trading session. Also has seen a big correction from the top as well. So these things keep, taking place in Vodafone Idea for a long time right now. So we'll keep an eye out on how this develops and how much of a positive this would be from a medium to long-term standpoint as well. With that, let's move on to the auto space now. Sudarshan joins us. Sudarshan, I'm told you have an important breaking news for all of us. Something on Maruti. What's that?
No, I'm yet to check the Maruti's numbers, but as of now, 3 companies that I have...
No, we're just kidding, Sudarshan. It's April Fools. We just came to you to pull your leg. But it's 1st of April, and not only will you be checking all these other numbers and the breaking news for all of us, but you'll also give us some data on the sales that were there for the month of March.
That's correct. So 3 major companies have reported numbers for March so far, and the first in the list is Eicher Motors, Royal Enfield. By first look, if you look at the numbers will look much better than estimates. Company has reported Royal Enfield sales of more than 1 lakh units versus our estimate of nearly 91,000 units. But now when you look at these numbers, especially for 2-wheelers for the month of March, you have to factor in OBD norms. What is OBD? That is on-board diagnostic norm. It's related to emission standards, which has come into effect from today. Now, what does this do? That once this norm comes into effect, this will lead to a price increase. And because of that, the month of March saw pre-buying, especially in the last week of the March. And that's the reason numbers of most of the 2-wheeler companies will look elevated. And it's the same case with Eicher Motor. And that's the reason you can see the stock is sharply off highs. Now coming to Scott's Kubota, numbers are much better than estimates. Total sales have increased 15%, even domestic sales have risen 15%, and company is saying because of Chat Navratri, the sales were higher in the last week of March, but it expects momentum to continue in Q1 FY26 as well. As far as M&M is concerned, both the auto and tractor sales have come in better than estimates. Auto sales, as usual, was led by SUV. Even tractor sales were higher, much higher than our estimates, and here too, company says the momentum is going to continue in Q1 FY26. So overall, tractor segment, one segment which has been outperforming for the last few months, is going to outperform as per management's commentary over next few months as well.
All right, Sudarshan, thanks a lot for that. Hopefully you come back with us with that Maruti breaking news as well sooner or later. But we take a short break. But before that, Bharat's growth story is being driven by leaders transforming policy into real progress, and you can hear them directly at the News 18 Rising Bharat Summit 2025 on the 8th and the 9th of April at the Bharat Mandapam in New Delhi. Now, this is an exclusive opportunity to hear straight from Nitin Gadkari, the Union Minister for Road Transport and Highways, on infrastructure-led economic transformation, Hardeep Singh Puri, the Union Minister of Petroleum and Natural Gas, on shaping Bharat's energy resilience and global positioning, and of course from Ashwini Vaishnav, the Union Minister for Railways, Transformation, Information and Broadcasting, and Electronics and IT, on advancing digital infrastructure, mobility and communication. You can get your tickets today for the summit that defines what's next for Bharat. You can book your passes right now. Welcome back. Now 315 points lower on the Nifty, still trying to hold on to that 23,200 mark. The Sensex, though, down 1,250 points as we speak. And among the top losers, of course, include PSU banks like UCO Bank, which is down now 8%, and Punjab and Sindh Bank too, which is down almost 20% in today's trading session. But the big event for this week, and that has also shifted the entire investor attention to that as well, is the 2nd of April, which is the day the reciprocal tariffs from Donald Trump take effect. Now, the uncertainties around that continue because the president himself said on Monday that he will be very kind, quote unquote, to trading partners when he announces further tariffs this week. Listen to what he had to say.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday, you're going to see. And they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us. And we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Relatively speaking, we're going to be very kind. That's something that, everyone will keep an eye out on. In fact, let's get you some important voices ahead of the April 2 tariff announcements as well. We spoke with Neelkant Mishra, who tells us that tariffs can impact global GDP by up to 1%. Well, Sunil Kaul of Goldman Sachs also says that reciprocal tariff number for India could be around 11%. Hear the experts out.
I think it's very important to see this as one of many important milestones because this will just be a starting point. Tariffs are only one form of industrial policy. You have many other forms of industrial policy which are not possible today because people are worried about the World Trade Organization. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult. We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion. Or if say it was $8 billion. So it's like 0.1 to 0.2% of GDP. Now for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if US matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT. Europe is obviously a large risk there as well. So depending on what the number could be, it could be north of sort of pure 11 percentage points, which is based on the weighted average tariff rates. Our sense is that it could still be an initial shock, as I said, because the numbers will be higher than what the market is currently anticipating. And then there is a room for negotiation. There's a window for each country, in which case I think there will still be sort of uncertainty in the market. The agri has the largest sort of tariff differential if you do sort of US versus India. So that could be impacted. But we think, for example, like pharma could be an area that could be impacted as well. Autos. In addition to the reciprocal tariffs, we also think that overall in the tax measures, you could see a global sort of auto tariffs. You could see tariffs on critical imports. And when we think about critical imports, electronics and components is one of the things the Trump administration has talked about.
Right, with that, we'll slip into a short break. On the other side, we'll get trades with Sachidanand Taker of TradeBulls.com. He joins with some trading strategies, even as we're seeing some bit of moves in the market on the way up and down. On the way up, we do have Whirlpool and Bank of India, which have picked pace, as has IOC. So we'll get you more details on individual stocks after this short break.
That started 25 years ago believes that its best is yet to come.
Yeah, it's kind of surreal. And even when I saw Young Turks 25 years, I told you the same thing. I said, my God, we've come a long way. And when you look back, I mean, it doesn't feel like 25. I think life in the internet industry is life in the fast lane. Till 6 months before the IPO, we weren't even planning an IPO. It was Sanjeev Bikhchandani, who was an independent on our board.
Who said IPO?
Who told us on a January board meeting that, guys, you are ready to IPO. We said, what are you talking about? He's saying, yeah, 3 years ago we were at the same level and you guys are growing faster.
What's the most unusual celebration case that you've seen?
I believe they're now breakup and turning single again.
What?
Parties.
Breakup and turning single again parties?
Parties and get-togethers. like, listen, now guess what? We're all single, we're partying. But all kinds of stuff is happening, as we know. Like, proposal economy is happening, yeah? People now, youngsters are choosing exotic locations to go make a proposal, and they actually travel.
For the last few quarters, we see our frequent travelers are actually taking more trips than they were ever before, right? It's a combination of short-term vacations, and we've seen trends like...
The YOLO phenomena is here to stay.
And Gen Z, and it's real, and Gen Z.
Total size of the global pharma industry is $1.5 trillion, and we are still, let's say, 6 lakh crores in terms. So it is still very small. So I am quite positive that over the next 5, 10, 20 years, this industry has a lot of leg. We are still dependent on China for basic stuff like solvent, starting material. When all of that shifts to India, which I think will happen in the next 3-4 years, because see, if you are a global major and if you are placing your bet on India, India is still sourcing those material from China. So that to that level, your cost competitiveness is not established. But Prashant, this is all work in progress, in my opinion, and we are in the right direction.
I think it's very important to see this as one of many important milestones because this will just be a starting point.
Welcome back. You're 300 points down on the Nifty, though a couple of stocks are moving higher. We've been speaking about Vodafone Idea all day today. It's up 20% now. Whirlpool's the other one, which has seen a big spike, up 5% right now. Order wins continue at the bottom of your screen. This one comes in for KC International. And we're also seeing some traction in a lot of these PSUs. So Bank of India, the individual intraday should come up for you. It's up around 3% right now. We're also seeing some traction in IOC, which from the lows has seen a big recovery. And NCC is the other one, which is moving higher as well. So a lot of individual stray stocks seeing good moves. Good time to actually get in a perspective on the FNO setup on day 3 of the April series itself, rather day 2 of the April series itself. The Nifty Bank and the mid-cap index, all of them lower. The Nifty Bank's the one which is leading the decline, though the mid-cap index is outperforming by virtue of not falling as much as the frontline indices. The India VIX has spiked as well, so we'll keep an eye out on that one. There are a bunch of events ahead of, the Trump tariff uncertainty. We have the RBI policy meet. We also have, the earnings season that is upon us. So all those factors keeping the India VIX higher. But the broader markets will have you believe that the decline is perhaps not as much as you thought. In fact, over the last 15 minutes, the green and red lines have only moved further apart, telling you that the bulls are in it from a medium-term standpoint, from an individual level as well. The Nifty is firmly below important, or between the important moving average range from a technical standpoint. 23,500, the 100-day moving average, 23,000, the 50-day moving average. So long as this is respected, no real worries. For the Nifty Bank as well, just below the 200-day moving average, but well above the 100-day moving average. Again, so long as this range is respected, no real worries are out there as well. Where are the option writers positioning themselves? 23,500 and 23,300 calls, both of them fairly active. 23,300 call more so because it's currently near to where we are right now. So 2370, 23,400 could see some supply. But at lower levels, we are expecting some support coming in at around 22,100 thereabouts as well, because we are seeing writing at the 23,200 put and the 23,250 put itself. A lot of individual stocks on our radar. We have Voltas and M&M Financials, which have seen some short positions being built up. Voltas more so with a 6% downtake, and a lot of long positions added on HAL, Hindustan Aeronautics, which Upasana just spoke about, that 63,000 crore order win. So positive on that one.
Good going for HAL and a lot of these other names as well that Manglam highlighted, and some interesting moves there. Even though the index is down 317 points, the advance decline though firmly in favor of the advances. But Sachitanand Uttekar of Trade Bulls is joining in now for a quick chart check and also with some trading ideas. Sachitanand, good afternoon. Thank you for joining in. Would you use this dip as a buying opportunity? Key levels on the charts for the Nifty, and of course your stock recommendations for the afternoon as well.
Good afternoon, almost. Good afternoon, Mangalam. Clearly, if you look at the 60 minutes, setup, it looks like a lower top, lower bottom sequence. So for the Nifty, at least the trend remains bearish. If you look at the Nifty IT, the index itself has given a decisive breakdown. Even if you look at its daily RSI, it has started trending below its 50 mark. So it is a sign of caution. And if you look at the supports placed for the Nifty IT index, they are well placed at around 32,500 kind of a zone where its 50 months exponential moving average is placed. So I think there could be further pressure during this particular week from this particular index. On the other side, Nifty Bank has a decent support at around 50,000 mark, probably, which will help it absorb some of the selling pressure from the Nifty IT. But if you look at the Nifty itself, I think there's a clear-cut low top, low bottom sequence. 23,350 now looks like a resistance for the day. And on the lower side, we may see Nifty slipping towards that 23,000 mark. So it's better to keep a long short equation. The advanced decline scenario is also healthy, but it's better to keep a long short equation. Last week, we highlighted a trade setup in trend when the stock was expected to trend above its 50-day exponential moving average. Now, if you look at the current setup, there's a strong continuation of long build-ups here. The stock is now trending towards its 200-day exponential moving average, which is placed somewhere close to around 57.90. If you look at the ADX itself, is turning towards that breakout zone, and there's a clear-cut, bullish track formation breakout on its 60 minutes chart, which is exactly matching the price target placed at 57.80. So we are recommending building long positions here. The stop loss for the trade can be placed at 54.60 and the trading target towards 57.80. And on the short side, SRF has displayed a kind of a dark cloud cover on its weekly chart. We are expecting a pullback towards 27.40, and that's why we have recommended building short positions to our clients as well. So SRF at 28.80 on a pullback towards 2900, fresh short positions can be deployed. The stop loss for the trade can be placed at 29.40 on a closing basis, and we may see a swing towards 27.40 during this week.
Trent and SRF. Sachitanand, thank you so much for joining in. with your views on the index and on specific stocks as well. Trend, though, continuing to buck the trend for the index, though, down, gaining over 4% in a index that is down over 1.25%. Take a short break. Up next, the management of Lemon Tree Hotels joins us to discuss their demand trends for the quarters ahead as well. Stay tuned. We'll be right back.
Only one form of industrial policy. You have many other forms of industrial policy which are not possible today because people are worried about the World Trade Organization. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult. We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. Now for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I would once again request that people must not extrapolate what has happened post-COVID in terms of return, in terms of finding multi-bagger opportunities where money has gone from 10 to 100 times, right? Because the lows were so...
Welcome back. Still holding on to 23,200 is the index, but still down 300 points. Of course, there are plenty of movers in the broader markets in the last few minutes that have gone to the downside. Ipca Laboratories is one of them, 7% lower now as we speak. The second worst performer on the Nifty 500. And there you can see at the lowest point of the day now is Ipca Laboratories. That's one of them. Voltas is seeing a bit of profit booking now after the surge that it saw in the month of March in anticipation of a very strong summer. That too is among the worst performers on the Nifty 500, 6.25% down here as well on Voltas. JB Chemicals is the other one, 6% lower there. Godrej Industries is another underperformer in today's session. What's doing well though, other than Vodafone Idea, is HBL Engineering, and that is of course on the back of that 700 crore Kavach order that the company had won. 12% higher on HBL Engineering. At the highest point of the day is the stock at 527. The RHI Magnesita had a good week, the last one, and continuing from where it left off last week as well, 6.5% higher on that stock. And Sterling and Wilson is the one that I would want to point out after a recent order win that the company has had. It's won 3 orders of nearly 1,500 crore rupees, and there you can see the reaction on the stock, 5.25% higher on Sterling and Wilson. But onto our special segment, Insight Edge, and Mangalam is here to put the spotlight on AGI Greenpack, which is in focus today after the board has approved a 700 crore rupee expansion for a new container glass plant.
Yep, so they are into the business of container glasses, etc. The stock had opened higher, but then after the management clarified to us a couple of things about the 700 crore investment and the impending uncertainty around the Hindustan National Glass acquisition as well. The street's taken note of that. The stock is up around 6% right now. What was the news? They've approved a 700 crore, approval capex for a new container glass plant in Madhya Pradesh, which will expand their capacity by 25%. And this commences operations in the next 24 months itself. Management has said that for one, the 700 crore investment in MP will give them one-time sales turnover. So basically, 700 crore is what they invest. 700 crore in terms of revenue is what they will get. And in this year itself, the revenue should grow around 4 to 5%, 8 to 10% growth in the next year. And the margins in the new plant will be around 20% in the first 2 years as they ramp up capacity, 25% thereafter. And they are targeting increasing their capacity by 50 to 60%, including this one over the next 2 years, organically and inorganically. Why is that important? Because remember, the company was to expand its capacity inorganically by a big amount on account of the acquisition from the NCLT of Hindustan National Glass, which was then struck down by the Supreme Court. A review petition on that is pending with the Supreme Court. So until there is clarity on that, the company said, forget that for now. Let's go on our own growth path itself. And on their own growth path is where the company is. 70% of the 700 crore would be done via debt, on which they will be paying around 8 to 8.5% interest itself. So that insight, the street took that after a big correction that we've seen from the highs on the stock. It's now moving higher. This is what Sandeep Sikka, who's the group CFO of AGI Greenpack, had to say to us this morning.
So the board has decided that now we should look forward to, other organic and inorganic acquisition opportunities as they may come through. And this is the first step towards that we are implementing a 700 crore capital expenditure plan in state of Madhya Pradesh to have a state-of-art, container glass facility. With this investment of 700 crores, we feel that this should lead us to at least one-time sales turnover to start with. But once, as we move forward, the opportunities to expand at that site also, is not ruled out. We should close at somewhere around 4 to 5% growth as compared to last year, although the profitability has been higher. And next year onwards, based on internal, capacity debottlenecking, which we have done, we feel 8 to 10% growth is feasible for the next financial year. And this new capex will overall give 25% growth. So there are other plans which we are evaluating, but not yet approved by the board. I think once approved by the board, we'll definitely come back and explain them also. We should close at somewhere around 4 to 5% growth as compared to last year, although the profitability has been higher. And next year onwards, based on internal, capacity debottlenecking, which we have done, we feel 8 to 10% growth is feasible for the next financial year. And this new capex will overall give 25% growth. So there are other plans which we are evaluating, but not yet approved by the board. I think once approved by the board, we'll definitely come back and explain them also. I'll be candid here that we missed around 12 to 18 months as a part of the plan because of pretty long litigation which happened relating to the acquisition under the IBC process. But right now, management is looking the mix of both organic and inorganic. But definitely there are a number of things to be sorted out, especially on the inorganic side. But we are successful. We feel that in next 24 months, we should be able to expand our capacity by around 50 to 60% from the base of what we have in FY25.
Well, the management of AGI Greenpack, there the stock doing well for itself in today's session. But we take a short break, and just as we do that, here's some good news for our viewers, and that is, of course, the CNBC-TV18 app, which brings you India's business news leader in just a click. You can get instant access to breaking news, in-depth articles and financial world updates on the app. You can download it from the Apple Store or the Google Play Store, or scan the QR code that's on your screen. We take a short break, back on the other side.
The returns were fabulous, right? So I don't think that we must expect those kind of returns. Having said that, I am not in a camp that the bull market is over and this is the beginning of some bear market. In my view, 15 to 20% kind of return is still in these markets.
Welcome back. And as summer vacations are approaching, of course, for those who have them, we connect with the management of Lemon Tree Hotels, which is also doing well for itself in today's trading session. The Chairman and Managing Director, Mr. Patanjali Keswani, is joining in. Mr. Keswani, good afternoon. Thank you for joining in. You know, as summers are approaching, of course, the trend for travel tends to increase. What are the demand trends that you've witnessed, firstly in the fourth quarter, of course, and what are you expecting to witness in this upcoming quarter as well for the vacation season?
Good afternoon. Well, firstly, Q4, I think I've said it before too, is going to be a very good quarter for us, and much better than the previous year, same quarter. Coming to H1 of this year, I was just reading that the Indian Meteorological Department says there'll be a lot more hot days. So that is not good for travel. And if you have heat waves, typically people, as you can imagine, would not travel. So that's a downer, not an upper. As far as holiday season goes, that will be good for resort hotels across India. But I think what we have seen this year, and if you see the various reports that are coming out, resorts in India now had gotten somewhat overpriced. And with the opening up of nearby destinations like Thailand, for example, there has been a lot of movement out of India for resorts, for resort stays. And I think that is something which will become visible for those companies which have large resort inventory in even Q4 of this year. Overall, however, see, what I'm looking at is something entirely different, which is that what is the number of households in India that have, roughly 30 lakhs income? And that is the key metric for the hospitality industry. What I find is that as more and more households, with an increase in, with a 6-7% growth in GDP, in the next 5 years, the number of households that earn over 30 lakhs an annum will increase 4 to 5x. So that is where the real structural shift in demand for mid-market hotels will occur. Like has happened in every other country in the world that went through a similar change in its cohorts of consumers at $8,000. That's the number, magic number per person in a household of 4 or 5. So that's
very interesting. Yeah.
Yeah, so that is interestingly in India, if you see it started with, you see it in the other countries, it started with SUV sales. SUV sales, highways which are being built in India, Vande Bharat, the fact that so many new aircraft are on order, airports are being upgraded, it is all a proxy for ultimately what will be very high demand for branded hotel stay.
All right. So holiday season not particularly good for resort hotels because of the heat wave. But for you, it is not a problem because you're obviously catering more to the business traveler. I just wanted a couple of things. You said that, there were competitive opportunities opening up in the resort space itself, where people were going to nearby countries, etc. as well. And the magic number that you spoke about. Just from a average room rate standpoint, what I wanted to understand is that do you think that now ARR increase will largely be inflation-led, and for the industry, growth will be more occupancy and new capacity addition-led, because that reset of undervaluation has already happened, and any more than that may actually be counterproductive? Would that be a fair assessment, or do you think there's still room for ARRs to grow higher?
I think it's a very unfair assessment.
Okay.
Let me summarize. And I think I mentioned this to you earlier too. The average rates in India today, in absolute rupee terms,
yes,
are 15 to 20% less than what they were 18 years ago. And take into account inflation over 18 years, take into account the weakening of the rupee versus, say, the dollar. So from a global perspective, actually, we are very, very, very underpriced. Okay, because factor costs are high in India. Interest rates are high, cost of debt is high, cost of electricity is high. Now with interventions, political interventions, since we are obviously a political economy, of raising of minimum wages and so on, all these have an impact on our input costs. So I think rates in India in the hotel sector, and you can hold me to it even 5 years later, will double in the next 3 years.
All right, rates in India will double over the next 3 years. Your investors will be happy to hear that. Some of the customers will be feeling the pinch a little bit, but be that as it may, where there is demand, there is supply, and supply is obviously growing slower than the demand, so that should work for the industry at large, irrespective of what individual consumers feel. But just from a here and now standpoint, you said that the occupancy in H2 along with the ARR etc. will be a lot higher, as you had earlier pointed out as well. How much higher, if you could give us a quantified number? Because in Mumbai itself, the big delta would be increased occupancy in the Aurika properties. How much do you think your fourth quarter will be in terms of occupancy and ARR? And in light of that, what is the kind of growth target that you have for FY26 from a revenue and a 50% EBITDA margin standpoint?
So, well, I would say that our Aurika Bombay has finally crossed 80% occupancy.
That's positive, yeah.
Yeah, and that's a 670 room hotel. So what I'm basically saying is it's north of 550 rooms. It is definitely crossed 65% in EBITDA. It is showing no signs of slowdown. My view is that as a company now, because it is same store, we are now comparing same store because Aurika 2 was operational last year in Q4. Our occupancies in Q4 this year will be in the mid-70s. Our ARR will be, high single digits increase. So RevPAR increase will be very significant. Most of our costs are well under control and already factored in with our renovation. So obviously there will be a very significant EBITDA margin expansion. And my view is that this will continue next year. Certainly H1 will be much weaker than H2, as is every year, because it's a seasonal business. But for the next 3 years, till such time I'm pretty sure about this structural shift, because I look at some other proxies. I don't know how many of the viewers here are aware of what the Premier of China said in 2006, which was roughly where India is today. When he was asked about the GDP, he said, I don't even look at it. I look at high frequency indicators like, consumption of coal, freight movement, traffic on roads, construction of infrastructure. India is doing a phenomenal job in all these cases. I mean, look at it. Our highways four-lane highways have doubled in the last 5 years, and I believe that it is doubling in the next 4 years. SUV sales have finally hit that inflection point of nearly 50% of sales of cars. Aircraft orders are 3x of what they are today. So what are we talking? We're talking a huge shift in consumption. And our country is, as the Prime Minister has often stated, we are well on our way to, to becoming the third largest economy. I see nothing, unless it's a self-goal, there is nothing that will stop us.
Mr. Keswani, my heart just sank when you mentioned that room rates will double in 3 years. But when you speak of management fees, Mr. Keswani, what are you targeting? You mentioned earlier that including Fleur hotels, your management fees over the next couple of years are going to be 300 to 350 crore. Do you stick to that? And what's the kind of figure that you're anticipating this time around for the fourth quarter?
Well, quarter-wise, I don't want to comment really, but I'm very much sticking to 300 crores as lemon tree, as an operator of hotels, the fees. And 350, when I said maybe sounded a little aspirational, but actually I would change my guidance and say it would be 350 plus.
All right, 350 plus. That time it was aspirational, and now you are believing that 350 plus more is also realistic. And given the sort of optimism that you're showing, obviously it's reflecting on the way the stock has moved as well. Just a final question from my end. We recently had a note from a brokerage firm which said that there is potential value unlock, which could be an optionality if you were looking at the IPO of Fleur Hotels. I just wanted to know, what's your strategy here? I mean, by when, if at all, you are thinking on those lines as well? The IPO of Fleur Hotels, is there a possibility?
See, what you are seeing today is the listing of many asset companies, or what are internationally called propcos, property companies.
Yeah.
The hotel business is 4 parts: who develops hotels, who owns hotels, who manages hotels, and who brands/franchises hotels. the world's largest players, like Hilton or Marriott, when they announce they are opening 50 hotels, 100 hotels, and so on in India, have not invested a single rupee.
Right.
They are simply going to manage hotels owned by Indians or by funds. Now, when we started Lemon Tree, obviously nobody was willing to give us, hotels to manage. We were an unknown brand. So we had to build our own hotels, and therefore we operated across both the development/ownership and management/brand, which is the entire value chain. However, the kind of investors that want to invest in a capex-heavy, capital-heavy business are fundamentally now different to those who want to invest in a high-growth asset-light business. So rationally, it is, if you look at Marriott even, or look at all the other big players, over time, they got rid of the asset-heavy side of the business from the balance sheet. We will certainly do the same. I have said, in fact, that I'm hoping we will do it in the next 2 years, in which case hotels will be in Fleur and all management and brand will be in Lemon Tree.
Right.
And we will have a very interesting, I think, set of options for investors in our business.
Right. All right, Mr. Keswani, thank you so much for sparing time and joining us this afternoon. Wish you good luck for FY26. The management there of Lemon Tree Hotels on the road ahead. Take a short break. On the other side, Manisha Gupta joins in with Kishore Narne, who is the director of Motilal Oswal Financial Services. Stay tuned. Back on the other side.
Our government has chosen to face global challenges the Australian way, helping people under cost of living pressure while building for the future. Because of the strength and resilience that our people have shown, Australia is turning the corner. Now, on the 3rd of May, you choose the way forward.
Welcome back. Joining us now is Kishore Narne. He's Director, Head Commodities at Motilal Oswal Financial Services. Kishore, hi. Welcome to the show. And what a quarter and what a start to the new financial year. When you look at the gold price, is an all-time high, 3150 almost on the charts now. What's your sense on the prices from here on?
Good morning, Manisha. I think it doesn't make any sense anymore. So I think, gold as a preservation of value is has never been so important in the circumstances than what it is today. Either it could be the central banks, or it could be the fund houses, it could be for the investors, or it could be the various stakeholders, actually, gold is actually showing as an ultimate safe haven, ultimate store of value. So that is what is pushing up the prices. But the rest of the thing is a backdrop. It could be geopolitics, it could be Trump, it could be currency fluctuations. So this is all a backdrop. But at the end of the day, the pure capability or the pure characteristic of gold itself is driving it up. Until the time we have any alternative, I think central banks will continue to diversify their reserves into gold. Even if we look at 5% to 10% of diversification of these reserves across the world, that will be a massive flow of money. So I don't think there is any kind of a ceiling, but definitely over the short term, as we are looking at an investment perspective or a tactical perspective, 3200, it's been we've been for quite some time we've been telling that 3200 could act as a resistance for some time. So we are close to that. Probably we are still believing that there could be some price correction from 3200 levels. Indian market 91,500, 92,000 could be potential short-term resistance where we can see some correction coming up.
So, Kishore, usually we do see, every time that gold prices have run up, April does tend to behave like a peak. Is it going to happen this time, or 3,200 and some correction and then some more gains yet again? Because most banks and brokerages are now talking about 33 and 3,500. Goldman Sachs has talked about 4,500 if there actually is a recession and investment buying goes higher.
See, I don't, again, that's what I was trying to put it in a perspective when I started. I don't see any ceiling of the price. It could be 4,000, it could be 4,500. So any number you put it up, it will come eventually, right? It's just a matter of time. Whether it will come within this financial year, whether 4,000 could be touched within next 3 months, I'm not denying it. It can be possible. So 4,000 in 3 months, it's just another $800. It's like 15-20%. It could happen anytime, so it's not a big deal. But is it the current investment? If the new money is going into gold, whether it comes with a certain amount of risk, yes, the risk is elevated because the prices have run up too far too soon. So there could be price correction. So anybody who is willing to invest new money should be aware of that and should be able to utilize those opportunities. If there is a $300, $400 correction, it could be 5, 7, 8% at any point of time. That could be seen as a potential opportunity. But every time, as you are absolutely right, every time we say that you look for dips, those dips never come, and those dips are very temporary. They are very fast. You'll not be able to catch up. So it's always better to have a portfolio approach. You should be always having 5, 10, 15, 20% of your investments into gold and gold related investments. That's been preaching for forever. So people who have that, just sit on that, sit tight. I don't think there is any fear to be sitting in gold at this point of time. And I don't think there is a limitation of gold that 3,800, 4,000, 4,500 should be a limit. As I'm saying, if there is a global uncertainty and the central banks want to put more money, there is nothing which is going to stop.
Oh, well, okay. All right. Kishore, I also want to talk about metals now, because we've seen silver near those 12-year highs, unable to break those higher sides there. And metals, in the meanwhile, after doing very well for the month of Feb and March, have finally gone into profit-taking.
Yeah, I think silver, as always, we've been extremely bullish on silver for the last couple of years, and especially last year has been extremely good on the returns front. We continue to be bullish on that. So I think short term, 1,02,000, 1,05,000 could be a potential resistance levels, but I think we stick to our targets of 1,25,000 in India and around $45-46 in global terms. I think we still maintain the same. As far as non-ferrous metals are concerned, I think copper looks extremely good. 960, 970 could be on the cards. So I think the Chinese recovery is going to be very surprising and very powerful. So we were actually anticipating Chinese recovery to happen on a much stronger base towards around July, August. But I think the current indications are there that they could be doing much better by the end of April, May itself. So I think that's what the market is building up right now. So around 940, 960 could be short-term targets for copper.
Kishore, thank you so much for joining in. Well, I absolutely get your point that uncharted territories and the way the kind of uncertainty that we have in the international markets and that new money, smart money, safe haven money flying into gold, well, that is perhaps a place to be at this point in time. Thank you so much for joining in. Well, of course, tomorrow is another day and tomorrow is 2nd of April and we will see those reciprocal tariffs come in as well. So next 24, 48 hours going to be very, very volatile. But with that, it's a wrap on Halftime Report. The business lunch will take all the action forward.
Quarter of a century, zillions of designers, and orders of style later, Lakme Fashion Week is back to rock the ramp. This year's collection promises to showcase modern sophistication with effortless elegance. The showcase is set to be bold, reflecting a connect between beauty and style. Let's take a look at the showcase straight from the runway.
How do you think beauty and fashion empower young women like you in today's world?
So I think beauty and fashion, if you have fun with it, can be very, very empowering. Like me, I like dressing very casually. I like being very chilled out. I don't play too much with like colors and stuff. And that makes me feel very empowered and very beautiful. So I think it can be used as a tool to enhance your strengths rather than cover up your weaknesses.
Who are you walking for, and tell us about your inspiration behind it?
So I am walking for AKOK. I'm walking for Anamika Khanna, and I'm
Benchmark indices see a sharp cut, but the advanced decline ratio exhibits a positive bias, keeping the market trend muddled. Realty and IT and financials are the big drags, while telecom stocks gain. The government will convert about Rs 37,000 crores of Vodafone Idea spectrum dues into equity at a price of Rs 10 per share, raising its stake to near 49%. The move is expected to help the telco raise funds to meet its liquidity needs. The stock jumps, as does the vendor Industars. The stock of Hindustan Aeronautics perks up after it bags two orders totaling almost 63,000 crores rupees. The win swells its order book to over 1,80,000 crore.
ITC is set to buy Aditya Birla Realty's paper business for near rupees 3,500 crores. The deal is expected to add significantly to ITC's paper business and revenues by being earnings accretive. The word go is that Aditya Birla's Realty arm also gets a non-core exit. Noted banker Uday Kotak flags the negative spreads banks are seeing on loans backed by wholesale deposits. He sees a threat to the banking business model if deposit intake doesn't improve. Hello, good afternoon. You've tuned into Business Lunch, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. The beginning of the new financial year has not started on a great note. We're seeing red coming in across the screens. Nifty is seeing a very, very sharp decline at the day's lowest point. As of now, 23,184 is what the Nifty is at, down 1.5%. What's leading to the drags? We have the private banking side, so HDFC Bank, ICICI Bank among the top drags. Other than that, Infosys as well as Reliance, that's also seeing pressure coming in. IndusInd Bank is the one on the flip side of the private bank, which is managing to hold on to some bit of a gain. Overall, because most of the banking names are down and out, financial names are down and out, we're seeing Nifty Bank also trading at the day's lowest point. Mid and small cap, on the other hand, that is seeing a decline, but not as much as one was seeing coming in on the benchmark indices. Both of them are down almost 1%. Nifty small cap still better, down almost 0.7%. Mid cap was down 0.9%, like you just saw. Nifty Media, that's the only sector that's managing to hold on to some bit of a green today. Quite strong gains there. PVR Inox is managing to hold on to very, very good gains today as well. So keep an eye out on that. Realty, IT, Pharma, all of them seem clear pressure coming in. Tomorrow is 2nd of April. We're going to be seeing some announcement coming in from a Trump tariff point of view. So maybe some bit of that jitteriness that we're seeing coming in, especially for these pharma names as well. You know, what is that going to be is something that we're keeping an eye out on. But the stock today that we should talk about and keep an eye out on is Vodafone Idea. That's locked in upper circuit, and this came in after the government's has converted the spectrum dues worth nearly 37,000 crore rupees to equities, raising its stake to 49%. Let's go across to Rima, who's here to give us an understanding on this, what it means as well. Rima, afternoon.
Thank you very much for that. Indeed, the government of India has announced a major financial move, converting 36,950 crore of its spectrum dues into equity. Now, this will raise the government stake in Vodafone Idea from 22.6% to 49%. And even though the government owns 49%, the operational control of the company will continue to remain with the existing promoters. The shares will be issued at 10 rupees per share, which is at a 47% premium to the 6.8 rupees that the share price closed in Friday's trade. Now, this news is a big development for Vodafone Idea because, for starters, it improves the company's ability to raise 25,000 crore in bank debt, which has been long delayed. Secondly, the conversion will also ease Vodafone Idea's cash constraints significantly, at least in the first half of FY28, according to analysts, which will help the company execute its planned capex and also, in a way, perhaps arrest the subscriber losses. Moreover, Vodafone Idea's annual dues to the government will decline over the next 3 years, and these are the numbers which IFL has put out. They're saying in FY26, earlier, the company would have owed 29,000 crore rupees to the government. That number comes to 18,600 crore rupees. FY27, once the moratorium comes to an end, the dues will fall by nearly 20,000 crore rupees, from 43.5 to 23.5, and FY28 onwards, the decline will be close to about 10,000 crore rupees. So fairly sizable, even though the amount that the company still has to pay to the government is going to be pretty substantial. But according to analysts, this development could be a bigger positive for Indus Stars because it shows the government's continued commitment to maintaining a 3+1 market structure and a stronger Vodafone Idea. Now let's get to the brokerage views. IFL says government stake conversion postpones Vodafone Idea's problem. They note that the company's free cash flow remains insufficient for future payouts, and therefore they see the possibility of the government further increasing its stake in Vodafone Idea. That means continued dilution, and that could limit the upside for the existing shareholders. They say that if the government were to hypothetically convert all its dues into equity, its shareholding in Vodafone Idea would stand at 81%. They've got a reduced rating on the stock. Motilal Oswal says another lifeline for Vodafone Idea, but it's pushing the can further down the road. They say the key concerns still remain around subscriber losses. You want to stabilize that, debt raising, AGR dues. They've got a sell rating on the stock, but they've raised the target price to 6.5 rupees from 5 rupees earlier. And this is driven by the government's equity conversion at a premium. Moving on to Ambit, they've titled the report as Government Reaffirms Support to the Industry. They believe Vodafone Idea is best suited only for high-risk investors. They've got a buy rating, target price 15 rupees, because their rationale is the government has only converted its spectrum dues into equity. AGR is untouched, and that gives the government some scope, leeway, to consider further relief measures with respect to AGR dues, while Citi has placed both Vodafone Idea and Industars on a 90-day catalyst watch, citing 5G rollout in Mumbai and progress on debt funding as the key triggers. So for Industars, it's their top pick in the telecom sector. They've got a buy call. And Vodafone Idea, again, it's a high-risk call, buy call, target price 12 rupees per share. Back to you.
Okay, Reema, thank you so much for that. Surely keeping an eye out on a Vodafone Idea now in focus today, also managing to hold on to strong gains, like I mentioned before. But let's shift focus to the auto pack. Now, this is the first of the month. Auto sales numbers are pouring in for the month of March. Sudarshan is here to give us more details on this one. Sudarshan, good afternoon. And how are the numbers looking like so far for the month of March? Anything exciting?
Good afternoon, Vinny. So 3 auto companies have reported sales for the month of March as of now. One from the two-wheeler space, that is Eicher Motors, has reported numbers from Royal Enfield. By first look, if you look at the numbers would look much better than estimates. It has come 34% higher, and for the fiscal FY25, for the very first time, total sales have crossed 10 lakh units. But the problem here is most of the two-wheeler companies will be reporting numbers that would look elevated because of OBD norms. OBD norms, basically it's on-board diagnostic norms, that is for the emission standard. What has this done? Because it has come into effect from today, and this will lead to an increase in prices. Because of this, most of the two-wheeler companies have seen a pre-buying in the last week of March, and that's the reason numbers have seen a sharp rise. And that's the reason you can see even in the stock of Eicher Motors, it has come sharply off highs. Now coming to the two tractor-based companies, M&M and Escorts Kubota. First talking about Escorts Kubota, numbers are looking much better than estimates. Total sales have increased 15%. Even exports are higher and domestic sales too, so a rise of more than 15%. What does company say? Because of Chat Navratri, the sales have increased in the last week of March, and this momentum is going to continue. For M&M, both auto and tractor segments have reported numbers that were much better than estimates. So overall, as of now, all the companies that have reported numbers are better than estimates.
Okay, as of now, the numbers that are reported are better than estimates, is what Sudarshan has highlighted. But thank you so much for that. On that note, let's just slip into a very short break. We'll be back with more news and updates after this break.
Collection, and I think the inspiration around it is just warrior princess, something to make women feel very powerful, very strong, very modern, very cool. That's her inspiration, I'm assuming. I'm just channeling that.
The opening night showcased designer Anamika Khanna's designs that celebrated bold, ambitious women who own their space, lead with confidence and inspire with their individuality.
It's been 25 years of Lakme Fashion Week. What is in store and what can we expect?
As you can imagine, it's the most emotional, sentimental moment for us. 25 years of all of us together. It's going to be a spectacular celebration, and I'm so looking forward to it.
Can you tell us on what the collection is all about?
This collection, it's called the Silver Collar, and as the name suggests,
Welcome back. Thanks for staying tuned into Business Lunch on CNBC TV18. Now let's move on, and before we slip into this week's more updates coming in and what is happening on the market front, we had seen NASA astronaut Sunita Williams as well as Butch Wilmore, who finally reached Earth after spending 9 months at the International Space Station. In their first press conference, they said that they spoke about who is responsible for the issues and more on that front. Listen in.
There were some issues, of course, that happened with Starliner. There were some issues, of course, that happened that prevented us from returning on Starliner. And I'll start with me. There were questions that I, as the commander of the spacecraft, that I should have asked, and I did not. At the time, I didn't know I needed to. And maybe you could call that hindsight, but I'll start and point the finger and I'll blame me. I could ask some questions, and the answers to those questions could have turned the tide. So blame, that's a term, I don't like that term, but certainly there's responsibility throughout all the programs, and certainly you can start with me. Responsibility with Boeing, yes. Responsibility with NASA, yes. All the way up and down the chain. We all are responsible. We all own this.
We all have alluded to it. There's lessons learned. And that's like a piece of hope, right? We're not just sitting here doing the same thing over and over again, and we're learning from every mistake potentially, or maybe a decision that we've made and how we could make that better and do better the next time. When we go to the moon, we won't have an International Space Station to maybe take a stop at. We really have to get it right. And because of our mission, I think that highlighted some areas where maybe we need to work on and get it right for our fellow astronauts. I think they're encouraged by that, right? You learn and you move on and you get better. And I think that's part of the learning process. It's part of the exploration process.
Let's move on, and now the IMD has given a forecast for a hotter than usual summer with above normal number of heat waves in 2025. Sandhya joining in with us to give us more details on this one. Sandhya.
Yes, IMD has forecast a hotter than usual summer for 2025. As you can see, and I'm here on the screen itself, IMD has stated that for the duration of April to June, many parts of the country, including central parts of central India and northwest India, will experience above normal minimum and maximum temperature. So this is for the duration of April to June. This is for the maximum temperature, and this is for the minimum temperature. For the month of April, the maximum temperature, you can see parts of northwest India, Central India, Eastern India, and some parts of Peninsular India will witness an above normal maximum temperature. And for the month of, again, April, the minimum temperature will be above normal in North India, Northwest India, Central India, Peninsular India, and parts of Eastern India. To make matters worse, as per IMD's forecast, the number of heat wave days will also be above normal this year. And here you can see in this chart, parts of Eastern India, North India, some parts of Peninsular India and Northwest India will witness above normal heat wave days in the duration of April to June, and this combination of high temperature and prolonged heat wave is likely to drive India's peak power demand this year.
Absolutely, Sandhya. Thank you so much for that. Now let's move on, and the stage is set. The leaders are ready. News 18 Rising Bharat Summit 2025 brings you thought-provoking conversations, groundbreaking ideas, and the voices shaping tomorrow at the Bharat Mandapam, New Delhi. Be there, scan the code, and get your passes now. April 8th and 9th, save the date for the event.
Elevating workwear for women, and the very fact that we don't really follow rules anymore. Everybody is bringing that power to the workspace, but they also bring that emotion, the gentleness and all of that. So it's just about elevating workwear to another level.
One message that you would like to see your brand on these young empowered women wearing your collection?
I feel like if my collection can give you a sense of freedom, I've done my job. And that's what I want to do. I want to make people feel free.
From legacy designers to fresh voices, Lakme Fashion Week continues to redefine not just trends, but the business of fashion. In Mumbai, Xenia Baria.
Did you know Tirupati's Lord Venkateshwara temple is all set to earn an annual revenue of 1,729 crore rupees for FY26? And we're talking just revenue from collection boxes alone. This means that one of India's holiest and most culturally significant temple sites will see its annual revenue from collection boxes far exceed the total net worth of A-grade celebrities and cricketing icons much like Sachin Tendulkar, Virat Kohli, MS Dhoni and Amitabh Bachchan, even as the temple is all set for a bumper FY26. In its recently released budgetary estimates for FY26, the Tirumala Tirupati Devasthanams, that's the management committee entrusted with running the Tirupati shrine, has laid out a budgetary outlay of 5,259 crore rupees, which is a testament to the cultural, historic, religious and even the financial significance of the Venkateshwara temple. Now the TTD, which is of course the abbreviation for the Tirumala Tirupati Devasthanams, has
Welcome back to Business Lunch on CNBC TV18. Now let's move on. And US President Donald Trump's Liberation Day is just around the corner with the imposition of reciprocal tariffs due tomorrow, that is the 2nd of April. We have Pariksha this year to tell us on what this could mean for India.
Donald Trump is set to announce tariffs on all nations that levy duties on US goods on the 2nd of April, and he is calling this Liberation Day. He will be unveiling country-based tariffs in Rose Garden in the White House. Treasury Secretary in the US has said that the tariff announcement would be at 3 p.m. Eastern Time on Wednesday, which would be 12:30 a.m. India time on Thursday. Trump has said that he expects substantial tariff cuts by India ahead of Liberation Day, and he went on to say that India has agreed to reduce tariffs. The 25% auto tariffs announced earlier will also come into effect on the 2nd of April. Sources tell CNBC-TV18 that the US believes that talks with India on the bilateral trade agreement have been very positive. In fact, the US side is encouraged by India's offer of reductions in tariffs and non-tariff barriers and is now considering a pause on reciprocal tariffs on India by a month or so. Reciprocal tariffs are likely to be applied for all nations, including India, but a temporary reprieve is under consideration. US officials believe substantial progress has been made in talks of market access in all areas except for agriculture and dairy. India's removal of 6% equalization levy and also the reduction of tariffs on cars and motorcycles in the union budget and also tariffs on bourbon whiskey has been welcomed by US authorities. India's Commerce Ministry has said that India and US have broadly come to an understanding on the next steps towards a mutually beneficial multi-sectoral BTA. The ministry said that both India and the US have expressed satisfaction with the outcomes of the meeting.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday, you're going to see, and they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us, and we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
And there are also a number of unknowns which are contributing to the uncertainty around the imposition of the tariffs. Prashant is here to give us more details on this one. Prashant?
Well, it is time to focus on those April 2nd tariffs, isn't it? Will Trump's tariffs be bigger and more disruptive than commonly believed? To be able to answer that question, we need answers to a few questions. Answers that at least right now we don't have. Let me try and explain. There are 4 questions around the April 2nd announcement which remains unanswered. The first is timing. There is still no clarity on whether Trump will use tariff law requiring a mandatory review period or instead use emergency powers that allow tariffs to take effect immediately. My guess is Trump aims for the latter. There is also the potential for tariffs to be phased in, which means you want to impose 20, you go in with 10 and then spread out the rest of the 10. If it is phased in, it will and it should take out some of the initial sting from the announcement of tariffs itself. A second question is the size. not so long ago, the consensus worst-case scenario was a universal tariff near 10%, with China tariffs higher. These consensus estimates have risen, but I see the risk of something closer to between 15 and 20% for many countries. Few carve-outs are expected, at least as far as the first round is concerned, based on statements we've heard from Trump administration officials. Third, there is the question of which countries are going to be impacted. Recently, Treasury Secretary Scott Bessent mentioned a list of the quote-unquote dirty 15. He didn't name countries per se, but the EU, Switzerland, Japan, South Korea and India are likely included on the list, along with, of course, Canada and Mexico. These 15 would make up some 80% of US imports. Finally, there is the question of how other countries respond. Remember, earlier this year, the consensus view was that other countries would use restraint in the response to these tariffs, Trump tariffs. Can we be so sure of that now? Unlikely. Many countries are openly now saying that they plan to impose or rather retaliate in response to Trump's reciprocal tariffs. And these are the four reasons mainly why there remains an enormous amount of uncertainty around what is coming in basically the next 36 hours or so. Let's for a minute zero in on India and the potential impact here as well. I'm using calculation of JP Morgan economists here. The tariff the tariff differential weighted average basis between India and US, basically what India imposes on US goods and what US imposes on Indian goods going there, is 8%. JP Morgan, though, points out that the number rises substantially if the US administration decides to include VAT of 18%. Their estimates suggest that the GDP impact could be about 20 basis points if it's just weighted average reciprocal tariffs, but the impact could be 50 basis points if reciprocal tariffs include the tariff differential plus VAT as well. Now let's just take a quick look at the sectors here, right? This again from JP Morgan economists shows that tariff differentials against exposure to the US. The sectors here that appear to be most vulnerable, as you can see, the first column is exports to US as a percentage of India's GDP. Second is tariffs by US and India and tariffs by India and US. So the difference between this and taking into account the exposure to India GDP is what we're talking about. And by that measure, the sectors which are most impacted seem to be chemicals and pharma, textile and clothing, agri and meat products. These are the three areas where perhaps there is likely to be the biggest question mark. The big question out of all of this for markets really is this: will April 2nd, or US Liberation Day as Trump is phrasing it, be a risk shock? Can there be downside surprise, or can it be a clearing event, a hump which the market crosses over and finds better pastures on the other side? It has been exhausting for markets to trade and chase Trump tariff headlines, and now finally we don't have to wait very long to find out. Back to you.
Absolutely, Prashant. Thank you so much for that. But let's also get you some important voices ahead of Trump tariff on 2nd of April announcements coming in there. Neelkanth Mishra of Axis Bank tells CNBC-TV18 that tariffs can impact global GDP by up to 1%, while Sunil Kaul of Goldman Sachs says that reciprocal tariff number for India could be 11%. Listen in.
We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. Now for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if US matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT. Europe is obviously a large risk there as well. So depending on what the number could be, it could be north of sort of pure 11 percentage points, which is based on the weighted average tariff rates.
Okay, and with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Midcap Radar up next.
I think the first thing we have to address is safety and hygiene. I think we have to be perceived, and we'll only be perceived if we are a very safe place to travel for everyone, including particularly women travelers. So I think we all know there have been enough incidents, they keep happening. That has to stop. Otherwise, what happens, we'll have two kind of tourists. We'll have the super rich tourists who come and have the 5-star premium holiday, rose-tinted glasses, blah, blah, blah. They go see everything. They don't really feel India, but they're seeing a very sanitized India. Or you have the backpacker who's out in the hills and doing whatever they're doing, coming from wherever, etc. That's so you don't have the classic middle class.
And there have been stories, Shireen, believe it or not. I mean, I remember those moments because when IPO happened, they suddenly started going back to their records and saying, where's that damn paper that you have?
Where's that piece of paper?
Where's that piece of paper? Because nobody really realized that it had any value. And some of them came back and then we've lost it and can we just get it back, right? So it was really, really good to see.
They probably didn't think that anything would come off it, right? So you're tucked away in some file
luckily
somewhere.
finance had all records and everything's electronic. But yeah, people were like that. I remember them coming saying, "Aapne kuch ek wo diya tha, letter nahi mil raha." They were scared. It's gone.
So you're the big daddy at Make My Trip, but you're also the big daddy for the startup ecosystem.
Yeah, from young Turk to not so young Turk, 25 years. So I think we all grow up. Now that you showed me the old young Turks we did.
Yes.
And you and so Shireen and CNBC, you might be our good luck charm. So you've seen us through thick and thin. And I officially want to thank you for being a huge supporter through our toughest times. So, we recall that and don't forget when people, help out when in the tough times. So thank you for that.
Matters pertaining to the running of one of India's holiest shrines. In a recent announcement, the TTD said it would sack all non-Hindu employees of the temple itself, thereby ensuring that only individuals who practice the Hindu faith will be involved with the conducting of sacred rituals within the temple itself. The budget session also saw the TTD make an announcement for the formation of a special committee to oversee the protection of all TTD-owned lands across the country. However, the 1,729 crore rupees by way of collection box revenue isn't the only revenue source for the managing committee, which of course is independently run, remember. The total of 600 crore rupees by way of income from the sale of prasadam also makes for a significant revenue source, even as nearly double of that, that's 1,310 crore rupees, comes by way of interest earned by total of 18,000 crore rupees of Tirumala Tirupati Devasthanam cash that lies in fixed deposits in several banks across the country. Insofar as cost heads are concerned, the major one totals to around 1,773 crore rupees by way of quote-unquote HR payments, which translate to salaries that will be disbursed to all employees of TTD, even as a total of 769 crore rupees has been earmarked as a cost head towards expenses pertaining to material costs that will be used for reconstruction or renovation purposes across the temple itself. But for the moment, that figure of 1,729 crore rupees by way of collection box.
It's the start of a new week, a new month, a new quarter, a new financial year, and I have a new co-anchor sitting next to me here watching Midcap Radar this afternoon live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Fatakia, and joining me today is All Things Capital, Vamakshi Dhoria, Capital Goods, Capital Markets, on top of everything. Vamakshi, good afternoon. Welcome to the show.
Well, good afternoon, Hormas. It's the beginning of the new financial year, and it's a new start for me as well. So thank you so much for that. The markets as of now do look a little wobbly. In fact, not a little wobbly, a lot wobbly. It's red across the screen. And on that note, let's get started with some of the top headlines. Benchmark indices see a sharp cut, but the advanced decline ratio exhibits a positive bias, keeping the market trend muddled. Realty, IT, and financials are the big drags, while telecom stocks gain. Mid-cap relatively perform better.
The government will convert about 37,000 crores of Vodafone Idea spectrum dues into equity at 10 rupees a share, raising its stake to near 49%. The move is expected to help the telcos raise funds to meet its liquidity needs. The stock jumps 22% as that of vendor Indus Towers as well.
Stocks like HAL, HBL, Engineering, Sterling and Wilson and KEC International are in focus on the back of order wins. The stock of Hindustan Aeronautics perks up after it bags two orders totaling almost 63,000 crores. HBL Engineering gets 5 letter of awards worth almost 763 crore rupees. KEC International bags orders worth 1,236 crore rupees. Meanwhile, Sterling and Wilson gets letter of award for 3 projects.
Real estate stocks like Godrej Properties, Lodha, Raymond, all of them actually of the Nifty Realty is under pressure today after the Maharashtra government has increased the ready reckoner rates of Mumbai by 3.5% and the state average by 3.9%.
Punjab and Sindh Bank along with UCO Bank are among the top PSU bank losers today. Both stocks closed their QIPs last Friday.
As Vamakshi was just mentioning, it's not looking a little wobbly. It's very wobbly right now as we count down to the final 2 hours of the trading session. 360 points down on the Nifty, 1,400 points down on the Sensex. The Nifty now well below the 23,200 mark as we speak. The advance decline too, though firmly in favor of the advances. Now that is a trend that you would want to see, a 360 point cut on the Nifty, but 1,700 stocks advancing on the NSE, the 8 compared to 900 stocks declining, and it's a very parallel line as you can see, firmly in favor of the advances. But which are those stocks that are contributing to this trend? Vivek is now across the wall to take us through some of these mid-cap movers. Vivek, good afternoon.
Well, good afternoon, Hormaz, and good afternoon to Vamakshi as well, and wish you all the best in this new journey. Well, quite a few stocks in focus. The mid-cap end of the market, it's buzzing a lot, and especially quite a few stocks have received order wins on the back of which they are buzzing significantly. Look at names like NCC, beating its order inflow guidance. Look at names like Sterling and Wilson, HAL, something you alluded to at the start of the show. All of these stocks doing quite well, and on the back of the order wins here. A lot of stocks on the back of positive news flow. Again, something that we alluded to at the start. Vodafone Idea higher by 23% in the stars on the back of positive news flow for Vodafone Idea, up almost 6%. Wadilal Industries, management warring parties actually coming to some sort of an agreement on the back of that, almost 10% higher. Hoodco strong disposals. Borosil Renewables earlier telling us that strong positive is what they're expecting as far as the EBITDA break-even is concerned for this particular quarter. Mid-cap laggards, well, quite a few stocks in focus, lot on the back of news flow. UCO Bank, one of the top laggards as far as the banking pack is concerned. Remember, the entire BFSI space is under pressure today. Voltas, market share concerns continue over there, 6.5% lower. Umber Enterprises, one of the top laggards on the NSE 500. Blue Jet Healthcare and income tax demand coming in for this particular company, a large income tax demand, almost 5% at the lower circuit. Avanti Feeds, another stock rounding off as far as the laggards are concerned. The entire real estate pack under pressure today. Remember, MMR region, there has been a hike as far as stamp duty is concerned. Now, worries are rising as far as demand, as well as increasing TDR leading to margin erosion for developers. The entire pack, Oberoi Realty, Godrej Properties, Macroeconomic, all of them under significant pressure today. And lastly, let's go to the pharma pack. Impending tariffs loom large. Overhang as far as the entire sector is concerned, especially generic players. Remember, whole host of Indian companies get majority of their revenues from the US markets, and on the back of the entire pack today under significant pressure. Ipca Labs, one of the top laggards, almost 7% lower. Suven Pharma down 5%.
Well, thank you so much for that, Vivek. Markets continue to tumble, but the mid-cap index is attempting to make a slight bit of recovery, and it's a good time to get a technical check. Let's welcome Shrikant Chauhan from Kotak Securities for a technical check on the market. Well, good afternoon, Shrikant. This is Vamakshi Doria joining in. Shrikant, what are the levels that you're watching out for now?
Good afternoon, Vamakshi. Well, for Nifty, our view is that it is correcting to the spectacular rally that we saw from the levels of almost 21,800 to 23,800. So in a very short span of time, the market managed to gain 2,000 points, and now it is correcting to that. Also, if we go through with weekly formation of the Nifty, then it was very clear that someone has taken a huge profit at higher levels, and the closing was very close to the opening levels of the previous week. So while looking at the entire setup of the market, I am of the view that this is something which we are going to face in terms of corrective pattern, and we may see the levels of 22,900 or maybe 23,000 very shortly. So around those levels, the market is having next leg of support, and I'm expecting market to stabilize around those levels. So yes, we may see some more correction, but close to 22,900, we should be active buyer, or we should look for taking some contra bets in the market.
So Shrikant, are you looking at buying anything at these levels, or are you looking at selling some things?
See, at these levels, if we go through with the mid-cap stocks, then specifically most of these stocks recover from their lows, and few of them have crossed their important resistance levels. Also, we saw some specific technical formation in few stocks with the help of which we can decide the next target for the stock. So in that specifically, we like Hindustan Aeronautics. See, like all these defense stocks, they are doing really well, and they did well when there was like a specific recovery, and also there is specific news flow. So if we consider the technical formation of Hindustan Aeronautics, then it is forming V-shaped recovery. And based on that, I'm expecting this stock to cross the level of 4,800 or maybe again 5,000 in the near future. So it's a buy at current levels around 42.50. In case if there is any correction, then we should look for adding some more. I'm not now expecting the stock to sustain below the levels of 3,900 so easily. So it's a buy at current levels and more on dips. The other stock which we like is GAIL, Gas Authority. And there also, if we go through with the monthly pattern of the stock, then it is clearly indicating us that it has reversed its previous trend, which was falling. And now it is moving towards the levels of again 220 or maybe 225. So it will take some time. Next maybe few months, we could see these levels. But broadly, I am of the view that the stock has seen its worst. And again, the strategy should be to look for adding at current levels and more on dips.
Well, Shrikant, you mentioned GAIL has seen its worst. I would like to put in one more stock here that a lot of people on the street would want to know, and that is Vodafone Idea. And can't not help but ask that question. A 22% up move in today's session now. The stock is around about 8.5 rupees. Would you use this bounce to exit the positions, or do you put Vodafone Idea into the same camp as GAIL, saying that the worst is over?
Yeah, Ormas, I think, based on technical formation, I am of the view that the stock has seen its worst. The reason is because the previous low, which the stock has made in the month of November 2024, that time the stock was around 6.6. And on Friday, when there was like weakness in the market and the stock was sliding, the lowest was around 6.77, which was slightly above its previous lowest level, which always helps technical analysts to take some specific call on the stock. So based on that, I am of the view that the stock is forming some double bottom sort of formation, and we could see the levels of maybe 11 or maybe 12 in the near future to validate the double bottom formation. But yes, based on the volume and based on the news flow, I am of the view that the stock has formed double bottom sort of formation, and in the near future, we are heading towards 12 rupees.
Heading towards 12 rupees, that'll be good news for a lot of those people who were issued shares in the FPO as well, that the FPO price was 11 rupees. So Shrikant, thank you so much for sparing time joining us today with your views on the index and on specific stocks as well. We take a short break, but just before we do that, a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates the SMEs that are pushing boundaries, making an impact, and are shaping the future. Nominations are open now. You can scan the QR code and submit your entry for the SME Champion Awards Season 2. Take a short break. Back on the other side.
making heads turn even as it underlines the Tirupati shrine's significance as India's holiest, most culturally significant and richest temple site.
One is timelines, but what about costs? I mean, how much does it cost to put out a drug in the market today?
A little over $4 billion per drug.
$4 billion per drug.
Just before you make one sale. Yeah. So it's hugely expensive and complicated and slow. So on average, the industry takes about 14, 15 years. We're about half of that, but we spend about the same as others. And that is a function of both, I think, two big trends. One is hard to change, which is that science builds on itself. Mm-hmm. And so each new drug has to demonstrate benefit over everything that came before it. So we actually have to make those comparisons. Of course, as a multinational company, global.
Welcome back. You're watching Midcap Radar on CNBC-TV18. A whole host of capital goods and infra stocks are reacting in trade on the back of order wins. Vivek Iyer now joins in with more details on this. Vivek?
Well, that's right. So capital goods, infra, defense companies, all of them rushing to go ahead and announce order wins that they received before the end of FY25. A lot of news flow on the back of those particular developments that have been announced. So first on the list has to be Hindustan Aeronautics. What a large order win that the company has announced. 2 contracts worth almost 62,700 crore rupees. This for the supply of 156 light combat helicopters. 66 of those helicopters will go to the Indian Air Force and 90 to the Indian Army. The other stock in focus is actually HBL Engineering. The company has received 5 letters of awards totaling worth over 760 crore, and this is for various coverage projects that are being undertaken across the country. The other stock on the radar is KC International. Again, the company has gone ahead and given an update to the exchanges that they've received orders of a little over 1,200 crore rupees. This is across various segments that the company is present in, T&D, civil, as well as transportation. And lastly, Sterling & Wilson, a very sharp mover in the session today. The company has announced that it has received 3 orders worth 1,470 crore. The first order is for a wind EPC project in Rajasthan. The second order, where the company is the L1 or the lowest bidder, for a 200 megawatt solar project in Gujarat, and this is from a PSU company. And lastly, the company has also received an order for a solar project in Rajasthan, and this is for a private independent power producer. So overall, order inflows quite strong, especially in the last week of FY25.
Indeed, Vivek, thanks a lot for that, and a significant recovery also seen from the lows of the day for both KC International and for Sterling & Wilson as well. Now 5.5% higher for Sterling & Wilson, and of course HBL Engineering 12% higher, the second best performer on the Nifty 500 in today's session. But a pocket that's not doing very well in today's session though is real estate, and place agnostic, every real estate developer on the Realty Index today is trading with very, very sharp cuts. Vinny is here to tell us why. Vinny?
Afternoon, Roma. So yes, we have all these real estate names that are under pressure. Now, specifically, we have an announcement that's come in for the Maharashtra front and Mumbai real estate developers. Now, the ready reckoner rates that have seen a hike coming in. This is coming in almost after 2 years. We're seeing a hike coming in. Now, the Maharashtra rate overall, when you see on an average, state average, the ready reckoner rate has seen an increase by 3.9%. Specifically, Mumbai is 3.4%. Now, this 3.39% hike that we're seeing coming in is something for Mumbai is much lower than the other cities in the state that we have seen coming in. This will help Maharashtra government increase its revenue by almost 10,000 crores in terms of the collection that is made from them on this front. So that is something positive from the Maharashtra government point of view. But from a developer's point of view, a bit of a concern comes in because there's an increase in terms of prices that we see. And higher ready reckoner rate means higher stamp duty prices as well as higher property prices. Some bit of a pressure on that front. Though when we spoke to some of the experts, they did say that, this hike is, something that surely was on this line, expected lines that one we were seeing coming in. It's an acceptable one because most of the transactions currently are taking place at much higher rate, higher market rate. So this will impact ones which are at the lower rate. So it'll be very specific in terms of that. But yes, some bit of a pressure surely we're seeing coming in on these stocks.
Well, thank you so much for that, Vinny. The Nifty Realty space definitely seeing a fair bit of pressure in today's trading session. In fact, the Realty Index is the top sectoral loser today. Now, on to some exclusive news now. Sudarshan is joining us with the details. He is picking up on the Karnataka mineral bill case. Over to you, Sudarshan.
So it's a very interesting update, especially for Karnataka iron ore companies like NMDC, Sandur Manganese, JSW Steel and Vedanta. If you remember, in December 2024, Karnataka State Assembly had approved new mineral rights bill, and that could have led an increase of at least 100% more in the iron ore mining that company does. So basically, it would have increased the prices. Now, tax, basically it would have increased the tax that NMDC or JSW Steel pay to state government. Now the update is that it had gone to governor, and governor had sent the bill back to government asking for certain changes to that bill. Now the new update has come that Karnataka governor has decided to send the bill to president. So now what happens? So state governor can reject the bill once, not twice. If he, for the second time, he has no option but to approve the bill. But unlike governor, president has right to withhold the bill. So now what would happen now? President will direct the governor to send the bill back to government, and state government would have 6 months to make those changes. After 6 months are done, the bill will go back to president, and now it would be in the hand of president if she decides to approve or withhold the bill. Also, unlike governor, she has the option to make the bill null and void. So it's very positive for all these companies, especially NMDC, for which more than 30% of revenue comes from the state of Karnataka. So for now, this bill at least gets postponed for more than 6 months. Now it's in the hand of president if she decides to withhold or approve the bill.
Indeed, and it's showing up on the price as well, right? 0.8% higher for NMDC. Sudarshan, thanks a lot for that. We take a short break, but just before we do that, here's some good news for our viewers. And India's business news leader is now just a click away, and that is, of course, CNBC TV18's all-new app. You can get instant access to breaking news, financial world articles, all of that on your fingertips. You can download the app from the App Store or the Google Play Store, or you can also download the app from the QR code that comes up on your screen. Take a short break. Join us on the other side.
I think the first thing we have to address is safety and hygiene. I think we have to be perceived, and we'll only be perceived if we are a very safe place to travel for everyone, including particularly women travelers. So I think we all know there have been enough incidents, they keep happening. That has to stop. Otherwise, what happens, we'll have two kind of tourists. We'll have the super rich tourists who come and have the 5-star premium holiday, rose-tinted glasses, blah, blah, blah. They go see everything. They don't really feel India, but they're seeing a very sanitized India. Or you have the backpacker who's out in the hills and doing whatever they're doing, coming from wherever, etc. That's so you don't have the classic middle class.
And there have been stories, Shireen, believe it or not. I mean, I remember those moments because when IPO happened, they suddenly started going back to their records and saying, where's that damn paper?
Where's that piece of paper?
Where's that piece of paper? Because nobody really realized that it had any value. And some of them came back and said, we've lost it and can we just get it back, right? So it was really, really good to see.
They probably didn't think that anything would come off it, right? So you tucked away in some files
luckily
somewhere.
finance had all records and everything's electronic. But yeah, people were like that. Like I remember them coming saying, "Aapne kuch ek wo diya tha, letter nahi mil raha." They were scared. It's gone.
So you're the big daddy at Make My Trip, but you're also the big daddy for the startup ecosystem.
Yeah, from young Turk to not so young Turk, 25 years. So I think we all grow up. Now that you showed me the old young Turks we did.
Yes.
And you and so Shireen and CNBC, you might be our good luck charm. So you've seen us through thick and thin. And I officially want to thank you for being a huge supporter through our toughest times. So, we recall that, and don't forget when people, help out when in the tough times. So thank you for that.
Not really for tariffs. We think actually both non-tariff and tariff trade barriers should fall everywhere so that everybody can enjoy the benefits of products, and we have global competition that's balanced and fair. If there are tariffs on pharmaceuticals, I understand what's being discussed is more of a general tariff situation. For us, that has limited impact because we have very regionalized supply chains already. We can move things around, and our cost of goods is not so sensitive to the end price. I think the big thing in healthcare people are watching is the generic industry, where the cost of producing the medicine is much higher compared to innovative. Our biggest cost is R&D. Yes. They don't have R&D. So that might affect medicine costs in the US or in other countries, and that would be that would not be good, I think.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Welcome back. Still 350 points down on the Nifty, but the broader market still, though the advance decline still firmly in favor of the advances. And one stock that's contributing to that is AGI Greenpack, and that's after the board has approved a 700 crore rupee investment for a new container glass plant. Manglam is here to tell us more on that. Manglam.
Well, it's a positive development where the company, on the uncertainty of the acquisition of Hindustan National Glass, despite that they've decided to move on and get on with their organic and inorganic capacity addition plans. The one part of that is the 700 crore approval that has come in from the board to set up a new container glass plant in Madhya Pradesh, which augments their capacity by about 25%, which takes the daily production of that plant to around 500 tons per day itself. And more importantly, they expect this will commence operations in the next 24 months. We spoke to the management this morning, and this is what they had to say on the revenues. This would yield about 700 crores in terms of revenue, because the asset turnover on this plant or this investment is close to 1x, and they will see growth of 4 to 5% in an overall business revenue in FY25, and next year they target 8 to 10% growth. Margins in the new plant, because it's ramping up with all the investments, etc., would be 20% for the first 2 years. Thereafter will ramp up to 25%, and they are targeting increasing their capacity from current levels to around 50 to 60% in the next 1 to 2 years, both organically and inorganically. So the street, had downgraded the stock ever since the acquisition of H&G did not materialize. But now the stock is doing well because the street wants to move on from that, and the company itself has said that they have put that behind themselves and are looking to expand their capacity. In fact, we spoke to the management, and this is what they had to say.
So the board has decided that now we should look forward to, other organic and inorganic acquisition opportunities as they may come through. And this is the first step towards that we are implementing a 700 crore capital expenditure plan in state of Madhya Pradesh to have a state-of-art, container glass facility. With this investment of 700 crores, we feel that this should lead us to at least 1 time sales turnover to start with. But as we move forward, the opportunities to expand at that site also, is not ruled out. We should close at somewhere around 4 to 5% growth as compared to last year, although the profitability has been higher. And next year onwards, based on internal, capacity debottlenecking, which we have done, we feel 8 to 10% growth is feasible for the next financial year. And this new capex will overall give 25% growth. So there are other plans which we are evaluating, but not yet approved by the board. I think once approved by the board, we'll definitely come back and explain them also.
Well, moving on to the financial sector, Uday Kotak in his latest tweet warns of a significant deposit crunch threatening banks with margin erosion. He said, and I quote, "Leading banks are taking one-year wholesale deposits at 8%, translates to loaded marginal deposit costs of 9% plus after CRR, SLR, deposit insurance, priority sector, excluding OPEX. Low-cost retail deposits show muted growth across the system. Yet, banks are issuing home loans at 8.5% floating rate, borrowing at 9% and lending it at 8.5% at a 0.5% spread, and repo rates likely to drop. What about the OPEX credit costs? If the deposit tightness persists, it is a challenge to the banking business model." That's the word coming in from Uday Kotak.
In fact, we spoke to Rahul Jain, who's the head of PSE Financials and India Equity Research at Goldman Sachs, for his views on this issue and what does this mean for the sector. Listen to what he had to say.
I think we are seeing the stock market kind of bottoming out, and there are opportunities that are opening up, and even banking sector, which has outperformed in the last couple of weeks in particular. But the fundamentals are still looking a bit like a muddle-through scenario at this point of time. And liquidity is an important area where I think while the RBI has been trying to do a lot more, but the banks are still looking to raise money at an expensive rate. There has been a rush to raise the year-end deposits. So we have seen a significant activity in the certificate deposits, and some banks even offered higher interest rates there. And I guess the point that you're referring to is on the margin about the incremental profitability that you're making on incremental borrowing. So I think it kind of allows me to also segue into my overall view on the sector. And there we see the muddle-through scenario to continue for the banking sector.
With that, we call time on this edition of Midcap Radar. From a happy and relieved Vamakshi and me and the team that put this show together, thank you so much for watching. We leave you with the Nifty still down 360 points. MF Corner for the next 30 minutes.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first.
Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC-TV18. I'm Vinny Motiwala and thank you so much for tuning in. Today, what we're going to be putting the spotlight on is stress test results that have come in for the small cap mutual funds. And this is at a time when the market has been so volatile since January. We've seen a fall coming in for small cap, mid cap sides specifically. And even in terms of funds, if you just look at the short term return, we've seen that decline coming in here. Now, we'll touch upon the relevance of conducting stress test results for the viewers, what it means for you as as an investor. Also, we'll be discussing more on, what this will indicate, what are the red flags that you all should watch out for from these stress tests as well. To discuss all of this, we have Nirav R. Kurkera, Head of Research as FISTM, joining in with us to talk to us about all of this. Nirav, very good afternoon, and thank you so much, as always, for joining in with us on the show. I'm going to just start by talking about the basics. First is, what exactly is stress test in context to the small cap mutual funds, and how is it normally conducted? What does this indicate for an investor as well? What should they be making of this?
So, Vinny, always a pleasure chatting up with you on the most relevant topics. So, the stress test is a very recent phenomena. It was introduced by way of a circular/guideline by SEBI. So, for the longest period in time, one of the biggest issues that small cap and mid cap funds would grapple with would be the liquidity profile of the underlying stocks, right? We have often heard about several funds taking exposure to low float stocks, etc., right? And most investors were left in the lurch wondering how could they even assess the liquidity of the portfolios managed by several mid and small cap funds. So here SEBI, of course, in line with its investor protection agenda, decided to bring a certain sense of uniformity and comparability between small and mid-cap funds, especially in context of the liquidity of the portfolios that they hold. So SEBI has, of course, outlined a mathematical way in which fund houses are to compute the liquidity of their specific portfolio. While the formula is highly convoluted, I'd say a simple way to look at it is to look at way is funds evaluate how long will it take for them to liquidate half of its portfolio, that is 50% of its portfolio, and at the same time, how long would it take for it to liquidate 1/4 of its portfolio, that is 25% of the portfolio. Now, the math here entails a lot of math around the historical volumes in very specific counters or very specific stocks that they have included in their portfolio. But this serves as a very good yardstick for investors to compare different funds on their liquidity profile. Of course, the standard metric used here is number of days. So an easy way to interpret liquidity stress test is it's going to take X number of days for a fund to liquidate 50% of its portfolios, or it's going to take wide number of days for a portfolio to be for 25% of the portfolio to be liquidated, right? So this is the standard interpretation with which an investor can look at these details, which are now mandatorily published along with the fact sheets every month.
Right. So, Nirav, in short, then, does it mean that if, there are fewer days to liquidate, then that is a better option to go for always? Does it indicate that just as a metric? So, there are other factors also one should watch out for here.
So definitely there are several other factors that one must look at while choosing a mutual fund, especially in the mid and small cap space. But definitely, if you are going to evaluate the liquidity risk involved in two different portfolios, this is a go-to metric. A lower number of days indicate that the portfolio is highly liquid. However, a highly liquid portfolio does not entail a high-quality portfolio or a high-performing portfolio as well. It could be very well possible that the liquidity of a portfolio might be slightly low, but at the same time, it could be a very good portfolio. So this is just a starting point. This is just a risk assessment metric. This is not going to be your foundation for deciding which fund to go for.
It's just one of the things that you should keep an eye out on when you are investing. Not the most important one. There are other factors also that you should keep an eye out on. Nirav, one point that I want to understand, while fund houses carry out and evaluate this metrics in terms of stress tests for small cap funds specifically, but how is it important in terms of during these market downturns? How do they evaluate during that time? Liquidity crisis, these are concerns that come in as well. So is there some different matrices that they also follow during this time?
So, the beauty about this metric is that it is to be held uniform across market cycles. And, it is only when the tide goes out that we get to actually see how liquidity profiles are being managed. So, during an uptrend and typically, when the volumes are really high, it would be very easy for most stocks to enjoy a higher float or higher degree of volume and a higher liquidity as an after effect. aspect of it. But during troubling times, it is when it is actually put to stress. So this is what the stress test tries to really bring out. So it tries to highlight the liquidity of a portfolio even when under pressure. So during good times, of course, no one's talking about liquidity, no one's talking about risk, but it is during such scenarios where this particularly comes handy.
So Nirav, this is the right time to check this, right? Then which is the best fund for you in terms of liquidity as well? Given that small cap, mid caps have seen that fall, then would this be the perfect time to judge the fund as well and make those interpretations?
Absolutely. Now is a wonderful time to look at it because the recent bout of pressure that we have been seeing in the mid and small cap segments, especially over the past 2 quarters, makes it an opportune moment to distinguish the boys from the men when it comes to fund management and liquidity management, especially in the small cap segment where it is all the more critical. It is very easy to get trapped in low float stocks, low volume stocks, so there's a risk that, really materializes during such periods. Of course, I would insist and implore that, checking this metric should be a part of your standard checklist across various cycles. But if you haven't been doing it till now, and now is a wonderful time to start doing it.
Absolutely wonderful time to start doing it. Are there any specific red flag, if they start seeing this, that one should watch out for in this stress test as well? Like, what is the most important thing that they should check, right? And right now, like you were mentioning as well, that, this is the time to check. So if anything as a red flag that pops up in your small cap fund, then should you just get out of it, or what more should they follow as an investor?
Absolutely. So I'll take the latter part of the question first. If there's a red flag, absolutely, that's the purpose that a red flag serves. That should, while it can, it should not directly warrant an action, it should definitely warrant an investigative behavior as an investor, wherein you must go in deeper and go in for a full-blown root cause analysis to understand why is the red flag showing so, and if it is going to be pertinent even going ahead, and does it derail your entire investment thesis. So definitely keep a watch out for red flags. That's point number one. Second, what are these red flags? Of course, the most, in the face metric is the number of days to liquidate a portfolio, 50% of the portfolio. That is the number one thing. If you feel that your portfolio is taking much longer to liquidate in a hypothetical scenario versus, what the rest of the category averages are taking. Now, this is very simple to look at, right? Amphi publishes. So that is one red flag. You need to get in deeper. There are a couple more metrics that comes along with the disclosure. Another metric could be investor concentration. If a particular fund has a very high degree of investor concentration, and by that I mean a very large percentage of the total assets it managed being controlled by a very few individuals, that could also be a concentration risk. And that could potentially lead to a liquidity risk. Now, imagine a situation where a large chunk of your AUM is held by a small clutch of investors and all of them decide to redeem together. Now, that's going to put a lot of pressure on the fund manager, and that would lead to, distress selling, which will impact the NAVs for others as well.
Okay, Nirav, the days, I want to just know, on an average, what is the number of days that one should keep, and be like, okay, this is okay if, I take so many days to liquidate my fund. What is that number that we should keep an eye out on?
So there is no such golden rule on how many days is good enough. But what you must observe is the trend for a particular fund. How is the trend going? If you see it is slowly and gradually becoming more and more illiquid, that is, the number of days are increasing, that should be a red flag. That's number one. Number two, you must always compare it with, category peers, and you must see if the days are exorbitantly high versus what, most other peers in the same segment are, exhibiting on an average. Now, you must take into context for larger fund sizes. Of course, this is not a given. I know there are several large fund houses that manage a highly liquid small and mid-cap profile, at least relatively. But, the larger the size gets, you can often notice a tendency for the liquidity to really drop because, they inadvertently need to invest more and more into counters and absorbing a lot of liquidity themselves. So you must take that into context. And number two, you must place these number of days also into market context and see if it is your particular fund that is under stress, or is it a market phenomena that the volumes are drying up in a particular segment, etc. Right? So context is of key relevance over here. So while there's no golden rule, I feel the two things that you can do: compare it with the category peers and compare it with its own historical trends.
Okay, own historical trend as well as category peers. One thing, when I think you had done a detailed research in terms of this as well. So what I was looking at in terms of that was that cash holdings for some of these funds were as low as 1.5%. How does one actually, what should one make of this? How do fund managers plan to handle the redemption during such a time and a downturn, right? If there are red flags coming in or if the liquidity is an issue, then how would they be managing that? And is that also a concern that we should watch out for?
That's a wonderful point, Vinny, because cash holding is indeed very critical to fund management, also from a standpoint that it helps cater to redemptions, right? But like you rightly pointed out, there are a few funds that have decided to maintain very low cash levels, and nothing against it. They might have a philosophy that they want to participate in the markets as much as possible, right? So so there are a couple of ways in which fund managers mitigate the liquidity risk despite deploying a high degree of the cash available. So number one is managing liquidity through more liquid counters, right? Although it is not in cash, there could be an allocation towards very, very high liquidity, large cap or, blue chip stocks as well, right? We know the volumes are pretty good over there. We know there's market depth over there. So even though there is, very limited cash available, the fund manager can very easily liquidate some of those holdings without as much of an worry about the impact cost, and yet manage to cater to redemptions. That's number one. Number two, the low cash holding is not written in stone, right? So slowly and gradually, with time evolving, with the warning signs flashing and the red flags, propping up, it gives fund managers enough buffer time to increase their intermittent cash holdings, even if it, if the tides turn south, intermittently. So that is not something reported exactly at the month end, but there could be intermittent management of cash holdings to cater to redemptions if the fund manager senses any trouble brewing in their portfolio.
Okay, Nirav, thank you so much for that there. We'll keep an eye out on those points. But on that note, we're going to sip into a very short break. Do wait with us, Nirav. We'll continue this conversation after the break.
To get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Today, my cabinet colleagues and I met to discuss Canada's response to the latest developments in the trade crisis. Yesterday, in the latest salvo in his trade war, President Trump again imposed unjustified tariffs on our nation in violation of our existing trade agreements. We will respond forcefully. Nothing is off the table to defend our workers and our country. And our response to these latest tariffs is to fight, is to protect, and to build. We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. The road ahead will be long. There is no silver bullet. There is no quick fix. The old relationship we had with the United States, based on deepening integration of our economies and tight security and military cooperation, is over. It's my solemn promise that when President Trump threatens us again, we will fight back. We will fight back with every...
Welcome back to Mutual Fund Corner on CNBC-TV18. Thank you so much for tuning in. We're discussing today is stress tests on small cap funds, what it indicates for you all, and we have with us Nirav Kharkera. Nirav, let's continue the conversation forward. Now, when I was analyzing the data you sent us as well, it also showed that, some of these funds had over 22% that was held by top 10 investors, right? So if they make an exit, then it does destabilize the fund as well on some sort, or does it start worrying? And is there a way that we could actually check on this or figure out anything in terms of red flag that comes in from that front?
So, Vinny, as a part of a previous response also, I just briefly touched upon it, but I'll also elaborate, right? As a part of the disclosures, fund houses also disclose what percentage of the portfolio is concentrated in the hands of, let's say, the top 10 investors, right? Now, the risk that comes along with concentration risk is an event wherein this very small clutch of investor press the redeem button. The fund manager is required to create liquidity in a very short span of time, right? So a high investor concentration could also potentially lead to a liquidity risk. So this implies that when a fund manager tries to liquidate a large amount which is controlled by a limited set of investors, the fund manager also runs the risk of impact cost and may probably under pressure need to sell at lower levels, which impacts the overall NAV of the fund, which implies that even the rest of the investors who are still invested will sort of have to bear the brunt of this post-redemption, right? So this becomes a challenge in particular. So this is one thing that you must be on the lookout for. Of course, this is a more common phenomenon in smaller funds with smaller asset sizes, with very new funds, because they have limited investor bases. The investor concentration could look like really, really high. But for the ones that have been around for quite some time and enjoy a very granular subscriber base, they typically have a well diversified, AUM per client sort of a metric, right? So this is something you can look out for when you look at the disclosures.
Absolutely, yeah, you had mentioned that concentration risk also that comes in there. One thing, Nirav, is that are there any other tests that can be done, so that an investor or a retail investor can figure things out? Is there something one can do by themselves, to take measures?
So there are a couple of things, but it's not going to be easy and straightforward. There are, of course, disclosures and data available, but I'll probably talk about a few simple things on the same lines, right? Number one is no matter what metric you look at, as a guiding principle, always look at it in context. So we spoke about number of days to liquidate. We spoke about, the investor concentration. Apart from that, you must take into conjunction how the performance has been doing in context of all of this that we spoke about, right? And how is the performance doing vis-a-vis the risk that it entails? So for instance, standard deviation, right? So standard deviation is a known risk. A very close proxy that is also published is Sharpe ratio, right? So you can look at how well the Sharpe is looking versus other funds in the same category. This should be a good proxy of the risk-adjusted returns. And this is market risk that I'm talking about. So you have ratios like Sharpe and Trainer that is generally disclosed by AMC. So you could probably collect it at the end of the month and do a intra-category comparison. That should give you a whole lot more context in terms of what is the risk you're undertaking and for what kind of returns.
Okay. Surely, that's interesting. One could watch out for as well in terms of the standard deviation levels as well. Because some of them I was seeing is as up to 19.3%, right? So in that standard deviation also, any specific level is there, or, that goes on case-to-case basis?
So in the small cap universe, of course, it is almost as if the sky is the limit in terms of standard deviation. This is indeed among the most volatile segments of the market, which directly translates into higher standard deviation. On an average, we notice standard deviation ranging between 18 to 22 odd figures, right? So that's a typical standard range. However, let me point out any standard deviation beyond or below this range also is not a cause of concern in isolation. What needs to be understood is that, of course, the fund is experiencing a lot of volatility. That's one. But is the fund able to perform while taking on such level of risk? So that's the number one check. Basis the standard deviation, what's the kind of returns that they're using? And I just spoke about Sharpe as being a good metric to capture this effect. So that is one. If your risk-adjusted returns are looking good. Number two, you must check if this is in line with the volatility that you want in your portfolio, Right. So one is to optimize for the market cycles, and second is to optimize it for your own investment strategy. So the second part is also as critical. You don't want to just maximize your returns and just maximize your risk-adjusted returns. You want it to be in line with your larger objectives. So these are a few things that you must include while looking at standard deviation. But in small caps and mid caps, it's going to be typically high. You have to be prepared for it. That's the nature of the beast.
Absolutely, but there's one more thing that I want to know, Nirav, is portfolio PE ratios also, right? Does it mean that higher PE means overvaluation, or is it justified given the growth potential? How should one be judging all of this also in this situation? Specifically, obviously, small cap side, what we're talking about.
Of course. So P is by far amongst the most widely followed metric. But here are a few reasons why I am particularly not a huge fan of PE, at least in isolation, right? So number one, it does not capture for growth effects, right? So PE is basically price to earnings, and it captures price and earnings, right? So it does not capture the growth effect or the anticipated growth very effectively. Second, there's a lot of sector variability. You cannot compare the PE of a stock operating in a certain sector with the PE of another stock in another sector. It is just not comparable because of different earning cycles, etc. Now, talking about cycles, there are cyclicality in earnings that this again doesn't account for. Not all earnings are very linear. There are several businesses that are vulnerable to seasonality and cyclicality. This does not capture that as well. So, there are a couple of such defects. It does not include debt levels as a part of its consideration. So PE, while a very good indication of valuation, it may not suffice in isolation or standalone as a solo valuation metric. A higher PE may just imply that it trades at a higher PE, and reading too much into that could also sort of set you on the wrong rail, right? So do not try and compare PEs would be my recommendation. Just look at PE as a starting point, as a sanity metric. Just look at it, be conscious, but move ahead well beyond it.
Okay. And Nirav, so far it's just been a very little amount of time, right? Almost a year since this has come out. Do you think that in the current scenario of the stress test that we've seen so far, it has managed to do well in terms of the MF system? Are there any concerns that you are seeing coming in? And do you think a possibility that the stress test may fail? Is there any possibility of that front as well?
So when this stress test was first introduced, of course, most of us were waiting for it with bated breath almost, right? We were really worried, anxious, what is it going to show up? But surprisingly so, the results came out pretty well. On an average, all small cap and mid cap funds also, for that matter, have been very conscious about their liquidity profile, right? So there was no shocker so far. In fact, even during this entire cyclical downturn that we have been witnessing since a little over 2 quarters now, mutual funds have been holding up, in terms of their liquidity profile pretty well. So, while, we also look at individual portfolios, direct equity portfolios, we realize that mutual funds have been doing a phenomenally good job, at least on a relative basis versus several other products, in terms of managing liquidity risk as well. So the good thing is we have seen it across steep cycles. Although it has been a short period, we have had the fortune/misfortune of seeing it across 2 different cycles of a cyclical uptrend as well as a downtrend, and it is holding up really well. I feel this reinstates faith into the mutual fund management scheme of things, that they know how to manage liquidity risk.
Okay, Nirav, thank you so much for joining in with us and help our viewers understand this stress test that is done for small cap funds and what they should be doing as well. So thank you so much for joining in with us. And thank you so much, viewers, for tuning in to CNBC TV 18. But up next, you have a closing bell to take you through the last hour of trade.
The best deal for Canada. We will build an independent future for our country stronger than ever.
To understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwanese index up over 2%. The Hang Seng 2 trading with gains of around 0.8%.
So whatever they charge us, we charge them, but we're being nicer than they were.
23,142. It's a little away from where we are, but that's the first retracement of the recent bounce that we had from the lows to the recent high. So first rates are going to be lower, 0.6, 0.7% down, 23,385 on the Nifty.
As far as the fundamentals are concerned, nothing much has changed. If anything, on the earning numbers, we have seen some downgrades.
VIL has taken care of its spectrum dues till FY27. And this will allow them to borrow money from the market and pump it back into capex.
The benchmark indices have lost about 1.5% down on the Sensex, and the Nifty right now is below the 23,250 mark.
Ready reckoner rates are nothing but what exactly are the market rates going on in the transactions that happen in the market.
This will raise the government stake in Vodafone Idea from 22.6% to 49%.
House do look a little wobbly. In fact, not a little wobbly, a lot wobbly. It's red across the screen.
Well, it is a tough-looking screen. The market down almost 400 points. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima, Tirupati here in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, looks
afternoon.
like Trump jitters, fear factor at its highest before the 2nd of April.
And whoever was saying, hurrah, we are closed on Monday and we've escaped the global fall, all of that, it's out of the window. No such luck, right?
Well, that's right. It appears we're catching up on the downside. I think the lone positive is still you have way more number of stocks advancing than declining. On a day when you have the frontline indices that are down more than 1%, and still you have, the advanced decline ratio that's tilted in favor of number of stocks advancing. That's telling you select stocks are still doing well. So I guess that's the way it plays out. But I think in the next 48 hours or so, we'll know what's on President Trump's mind, and then the markets can, react to all the pieces of news without any kind of question marks. That's the hope. Hopefully, he delivers what he has to say in the next, 36 hours or so, and then we react to that.
Absolutely, Nigel. But, he said so many things.
Yeah.
That's the question. That,
just let him get done with it. Whatever he wants to do, let him get done with it.
That's the hope, but I think it's going to linger. We will see. But, tomorrow is tomorrow, and we will at least know to begin with what these tariffs look like, what he wants to do in terms of size, implementation, etc. So, let's just begin there, right? The market is at this point in time, we put out one level on the Nifty in the morning. We are exactly at that number now, after a 360-odd point fall. 23,142 is the level that we put out as a support in the morning. And it looked highly improbable, right, that you touched that level. I didn't think we would, but that was the closest in terms of a proper support. That is nothing but the first 38% retracement of the rise that we saw from the 4th of March low to the high that we saw on the 25th of March. 4th to 25th, the market rallied sharply. 23,142 is the 38% retracement of that rally. And I think at the day's low, we've come almost exactly to that. Actually, we broke that. 23,136 is the low today. So we broke that by about 8 points or so. But we'll see if we are able to, if we close here, if you retrace something, we'll have to kind of see. Let's just look at the Nifty Bank as well. And the Nifty Bank is down about 1.33% as well. I think here supports are still some distance off. Nifty Bank was looking much stronger as compared to the Nifty. It had on Friday and actually all of last week it had closed at an important sort of resistance, which is the 61.8%, and we were looking at maybe potential highs back in focus, but we've retraced about 1.33%. As Nigel said, 2:1 advances to decline ratio. So broader market is still holding on in a pretty good fashion, all told. In the morning, it was about 4:1, but still looking good with about 2:1 or roundabout. A lot of stock-specific action, which we will focus on as we go along. Prima.
Well, let's get to the stock-specific or sector-specific action today. So for starters, the Nifty Realty is the top sectoral loser. That's down close to about 3%, with Mumbai-based real estate companies, whether it's Macro, Keystone, Oberoi Realtors, all taking it on the chin after the increase in the Maharashtra ready reckoner rates. So that's negative for the real estate companies, and you can feel the pain. IT too is under pressure. The Nifty IT index is down nearly 2.5%. The street fears the Trump tariffs could hurt the US economy. There could be a slowdown. And therefore, the Indian IT companies, which derive 60-70% of their revenues from North America, could get pressured. And then the third pocket, the third leg of the weakness today is banks. The Nifty banking index is down close to about 700 points, 1.33 of a percentage point down, with heavyweights like HDFC Bank. That's down close to about 3% odd. You've got weakness in ICICI Bank, that's down 2%. Reliance Industries, that's the other one which is weighing, on the way down. Reliance Industries has lost nearly 2%. Not too many places to hide on the way up. You've got an Innocent Bank up 5%. Trend, I think 1000 Store. That's been the, the one which has helped Trend today.
No, I was just thinking, listening to you guys, that whether it's budgets, whether it's general elections, state elections, we've been there, done that, and it's all fine. But this tariff, this Liberation Day issue, just you don't know what to expect, from lenient to I think I'll be hard, but no, I might be lenient to our friends, to our foes. This one is
nice, kind.
Nice, kind. You just don't know what to prepare for this and how to prepare for this. It's really uncharted territory for markets, just in terms of the extent of uncertainty. Anyway, what's interesting is that while the overall market is down, individual stocks are really doing their thing. So there's a lot of stock picking going on. By the way, look at SML Isuzu. In the last, I think, half an hour or 40 minutes of trade, the stocks, it's on our ticker. The ticker team's also picked it up. Let's get the hot board up on SML. Remember, it's a counter which is surrounded by a lot of deal bars. Ashok Leyland denied it. We don't know if M&M is still a suitor or not, but that one's alive and kicking. Some of the stocks that have been in news today, they've been doing really well. So Vodafone Idea, obviously, now it's a 8 rupees stock. When we started the day, when we ended Friday, with a 6 rupees stock, 18% up over there. HBL Engineering on the order wins, HAL on the order wins. So domestic-facing businesses where the business news is strong, there's still stock buying going on. So that's something that you have to keep in style. Plus, a lot of the consumer-facing business names, they are finding a lot of takers today. Look at something like a Bazaar-style retail, not a very frequent name on the volume charts, but today it's doing really well. Stock is up about 8.5%. The others would include, the ones that are moving on good volumes. Lemon Tree. There are a couple of tier 2 financials doing very well today. IDFC First Bank, Bank of India. So while the headline on the Nifty, the Bank Nifty is telling you that it's a really bleak day, Nigel, at an individual stock level, there are plenty of buyers doing their thing as well.
Well, that's right. Take a look at PVR. The stock has seen a sharp correction from the top. Looks like the street likes the collections that we have seen on Sikandar, which was released, I think a couple of days already in. So some were debating whether or not it's as big a blockbuster or not, but the screen is telling you that the street at least likes it. Stock up close to around 5%. I don't know whether you guys had a chance to watch the film or not, but it seems buy still has his magic because the stock is doing well. The other one I'm looking at is Trend. They put out the store editions, and it seems the street has liked that because that's the only way to explain the kind of outperformance you've seen on a day when the markets are down. That's one of the top gainers with Indicent Bank. So you have Trend that's up, store edition both on Zudio as well as on Best Side. It appears it's better than what the street is working with, just going by the stock reaction. And ITC Hotels, I recall when we had that, that split that took place and you had the separate listed entity, the stock was in that vicinity of around 170 rupees or so. And the valuations, it appears it's appealing. Even in today's trading session, it appears that stock is seeing good amount of buying interest. And if you look at the live delivery-based buying as well, that's giving you an indication there is delivery. It's not traded volumes actually delivered out here. So that stock as well doing well. So select stocks are doing a thing of their own, though the headline index continues to see some selling pressure. I'll tell you what, it may not be such a bad thing. You're going into the event, not expecting great things. So factoring in some part of the pain, getting into the event, that may be a blessing in disguise. Mitesh Thakkar joins us. Hi Mitesh, good afternoon. Good to see you win. Well, what do you make of today's trading action? And do you think the crucial technical levels are getting broken? Or do you think, it's still pretty much okay? On the Nifty Bank, one level I was observing was the 51,000 odd mark, which was one of the key technical support levels. That's mildly broken. We're 100 points lower from there. And on the Nifty, we're around that 23,200 mark. Your take?
So, I think, my understanding is that the Nifty Bank is still okay. It is the Nifty, itself which is showing mild trouble. The Nifty Bank had a gap up on last Monday, which is 24th of March. And the gap levels were around 50,680 to about 50,700. I think we are still above that. And just managing to hold. The indicators are still okay. Nifty has, come off slightly. It's filled the gap which was there on Monday. But then there is some mild support around these levels of 23,100 to about 23,050. But the hourly and the 2-hourly charts have started turning weak. So I'm more worried about the Nifty. With that, I think earlier in the day, we had initiated some sell calls because we were trading with mostly long bias on the real estate side. I think that's the space which has given some kind of a breakdown. And if that doesn't recover, then you might see the Nifty underperform the Nifty Bank. But for the time being, I think, if somebody wants to trade, Nifty Bank would be a slightly better idea. Keep a stop below 50,650 when you try to buy it around 50,800 levels, which is where we are right now. And, hoping that this gap would survive, then I think on the upside, 51,250, 51,300 could be the level which the Nifty Bank would do. Though the Nifty could also bounce back because of the Nifty Bank, but it might underperform given the fact that the other components are looking very good.
Okay. Mitesh, stock ideas for the last hour?
Yeah. Good afternoon, sir. So I have a buy on Telecom wagon with a stop at about 780 and look for a target of around 830 over here. And the sell on Titan, it's just trading below the earlier last closing swing low, which was around 3010. So sell on Titan with a stop at 3030 for targets of around 2910.
Okay. All right. Got it. We'll come back to you after half an hour or so and take stock of the market again. For the time being, let's move on to some of the stocks that have been in news today. And obviously, Vodafone Idea is topping that list. The stock spent the better part of the day on 10% circuit. Then that freeze opened, and now it's up about 19%, almost 19%. And this after the government decided to finally convert a large part of the spectrum dues that are still pending to equity. So dues worth almost 37,000 crore rupees have been converted to equity, taking the government's stake in the company to 49%. Rima breaks this down on what really this could potentially mean for Vodafone Idea.
Thank you very much for that. Indeed, the government of India has announced a major financial move, converting 36,950 crore of its spectrum dues into equity. Now, this will raise the government stake in Vodafone Idea from 22.6% to 49%. And even though the government owns 49%, the operational control of the company will continue to remain with the existing promoters. The shares will be issued at 10 rupees per share, which is at a 47% premium to the 6.8 rupees that the share price closed in Friday's trade. Now, this news is a big development for Vodafone Idea because, for starters, it improves the company's ability to raise 25,000 crore in bank debt, which has been long delayed. Secondly, the conversion will also ease Vodafone Idea's cash constraints significantly, at least in the first half of FY28, according to analysts, which will help the company execute its planned capex and also, in a way, perhaps arrest the subscriber losses. Moreover, Vodafone Idea's annual dues to the government will decline over the next 3 years, and these are the numbers which IFL has put out. They're saying in FY26, earlier, the company would have owed 29,000 crore rupees to the government. That number comes to 18,600 crore rupees. FY27, once the moratorium comes to an end, the dues will fall by nearly 20,000 crore rupees, from 43.5 to 23.5, and FY28 onwards, the decline will be close to about 10,000 crore rupees. So fairly sizable, even though the amount that the company still has to pay to the government is going to be pretty substantial. But according to analysts, this development could be a bigger positive for Indus Stars because it shows the government's continued commitment to maintaining a 3+1 market structure and a stronger Vodafone Idea. Now let's get to the brokerage views. IFL says government stake conversion postpones Vodafone Idea's problem. They note that the company's free cash flow remains insufficient for future payouts, and therefore they see the possibility of the government further increasing its stake in Vodafone Idea. That means continued dilution, and that could limit the upside for the existing shareholders. They say that if the government were to hypothetically convert all its dues into equity, its shareholding in Vodafone Idea would stand at 81%. They've got a reduced rating on the stock. Motilal Oswal says another lifeline for Vodafone Idea, but it's pushing the can further down the road. They say the key concerns still remain around subscriber losses. You want to stabilize that, debt raising, AGR dues. They've got a sell rating on the stock, but they've raised the target price to 6.5 rupees from 5 rupees earlier. And this is driven by the government's equity conversion at a premium. Moving on to Ambit, they've titled the report as Government Reaffirms Support to the Industry. They believe Vodafone Idea is best suited only for high-risk investors. They've got a buy rating, target price 15 rupees, because their rationale is the government has only converted its spectrum dues into equity. AGR is untouched, and that gives the government some scope, leeway, to consider further relief measures with respect to AGR dues, while Citi has placed both Vodafone Idea and Indus Towers on a 90-day catalyst watch, citing 5G rollout in Mumbai and progress on debt funding as the key triggers. So for Indus Towers, it's their top pick in the telecom sector. They've got a buy call. And Vodafone Idea, again, it's a high-risk buy call, target price 12 rupees per share.
All right, Rima, thanks for that. As you come back here, let's quickly tell you, get you some more views on this subject, right? This is former Airtel CEO Sanjay Kapoor on the entire matter. Listen in.
VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here, because in March of 26, they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows are not good enough to take care of their capex requirements in the immediate future. So, so they're not completely out of the woods.
Okay, so they're not out of the woods. They will need to raise a ton of additional money. Perhaps a lot of it would have to be through debt capital. So it's a tough fight for survival out there. That's the view from experts. Well, let's welcome in our fundamental expert on the show this afternoon, Dipan Mehta, who is here with us from Lexer Equities. Dipan, I don't know if you have even any trading interest in either a Vodafone Idea or Indus. I mean, just tell us these developments, how do you view them? And either for a short trade or for an investment, would you keep any telecom stocks on the radar? Bharti, Jio, and of course, Indus and Voda.
Good afternoon, Surbhi, and thank you for having me on your show. I think in Vodafone, a lot of trading activity has taken place at our company and at a lot of brokerages. I think this kind of a move certainly attracts a lot of day traders, but I personally do not trade in Vodafone or invest and wouldn't advise as well, because in my assessment, unless the company increases its revenue by 50%, there's no way it's going to make even cash profits. So, and that looks highly unlikely. So I don't know what the future for Vodafone is. Although we do have investments in Indus Towers, and the prospects over there are definitely improving quarter after quarter, with Vodafone continuing its operation and even wanting to expand its 5G coverage, and that would mean more business for Indus Towers. But the stock has rallied also significantly, and end of the day, I think they're also reaching a stagnancy point because the rollout of Bharti Airtel for 5G is more or less over and done with. So there could be some slowdown in growth for Indus Towers as well. Coming to your question about investment, of course, you should be invested in telecom, but there's only one company to buy, and that's Bharti Airtel. And that's part of our core holdings, as it should be for a lot of investors, considering that the growth is sustaining very well and cash flows also should improve because of lower capex.
Okay, Bharti is your best bet. A lot of foreign investors had increased their stake in Vodafone Idea during the FPO. So in September of 2023 or December of 2023 or even March of 2024, the FI holding in Vodafone Idea was about 2.5%. That jumped up to 12.5% in June of 2024. And since then, they've brought it down marginally, but the FI holding still stands at about 9.9% as of Jan. The DIIs hold about 4.1% in Vodafone Idea. They all bought in at about 11 rupees, and the stock, even after the 20% up move, is at 8 rupees. But let's now turn our attention to the auto sales for the month of March. Sudarshan is here with a quick recap.
So most of the companies reported sales for the month of March have been better than estimates. So we'll start with the two-wheeler companies. First one is Eicher Motors, that has reported numbers much better than estimates. Total sales have come in at 1.01 lakh units versus our estimate of around 91,000 units. Even TVS Motor numbers have come in 7% higher than our estimates. But for two-wheeler companies, one thing has to be factored in is OBD norms, that is basically emission standards that has been effective from today. And ahead of that, last week of March, we saw pre-buying. That's the reason numbers are looking elevated, especially for two-wheeler company, and that is one of the reasons that most of the companies have reported numbers better than estimate, especially for two-wheeler segment. Now coming to the tractor segment, both M&M and Scotts Kubota have reported numbers better than estimates, and both the companies are saying because of festival, that is Chaitra Navratri, last week of March, they saw good growth, and now the important part is both the companies are saying that this momentum is going to continue even in Q1 FY26. And remember, this is the one segment which has been outperforming all the other segments for the last few months. And in all probability, it may continue going forward as well. Now coming to the auto segment, that is the passenger vehicle segment. Here, M&M has done better than estimates, while Maruti's numbers are in line. It's the weakest numbers amongst all the companies that have reported numbers so far. Even in the SUV segment, Maruti has underperformed Mahindra and Mahindra. For Maruti's SUV growth, that is utility vehicle growth, is just 6%, while for M&M SUV growth is 18%. The strongest numbers so far has been reported by Ashok Leyland. For Ashok Leyland, M&M SUV segment, which has been a drag for majority part of FY25. For this month, M&M HCV segment has seen a growth of 15%, even total sales have increased by 7%, and that you can see it's reflecting even in the stock. Ashok Leyland currently up almost 3%.
Indeed, thank you very much for that. So two-wheelers have reported good numbers aided by pre-buying. Ashok Leyland strong, and M&M outperforms Maruti, particularly the SUV growth rate at 18%. Dipan, your thoughts on the auto sales and the March numbers?
Yeah, first, Nigel, I think, did you see the numbers for Eicher Motors? I think phenomenal numbers for Royal Enfield. And
absolutely.
And what's going to happen is that the realization per vehicle also is higher because more and more riders are going for the 650cc, which is really the most expensive motorcycle in its entire product lineup. So very positive on Eicher, a disclosure we and our clients are invested in. Also, another small company in which we have an investment as a matter of disclosure, Atul Auto came with very good set of numbers, 34% plus kind of growth in volumes. And after a long period of stagnation, we are seeing very good growth numbers over there. And they are trying to scale up their EV three-wheeler portfolio as well. So that stock also has done very well today. But on the whole, I think the auto industry is sustaining its growth. And a lot of it is to do with seasonal and festival factors. I think more importantly, we have to see how April and May play out. But with interest rate cuts down the line and lower fuel costs, I think overall transportation sector should do well. And maybe investors should gradually start getting overweight auto. And by the way, M&M also has excellent set of numbers.
All right. Dipan, quick word on some of these cooling companies. Voltas is sharply lower, down close to around 7%. Any view on that name? In fact, most of these companies, they are lower. The lone one that's up actually is Whirlpool, and that's been the biggest underperformer because the issues you have at the parent level. Your view on this space itself, and given the prospects, would you look to buy Voltas on a dip, or would you find better opportunities?
No, I think Voltas is a solid company, and not only is the room AC business going to do very well this summer, but they are sitting on very good order position for the projects business as well. But look, a lot of it is in the price, considering it trades at very rich valuations. Within this entire, summer investment theme, there are two stocks which come to mind. One is Symphony, which is India's largest air cooler manufacturer, rather air cooler company. It gets manufactured by third party. And I think they should report exceptionally good numbers in the summer months and reasonable valuations. And a very small news item you may have missed is that the promoters of Vadilal Industries have come to an agreement and Vadilal is India's second largest ice cream manufacturing company. A lot of interesting developments happening over there, whereby some of the uncertainty around the promoter disputes have got resolved, and that stock also is trading at very attractive multiples. About a third of the revenues come from exports as well. So in the summer theme, these are the two stocks that we are advising our clients. Having said that, in both companies, we have an investment, so our views could be biased to that extent.
Vadilal and Symphony. Thank you very much for joining in, Dipan. Get into a break. As we do that, a quick reminder, discover the power of Young Bharat at the Rising Bharat Summit 2025, where innovation, ambition, vision converge. So this is your exclusive chance to gain insights from global visionaries. Jeffrey D. Sachs, one of the world's most respected economists, and Björn Brende, President and CEO of World Economic Forum, will be sharing their insights on India's role in a changing global order. Right here, Bharat Mandapam, New Delhi, 8th and 9th of April. Book your passes now.
Total size of the global pharma industry is $1.5 trillion, and we are still, let's say, 6 lakh crores in terms. So it is still very small. So I am quite positive that over the next 5, 10, 20 years, this industry has a lot of leg. We are still dependent on China for basic stuff like solvent, starting material. When all of that shifts to India, which I think will happen in the next 3-4 years, because see, if you are a global major and if you are placing your bet on India, India is still sourcing those material from China. So
Welcome back. So let's address the elephant in the room, should we say the elephant around there in the world. The number of unknowns which are contributing to the uncertainty around imposition of tariffs. Too much up in the air, and Prashant has moved over to the wall to help us decipher and make sense of it all. Prashant.
Well, it's finally time to focus on those April 2nd tariffs, isn't it? Now, will Trump tariffs be bigger and more disruptive than commonly believed? That's the big question. To be able to answer that question, we need answers to a few questions, answers that we don't have right now with us. Let me try and explain. I mean, all we can do at this point is actually put them up as questions. 4 questions to be precise about the April 2nd tariff announcement, 36 hours away. The first is simple, timing. There is still no clarity on whether Trump will use tariff law requiring a mandatory review period. That is one, or instead use emergency powers that allow tariffs to take effect immediately. Like, for example, the case of auto tariffs, there was no review period. They came into effect immediately. There is also the potential for tariffs to be phased in. So, for example, if he wants to impose 20%, in some cases 10 now, 10 over a period of time. If it is done like that in a phased manner, it should actually take off some of the sting from the initial announcement, so as to speak, from a market standpoint. I mean, it'll be seen as negotiating. The second question is size. Not long ago, the consensus worst case scenario was a universal tariff near 10%, with China tariff specifically being higher. These estimates, consensus expectations rather, have risen. I mean, they stand between 15 to 25% for many countries, depending on who you ask. And very few carve-outs are being expected by market participants, at least, when they're announced initially in the first round. Third, there is the question of which countries are impacted. Recently, Treasury Secretary Scott Bessent mentioned a list of the, and I quote, quote-unquote, dirty 15. He didn't name countries, but the EU, Switzerland, Japan, South Korea and India are likely included on the list, along with, of course, Canada and Mexico, where there is already tariffs which have been imposed. The likely 15, this set, would make up some 80% of US imports. Finally is the question of how other countries would respond. Again, I mean, a few months ago, earlier this year, the consensus view was that other countries would use restraint in their response to Trump tariffs. Can we be sure of that now? I mean, unlikely. Many countries are openly saying they plan to retaliate, impose retaliatory tariffs. And of course, as we've seen in the case of Canada, I mean, it's also maybe a vote getter, standing up to Trump and sounding like you're not afraid. Now, these are, I mean, four of the big reasons. There are more, but these are the main four reasons which basically are causing enormous amount of uncertainty around what is coming next and the shape and size and the way it's going to be conducted and implemented. We'll know, of course, in the next 36 hours, like I said. Now, let's just focus on India and the potential impact. Now, here I'm using calculations from JP Morgan economists. The tariff differential between what India imposes on US goods coming here and US imposes on Indian goods going into the US is 8% on a weighted average tariff basis. So if it is reciprocal, I mean, it should be 8% on a weighted average basis. But JP Morgan points out, and others like Neil Kant and Sunil Kaul of Goldman Sachs have also pointed out, that number rises substantially, that 8% number, if the Trump administration decides to include the VAT figure of 18%. Now, the GDP estimate, according to JP Morgan economists, is 20 basis points if it's simply the weighted average tariff, and that number can rise to 50 basis points if it actually is weighted average tariffs plus VAT. If you can sort of, that's essentially what I'm talking about. Now let's go on to the table, which will tell you sector-wise implications as far as the tariffs are concerned. Very, very simple. Exports to US as a percentage of India GDP, tariffs imposed by US on India, tariffs imposed by India on the US. So it's to make sense of this, I mean, simply put, the way to do this is take the tariff imposed by India minus the tariff imposed by the US. That's the differential on a weighted average basis. And of course, you consider the exports to US as well in terms of how meaningful it is to in terms of sizable contribution to Indian GDP. And in that sense, the three sectors which come to mind here are chemicals and pharma. There is textiles and clothing, and agri and meat products. These are the three sectors which kind of satisfy that criterion, which could face a substantial and sizable hit. These numbers are also from a JP Morgan report. Now, of course, the question then, of course, having said all of this, lots of unknowns, some knowns in terms of the data itself, the question for markets near term is this: will US Liberation Day, as Trump has been phrasing the 2nd of April, be another risk shock? Can it cause more downside? Or will it be a bit of a clearing event, a hump to be crossed with greener pastures ahead? I mean, it's been exhausting for markets to trade and chase these Trump headlines all along. But finally, and thank God, and I don't know if I should say thank God, but we don't have to wait very long to find out. Back to you.
All right, Prashant, thanks for that. It's really comprehensive and it puts in context what we know right now and, more importantly, all that we don't know and the answers that we are still seeking. So let's see whether we get all those answers on the 2nd of April. I don't know. I wouldn't be holding my breath, at least. Well, let's welcome in our next guest, Atul Mehra, Fund Manager at Motilal Oswal Asset Management Company. Atul, thanks for joining in. We'll talk about your domestic stance and what you're liking in the market in just a bit. But let's talk about the big global risk at this point in time. At a headline market-wide level, I mean, we nicely started making some sort of a bottom. March was a good month. And now we've started April with a fair amount of volatility. Are you expecting further downsides because of these global issues, or do you believe that the bottom formation process was pretty real and durable, what we saw in March?
Yeah, it should be good afternoon. So the sense is, I think many times, like, you have a lot of these risks that emanate but it's good to look at things in perspective. So if you look at India specifically, exports to US as a percentage of India's GDP is about 2%. Many of the crucial items like pharmaceuticals are very much needed, and they are the backbone of the US pharma industry. So to that extent, if we look at things in perspective, there will be a lot of noise as we head into the event. We've already seen that. But I would say that if you look at it from the construct of India per se, I don't think it really impacts. Maybe like a month down the line, you wouldn't be as concerned or bothered about this particular event as we see it today. So I think it'll make a lot of noise, but it'll pass by without major issues per se.
So it's like a thunderstorm which will pass by.
Yeah, absolutely. Yes, Prashant. So many times, we've lived through COVID, right? So now just look at this in perspective of that. It's very, very minor. There will be some industries, some companies which will benefit, some will be hurt. But I think 3 months down the line or something of that sort, India as a country, it's primarily domestic driven, and this will be a passing event in that sense. So also in parallel, our government is also negotiating a bilateral trade agreement. So whatever I would say negotiation has to happen, it is also happening parallelly to some extent. So I don't think it is as big an event as it's made out to be, especially for India.
Brave call, Atul. Good to hear that, actually. You don't believe that it's going to be that big a call. Atul, I'm looking at a couple of your funds, that you manage. And if I look at the large cap portfolio, it's pretty much in sync with what the Nifty has. Look at the large private sector banks, Reliance Industries. The top 7 or 8 is actually replicating what you're doing. How are you going to generate that alpha then? Because all those who are investing in your fund will want that additional return, right? So where's that going to come from?
So Nigel, happy to inform that we've completed about close to 14 months of the large cap mutual fund. We did the NFO last year. And so far we have generated about 21% alpha in the large cap fund. So it is, I would say that there are times in the markets where you need to protect capital. There are times in the market where you need to go for alpha creation. And clearly in the last few months, we've become a lot more defensive. We've added a lot of defensive names in the portfolio. And to that extent, you're seeing in terms of some of the common names come by. But the way I see it is in a full cycle, you'll have time phases where you'll protect capital and time phases where you'll go for alpha. So at this point in time, it's more the former, that you kind of protect capital given how volatile the situation looks like.
Okay, all right. And kudos on that then, Atul, for bringing us that data point that you'll have generated better alpha. You believe maybe at the time being, it's more prudent to preserve capital. Got that. Atul, one of the stocks that you'll have largely overweight in comparison to the index is Trent. That's one of the top gainers today. And there's that debate out there, best behind or best yet to come. What's the view on this one? The store edition is something that the street seems to have liked. The stock, after seeing a big run-up, has cooled off close to 25% from the top. View on it?
So yes, we own it. While I can't talk a lot about the stock, but one thing I can say is, end of the day, you have to look at management teams which have an ability to, in terms of out-execute other peers. And we've seen that either in terms of Trent or either in case of quick commerce as well, for that extent. End of the day, the space is the same, but there are companies which are absolutely out-executing others. And Trent is clearly, I would say, one of those companies which has, in the past, executed really well on some of the formats. And in the future as well, they have a number of new formats that are in the making, and which we should likely see the benefit and scale of in the years to come. So yeah, we are holders in Trent in many of our portfolios. We continue to hold it.
Okay. Got that point. Overall, on financials, Atul, what are you doing? Because March brought a lot of hope, and people were saying that maybe they can finally start taking a leadership space. But the problem is that they're so susceptible to FPI selling. Look at what happened. Friday, we had a big negative FPI sell number. Stocks were under pressure. Even today, we'll get to know FPI numbers in the evening. But the way in which large cap financials are falling, who knows? What's your call? What do you like here, and what are you avoiding?
So in terms of the call here is they are very reasonably priced. Businesses are doing well, and stocks are attractively priced at this point in time. I would say that like today clearly looks like a large FII sell day, but I would say that the FII numbers are also in the construct of what is happening in the rest of the world and so on and so forth. I was talking to somebody the other day, and there was a mention of a lot of global managers kind of looking to diversify at the margin away from US and starting to increase allocation to India. So what we've seen in the last 2 weeks is perhaps some reflection of in terms of some global managers kind of moving money towards India. So maybe today is a down day, but as a trend, I would say India is to some extent a derivative of the US market is, what something like Taiwan does, what Japan does. So it's a mix of a lot of things. But in like end of the day, like money will chase value, and in terms of many of the private financials are well-managed businesses trading at very reasonable valuations. So I think it'll come back after a point in time.
So Atul, what are your fresh ideas? What what are the bets that you've taken in the last 2 months? So give us some color on that. Even if you can't talk individual stocks, tell us the themes and the narrative behind it, which has attracted you to those stocks.
Yeah, yes, Prima. So basically, like I was mentioning, the last few months has been around protecting capital. So we have in our portfolio, in a large cap portfolio that I run, basically added a lot of defensive names across FMCG, across pharma, one oil and gas name as well. So basically, we are trying to make sure that in this volatile time that we've got into, we don't lose capital. And hence, most of the additions in the last few months have been around in terms of protecting capital. So that's been the key theme in the last, I would say, 3 or 4 months.
Okay, all right, Atul. More time at the pitch, so to call it, at the crease. That could be the call of the day for the time being. And once you get into perfect form and weather the storm with regard to Trump's tariffs and the likes, then maybe move into aggressive mode. Thanks a lot for joining in, Atul, and filling us in with your take on how you see the markets pan out and the way you're investing as well at current reckoning. That said, well, it's that time of the day when we move to D-Street Chatter. Nimesh joins us to tell us what is he picking up. Nimesh, are we going to be expecting a large sell number from the FIs? Is that the feedback?
Doesn't look like, Nigel. At least that's not the feedback to me. It's been quite mixed, and there is buying as well into select pockets. So, but the nervousness is simply seems to be in the large cap names. The Nifty looks a bit dragged, but if you look at the overall market, the breadth is positive. Mid and small cap is relatively outperforming. We normally don't talk about SME stocks, but a lot of the SME stocks are buzzing in trade. I was just checking out some data. A lot of the SME stocks are up 8-10% in today's market. So on a day when the Nifty is down 300, the Bank Nifty is down 800, to have SME stocks, mid cap stocks buzzing, slightly gives you a different picture, right? So that suggests that there is not big panic, so to speak. I guess it's a bit of positioning just one day before the big Trump event. So that's, and again, only those sectors which might have an impact are in negative territory today. IT is under pressure, pharma is under pressure, and so is some of those chemical stocks and all. So that seems to be the pocket where there's a bit of weakness today. Flows, as I said, it's been quite mixed. There is buying in OMCs and select banks. So the Nifty Bank is down 800, 900 points. There is selective buying in the bank names. I guess what's dragging the Nifty Bank down is the HDFC Bank stock. We might hear the quarterly update in a day or two, and the street is anticipating some nervousness there. So maybe that's the reason why the Nifty Bank is under pressure today. Technically, 23,800, 900 seems to be a resistance on the upside. So that's the level where you will see some bit of supply in days to come. But even within the sectors like pharma and IT, which are under pressure, the sense I'm getting is watch out for pharma names after the announcement. If there is an announcement, it is positive. If there is no announcement, even then it's more positive. So that's the call largely on pharma, not so much on IT. But broadly, I guess there is momentum in the broader market stocks.
Well, that's right, Nimesh. It's that sort of a day when people post-work will be looking at their portfolios and saying we're green for the day, but the headline index was down. Correct. A bit of a rarity, but that's going to be the case for today. Tell us individual stocks. What are you picking up?
So in terms of individual names, the first stock on my list is IndusInd Bank. I've chosen this because there is a bit of buying interest back in this particular stock. The stock is up in trade today, up 4-5%. The volume is on the higher side. And again, I guess the street was a bit short as well in anticipation of that PwC note. the auditor's report. That's not come yet, but I guess that will be a big near-term trigger. But there is buying which has resumed in IndusInd Bank. At least in today's trade, there are buy flows. So that's the first stock. The second stock is BPCL. I spoke about broadly there is buying in OMCs. BPCL stands out among the three OMC names. The highest volume you're going to see in BPCL, and there is aggressive buying from larger FI in BPCL. So the second stock. Third, couple of metal names which are under pressure, both Tata Steel and Nalco. Purely from a flow perspective, in both the names, there is selling pressure today. So expect high delivery volumes on the sell side on both those names.
Okay, thank you very much for that. Now let's get in Mitesh and get in a few... Okay, we'll get to that in just a bit. For now, it's time for a break. We'll come back with more on the markets.
Your cost competitiveness is not established. But Prashant, this is all work in progress, in my opinion, and we are in the right direction.
I think it's very important to see this as one of many important milestones because this will just be a starting point. Tariffs are only one form of industrial policy. You have many other forms of industrial policy which are not possible today because people are worried about the World Trade Organization. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult. We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion. Or if say it was $8 billion. So it's like 0.1 to 0.2% of GDP. Now for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I would once again request that people must not extrapolate what has happened post-COVID in terms of return, in terms of finding multi-bagger opportunities where money has gone from 10 to 100 times, right? Because the lows were so drastic, the returns were fabulous, right? So I don't think that we must expect those kind of returns. Having said that, I am not in a camp that the bull market is over and this is the beginning of the bear market. In my view, 15 to 20% kind of return is still in these markets.
Welcome back. Let's get in a few trading ideas as we come to the close of today's trading session. Mitesh is back with us. Mitesh, there is no recovery per se. We're not at the day's low, which is 23,136, but we're pretty close to it with a 350-point cut.
Yeah, that's right. Actually, we did not bounce back from the lower levels. We had one bounce back early in the morning, which really got sold in. So not a very positive sign, especially the Nifty, I think, slightly on the buying side for me, because it's trading below key intraday averages. And then the next daily average will come in around 23,100 or 23,050. So which means that we could have another 80-100 points kind of decline, and still there's no sign of a reversal yet. It's slightly worried, but let's see how it goes. The only hope is that the back Nifty, if it can sustain 5750, 5600, 80 to about 5750 zones, then we might bounce back strongly. But right now I have a BTST on Nykaa with a stop at about 177. And look for a target of around 185, while Oracle Finance is a STBT with a stop at about 76.15 and look for a target of around 75.30.
Okay, all right. Thanks a lot for that, Mitesh. Well, by the way, keep an eye out on a couple of stocks in the broader markets. Coromandel, I think we should pull up the intraday chart out there. the stock was as doing a relative outperformance. It was up, I think, 1.5%. But now the stock is up close to around 4%. And majority of that move on Coromandel has come in the last few minutes. So that's one of them. The other one is Indian Hotels. That one as well has taken off. Checking in with the bulls, that one is holding strong in an otherwise a little bit of a wobbly market. But the stock that started off well in the green was HAL. This after it signed a 62,000 crore rupee order contract with the Defence Ministry. Upasana joins us to break it down for us. Upasana.
That's correct, Nigel. While Defence Ministry has signed 2 contracts with the company worth 62,700 crore, this is mainly for the supply of 156 light combat helicopters, out of which 90 is for Indian Army and 66 is for Indian Air Force. Now, this is the single biggest procurement by Ministry of Defence from HAL till date, is what the company has indicated. Company has also reported its provisional numbers for FY25, in which revenue stood at 30,400 crore with an uptick of just about 2% on a YoY basis. If we look at the past trends, if we look at the FY24 revenue growth, it stood at double-digit 10% growth on a YoY basis. Now, this year, the growth has come in lower. This is mainly because of the supply chain issues and also delay in the delivery timeline. Now, order book of the company stands strong at 1.84 lakh crores, and company says that it is gearing up for a robust FY26 with supply chain issues stabilizing, enhancement of capacities and also new order wins. Now, on the back of this, UBS has given a buy rating on the stock and that has also raised the target price to 5,440 per share. It says that this award order of 156 light combat helicopters is a positive surprise for the street, and LCA Mk1 Tejas delivery is likely to drive P&L of the company for the next 3 years. Hence, we can clearly see the stock surging in trade today, one of the newsmakers.
All right. Thank you very much for that, Upasana. That is HAL, I mean, 0.75% gain. Started with about a 5-6% kind of a pop, but basically since then has given up quite a bit of, actually almost all the gains. But the market has also come off quite heavily from that point on. Jay Bala is now with us, if Cash the Chaos. Jay, good to have you with us here. Thank you very much. You're expecting one more bounce, one more swing high before... before the downtrend plays out again? I mean, just give us the view, near term.
That's right, Prashant. See, last week I had pointed this out. The view was same. I expected the Nifty to drop to 23,200, but today the move has been slightly beyond that. This doesn't impact the view too much. Still holding to the view that the market could see one more high above last Tuesday's high of about 23,869. So that was a high last week. So I think there's one more high due for the counter trend bounce. The market has been quite obliging, and it's been, I said on 4th of March to Nigel that market is due for a 1,000-point bounce, and it gave a 1,000-point bounce. And on the next week to Mangalam, I said even if the market were to come to 23,800, this would be within the parameters of a counter trend bounce. But the market should periodically misbehave than my expectations. That's how the markets work. So right now I'm still anticipating one more highs to come through. But if the markets were to get rejected under 23,412 and also print 22,676, then it would mean that last Tuesday's high is the end of the counter trend bounce. So so let's see what the markets are doing. But the message from Reliance is that so far the bounce is a corrective rise. The message from the auto index is that at least for the auto index, if not for the whole overall market, the rise is a corrective rise. And if Nifty IT index were to break below the March low even by 1 point, then it would mean that this has got further lot of downsides to work with in the medium term. That could be a bounce in the short term.
What's the March low on Nifty IT that you're watching closely? And the call on Nifty IT is that it heads down to 26,000. Is that correct? Because the current market price is 36,000 on Nifty IT.
That's right, Rima. But it's a medium-term call. Probably that will work out in say something like a several months time frame. The low of March is 35,674, and if that were to get exceeded, the markets are likely to complete a short-term price structure. And then that will result in a short-term bounce somewhere close to 39,000 to 40,000. maybe even slightly higher, but I'm expecting 39,000 to 40,000, 39,900 to 40,000. So if markets were to exceed that, it will still be okay, but it give a better opportunity for exit in the IT names. It's mostly the frontline IT names which are quite weak.
Okay, all right, Jay, stay on. We'll have more questions for you in just a bit, but we do have to take a quick break on that note. As we take the break, let's tell viewers about some good news. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. You can get instant access to breaking news, in-depth articles, analysis, and financial world updates at your fingertips. You can download the app from either the Apple Store or Google Play, or of course, you can also scan the QR code that's coming up on your screens.
If they pump in more capex into their business, then Indus Tower gains definitely, because they'll get better tenancies and they will also get newer towers with that capex. And the last stakeholder is Bharti Airtel and Jio. They are stakeholders to this as well. Contrary to many beliefs, my belief is that a stronger VIL is better for both those companies than a weaker VIL. For a simple reason that a weaker VIL will resort to pricing and discounting. VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here, because in March of 26, they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows are not good enough to take care of their capex requirements in the immediate future. So, so they're not completely investing.
Welcome back. Keep an eye on a couple of stocks. APL Apollo came out with a fairly good set of operational update. JTL's operational update was pretty much okay. But as we speak, it appears and the street is buying into that dip that we saw earlier today. JTL has moved to the high point of the day. To pick out another one, JG Chemicals, that's another stock that's up close to around 7%. Just highlighting these because these stocks are moving higher on rather large volumes. So a couple of them from the broader markets looking good. Jay Bala is still with us. Jay, I believe you have two bearish calls, shorting calls. One is Siemens and one is HPCL. Tell us the levels you're tracking there.
That's right, Nigel. Siemens, we had discussed in late December, early January. I had pointed to a triple top for the stock, and the stock from 6,500 then on has dropped to about 4,500. The rise from 4,500 to where it is today, the price action is looking like a corrective bounce, and it might be the end of this corrective bounce. As long as the stock remains below 55.25, it has potential to go back to its fresh 52-week lows. So, it's a difficult market. Stay light here. Try to do synthetic shorts or something like that so that you can keep your hedges and risks quite low. And the second is the short call on HPCL. HPCL has got probably one more higher highs to come through. As the recent high was about 372, possibly one more high close to 375, maybe slightly exceeding that to 380. And then I'm anticipating that to get repel lower. We also, I've been of the view that crude is likely to run higher to somewhere close to $99 to $100. And the recent price action is confirming that. Crude is probably already bottomed and it's likely to rally to somewhere close to 90 plus to somewhere close to $100. So probably that will weigh in on HPCL. Bearish on HPCL with a stop loss of about 375.
Okay, all right. You're talking about Brent going to $90 to $100. Did I get that correct?
That's right. That was the view last week, a couple of weeks ago also, Nigel. And I said that several months ago that crude needs to drop below the September low. It did that. I anticipated one more lower low, but it didn't come through. But it's taken out important resistance at 72 unchanged for Brent. and 70.66, I think, if my recollection is correct, for the NYMEX variety. So both varieties are pointing to much higher levels. Brent price objective is $99 to $100.
Bapre, 99 to 100. Jay, I don't see gold here. In terms of the view. I mean, 3100 plus. What's the view?
See, gold has coming to a very important resistance, and I'm waiting for a reversal signature to come through. It's still bullish, but and I'm anticipating some kind of surprise drop that surprises a lot of people. If gold were to, as things stand today, if gold were to drop to about 30.77, I would analyze the intraday price movement and come to the conclusion if it's topped out or not. But it's very close to an important high. Either it is a medium-term high that brings the yellow metal to somewhere close to 2,500, or it's a long-term top that brings the bullion to somewhere close to 2018 levels, 2016 levels, somewhere about $1,300. So, it's still an evolving situation. We don't have a confirmation yet, but it's a big, big potential. And that also has an implication on the dollar index. Without the dollar index getting stronger, this is unlikely to happen. If the dollar index were to print 106.13, that will also convince me that a long-term top is due for gold.
So, very quickly, we're running into market close, Jay. Now, to wrap it up, what is the best trade right now, near-term trade on either the Nifty or the Bank Nifty?
Yeah, Bank Nifty, you could look at something like ICICI as a separate candidate, and you might have higher highs to come through for ICICI as long as it holds above the recent low of about 1280. I don't expect it to print 1280, so that could be used as a stop. A fresh 52-week high is possible, but the banking index may not take the result in 52-week highs. But the main stock is probably HDFC Bank. If we see a print of 1743 on HDFC, we can very broadly conclude that the correction is completely over. We don't have to wait for Nifty to print 22,676.
Okay. All right, Jay, just hold that thought. We'll quickly recap the day's close, and then we'll come back to you for some more inputs. And it's a week close, 340 to 350 points lower. That's where the Nifty will finally end after the adjustment of the close. And if we talk about the weakness, well, a lot of large caps. It's very heavy-duty large cap selling that we've seen. So HCL Tech, HDFC Bank, Infosys, ICICI Bank, Reliance, TCS, L&T, Axis Bank, you get the drift. Big boys have been absolutely slammed hard. And even some of the PSUs have not been spared today. I mean, for instance, BEL is down about 3.5%. Asian Paints, I could go on and on. Lever as well. Most of these stocks weaker. M&M down about 1%. ITC down about 0.7% as well. The only stocks that have actually held out on the Nifty, Trent, because of that store update, which investors like, 4.5% higher. IndusInd Bank, not sure if there's something brewing there with respect to more fund infusion from promoters, but 5% up. The market was excited around this one. Bajaj Auto did well today. There was some buying on Zomato, but that was it. Bajaj Auto and actually Hero Moto as well. So those two stocks did well, but otherwise heavy-duty large cap selling today.
Absolutely, and the broader market though did a lot better. The mid and small cap indices down, but down 0.7, 0.8%. They're up on your screen. And the Nifty micro cap index was actually up on the day, about 0.65%. Although I have to say, I was just sort of, sorting the broader market gainers and losers by volume. Volume is on the downside. I mean, there is no doubt about it. 2:1 is the advanced decline. I mean, advanced is outnumbering declines. But unlike what I've been saying for the last many days, today it's actually quite the opposite. Volumes, number of advances, greater than it declines, but volume is on the downside quite clearly. So that's something to kind of keep an eye out on. That FII number is also going to be in focus. Remember, FIIs were sellers on Friday after buying for a while. So I think today's figure should also be in focus. I mean, are they at the margins getting a little... I mean, they've only been buying for a few days. So I think in that context, it'll be interesting to see what they've done today. 340 points lower on the Nifty, 23,180 is where we leave off at. It's a wrap of this edition, a closing bell from all of us. Thank you for staying with us, but we're not going anywhere. Rima and I'll take you through markets forward coming up after a quick break.
અમારું યાત્રા ચાલે છે પદયાત્રા અહીંયા જામનગર અમારા ઘરથી દ્વારકાધીશ સુધી અને બસ આ બધાના આશીર્વાદ રહે અને શ્રીજી બાબા દ્વારકાધીશના બધા ઉપર કૃપા રહે આ જ મારી પ્રાર્થના છે અને અમે હમણાં પદયાત્રામાં 5 દિવસથી ચાલીએ છીએ અને 2-4 દિવસમાં પહોંચી જશું દ્વારકાધીશનું કૃપા રહે અને બધા શ્રીજી બાબા બધાને સંભાળીને રાખે ને બધાને આશીર્વાદ આપે બધા યુવાને ભગવાનના પ્રતિ પ્રેમ રાખવું જોઈએ અને બધા યુવાને સનાતન પ્રતિ પ્રેમ રાખવું જોઈએ અને બધા યુવાને બસ એ જ મારી બધા યુવાને એક મેસેજ મોકલાવું છું મારા ભાઈઓ અને મારા મિત્રોને કે આપ બધા શ્રીજી બાબાના આશીર્વાદ લઈને આગળ વધો અને જ્યારે ભગવાન છે તો કંઈ ચિંતા નહીં કરવાનું
The Indian market feels the jitter ahead of Trump's fresh set of tariff announcement. Market slips over 1% in trade. The Sensex down over 1,300 points. 340-odd point cut in the Nifty. Mid-caps relatively outperform. Micro-caps do even better.
Hindustan Aeronautics shares jump in trade. This is after the company bags an order worth 62,000 crore rupees from the Defence Ministry. Shares of Vodafone Idea climb after the Indian government ups its stake in the company by converting dues into equity.
The US is said to be kinder to its trading partners, says US President Donald Trump, ahead of reciprocal tariff deadline. Further claims India and other US allies are set to cut down their tariffs substantially. Hello and welcome to a fresh new edition of Markets Forward. We started the week on a risk-off mode in line with global markets because, global markets sold off at the beginning of the week. Actually, the sell-off happened on Friday and then they continued on Monday as well. We'll, of course, wrap up everything for you, all the key data points, stocks, etc. as we gear up for the next trading session. I'm Prashant. With me, my colleague Reema Tendulkar. Reema, hi.
I started the week and the financial year on a negative note, and you could say that there were Trump tariff jitters ahead of the 2nd April deadline. But it's a weak close, right? The Nifty ending below 23,200, and it's a steep 1.5-2% cut on the benchmark indices.
No, absolutely. And, on the Nifty, we, by the way, very quickly broke down to an important sort of retracement level, 23,142. It's a support we put out in the morning. And it didn't look like the way the market opened, then there was a bounce that we'd actually ever get to that number, but we did. We actually broke that level and we closed barely 20 points above that level. So 1.5% sharp cut, but broader markets held up much better. So advanced decline was about 2:1. Micro-cap index, smaller shares. If you look at the SME space, etc. as well, that did much better. But I have to say, volumes were on the downside, unlike what we've seen over the past many days. You've had days over the last 5-6 sessions when advanced decline was negative, but volumes were on the upside. Today, volumes clearly were on the downside, even though numerically there were more stocks up than down. And I think that's something to wait and watch. FIIs, I think, were sellers on Friday after being buyers for many sessions prior to that. And I think that is something we'll have to wait and watch as well. But in any case, the big and perhaps the only game in town over the next 36-48 hours, of course, is what Trump really does with tariffs, implementation, the way he implements it, etc., etc. So I think that's a big one. We'll note tomorrow night, and of course, we'll be reacting to it on Thursday morning. Reema.
At least when the Indian markets wrapped up trade, the European markets were well in the green, up nearly about 1%. But let's tell you what we have lined up for you on our show today. We start with the top movers and shakers of the day. Hormus joins in. The stocks of the day were the telecom names, Vodafone Idea, Indus Stars, auto names in focus on the back of the March auto sales numbers. So Eicher Motors, M&M will get you more details on these stories and then the key market events to watch tomorrow. But as always, let's get to the first segment of the day. It's Hormus. He's at the big wall with the top stock movers.
Well, possibly a reaction to digesting 2 days of global cues, right? We were off yesterday, so pretty much a reaction to what happened on Wall Street on Friday. And of course, it was the index heavyweights that led the Nifty lower, even as the broader markets were outperformers on virtue of not falling as much. But take a look at HDFC Bank, ICICI Bank, the principal culprits of the downside today. Infosys, Bajaj Finance, Reliance, all 5 of them contributing to at least 200 points out of the 350 that the Nifty shed in today's trading session. A pocket that was under pressure in today's session was real estate, and there was multiple news flows surrounding that. Of course, the top sectoral loser as well. All of the stocks on the realty index ending with losses of anywhere between 2 to 5% in today's session. IT was another sector, of course, because of the volatility seen on the Nasdaq over the last 2 days, ahead of its results as well. Some chaos, that was some uncertainty, volatility. Mid-cap IT in particular ending with losses of anywhere between 5 to 5.5% for Persistent and Coforge. HCL Tech and Infosys too among the key contributors to the downside. There are a lot of newsmakers in today's session. Cannot not mention Vodafone Idea, of course, at one point was up 25%. Indus Towers too cooled off from the highs but ended with gains. Lemon Tree ahead of the summers was a good performer in today's trading session, but it was a PSU banks though. Look at Punjab and Sindh Bank and UCO Bank, of course, low float PSU names, but ending with 20% and a 13% cut. And lastly, plenty of order inflow coming in today's trade. HBL Engineering ending off the highs but still 9% higher, as did HAL. Sterling and Wilson ended at the highs of the day after winning almost multiple orders, as did KEC International. And L&T, even after winning a major order, still ended at the lowest point of the day. Back to you guys.
Right, Hormus, thank you very much for that. We have Jay Balan now joining us of Catch the Chaos, and we also Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital with us. Thanks very much, both of you. Jay, I mean, for those who are joining us now, I mean, just a view, Nifty Bank, I mean, near term. And of course, near term is interrupted by these tariffs tomorrow.
That's right. The markets are quite smart, Prashant. The markets interpret well ahead of the event, and they are actually driving an important message. And the very short term, the Nifty could, likely hold 23,090 and then probably bounce to some one high above the last Tuesday's high of about 23,869. That's the view I'm working with. But in the event that Nifty were to break 22,676, I think the high of 23,869 is already the counter-trend top. When it comes to the banking index, it could probably push to somewhere close to 52,600, probably driven by ICICI Bank. I believe ICICI Bank has one more higher highs to come through, possibly fresh 52-week highs, fresh all-time highs, as long as it doesn't print to 1280. But the key for the banking sector and the overall market, though, is HDFC Bank. If we try to print 1743, that will be a damage to the bulls. We don't want to see 1743 on HDFC Bank yet. The resistance for the banking index is 52,600 and 52,900.
Okay, got that. Let's get to the big story of the day, and that's in the telecom space, where the government has announced its intention to convert 36,950 crore of equity dues in Vodafone Idea into equity. Now, this will result in the Government of India's stake increasing from the current 22.6% to 49%, but operational control will continue to remain with the promoters, and the share issuance will take place at 10 rupees per share, which is the face value. It's positive for Vodafone Idea because, one, it increases the prospects of bank funding, and therefore the company can go ahead with its capex, perhaps help in stemming the subscriber losses. And two, the conversion will ease Vodafone Idea's spectrum repayments over the next 3 years, and that IFL, the table from IFL will come up how they expect that in FY26, Vodafone Idea's dues will decline from 29,000 on an annual basis to 18,500 FY27 and FY28. The dues will fall from 43,000 crore to 23 and 33,000 crore respectively. So it's a fairly big respite, though the payments continue to remain fairly substantial. The move is also seen positive for Indus Towers because it showcases the government's commitment for a 3+1 player market construct and a stronger Vodafone Idea. IIFL and Motilal Oswal, though, believe that while this development is a positive, they're saying it's a lifeline, but it's postponing Vodafone Idea's problem. According to IIFL, the underlying cash flow generation will be insufficient to meet the government payouts, and therefore they see the possibility of the government further converting dues into equity in the next 18 to 24 months, and that is negative for existing shareholders. They have a reduced rating. Motilal Oswal too concurs that this is positive, but it's pushing the can further down the road. The key problems with the company are stabilization of the subscriber base, AGR dues, that's the overhang. So they have a sell rating on Vodafone Idea, target price 6.5 rupees. Ambit, on the other hand, remains hopeful, though they do say that Vodafone Idea is only for high-risk investors, but they're keeping the hope alive because they're saying the government has only converted spectrum dues into equity. AGR is still untouched, and therefore that gives the government scope to consider relief measures with respect to AGR in the future. Citi has opened a 90-day catalyst watch list on both Vodafone Idea on Indus. Vodafone Idea too is a buy, but it's a high-risk trade with a target price of 12 rupees. Sudeep is also, Bandyopadhyay is still with us on the show. Sudeep, on Vodafone Idea, is there a tactical, is there a trading approach, any sort of view on Vodafone Idea? And what about Indus Towers? That is the other beneficiary.
Well, as far as trading is concerned, I think Jay will be able to better guide. But if it's from an investment point of view, I have been avoiding Vodafone Idea for a very long time, and I continue to maintain that it should be avoided. See, the fundamental problem goes much beyond all this, capitalization and AGR dues and spectrum dues. I think, operationally they're losing customers month on month, and till the time that is stopped, I think fundamentally it is not worth looking at this telecom company. If a company which is losing customer month on month cannot prevent that, and we were expecting this bleed will get stopped post the QIP came in, but it didn't happen. And let's see what happens now, because hopefully they will be able to borrow money and launch 5G in multiple areas which they didn't have. Only when they will be able to stop the bleeding of customers on a monthly and quarterly basis, it will be worth looking. Before that, I think it's completely avoid. Of course, this is a short-term relief. This doesn't, take Vodafone Idea out of the problem completely. Definitely short-term relief gives them one more chance to try and work things out. Let's see what happens, but I don't think I will recommend a buy. Traders can keep trading and making money and enjoying the volatility. As far as Indus Tower is concerned, I think it's much better position. It is a much better positioned company. The business is strong. The only challenge here is that 5G rollout for most players is reaching its peak level. So incremental towers coming off incremental towers, the scope is very limited. So the growth of revenue will not be commensurate with what the growth was in the previous quarters and previous years. So I'll be a little skeptical. There's no problem fundamentally, but the growth seems capped.
Growth seems capped. No, point taken. You said enjoying the volatility or bearing the volatility. Sudeep, but volatility there is most definitely. Now let's move on to the next one, right? The Maharashtra government has increased the ready reckoner rates across the state by 3.9% on an average for the year FY26. Real estate stocks slipped in trade today. Vinny is here with details on what this would mean. Vinny, over to you.
Yes, so this is a bit of a negative that comes in for these real estate companies, but not as much as the fall that we saw coming in. Now, overall, on an average trade basis, like you mentioned, we're seeing a 3.9% increase in terms of these ready reckoner rates. Apart from that, when you're looking at it for Mumbai, specifically the region, it's a 3.39% increase. This increase is the lowest that we've seen from other cities versus Mumbai versus the other cities. It's almost the second lowest that we're seeing coming in. Now, for the Maharashtra government, obviously, this is going to be increasing their revenue by 10,000 crore rupees in FY26. But for real estate developers, there would be an increase in terms of the stamp duty, other fees and property prices could see a rise coming in. Now, what is the catch over here? While we've seen Mumbai real estate developers see a fall today, the thing is that currently the hike that we're seeing is something that is acceptable. That's what Anurag is highlighting. Why? Because most of the transactions that we're seeing in the city are taking place at a higher market rate. So there's not much of a worry because they're taking place at a higher rate. So what would it impact? It would impact the properties that are mainly getting impacted will be the low price properties and low price markets. So that is where there would be a worry coming in, and that is going to be more specific in terms of certain regions.
Thank you very much for that. So affordable housing could take a bit of a hit. Jay, big fall in many of these Mumbai-based real estate companies. Fundamentally, analysts are not too worried, but technically, given the price action, what are you seeing?
I was bullish on the Nifty real estate index for the long term, but in the short term and the medium term, they could have little more downsides to work with. Probably the March lows will hold for some time. Most of the real estate stock could bounce around between the February highs and the March lows. But in my opinion, it's still got one more sequence of lower low to come through from a few weeks to a couple of months time frame. So once that's done, we can probably see how it's come there, and then we can evaluate if the long-term bullish scenario is starting to perk up. But the short pointers in the very short term and from a few days to several weeks to a couple of months time frame, there might be a little bit of downside to work with choppy negative bounce to work with.
Okay, got that. You know, another sort of sector perhaps in focus is the auto space. Sales of Mahindra & Mahindra, TVS, Ashok Leyland, Royal Enfield exceeded expectations in the month of March. Maruti sales figures were a bit on the weaker side. Let's take you through the data. Sudarshan has got those. Sudarshan, over to you.
So the number of companies reporting sales better than estimates for the month of March is higher than the number of companies disappointed the street. So we'll start with two-wheeler companies. First one is Eicher Motors. For the first time, company has reported monthly sales that has come more than 1 lakh units. That is against our expectation of around 91,000 units. For TVS Motor 2, numbers were higher than estimates by 7%. But for two-wheeler companies, one thing that had to be factored in is the OBD, that is emission standard norm, that has come into effect from today. So because of that, the last week of March, we saw pre-buying, and that's the reason numbers for two-wheeler companies for the month of March are looking elevated. Now coming to the tractor companies, both M&M Tractor and Escorts Kubota have reported numbers much better than estimate. For Escorts Kubota, numbers were higher by more than 30%. It's almost similar for M&M Tractor as well. And both the companies are saying that last week of March, because of Chath Navratri, sales have increased. But the important part is they are expecting the momentum to continue even in Q1 FY26. Now coming to the commercial vehicle segment. Here, Ashok Leyland has outperformed Tata Motors. For Tata Motors, total CV sales have dropped 6%, while for Ashok Leyland, M&HCV sales have increased by 15%. In the passenger vehicle segment, the top performer is Mahindra & Mahindra, again led by SUV segment, which saw a growth of 23%. Against 23% growth for Mahindra & Mahindra, the growth for Maruti's utility vehicle or say SUV has seen a growth of 6%, and for Tata Motors, the growth has come in at, for passenger vehicle, it's at 3%. So overall, it's a much better than estimates in entire, if you look at the auto sector for the month of March. But in the four-wheeler, M&M has outperformed. In two-wheeler, TVS has done better. And in the commercial vehicle, Ashok Leyland has outperformed.
Okay, all right. Thank you very much for that, Sudarshan. Sudeep, any thoughts on these names? By the way, with Mahindra, there was another story, right? There was some worry at the margin that BYD, the Chinese company, is going to invest big time and set up a facility. I think there was some clarification that they're not doing that. Tesla is another story, though. What's your sense, and anything you own, any views?
Prashant, I'm not worried about either BYD or Tesla. I think Mahindra is doing very well. Look at the numbers. SUV. I think they're performing much better than the entire other SUV players. Their numbers are outstanding. Also, tractor sales is picking up, and I believe that with the monsoon is good this year. Again, the numbers will be good. Rural income is increasing, and I think this trend will help M&M. So amongst the auto companies, if I have to pick up one stock, I will go and pick up M&M. The Tesla and all that will not be really a competition for M&M in the near term. Even for that matter, BYD. I think these are a little at some distance, and one needs to understand and look at situation as and when it develops. I think today it's just in the realm of speculation. Mahindra's EV plans, yes, there are plans and those are interesting, but they also have to fructify. I think we should not try and give a valuation to these companies based on either the EV potential or EV competition. Let's look at the existing businesses and take a call on where they should go. Based on that, I think M&M comes out a winner.
Okay, M&M comes out a winner. Jay, got that. Jay, any specific trades, any stocks on your radar, positional wise?
Yeah, within the auto space, I liked Escorts Kubota, and we spoke about it last week, Prashant. But the very important message the auto sector is driving is that it shouldn't have printed, the Nifty Auto Index shouldn't have printed 21,197, and that has happened. The message from the auto sector is that this is corrective. But when it comes to the pecking order within the auto space, M&M is stronger than Maruti. Maruti is stronger than Tata Motors. Tata Motors, Bajaj, and Hero are more or less within the same bracket of weakness. We probably have one more lower lows to come through, even in the short term for the Nifty Auto Index. But the key point is that without the auto index getting strong, there can be no bull market. That's it's a rare event, but I don't think we are in such a rare event. That's a key message of the Nifty Auto Index printing 21,197. The bulls wanted to defend and take the markets much higher. 21,197 should not have printed.
Sudeep, Trent was a big mover, 5% in a weak market. The stock has corrected quite a bit. It's down 33% from its high, but is it attractive at these levels?
Is that 1,000-store announcement which worked wonders today to the sentiment. No, I don't think I will, start buying Trent. I think there are challenges which they are facing in their business now. Look, Zudio took them to the level they went to. Now Zudio itself is facing a lot of competition, both online and offline. So let's see. Let's wait and watch. I think the time for getting into buying Trent hasn't yet come, and it's not cheap by any stretch of imagination. So let's wait and watch.
All right, we'll leave it there. Thank you very much, Sudeep. We'll chat again, I guess, day after when we have more clarity on these tariffs and maybe better sense. Jay, we'll speak again. Thank you very much, both of you, for being here with us. We'll take a quick commercial break here. We come back with some corporate voices that we heard on the channel through the course of the day and some events to watch out for tomorrow. Stay with us.
A quarter of a century, zillions of designers, and orders of style later, Lakme Fashion Week is back to rock the ramp. This year's collection promises to showcase modern sophistication with effortless elegance. The showcase is set to be bold, reflecting a connect between beauty and style. Let's take a look at the showcase straight from the runway.
How do you think beauty and fashion empower young women like you in today's world?
So I think beauty and fashion, if you have fun with it, can be very, very empowering. Like me, I like dressing very casually. I like being very chilled out. I don't play too much with like colors and stuff, and that makes me feel very empowered and very beautiful. So I think it can be used as a tool to enhance your strengths rather than cover up your weaknesses.
Who are you walking for, and tell us about your inspiration behind it.
Welcome back. Let's now get to the key corporate commentary that we received through the day. First up, the management of Intellect Design Arena. They say that AI is driving significant productivity benefits, and that could put pressure on the services industry. But the company Intellect is a product company, and therefore it sees quarterly volatility, but on the whole, things are okay. They expect their AI platform, the enterprise AI platform called Purple Fabric, to generate revenues of 1,000 to 5,000 crore rupees in the next 5 years.
Okay, we have the management of Lemon Tree as well, and they anticipate a weak holiday season for resort hotels. However, the overall hotel industry will certainly see an uptick this summer. the hotel chain believes room rates will double over the next 3 years, and India is underpriced compared to global standards.
And lastly, Reserve Bank of India's new lending guidelines for priority sector lending is effective from today. Aadhar Housing Finance, like other housing finance companies, have told us that they expect the impact of the new lending guidelines to be felt over a period of time. In terms of outlook, the management expects the spreads to be in a range of 5 to 6.75% in the medium term and NIMs to be at 9%.
Okay, well, Vinny is standing by with what to watch out for as we come back tomorrow. I mean, the big one, of course, is only tomorrow night, or actually early morning on Thursday. But what do we watch out for? Vinny is standing by. Vinny, over to you.
Apart from that, what we're keeping an eye out on is on the US front, we'll have the crude oil inventory data. So keep an eye out on that. We'll have the non-farm employment change for the month of March. That is something important to watch out from the US market point of view. European Union side, let's keep an eye out on the CPI data on a year-on-year basis. We'll see it coming in for the month of March. And on the domestic front, we do have the S&P Global Manufacturing PMI data. So that is key to watch out for. Corporate actions, not much. Retail Corp will go ex-dividend tomorrow. So that is something to watch out for. And like you mentioned as well, overall, tomorrow night is what we're keeping an eye out on, where we'll be seeing the Trump tariff data points coming in, or what is his decision on that front is key to watch out for.
That's the big one. Thank you, Vinny, for joining in. And that brings us to a close on this edition of Markets Forward. Thank you for watching.
Working for AKOK, I'm working for Anamika Khanna, and I'm wearing her silver collar collection, and I think the inspiration around it is just warrior princess, something to make women feel very powerful, very strong, very modern, very cool. That's her inspiration, I'm assuming. I'm just channeling that.
The opening night showcased designer Anamika Khanna's designs that celebrated bold, ambitious women who own their space, lead with confidence and inspire with their individuality.
It's been 25 years of Lakme Fashion Week. What is in store and what can we expect?
As you can imagine, it's the most emotional, sentimental moment for us. 25 years of all of us together. It's going to be a spectacular celebration, and I'm so looking forward to it.
Can you tell us on what the collection is all about?
This collection, it's called the Silver Collar, and as the name suggests, it's about elevating workwear for women and the very fact that we don't really follow rules anymore. Everybody is bringing that power to the workspace, but they also bring that emotion, the gentleness and all of that. So it's just about elevating workwear to another level.
One message that you would like to see your brand on these young, empowered women wearing your collection?
I feel like if my collection can give you a sense of freedom, I've done my job. And that's what I want to do. I want to make people feel free.
From legacy designers to fresh voices, Lakme Fashion Week continues to redefine not just trends, but the business of fashion. In Mumbai, Zenia Baria.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting?
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening: a sharp sell-off on the Lal Street. The Sensex loses nearly 1,400 points and Nifty gives up over 350 points. All sectoral indices, barring media, end in the red.
The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
President Trump says he's settled on country-based reciprocal tariffs just a day ahead of the 2nd April deadline, but stopped short of revealing the details. Trump claims India is going to drop tariffs substantially. The Indian government's sources tell us that the US is encouraged by the proposed tariff cuts and describe the trade negotiations as very positive. New Delhi is hoping for a temporary reprieve from the proposed reciprocal tariffs. Motown ends FY25 on a high. M&M, TVS, Ashok Leyland, Royal Enfield sales exceed expectations in March. Maruti Suzuki meets estimates even as it lags behind competitors on sales growth. Vodafone Idea shares rally after the government converts dues into equity, taking government shareholding to 49%. Brokerages welcome another lifeline to the company but remain cautious on cash flow and AGR dues, which is still pending. The Supreme Court upholds Piramal Capital's resolution plan for the bankrupt Dewan Housing Finance, scraps the NCLAT order, which had termed it illegal. The Apex Court directs that any recoveries from fraudulent transactions must flow to the resolution applicant, which is Piramal Capital, and not to DHFL's creditors. ChatGPT maker OpenAI is set to raise $40 billion, valuing the company at $300 billion. SoftBank alone invests $30 billion in what was the largest private tech funding deal on record. The Met Department warns of a heat wave, predicts above normal temperatures for most parts of India this summer, also warns of unseasonal rains and thunderstorms this week across Maharashtra and MP, which could damage crops. The Reserve Bank of India marks its 90th anniversary with President Murmu and cabinet ministers in attendance. RBI Governor Sanjay Malhotra says the next decade is crucial in shaping India's financial architecture. Well, let's start with the market action. A down day on the Lal Street. No other way to describe it. The Sensex lost nearly 1,400 points and the Nifty was down over 350 points after what was a broad-based sell-off. Mid-caps, bank stocks, everything down in the red today. 730-point cut there on the Nifty Bank. The mid-cap index losing 450 points. And, of course, a 1390-point cut there on the Sensex, 350 points lower on the Nifty. Except for media, everything else in the red. Surabhi standing by to take us through the market action. Surabhi, we were closed yesterday on account of Eid. We've opened and closed terribly today ahead of the tariff countdown. Is that what is spooking the markets?
Well, it was a tariff-induced turbulent Tuesday, if I could call it that, alliterating on all the T's out there, thanks to Donald Trump. The market basically had to play catch-up. There was no escaping the Monday global mayhem. We thought we were shut for trade on Monday, so we could escape it. That wasn't the case. And the market actually ended close to the lows of the day. Today was an interesting session because the selling did not, see too many buyers. So basically, the dip was not getting bought. The Nifty and the Bank Nifty, they fell about 1.5%, falling more than the mid-cap index and ended, like I said, towards the lows of the day. What led the fall? Actually, all sectors, but largely IT and financials were very weak. Real estate stocks, particularly the ones that are based out of Maharashtra, they took it on the chin because the state has increased the ready reckoner rates. Let's talk about the major Nifty movers. And as you can see in the heat map, it's far more red than green. And it's cutting across sectoral lines. Of course, IT was weak. HCL Tech, Infosys, TCS, large stocks falling anywhere between 3.5%. Financials, HDFC Bank, ICICI Bank, Bajaj Finance, Shriram Finance. You can see it's not just banks, but even in large NBFCs, they were all down together. The big boys, the heavyweights, couldn't do much to support the Nifty. So whether it was L&T, Reliance, big names like Lever, all of them were on the downside. So where was the green on the Nifty? Well, in few places, IndusInd Bank had an interesting session. It was an outlier, up 5%. Trent found some takers because the company detailed its store expansion plan both for Zudio and Westside. The market liked that. And some of the two-wheeler names were doing well as the auto sales numbers for the month of March have been trickling in. So Bajaj Auto and Hero Motor both managing a gain of about 1% each. Let's talk about the mid-cap market. The good news here is that there were more number of stocks advancing than declining. That's one. And like I said, the index was down just about 1%, doing better than the Nifty itself. Let's talk about the newsmakers. And Vodafone Idea, as one would expect, lots of action, high trading volumes on the stock, and finally up almost 18-19%. Indus Towers getting a leg up as well, 5-6% up there. HAL started the morning on a song with that big, huge, massive order, over 62,000 crores for the light combat aircraft, but finally it tapered down. And HBL Engineering, on the back of Kavach orders, also did really well. Realty, as I said, was weak. So Godrej Properties, Oberoi Realty, Macrotech, Prestige 2%, 5%, 5%. Those are the kind of cuts that we're talking about. However, all was not lost. So while there were stocks on the way down, Info Edge, PB Fintech, some of these internet companies were seeing downside pressure. Lemon Tree, Restaurant Brand Asia, pretty heavy price and volume action on the upside on these stocks as well. So mid-cap, some still select stock picking going on. Finally, of course, we are awaiting clarity on the tariff issue. But beyond that, also looking out for the FPI flows once again very carefully, because Friday was a bit of a disappointment. We had a big FPI sell number on Friday, 4,350 odd crores. So investors will want to see if that was a one-off or whether that selling spree has resumed by foreign investors.
Surbi, many thanks for joining us. Well, as Surbi was pointing out, the big global story that is impacting markets worldwide. US President Donald Trump will unveil reciprocal tariffs on the 2nd of April. Now, President Trump has said that he's settled on country-based reciprocal tariffs. However, he has stopped short of revealing the details. Speaking to reporters at the Oval Office, Trump also claimed that India will drop its tariff substantially. The US president was touting a flat 20% tariff on all imports into the US, but in the last few days, US trade officials have been signaling a tailored approach with different tariffs for different countries.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday, you're going to see, and they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us, and we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
President Trump has offered another indication, an indication only, that the US may not impose reciprocal tariffs on India, at least as heavily as contemplated earlier. Trump said at a press meeting at the White House on Monday that someone had just told him that India is going to be dropping its tariffs. Now, that could mean that India could be offering further concessions ahead of the big tariff announcement that is due on Wednesday, offering concessions right up to the last minute. Or it could mean that Trump had only just been briefed about India's intentions and plans. But either way, it would appear that the Indian move to drop tariffs beyond those lowered already is substantial enough to have moved beyond negotiations to take the shape of a proposal that has been presented to Trump. This follows, of course, the trade talks that have been held in Delhi through all of last week. President Trump made his remarks on India, and this was straight after remarking that the EU has dropped tariffs on cars to 2.5%, which would then make that level of tariffs more or less the same as the US tariffs on European cars. But going by Trump's remark, of course, it's not just India, but other major trading partners of the US that are making exceptional efforts and huge concessions really to the US in order to duck the worst of those threatened reciprocal tariffs. Trump, we know, had said earlier on board Air Force One on Sunday that the tariffs would not be applied to all countries. Trump said also that he would prefer a deal to the other options, which would not be pretty. A deal certainly is what India appears to have offered, and we will know Wednesday with what success.
We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. Now, for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if US matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT.
Well, reactions there coming into the potential impact of the Trump tariffs. Now, Indian government sources have said that the US is encouraged by the proposed tariff reductions. The US also described the negotiations for a bilateral trade deal between India and the US as positive. Now, New Delhi is hoping for a temporary reprieve from the proposed reciprocal tariffs. Parikshit is standing by with more. Parikshit, what should we expect now come the 2nd of April?
Sources tell CNBC-TV18 that the US believes that talks with India on the bilateral trade agreement have been very positive. In fact, the US side is encouraged by India's offer of reductions in tariffs and non-tariff barriers and is now considering a pause on reciprocal tariffs on India by a month or so. Reciprocal tariffs are likely to be applied for all nations, including India, but a temporary reprieve is under consideration. US officials believe substantial progress has been made in talks of market access in all areas except for agriculture and dairy. India's removal of 6% equalization levy and also the reduction of tariffs on cars and motorcycles in the union budget and also tariffs on bourbon whiskey has been welcomed by US authorities. India's Commerce Ministry has said that India and US have broadly come to an understanding on the next steps towards a mutually beneficial multi-sectoral BTA. The ministry said that both India and the US have expressed satisfaction with the outcomes of the meeting.
Parikshit, many thanks for joining us. Now, China, Japan and South Korea have agreed to boost regional trade amidst US President Trump's tariff threats. Now, this comes after the three countries held their first economic dialogue in 5 years. The three sides have agreed to strengthen supply chain cooperation and engage in more dialogue on export controls. Meanwhile, the European Union says it has a broad range of options to retaliate against Trump's reciprocal tariff strike. European Commissioner Ursula von der Leyen told the European Parliament that the EU is open to negotiations, but it will approach them from a position of strength. Von der Leyen said, and I quote, "We do not necessarily want to retaliate, but if it is necessary, we have a strong plan to do so and we will use it." End of quote. There are also a number of unknowns contributing to the uncertainty around the imposition of tariffs. Prashant is here with more. Prashant, what are the unknown unknowns?
Well, lots of them, right? I mean, the focus is squarely on those tariffs tomorrow. And why not? We've heard Trump talking about them non-stop. And even after we've heard so much from him, we know very little about what actually is going to happen. Will Trump's tariffs be a bigger than expected blow, more disruptive than what is commonly believed? To be able to provide answers to that question, we need answers to a few questions, answers we don't have right now with us. So let me actually then put this in the context of 4 questions really about the announcement tomorrow. And, as I said, they remain unanswered, we'll know. Now, the first, of course, is the issue of timing. Timing of these tariffs really, right? Here, the simple point is, how will these tariffs go into effect? Will Trump, if he can move things along, will Trump put these, will he go forward and use the tariff law requiring a mandatory review period, or instead use emergency powers that allow tariffs to take effect immediately? My guess is that Trump aims for the latter. There is also the potential for tariffs to be phased in. For example, if he wants to impose 20, he says does 10 now and does 10 later. And if it is indeed so, it should take out some of the initial sting from the announcements. The second question is the size. Not long ago, the consensus worst case was a universal tariff near 10%, with China tariffs specifically being higher. Now, these estimates have all risen, and depending on who you ask, they stand anywhere between 15 and 20%, some even going to up to 25%. For many countries with few carve-outs in the first round, I mean, markets don't expect carve-outs. At least they're not pricing that in right now. It'll be a relief if it were to happen. Now, third, is the question of which countries are impacted. We had the Treasury Secretary, Scott Bessent, who essentially talked about the dirty 15. At that point, he didn't name countries, but EU, Switzerland, Japan, South Korea and India are likely included on the list, along with, of course, Canada and Mexico. Now, this likely 15 perhaps would make up some 80% of US imports. Finally, there's the question of how other countries respond. Now, if you go back 3-4 months, the consensus was, actually, ever since President Trump took charge, the consensus was that countries would use restraint in their response to these tariffs. Can we absolutely be sure of that? Unlikely now. Many countries are openly saying that they will impose retaliatory tariffs on US reciprocal tariffs. Now, these are the 4 reasons. There are many more, but these are the 4 big reasons why there remains an enormous amount of uncertainty around what is coming in the next 36 hours. Let's zero in on India and the potential impact as well. Now, here I'm using calculations of JP Morgan economists. The tariff differential, simply put, what India imposes on US, what US imposes on India, is about 8% on a weighted average basis, according to JP Morgan calculations. Now, the number rises substantially, as you heard Neelkant and Sunil Kaul earlier point out as well, if the Trump administration decides to include VAT of 18%. JP Morgan says if it's only 8% weighted average, the GDP impact is 20 basis points. If the weighted average plus VAT is included, the impact on GDP could be about 50 odd basis points or so. Now, let's just also look at sectors, right? Individual sectors, and the table will come up on your screen, which gives you a sense of what I'm talking about. This again from JP Morgan economists. Very simply put, these are various sectors: exports to US as a percentage of Indian GDP, tariffs imposed by US on India, tariffs imposed by India on the US. The way to look at this is exposure to Indian GDP, and of course, you just deduct tariffs imposed by India minus tariffs imposed by the US. The 3 sectors which come on the radar very clearly are chemicals and pharma, textiles and clothing, and agri and meat products. These are the 3 sectors where the differential tariff is the highest and exposure is not small. It's not, it's not negligible in that sense. And this is essentially what we'll have to find out. What exactly will they do? The question for markets, of course, in the very near term, and we've seen the reaction today, is will this Liberation Day, as President Trump has been describing it, be a risk shock in the sense that even though he's spoken about it non-stop, are markets adequately pricing it in, or are they underpricing? Or will it be a bit of a clearing event that now we got clarity and the sort of, classic sell the rumor, buy the news kind of thing works out? It's been exhausting, I guess, Shireen, for markets, for us as journalists to track and chase these headlines. The only thing is we don't have to wait now very long. Even though we may not know the full extent of what they plan to do, at least we will know what's on their mind tomorrow, which is actually early Thursday morning. Back to you.
Well, the countdown is underway, but it's clearly not done, Prashant, and it's promising to be a long night, not just tonight, but for the next few days as this unravels. But thanks very much for joining us. President Trump has hinted that the Department of Government Efficiency, that's DOGE, headed by Elon Musk, might shut soon. Speaking at the Oval Office, President Trump said that Musk wants to return to run his companies. This comes a day after Musk had said he intends to step down from his cost-cutting role in May. Take a look.
He's got a big company to run, and so at some point he's going to be going back. He wants to.
You just want to keep him around.
But I'd keep him as long as I could keep him. He's a very talented guy. A lot of the people that are working with DOGE are the secretaries, the heads of the various agencies, and they've learned a lot, and they're dealing with the DOGE people. I think some of them may try and keep the DOGE people with them, but at a certain point, I think it will end.
Well, Musk's return to the companies he runs, quitting DOGE perhaps shortly. The Chinese Foreign Ministry said Xi Jinping and Indian President Draupadi Murmu exchanged congratulatory messages on the occasion of the 75th anniversary of diplomatic ties between the two nations. As per the Communist Party-run Global Times, the Chinese Foreign Ministry said that the history of China-India relations demonstrate that becoming partners who achieve mutual success and realizing the dragon and elephant dance is the right choice for both sides. So a reiteration of an earlier message. In stock-specific news, Vodafone Idea shares rallying in trade after the government decided to convert its dues into equity, not all, but some. With this, the government's stake in the company is now at 49%. Brokerages welcomed what they called another lifeline for the company, but the street remains cautious on cash flow as well as the pending AGR dues. That, of course, is an outstanding issue. Real estate stocks under pressure after the Maharashtra government increased the ready reckoner rates. On average, the rates have gone up by 3.9% across the state. In Mumbai, the ready reckoner rates have been hiked by 3.4%. The Maharashtra government is expected to earn at least 10,000 crore rupees in this new financial year from stamp duty and registration charges. Now, Motown has ended FY25 on a high. M&M, TVS, Ashok Leyland and Royal Enfield sales have exceeded expectations in March. Maruti Suzuki met estimates despite lagging behind competition. Sudarshan is standing by with the Motown report card. Sud.
So the number of companies reporting sales better than estimates for the month of March is higher than the ones which have disappointed the state. We'll start with two-wheeler companies. First one is Eicher Motors. It has reported sales for Royal Enfield, which was more than 1 lakh units against our estimate of 91,000 units, much higher than the estimates. Also, TVS Motors numbers were 7% higher than estimates. But for two-wheelers, one thing that has to be factored in is emission standard norm, which has come into effect from today. And that was the reason that these companies saw pre-buying in the last week of March. So numbers were looking elevated for most of the two-wheeler companies. Now coming to the tractor segment, both Escorts Kubota and M&M Tractor reported numbers that were much better than estimates. For Escorts Kubota, numbers were higher by 34% year-on-year. And both the companies said because of festival like Chat Navratri, the last week of March saw higher growth. But good part is both these companies are saying that momentum will continue even in Q1 FY26. And remember, this is one segment which has been outperforming over the last few months, and it's expected that this segment will continue to outperform going forward. Next is commercial vehicle segment. Here, Ashok Leyland has reported a strong set of numbers, while for Tata Motors, CV sales have dropped by 3%. In the parallel, Ashok Leyland's M&CV segment was higher by 15%. Last is passenger vehicle segment. Again, M&M continues to lead, and the reason is SUV performance, where for M&M, SUV growth was 23% against 6% growth for utility vehicle of Maruti, that is also called SUV, and for Tata Motors, passenger vehicle segment has seen a growth just of 3%, and that was dragged by electric vehicle, which was down by 21%. But overall, more positives than negatives for the month of March as far as auto sales are concerned.
All right, so many thanks for joining us. We will take a break, but up next, the Supreme Court upholds Piramal Capital's resolution plan for the bankrupt Dewan Housing Finance, scraps the NCLAT order, which had termed it illegal. That and more when we return.
How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
If they pump in more capex into their business, then Indus Tower gains definitely, because they'll get better tenancies and they will also get newer towers with that capex. And the last stakeholder is Bharti Airtel and Jio. They are stakeholders to this as well. Contrary to many beliefs, my belief is that a stronger VIL is better for both those companies.
GST collections in FY25 have risen more than 9% compared to last year. The collections in March stood at 1.96 lakh crore rupees. This is nearly 10% higher year on year. The mop-up in March is also the second highest monthly collection so far this year. That's how we closed the year for GST. Coal production in the month of March is down just over 3% as per Coal India, which informed the stock exchanges. Coal India has set a full-year target of 838 metric tons of coal, but it managed to achieve only 781 metric tons, which is 93% of its full-year target. Gas stocks in focus today. This after the government hiked the prices under the administrative price mechanism by 4%. This is the first hike in APM gas prices in 2 years. The revised price is now set at just under $7 per unit of gas until September this year. That's when the next review is likely to take place. British aerospace manufacturer H.R. Smith Group has strongly refuted allegations that it transferred sensitive technology to Russia via India's Hindustan Aeronautics. Refuting a report in the New York Times, the company said the alleged products were used in a satellite-based search and rescue network. The group said they were not provided any evidence to support the claim that its products were shipped to Russia. The Supreme Court has upheld Piramal Capital's resolution plan for the bankrupt Dewan Housing Finance. The Apex Court has scrapped the NCLAT order, which held that the plan was illegal. Ashmit is standing by now with more details. Ashmit.
Well, a bit of a mixed bag as far as Piramal Capital is concerned. Up front, what the main takeaway here is from the Apex Court judgment is that the Piramal Capital resolution plan for DHFL has been upheld. So that definitely comes as a breather, specifically after the NCLAT order, which had held this resolution plan to be illegal. The rationale that the NCLAT had given is that only a value of ₹1 had been ascribed to 45,000 crore rupees of avoidable and fraudulent transactions, and any recoveries would then flow to Piramal Capital, and that was a concern that had been raised by the various bondholders in this matter. The new formula that has been given now by the Apex Court as of this judgment, as of this morning, is that as far as this entire issue of avoidable and fraudulent transactions are concerned, adding up to 45,000 crore rupees, that is an issue that now the NCLT will decide. And importantly, the distinction that the Supreme Court has drawn is that recoveries from avoidable transactions will now flow towards the lenders. So that definitely comes as a big boost as far as lenders are concerned. However, recoveries from the fraudulent transactions will flow exclusively to Piramal Capital as a successful resolution applicant. So that to a small margin, a bit of a hit, a bit of a setback coming in for Piramal Capital. As earlier the condition was that all recoveries from the whole of 45,000 crore rupees, if any, would have gone to them. Back to you.
Ashmit, many thanks. The government is facing a liability of more than 1 trillion rupees for outstanding sovereign gold bonds, that at the current gold price. In a reply to Parliament, the government revealed that outstanding sovereign gold bonds have an underlying gold of 130 tons. Manisha standing by with the details. Manisha, a problem for the government?
Well, yes, absolutely, Shireen. And we did hear a similar kind of a statement in the last month as well in the Parliament itself. And when you look at the gold prices in last 1 month, we've seen prices gain up by 10%. If you look at the previous quarter, the gold prices have gained up by 18%. And we've started this financial year on a record high as well. So when you look at the calculations that we have been doing in the office today, RBI did issue 67 tranches. And the first tranche was put out in 2015-16. And the total tranches that were put out, that comes to 140 46.9 tons. Now, 6 of these tranches have been paid off, have been redeemed, but 61 tranches still remain and 130 tons of redemptions still remain as well. So when you look at the gold prices right now, the outstanding, if we calculate that to today's price, today's price really comes in at around 9,284 per gram. Now, when you multiply that to 130 tons, the outstanding that the government has to pay to the Indian investors is to the tune of 1.2 trillion rupees. And we are only taking the prices of today because as and when these tranches will continue to come in, you will have to pay them as per the gold price that day. And with the way the gold prices have been moving higher, this number perhaps can go higher as well. Now, just to give you a sense that the last tranche that the government put out was in Feb 2024. So the last of the redemptions will come in 2032. So we still have those years left by, and the gold prices, the way they have been moving, you could be looking at higher prices as well. Another thing is that the government also is paying 2.5% to the investors as per their investment, and this is paid bi-yearly to them. So this is an added calculation as well. The finance minister in the parliament did say that they are maintaining a gold reserve fund where everything is accredited in time, but clearly this 1.2 trillion rupees that stands outstanding as of today is only going to grow going forward.
All right, Manisha, appreciate you joining us. That's the latest there as far as the sovereign gold bond liability is concerned. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned. The news will continue right here on CNBC-TV18. We're back in a moment with more.
VIL, for a simple reason that a weaker VIL will resort to pricing and discounting. VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here because in March of 26, they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows are not good enough to take care of their capex requirements in the immediate future. So so they're not completely out of the woods.
મારું યાત્રા ચાલે છે પદયાત્રા અહીંયા જામનગર અમારા ઘરથી દ્વારકાધીશ સુધી અને બસ આ બધાના આશીર્વાદ રહે અને શ્રીજી બાબા દ્વારકાધીશના બધા ઉપર કૃપા રહે આ જ મારી પ્રાર્થના છે અને અમે હમણાં પદયાત્રામાં 5 દિવસથી ચાલીએ છીએ અને 2-4 દિવસમાં પહોંચી જશું. દ્વારકાધીશનું કૃપા રહે અને બધા શ્રીજી બાબા બધાને સંભાળીને રાખે ને બધાને આશીર્વાદ આપે. બધા યુવાને ભગવાનના પ્રતિ પ્રેમ રાખવું જોઈએ અને બધા યુવાને સનાતન પ્રતિ પ્રેમ રાખવું જોઈએ અને બધા યુવાને બસ એ જ મારી બધા યુવાને એક મેસેજ મોકલાવું છું મારા ભાઈઓ અને મારા મિત્રોને કે આપ બધા શ્રીજી બાબાના આશીર્વાદ લઈને આગે વધો અને જ્યારે ભગવાન છે તો કંઈ ચિંતા નહીં કરવાનું.
quarter of a century, zillions of designers, and orders of style later, Lakme Fashion Week is back to rock the ramp. This year,
Well, all that glitters is gold. The yellow metal rally has been unstoppable as tariff tensions spurred safe haven buying. Hello and welcome to another edition of Commodity Champions. I'm Manisha Gupta, and the gold has hit record highs for 20 days in 2025 in various countries including US, India, China, Japan, Australia and some more. Falling yields and a weakening US dollar has aided the yellow metals rally. It has gained over 18% between January and March this year, making it the best quarterly gain for the metal since 1986. Joining me now to discuss this further are Sachin Jain, MD World Gold Council, and Ananta Padmanabhan, MD NSE Jewelers. Dilip Narayan from Malabar Gold as well joins in to weigh in his thoughts there. Thank you, gentlemen, so much for making time for this. Sachin, to you first. And it has been a one-way rally and quite interesting at that. Tariffs on one side, China insurance companies buying is the second thing, the geopolitical tensions the third, and then the investment buying globally has been quite on the stronger side as well. Now, from where we stand, how does 2025, the rest of the year, look to you?
So, Manisha, thanks so much for getting me on. And in a very short span of 30 seconds, you've given all the points that I was thinking I would give. So just dwelling a little more, you mentioned about the 20 gold peaks, all-time peaks that we've already witnessed in the year 2025. This has already given us a 19% up. That's huge and one of the best asset class performances. Now, you talked about the tariff issues, which of course should get little more clearer in the coming weeks. But also what you softly touched upon is the pension fund opening of buying, particularly in China. And that, I believe, is going to be quite a significant change, which is not temporary, but quite a significant long-term sort of trend that we'll witness. We also open similar conversations in other markets, including India. Let's see how long it takes. But just to give you a sense that even if that market opens up to 1% of their AUM to be invested in gold, that is humongous. That's over like 600 to 700 tons of gold that they might sort of get into buying. So that's quite permanent. But you're spot on. The rally is strong, and all the elements around geopolitics, the conversations that we've been hearing from the US, not just on tariffs, but also on Iran, also on Russia, have been all sparking off the geopolitics even further, and are all strong pillars of why we see what we're seeing in gold today.
Sachin, a lot of people have been putting out those numbers of $3,000 an ounce, and then people revised it higher to 3,100 and then 3,200 for the rest of this year. But we've seen most of that getting achieved in the first quarter of 2025, if not the second quarter. And April is when markets believe that you could perhaps see the gold prices peaking if things change for any better. Any idea? There has been a report from Goldman Sachs suggesting that if it gets extreme in those circumstances, 4,000 and 4,500, I mean, you throw something and you'll find a number there, is what we really seem to be getting from the markets right now. We are into uncharted territories. We don't know a lot of things right now. But with the way the gold seems to be garnering a lot of safe haven money, smart money, new money as well, what's your sense?
Well, I think you mentioned about Goldman Sachs prediction. And the other thing they've also predicted is they've now proposing 35% probability of a US recession coming in. So a lot of these, as you said, numbers are out in the air. But I think if you look at the fundamentals and the basic articulation of gold around being a safe haven, around being liquid, around being a great diversifier, I only believe that through your channel, to your audience, I would only want to say that look at gold from a long-term perspective and not week, month as well. And the fact is that all these elements around the pillars of why gold is where it is today, they all seem to be in the favor of gold in the short term to medium term.
Dilip, Sachin would keep it away when it comes to talking about gold prices so much, but I do want to talk that with you. What is your sense? I mean, what is your back of the envelope sane calculation on where gold is going?
Well, thanks, Manisha, for inviting me to the discussion. And such as Sachin mentioned, the gold is a rally which is going up, like as you rightly mentioned, for the last one of the best quarters which we would have ever seen in terms of return. well, as a retailer, we've never seen this kind of a rally for a long period. Of course, the gold has been bullish, but this phenomenal jump for the last 3 months, or rather the last 2-3 weeks has been too high. The moment it reached 3,000, from there the rally's on. I think it wouldn't stop here, and it would definitely take up to next level of 3,400, and from there, the new level would be around 3,400 to 800 levels. And on a long term, with all the experts and with all the analysts speaking, and with all the tensions prevailing in the Western market, it looks like the gold is going to be bullish, and it's not going to come down any soon. For whatsoever it may be.
Dilip, for a retail house in Indian markets with the gold prices going where they are and a market which is slightly price sensitive as well, how has your experience been in last 3 weeks or 3 months?
Well, to be very open, there is buying happening in the dips. There is, as you see the gold price going up, the people who have been sitting in the fence waiting for the price to come down have started slowly moving towards store to buy jewelry, which is the pending buyings. And then, as you know, that the festive seasons are on, and in India there is no stop during the festive seasons of buying gold, for not buying gold. So yes, Akshaya Tritiya we're waiting for the Akshaya Tritiya, and then from there a couple of other. There was a Gudi Padwa which was over last 2 days before. We saw a good rush in stores during, and that was at that period of the time also the gold price was on the high. So yes, as far as India is concerned, the retail thirst for gold will still be on. Maybe on various dips, the purchase, the buying power would be, the pattern would be more. But yes, definitely there is going to be demand for gold.
Dilip, would also want to get an understanding on how are you looking at it as a bullion to begin with? I mean, keeping inventory, hedging it, the metal loans or the lease rates have been on the higher side, and very wild numbers coming in from there too.
Well, the hedging policy has definitely gone haywire a little bit because of the lease. I mean, the cost of doing business, the interest rates because of the lease rates going up, it did affect. But as a pure hedge mechanism, any retailer would want to not take any risk, and that's what we also follow. We have a policy in place through which we follow, and any retailer would want not to have a what do you call? Would not want to take a risk on gold price. Right? They would not want to speculate, and that's what globally any retailer would want to do. So lease is one of the best options, but if in case that you feel that it's on a costly side, of course there is exchange. You can always hedge on various exchanges. Now that you have your local exchange, and also now for a certain extent the IFSC is also open. So yeah, there is a lot of new mechanisms opening for a retail company like us to hedge us.
Ananta, getting you in the conversation as well, what is your sense with the gold prices? Dilip has just given us a sense that prices can go to 3,400, 3,800 as well on the higher side. Are you making any sense of these current numbers, and would you have a forecast as well?
Yes, very good evening to all of you, and a great financial year to all your viewers. See, gold prices have been going, it's unstoppable. So looking at 3,400 and 3,800, I don't think that it's going to happen in the near future, because there has to be a correction, and the correction has not happened for a very long time. So there has to be a huge correction. If you see the past 30 years, 40 years of how gold has behaved when there is such a big jump, naturally the prices have corrected by 25%, 30%, and once it has corrected even 56%. So when the horse is running fast, people will say faster, faster, but it cannot go on and on and on, because a bubble would be created. So my anticipation is there will be a correction in the coming days. But unfortunately, our US president, every day there is a statement, and markets are reacting to it. Yesterday, he spoke about Iran, and he's also talking about the third term for himself. So all this is not that good for the markets, but prices will fluctuate and it will correct sometime. Even before it reaches 3,400, 3,800, I'm sure it has to come to 2,700. Then only it can take off, because these tariffs, one day it has to come to an end. How long it will go on? Now on April 2nd, we'll know what is going to happen. So with all this in mind, they are trying to pull it as much as it can so that whatever the fall is, it will not fall bigger. See, when it was 2,900, if there's a correction, it would have come to 2,700. But now, unfortunately, 3,150. So even if there is a correction of 5-6%, then again it will be below 3,000. But this year and the coming years, it's going to be on the positive side. And whenever there is a dip, I would suggest my customers to buy. Consumers have to come forward and buy at the corrections. They cannot wait for the prices to have a very big correction. But going 3,400 and 3,000, I mean 3,800 and all is too early to say about it. Yeah, because I've been watching last 20, 30 years. So I can see that.
Oh, well, yes, but we haven't seen a kind of situation that we are into right now, where you have tariffs, where you have dollar. There is a concern about recession and a stagflation as well. So, Sachin, what is your sense? A correction is something that the markets has been waiting for, but they've been waiting it for since it was 2,900 and 3,000 and 3,100. We haven't seen that yet.
No, sure. I mean, and on that point, Manisha, the 2,000, 2,500 rally, and I'm sure we talked about it in your platform before, took 1,720 days. The 2,500 to 3,000, which is another $500, it took just about 217 days. So it's been incredibly fast. It's and the market is just playing a catch up. We do a lot of surveys from the consumer lens, and particularly in the lens of what Dilip was talking about, that Akshaya Tritiya is around the corner. We just finished Gudi Padwa, we saw Eid, and we and the entire team have been out on the floor. And I can tell you the buoyancy and the confidence on the retail consumer to buy jewelry is super, super high. Yesterday in the floors, we saw very good footfalls. I mean, I went to stores in Andheri. We were also covering the Delhi market and the Calcutta market. Lots of footfall, decent conversions, but which only reflect the confidence that the consumer has. Now, will this go up? I mean, who knows? And I quite am aligned to what Anand sir mentioned, that when the horse is running too fast, it needs to calm down. But again, my view would be long term. All the pillars around gold are in favor in the mid to long term.
Well, yes, when you look at long term for 2026 and 2027, most banks also believe that the gold prices will be higher than where we stand right now. But the current momentum on where that can take gold prices, what kind of correction do we see? The next couple of years, longer term is still positive, but the near term is what is really keeping a lot of us quite jittery. But gentlemen, stay on with us. We'll go for a very short break. When we come back, we'll see a more forward-looking statement in sense of how 2025 looks like and where is the money coming in from, and further in case of gold.
To showcase modern sophistication with effortless elegance. The showcase is set to be bold, reflecting a connect between beauty and style. Let's take a look at the showcase straight from the runway.
How do you think beauty and fashion empower young women like you in today's world?
So I think beauty and fashion, if you have fun with it, can be very, very empowering. Like me, I like
Well, we are talking about gold prices, and that clearly has been a headline for all of 2025 till time, clearly outperforming various other asset classes. And the way things are, we are looking at higher and higher numbers coming in from there. Dilip, this one is to you. When we look at gold prices from where they are, and if we are anticipating higher prices from here, what is the impact on an average consumer in India? Are we looking at gold in sense of an investment? Are people going for more ETFs? Is it lightweight jewelry? Is it low caratage jewelry that's doing better?
Well, the pattern seems to be, changing a bit on when it comes to a retailer. Yes, definitely the people who, as I told you, been waiting to buy. would look at dips and definitely buy at on various levels. But maybe in terms of weight, damages they might reduce for this lower middle, or I would say the middle class segment the weight might come down because of the price going up. But overall, the ETFs are definitely growing. I mean, there's no doubt about it. The investment bars are going very well. But it all matters about at what levels the buying happens. So once the marriage season starts, especially in South, those buyings are yet pending. That's going to start in very soon. So it is based on the dips that people are going to buy. Yes, definitely the weights. In terms of damage, it might reduce a little bit here and there for the reason why, because the price has gone up. But the retailers are still going to be purchasing gold on different various levels.
Dilip, I have a follow-up question on that. We've seen a lot of retail chains go for expansions, and that really means more inventory, more gold buying. And in Maharashtra, we've seen the stamp duty go higher as well. So that's about rentals and getting places. And there's a lot of factors in play here. How would you deal with something like that?
Well, Manisha, the expansion means, the more you have new stores up and running, you depend upon the hedging mechanism. That's the only way you can run a volatile market. You can have your jewelry on and you have your product on with the proper hedging mechanism. I don't think so. That shouldn't be a problem. It's the rest of it's all about your capex and in what kind of a size of store you open. But as far as the gold price volatility is concerned, I think a proper hedging mechanism will definitely help you open up new stores and then wouldn't have any kind of a price disruption while doing the same.
Point taken. Mr. Padmanabhan, what's your sense on this? As a jewelry, as an industry, how are you looking at the patterns and sense of people buying? Is the heavy jewelry doing as well? Are people talking about making charges? Because that's a percentage of gold prices which has gone up by just too much in the last couple of weeks, perhaps.
Yeah. That's why recently, if you see, there has been a lot of discounts from the jewelers to attract the customers because customers are paying a high price for gold. So people can afford to give a discount on the making charges, value additions. So we see business flourishing everywhere. See, India, we have a lot of marriages coming up. It's a big country. We are heavily populated. Gold has to go on. For every wedding, there is gold. So what my opinion is, people will buy, but they will buy according to the budgets. For the daughter's marriage, you'd have saved 10 lakhs or 15 lakhs. He will buy only for the 10 lakhs or 15 lakhs. So the weightage will come down. So we need to see how we are going to increase our weight. If I'm selling daily 100 grams of jewelry, I should maintain that 100 grams. So I need to attract more customers, more class of customers should join. So my designs has to be innovative. My advertising has to be innovative. So all this happens, definitely we can maintain our turnover in weightage, not in amount wise, because amount wise every year it's going to go up, but weightage is more important. Only then we can continue the same weight of quantity of workmanship with our workers. See, if I'm producing 3 kilos of gold, the workman is getting benefited. Suddenly, if the 3 kilos becomes 2 kilos, the workman will get affected. So that also we need to look into. But we are a fast growing economy. So we are very positive that business will be good, whatever the price is. Only thing, it has to stay at one level. If it is too much going up, means people can't accept it. So even 3,000, it's fine. Let it stay for some time. Definitely customers will come forward because their confidence will go up. Because as prices go up, their confidence also goes up. And now and then World Gold Council also very positive always, and it also adds to this benefit.
Oh, well, absolutely. I'm going to go to World Gold Council soon, but I have one more question for you, Mr. Padmanabhan, and that is that we're looking at 92,000 per 10 grams. Add making charges to that. We are perhaps at ₹1,00,000 per 10 grams already. Is this something that the buyer has been able to digest yet?
Yeah, that's very difficult for them. But see, one thing we are noticing is our monthly savings scheme, where customers save 10,000 rupees per month, every month. This week, when they are coming to to renew their cheat. People are not buying only the jewelry, but they're not renewing their scheme. They're waiting for the prices to correct. So that immediate impact will be there. But otherwise, as time goes on, people have to adjust to the new prices, because I've been seeing prices right from 100 rupees per gram. There has been no stop at all. People have been buying at every level. People are buying, and it will continue. It will continue.
Oh, well, absolutely. If you remember, sovereign gold bond scheme that came in 2015, the gold prices were at 2,500. We are trading at 9,200 right now. So clearly a huge jump up there as well. This one is to you, Sachin. How are you looking at Indian investment buying now? ETFs, even as we've seen strong growth, but remember the base was low. So the overall AUM still stands at around 1.5% perhaps. So not in the overall scheme of things, it still is a very small number there. Gold bond scheme is done with, monetization scheme is done with now. So when you talk about financialization of gold in India, what's your sense going forward?
I think, Manisha, when you said, let's look forward and seeing what's coming. I think from my perspective, you mentioned about ETF, which has done really well. You're absolutely spot on. The base is low, but we believe it's at the cusp. It's a fantastic product in terms of regulated product. It's transparent. Every gram, every unit of ETF is backed by physical gold, which is phenomenal. And the way I see moving forward, and your first question to Dilip was around who's really buying. And I think our research says that a lot of the financial savvy young consumer is getting more and more inclined towards gold. We, as an industry, need to do better to get through to them with newer, fresher products, and you'll see a lot of these coming through. And getting gold being a little cool, you'll see all of those things coming in. But clearly, I think a lot of demand generation from a young consumer will happen on the financial side. And what we're also doing is that we are trying to bring the ETF financial world and the jewelry world closer. And we're trying to do a pilot very, very shortly, which is around a fungibility of the ETF into a jewelry store. So the intent is that we bring these two very diverse worlds a little closer. And I think a large sort of future projection will be coming from the younger audience. And that's what matters, because the large bet on the future of India towards Viksit Bharat is on the young India. And I believe that the financial sort of education is there. And with newer products, a lot of innovation coming in that area, it's going to get very, very exciting.
Dilip, what's your sense? What are you looking forward in 2025? And what are your strategies? As Sachin says, he's betting on younger generation here. What are you betting on?
Well, as a retailer, the segments definitely are mixed. I mean, yes, there is new generation which do buy a lot of 18 karat jewelry, and there is also the pent-up wedding demand for which the season is going to start. So, and yes, the investment bars are also on. So it's going to be a mix of buying pattern, but it's going to be very interesting. I mean, this year as compared to last year, because of the price rally. We would definitely see buying happening in dips. Okay, we might see a volatility in buying, but one thing is for sure, as Sachin mentioned, as Mr. Padmanabhan mentioned also, this year is definitely for gold. Kind of return it has given you the last year and a year before, for at least on an average. For the last 3 years, it's given a fantastic return, and that's going to continue. So the segments are going to be mixed. The retailers will definitely do well. It's about, as Mr. Padmanabhan rightly mentioned, it's all about getting in more clients to your stores. So how do you bring them in? How to do more awareness about gold? To speak more positive about gold, because that is giving you a lot of positive return.
Oh, clearly. And I take your point on the fact that 2025 is going to be very different from what 2024 was, given the way we are in sense of prices. And nobody really believes that the Trump tariffs turbulence is going to end anytime soon. We perhaps could be looking at it for the rest of the year as well, and that would keep the gold prices perhaps in headlines going forward. But I get your enthusiasm and optimism on this, that, well, yes, India is a gold buying country, and we could be looking at that throughout as and when prices stabilize even a bit. Thank you, gentlemen, so much for joining in with your sense on gold and the markets going forward. With that, it's a wrap on another edition of Commodity Champions. Many thanks for watching.
Yeah. like being very chilled out. I don't play too much with like colors and stuff, and that makes me feel very empowered and very beautiful. So I think it can be used as a tool to enhance your strengths rather than cover up your weaknesses.
Who are you walking for, and tell us about your inspiration behind it?
So I am walking for AKOK. I'm walking for Anamika Khanna, and I'm wearing her silver collar collection. And I think the inspiration around it is just warrior princess, something to make women feel very powerful, very strong, very modern, very cool. That's her inspiration, I'm assuming. I'm just channeling that.
The opening night showcased designer Anamika Khanna's designs that celebrated bold, ambitious women who own their space, lead with confidence and inspire with their individuality. It's been 25 years of Lakme Fashion Week. What is in store and what can we expect?
As you can imagine, it's the most emotional, sentimental moment for us. 25 years of all of us together. It's going to be a spectacular celebration and I'm so looking forward to it.
Can you tell us on what the collection is all about?
This collection, it's called the Silver Collar, and as the name suggests, it's about elevating workwear for women and the very fact that we don't really follow rules anymore. Everybody is bringing that power to the workspace, but they also bring that emotion, the gentleness and all of that. So it's just about elevating workwear to another level.
One message that you would like to see your brand on these young empowered women wearing your collection?
Hello and welcome to News Center. I'm Arundhati Ramanan. Large economies across the world are bracing for April 2nd when US President Donald Trump is scheduled to unveil his reciprocal tariff measures, a move that is set to disrupt the global trade ecosystem. Trump has, over the course of the last few weeks, dubbed April 2nd as the Liberation Day for America, even as his administration remained tight-lipped about the granular details of the tariff measures. Speaking to reporters at the Oval Office yesterday, President Trump said that he has settled on country-based reciprocal tariffs. Trump also claimed that India will be dropping its tariffs substantially. The US president was touting a flat 20% tariff on all imports into the United States. But in the last few days, US trade officials have been signaling a tailored approach with different tariffs on different countries.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday, you're going to see. And they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us. And we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
President Trump has offered another indication, an indication only, that the US may not impose reciprocal tariffs on India, at least as heavily as contemplated earlier. Trump said at a press meeting at the White House on Monday that someone had just told him that India is going to be dropping its tariffs. Now, that could mean that India could be offering further concessions ahead of the big tariff announcement that is due on Wednesday, offering concessions right up to the last minute. Or it could mean that Trump had only just been briefed about India's intentions and plans. But either way, it would appear that the Indian move to drop tariffs beyond those lowered already is substantial enough to have moved beyond negotiations to take the shape of a proposal that has been presented to Trump. This follows, of course, the trade talks that have been held in Delhi through all of last week. President Trump made his remarks on India, and this was straight after remarking that the EU has dropped tariffs on cars to 2.5%, which would then make that level of tariffs more or less the same as the US tariffs on European cars. But going by Trump's remark, of course, it's not just India, but other major trading partners of the US that are making exceptional efforts and huge concessions really to the US in order to duck the worst of those threatened reciprocal tariffs. Trump, we know, had said earlier on board Air Force One on Sunday that that tariffs would not be applied to all countries. Trump said also that he would prefer a deal to the other options, which would not be pretty. A deal certainly is what India appears to have offered, and we will know Wednesday with what success.
We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. Now for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if US matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT.
The Indian government sources have said that the US is encouraged by proposed tariff reductions. The US also described the negotiations for a bilateral trade deal between the two nations as positive. New Delhi is hoping for a temporary reprieve from the proposed reciprocal tariffs. Parikshit Luthra is here with all of those details. Parikshit, what are you picking up?
Sources tell CNBC-TV18 that the US believes that talks with India on the bilateral trade agreement have been very positive. In fact, the US side is encouraged by India's offer of reductions in tariffs and non-tariff barriers and is now considering a pause on reciprocal tariffs on India by a month or so. Reciprocal tariffs are likely to be applied for all nations, including India, but a temporary reprieve is under consideration. US officials believe substantial progress has been made in talks of market access in all areas except for agriculture and dairy. India's removal of 6% equalization levy and also the reduction of tariffs on cars and motorcycles in the union budget and also tariffs on bourbon whiskey has been welcomed by US authorities. India's Commerce Ministry has said that India and US have broadly come to an understanding on the next steps towards a mutually beneficial multi-sectoral BTA. The ministry said that both India and the US have expressed satisfaction with the outcomes of the meeting.
All right, Parikshit, many thanks for those details. Now, China, Japan and South Korea have agreed to boost regional trade amid US President Trump's tariff threats. This comes after the three countries held their first economic dialogue in 5 years. The three sides agreed to strengthen supply chain cooperation and engage in more dialogue on export controls. Meanwhile, the European Union says it has a broad range of options to retaliate against Trump's reciprocal tariff strike. European Commission Ursula von der Leyen told the European Parliament that the EU is open to negotiations, but it will approach them from a position of strength. Von der Leyen said, and I quote, "We do not necessarily want to retaliate, but if it is necessary, we have a strong plan to do so, and we will use it," end of quote. There are also a number of unknowns contributing to the uncertainty around the imposition of tariffs. Prashant Nair is here with more on this. Prashant, what are these big unknowns?
Well, lots of them, right? I mean, the focus is squarely on those tariffs tomorrow. And why not? We've heard Trump talking about them nonstop. And even after we've heard so much from him, we know very little about what actually is going to happen. Will Trump's tariffs be a bigger than expected blow, more disruptive than what is commonly believed? To be able to provide answers to that question, we need answers to a few questions, answers we don't have right now with us. So let me actually then put this in the context of 4 questions really about the announcement tomorrow. And, as I said, they remain unanswered, we'll know. Now, the first, of course, is the issue of timing. Timing of these tariffs really, right? Here, the simple point is, how will these tariffs go into effect? Will Trump, if he can move things along, will Trump put these, will he go forward and use the tariff law requiring a mandatory review period, or instead use emergency powers that allow tariffs to take effect immediately? My guess is that Trump aims for the latter. There is also the potential for tariffs to be phased in. For example, if he wants to impose 20, he says does 10 now and does 10 later. And if it is indeed so, it should take out some of the initial sting from the announcements. The second question is the size. Not long ago, the consensus worst case was a universal tariff near 10%, with China tariffs specifically being higher. Now, these estimates have all risen, and depending on who you ask, they stand anywhere between 15 and 20%, some even going to up to 25%. For many countries with few carve-outs in the first round, I mean, markets don't expect carve-outs. At least they're not pricing that in right now. It'll be a relief if it were to happen. Now, third is the question of which countries are impacted. We had the Treasury Secretary, Scott Bessent, who essentially talked about the dirty 15. At that point, he didn't name countries, but EU, Switzerland, Japan, South Korea and India are likely included on the list, along with, of course, Canada and Mexico. Now, this likely 15 perhaps would make up some 80% of US imports. Finally, there's the question of how other countries respond. Now, if you go back 3-4 months, the consensus was, actually, ever since President Trump took charge, the consensus was that countries would use restraint in their response to these tariffs. Can we absolutely be sure of that? Unlikely now. Many countries are openly saying that they will impose retaliatory tariffs on US reciprocal tariffs. Now, these are the 4 reasons. There are many more, but these are the 4 big reasons why there remains an enormous amount of uncertainty around what is coming in the next 36 hours. Let's zero in on India and the potential impact as well. Now, here I'm using calculations of JP Morgan economists. The tariff differential, simply put, what India imposes on US, what US imposes on India, is about 8% on a weighted average basis, according to JP Morgan calculations. Now, the number rises substantially, as you heard Neelkant and Sunil Kaul earlier point out as well, if the Trump administration decides to include VAT of 18%. JP Morgan says if it's only 8% weighted average, the GDP impact is 20 basis points. If the weighted average plus VAT is included, the impact on GDP could be about 50 odd basis points or so. Now, let's just also look at sectors, right? Individual sectors, and the table will come up on your screen, which gives you a sense of what I'm talking about. This again from JP Morgan economists. Very simply put, these are various sectors: exports to US as a percentage of Indian GDP, tariffs imposed by US on India, tariffs imposed by India on the US. The way to look at this is exposure to Indian GDP, and of course, you just deduct tariffs imposed by India minus tariffs imposed by the US. The 3 sectors which come on the radar very clearly are chemicals and pharma, textiles and clothing, and agri and meat products. These are the 3 sectors where the differential tariff is the highest and exposure is not small. It's not, it's not negligible in that sense. And this is essentially what we'll have to find out. What exactly will they do? The question for markets, of course, in the very near term, and we've seen the reaction today, is will this Liberation Day, as President Trump has been describing it, be a risk shock in the sense that even though he's spoken about it non-stop, are markets adequately pricing it in, or are they underpricing? Or will it be a bit of a clearing event that now we got clarity and the sort of, classic sell the rumor, buy the news kind of thing works out? It's been exhausting, I guess, Shireen, for markets, for us as journalists to track and chase these headlines. The only thing is we don't have to wait now very long. Even though we may not know the full extent of what they plan to do, at least we will know what's on their mind tomorrow, which is actually early Thursday morning. Back to you.
So we'll have to wait and see what happens tomorrow. Thank you so much for those details, Prashant. On that note, it is time for us to head into a short break. But don't go anywhere. More news and updates coming up right here. Stay tuned.
I think the first thing we have to address is safety and hygiene. I think we have to be perceived, and we'll only be perceived if we are a very safe place to travel for everyone, including particularly women travelers. So I think we all know there have been enough incidents, they keep happening. That has to stop. Otherwise, what happens, we'll have 2 kinds of tourists. We'll have the super rich tourists who come and have the 5-star premium holiday, rose-tinted glasses, blah, blah, blah. They go see everything. they don't really feel India, but they're seeing a very sanitized India. Or you have the backpacker who's out in the hills and doing whatever they're doing, coming from wherever, etc. That's so you don't have the classic middle class.
And there have been stories, Shireen, believe it or not. I mean, I remember those moments because when IPO happened, they suddenly started going back to their records and saying, where's that damn paper that you have?
Where's that piece of paper?
Where's that piece of paper? Because nobody really realized that it had any value. And some of them came back and said, we've lost it and can we just get it back, right? So it was really, really good to see.
They probably didn't think that anything would come off it, right? So you're tucked away in some files
luckily
somewhere.
finance had all records and everything's electronic. But yeah, people were like that. Like I remember them coming saying, "Aapne kuch ek wo diya tha letter nahi mil raha." They were scared. It's gone.
So you're the big daddy at Make My Trip, but you're also the big daddy for the startup ecosystem.
Yeah, from young Turk to not so young Turk, 25 years. So I think we all grow up. Now that you showed me the old young Turks we did.
Yes.
And you and so Shireen and CNBC, you might be our good luck charm. So you've seen us through thick and thin. And I officially want to thank you for being a huge supporter through our toughest times. So, we recall that and don't forget when people, help out when in the tough times. So thank you for that.
If my collection can give you a sense of freedom, I've done my job. And that's what I want to do. I want to make people feel free.
From legacy designers to fresh voices, Lakme Fashion Week continues to redefine not just trends, but the business of fashion. In Mumbai, Zenia Baria. Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? Welcome back. You're still with us on the News Center. The Indian government is facing a liability of more than 1 trillion rubles for outstanding sovereign gold bonds at the current price. In a reply to Parliament, the government revealed that outstanding sovereign gold bonds have underlying gold of 130 tons. Manisha Gupta is here with more. Manisha?
We did hear a similar kind of a statement in the last month as well in the Parliament itself. And when you look at the gold prices in last 1 month, we've seen prices gain up by 10%. If you look at the previous quarter, the gold prices have gained up by 18%. And we've started this financial year on a record high as well. So when you look at the calculations that we have been doing in the office today, RBI did issue 67 tranches. And the first tranche was put out in 2015-16. And the total tranches that were put out, that comes to 146.9 tons. tons. Now, 6 of these tranches have been paid off, have been redeemed, but 61 tranches still remain and 130 tons of redemptions still remain as well. So when you look at the gold prices right now, the outstanding, if we calculate that to today's price, today's price really comes in at around 9,284 per gram. Now, when you multiply that to 130 tons, the outstanding that the government has to pay to the Indian investors is to the tune of 1.2 trillion rupees. And we are only taking the prices of today because as and when these tranches will continue to come in, you will have to pay them as per the gold price that day. And with the way the gold prices have been moving higher, this number perhaps can go higher as well. Now, just to give you a sense that the last tranche that the government put out was in Feb 2024. So the last of the redemptions will come in 2032. So we still have those years left by, and the gold prices, the way they have been moving, you could be looking at higher prices as well. Another thing is that the government also is paying 2.5% to the investors as per their investment, and this is paid bi-yearly to them. So this is an added calculation as well. The finance minister in the parliament did say that they are maintaining a gold reserve fund where everything is accredited in time, but clearly this 1.2 trillion rupees that stands outstanding as of today is only going to grow going forward.
All right, Manisha, many thanks for those details. Now, the Reserve Bank of India has marked its 90th anniversary with President Murmu and cabinet ministers in attendance. President Murmu praised the central bank for its transformative role in making India a global leader in digital payments. RBI Governor Sanjay Malhotra has said that the next decade is crucial in shaping India's financial architecture.
Next decade will be crucial in shaping the financial architecture of our economy. We remain committed to expanding and deepening financial inclusion. We shall strive to foster a culture of continuous improvement in customer services and strengthening consumer protection. It will be our endeavor to optimize our regulatory frameworks by balancing the interests of financial stability and efficiency.
In a first, the Supreme Court has penalized Prayagraj Development Authority for what it called illegal and inhumane bulldozer demolition. A lawyer called Zulfikar Haider and Professor Ali Ahmed moved the top court, claiming their homes were illegally demolished. Ashmit Kumar is here with more. Ashmit, you know, the Supreme Court finally cracking the whip against illegal bulldozer demolitions.
Indeed, in fact, this is an issue that has been agitated a number of times before the Supreme Court. In fact, this round of petitions as well featured 6 petitioners who claimed that in 2021 their houses were demolished, and they said that this was done as a part of the bulldozer justice drive of the UP government, and that this was done to punish Atiq Ahmed. It was given to understand that it was wrongly assumed by the UP government of the day that this property, the property in question, was in fact related to or owned by gangster turned politician Atiq Ahmed, and therefore this is something that needs to be chastised. This is something that needs the intervention of the Supreme Court. That was the core concern that had been moved. The Supreme Court, as a part of these proceedings, made some very stern observations. Number one, it said that this is completely inhumane, that this is completely insensitive to the location, to the sensitivities of the people, that this is illegal, this is arbitrary in nature. In fact, the Supreme Court went on to say that it has shocked to learn that this was in fact a residential property, not a commercial property. Also going on to say that this has shocked their conscience, and because it is a violation of the fundamental right under Article 21, which is the right to shelter, and that this is something that needs to be condemned. And therefore, the Supreme Court unequivocally stating that this shall invite the condemnation of the court, and that it will take it a step further in asking the Prayagraj Development Authority to cough up a sum of 10 lakh rupees for each of the 6 persons concerned. And with this, a final word of warning coming in for the Prayagraj Development Authority as well as for the state government, that they should pay heed to the 2024 judgment where the Supreme Court had prescribed various safeguards. The safeguards that had been prescribed by the Supreme Court include having a show cause notice, allowing at least 15 days to respond, ensuring that there's a hearing, ensuring a demolition is in fact a last resort measure, that there is videography of the demolition actions. So a number of safeguards had been prescribed. The Supreme Court said all of that is applicable across the country, needs to be complied with respective state governments as well. Back to you.
All right, Ashmit, thank you so much for taking us through those details. Now, from new tax slabs to a higher tax deducted at source, the start of the new financial year means we're looking at a slew of tax changes coming into effect. CNBC-TV18's Timsi Jaipuria has the most important ones we should be watching out for. Timsi, if you could take us through the top 5 changes.
So a lot of these changes were announced in the recent months, but the most important ones were part of the income tax revisions introduced by the Finance Minister Nirmala Sitharaman in her February Union Budget. Given that the finance bill has been passed by the Parliament, so these provisions take effect from 1st of April. Here are the top 5. Starting the 1st of April, key income tax changes aimed at providing relief to individuals and senior citizens come into effect. The revised tax slabs under the new regime increase the basic exemption limit to 4 lakh rupees, while income up to 12.75 lakh rupees per annum effectively is tax-free for salaried individuals. That is when you factor in a standard deduction of 75,000 rupees. According to the government, the new tax slabs are likely to help individuals save 1.10 lakh rupees annually. Second, relief for senior citizens. The TDS threshold on interest income from banks, cooperative societies and post office deposits has been raised from 50,000 rupees to 1 lakh rupees. So this means there will be less tax deducted at source. At number 3, we have TDS thresholds on house rent. Budget 2025 increased the threshold limit to deduct TDS on house rent paid by non-individuals and companies. Now the TDS on house rent paid has to be deducted from the rent itself if the rent payment is 50,000 rupees per month or more. Number 4, taxpayers can now designate 2 properties as self-occupied without requiring justification for non-occupation. These reforms are aimed to reduce tax burden and enhance financial flexibility. At the 5th, we have changes to the limits of the TCS. Now, the limit of TCS on foreign travel investments and other large transactions has been increased from 7 lakh rupees to 10 lakh rupees. But there are a number of smaller changes that individual taxpayers and investors should keep in mind. Like starting today, if an investor has not linked their PAN with Aadhaar, then dividend payouts to them will be suspended. Another change is that in case of non-linkage, TDS will also be increased and no credit will be given in Form 26AS. Another operational change, and this one is for UPI users. If your mobile number is linked to UPI and you have not been using it for a long time, you have to update it. Otherwise, your UPI account linked with the number will not be accessible. So quite a few things for us all to keep in mind as the new financial year begins.
So the new changes you have to keep in mind. Thank you so much for Timsi for those details. Now, Ayurvedic beauty is going luxe, with India's luxury skincare market set to hit $4 billion by 2035. Homegrown brands are stepping up their game. CNBC-TV18 Shivani Bajaj brings you an exclusive sneak peek into Kama Ayurved's premium makeover as it gears up to take on global giants. Take a look.
A new look, new prices, new products for a new India. This is Kama Ayurveda's refreshed store in Mumbai, and for Kama, this is just the beginning of a new phase, where it takes the battle to some of the biggest players in India's glowing skincare market.
Well, the luxury skincare market is booming in India, and it's already valued at $1 billion and is set to grow at a 12% CAGR, expected to touch $1.6 billion by 2028, according to industry estimates. And it's not just the global giants. Ayurvedic beauty is having a moment too, growing at an even faster rate of 27%, according to industry estimates. Now, Kama Ayurveda, one of India's most recognized Ayurvedic skincare brands, is making a bold move, elevating its brand image, pricing, and product innovation to compete at a global luxury level.
But it's not just about turning up the luxury dial by putting old wine in new bottles. The new logo, the swankier stores come with revamped formulations as well. The company says its premium pricing rivals brands like Kiehl's and Clinique, all aimed at catering to the Indian consumers' rising aspirations and evolving tastes and preferences.
When we started the brand, we only thought of quality. The hair oil was some 400 or something rupees, when everything else is 40 rupees. This new generation is willing to pay extra if the product delivers. And it's all natural.
But Kama is adamant that premium does not mean expensive. Not every product sports a higher price tag. The stores themselves are also no longer just outlets, but a place people can experience Ayurveda as Pharma expands beyond skincare into holistic wellness. Its new stores will offer Ayurvedic consultations and treatments. It also already offers this in London, and its treatment rooms at Harrods and Notting Hill are already fully booked.
One is obviously this consultation space, okay, with the therapist, with the doctor who will come and consult with you, specifically tell you what you want to. There are nice tools over here. You can sit down and actually try the products out. Earlier it was standing only, so you can sit down and try the products out. And then in the bigger formats, once you have a larger space, like we have one in Delhi, but it will be expanding, I think, around the country, is treatment rooms. So basically face treatments, hair treatments, and body treatments.
Okay.
So you can physically come in, get a doctor's consult, figure out what you need to do, and then get a physical facial, hair treatment, body treatment.
With global brands investing in Indian Ayurvedic companies to global brands making a beeline to enter the Indian beauty market, it's evident that the world recognizes the potential of India's beauty industry. Pharma Ayurveda's transformation is not just about elevating a brand, it's about setting new standards in luxury skincare, both locally and globally. In Mumbai, this is Shivani Bajaj.
And with that, it is a wrap on this edition of News Center. More news and updates coming up right here on CNBC-TV18.
It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's
April 2nd is US Liberation Day, according to President Trump, but most market participants, you and I, know it as Reciprocal Tariffs Day. There has been a lot of uncertainty around tariffs and market remain on tenterhook. To dive deeper into the tariffs issue, let's connect with some important market voices. I'm joined by Neelkant Mishra, Chief Economist at Axis Bank and Head of Global Markets Research at Axis Capital. Thanks very much, Neelkant, for joining us. Simple first question, simple question, but not so simple answer. As we go into the 2nd of April, they've said that they will hand over all countries a number, a reciprocal tariff number. In your opinion, what will that number be for India?
It is wise to even surmise that. As we think about the economy and the markets, I think it's very important to see this as one of many important milestones, because this will just be a starting point. It is very important to understand what is it that the Trump administration is trying to achieve. As we see it, underneath the somewhat chaotic announcements of tariffs today and no tariffs tomorrow and then tariffs the third day, there are 3 broad objectives that the US is trying to achieve, the current administration. The first is that they are no longer willing to bear the costs of multilateralism. So we are moving from multilateralism to bilateralism. That will have its own repercussions, and we can discuss that. The second is that they realize that being the reserve currency of the world has meant that they've had to sustain a current account deficit. The currency is overvalued, and they want to do something about it. I don't think they're 100% clear on exactly what needs to be done, but they want to address the problem. And the third is that most people in the current administration want to go back to the glory days of pre-World War II isolationist America, where they focused on their own strengths and they benefited from it. And over the next year or two, you will see them moving and pushing in that direction. And I think we have to anticipate that. So what that number is on April 2, I mean, frankly, will matter a lot less. But I think these changes are what we have to get used to.
Many in the market are of the view that this is a hump to get over, and then from there things will get easier. You were suggesting otherwise. Have I read that rightly?
Yes, absolutely. See, remember that we are reshaping the world order. The post Second World War world order is now being reshaped. And remember that tariffs are only one form of industrial policy. You have many other forms of industrial policy which are not possible today because people are worried about the World Trade Organization. Now, suppose export subsidy. Export subsidies are not allowed. So companies and countries don't. Most countries don't have them, at least not explicitly. Now, imagine that you are only having bilateral relationships now. And if one country starts to subsidize their exports of a certain product, so long as it doesn't affect the US, they're not going to be bothered about it. And the countries will start working on these themes. They will start raising the barriers. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult.
Absolutely. What does the math say right now, the models that you've already sort of arrived at? For India, that blended tariff rate or the weighted average tariff rate, to what extent could it go up by? That's part A of my question. And part B is that since we're still not a fully export-oriented economy, what is the implication on GDP growth? How many basis points?
See, this is why, while I'm sure you and your viewers would like certainty on a particular number. So suppose we say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. But is that the right number? Is that the real impact on GDP? Because over a period of time, of course, there will be negotiations. Not all of it will be borne by the supplier. Some of it will be borne by, and it'll vary from. So suppose you are a pharma company, and there is a very concentrated pool of buyers, but the cost of production in the US is 80% higher. So there's no way that they can really replace you with someone else. In which case, you actually have some bargaining power. If you are an auto component maker, and what price increases can happen. So these things will settle over a period of time. You also have other alternatives. You can actually reroute it through some other channel. And therefore, the impact could be actually far lower than that. So in fact, for India, given that exports to the US are, less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot. What I'm much more worried about is how uncertain this makes things for the world, and therefore what happens to global markets and what happens to the global economy. And therefore, the channel through which I think this uncertainty will affect us will be the financial markets and not as much the trade. To give you perspective, if, say, corporate capex as a percentage of GDP globally is, say, 8 to 10%, it's higher in India, it's higher in China, but globally it should be about 8 to 10%. And if 10% of those companies, 10-12% of those companies or of those investments get postponed by 6 to 12 months because of the uncertainties that we're talking about, we're talking about a 1% of GDP growth globally getting shaved off. It will show up over 12 months, but that's a substantial reduction. And imagine the second, third order effects of that. And then what that does to equity risk premiums, the uncertainty.
So just to understand this again, what you're saying is that expecting a 1% GDP impact, global, world GDP,
that probably is a realistic number that we can work with, and therefore there could be significant impact on financial markets, including ours, right?
That's the order of magnitude. See, I know we are all grappling with a lot of uncertainty, but remember that these are the first salvos being fired. Everyone is wanting to have a negotiation. Soon enough, as the implications start getting clearer. So, for argument's sake, suppose the Venezuela-related tariffs also take effect, and now there is 45% impact on Chinese exports to the US. What will happen to Chinese exports to Indonesia, to Malaysia, to India? And then how will our economies respond to this? Will we respond to this with currency, with non-tariff barriers? Will we then start raising tariffs, in particular on Chinese imports or imports from China? Remember that this is just the first salvo being fired in what is actually going to be a multi-year trade war. It is unwise to anchor yourself, this is how it will happen, and then, finally, then we are sorted out. Which is why I think we have to gear ourselves up for sustained period of uncertainty. And that is why I started off with the strategic objectives that I think the Trump administration is driving towards. Imagine that, even the auto component example. I mean, I was reading this article that now the US is saying that if the auto components in the imports from Mexico are US manufactured, there's nothing. It's almost like the popcorn on GST situation here, right? I mean, imagine the complexity of the trade flows. It is, I think at this stage, it is reasonable to expect there will be a lot of uncertainty and not try to quantify everything immediately.
You said the main channel through which this is going to affect us is going to be markets, financial markets. You mean financial markets are in for a bit of a turmoil?
Yes.
Which means lower equity markets overall, broadly. I mean, they'll be tougher markets to do well.
Yeah, higher equity risk premium, and which means lower price to earnings multiple.
Okay. Is there a risk of overcompensating for all this? That we are maybe, because this is a 4-year presidency. So, as you said, post-World War consensus is being broken now. I mean, what if Democrats come back? So will we kind of completely revert now, or this is a permanent break? Or not? Tough to know.
No. It's like, you start a war when someone slaps the next person, and then they slap them back, and then the next person punches, and then you say, now, or everyone behave. It's very hard to... one hopes that it will happen, because I think the previous world order, I think everyone behaving with certain common norms is actually not a bad thing. And eventually, even after the Smoot-Hawley and the breaking of the gold standard and all of that, finally some agreement came through in Bretton Woods, right? So it takes, I'm not saying it will take 10 years, but 4 years is a long time. Second, once you break things apart, even if you reset them, there will be new optimizations. And clearly there were some things that were wrong or that were not working in the previous order, which is why we are seeing this. So
this is happening.
It will be a different reset, but that's quite some time away. I mean, we all should be optimistic about the world.
Thank you very much, Neelkanth, for joining us with those insights. This calls for a much deeper chat, but we will connect with you post the 2nd of April, opening salvo, as you called it. Let's slip into a short commercial break. On the other side, we continue to dive deep into the tariff issue. We will connect with Sunil Kaul of Goldman Sachs in just a bit.
And award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch Watch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
If they pump in more capex into their business, then Indus Tower gains definitely, because they'll get better tenancies and they will also get newer towers with that capex. And the last stakeholder is Bharti Airtel and Jio. They are stakeholders to.
We have Sunil Kaul, emerging market strategist at Goldman Sachs, to help us with, broadly how to think about this subject, because we'll talk some numbers here over the course of this conversation. And of course, right on top, I want to just put out the disclaimer that these are just, it's a thought exercise at this point, and we just have to wait it out in the second to see what actually comes through. Sunil, welcome to the program. Thank you very much for joining us. Let's just get some broad thought numbers out of the way, Sunil. Let's do India first, and then we'll look at the global scenario as well. India has been mentioned as sort of a tariff abuser multiple times by the Trump administration, by President Trump himself, in various speeches over the last 2 months, actually even before that. Now, as we are close to the 2nd of April date, what is the, and they've, the indication is they will hand out a number to each country. What will that number for India be in terms of reciprocal tariffs? Sunil.
Sure, Prashant. First of all, thanks for having me on. Look, as you said, there is a lot of uncertainty on all of this. Nobody knows what will exactly come out. Listen, I think our sense is that, look, India will be one of the many trading partners that will likely get sort of be included in the reciprocal tariffs. I think the Office of U.S. Trade and Representatives, they sought inputs from 19 of the trading partners. Out of those, 15 have trade surpluses with the U.S., which covers close to 90% of the U.S. imports, right? So India would be one of the 15 trading partners we think that could come in the reciprocal tariffs. I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if U.S. matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT. Europe is obviously a large risk there as well. So depending on what the number could be, it could be north of sort of pure 11 percentage points, which is based on the weighted average tariff rates. I think the one thing I wanted to mention in here is that our general sense is that these proposed tariff rates are intended to be sort of basis for negotiation, right? Like we have seen in Mexico and Canada's case. And so the likely number for each country is probably going to be somewhat higher than what the pure sort of product level matching of the tariffs would suggest. And then there will be room for that to get negotiated down.
So on a weighted average basis, tit for tat, reciprocal tariffs, 11% could be the number. Again, this is all in the possible. This is more than anything else a thought exercise. Yeah. But if you throw in VAT, etc. as well, the number could be actually meaningfully higher than 11%. It's possible.
It's possible, yes.
And the way, Sunil, as you also sort of explained, it is in a way, an opening gambit for negotiations. Is that the way to think about it? I mean, say, for example, if the number is 20%, market will be shocked. But will that then be, will they walk back based on how negotiations go?
I mean, that's exactly our expectation, Prashant, because there are a couple of things in here. One, I think if you looked at the amount of imports that these trading partners have, that's almost thrice what the imports from Mexico and Canada were. So the quantum we are talking about is quite large, which means that if you go by precedence, if they sort of delayed the tariffs on Mexico and Canada by 30 days, and then they sort of had partial reduction in those tariffs for another 30 days, that just suggests that there will be sort of room for negotiation, and it won't be sort of implemented immediately in India's case, and for that matter, in most countries' cases. As I said, these numbers are sort of open to negotiation, in which case the numbers will be higher, and then there will be that sort of 30 to 60-day window, as I just spoke, where there will be sort of obviously back channel talks, and there will be some room to take those numbers lower.
And it is also possible that, instead of saying, okay, the number is 20% and then walk back from 20, I mean, they say, well, there's 10 now and 10 more coming. So that also, in that sense, perhaps could be a way to negotiate show me proof that, well, you're willing to work with us, and then maybe... so we don't know, right, what combination and what measures and what route they use.
That's right. I mean, as I said, we are not entirely clear how it will be implemented, but just going by the prior instances with Canada and Mexico, most likely the number is going to be higher. Most likely it won't be implemented immediately on day one. They will give a window before this gets implemented. And then within that window, the numbers will be likely negotiated down with a final number, or in some cases, if there is potentially a deal, then it could be even sort of revoked entirely, as we saw with in some cases, right? So there is, as you said, there is a lot of uncertainty around how this pans out, but it does feel like the market will be somewhat negatively surprised, because the quantum of this is going to be larger than many of our investors are thinking, and it's probably going to be also pretty broad-based when it comes to different countries.
Market expectations, Sunil, are under 10% right now?
Yeah, I think on a weighted average basis, some of the recent surveys we did among clients is around sort of 9-10% on an average basis across these trading partners, not sort of singling out India in here. But that's, I think, what the expectation is, so about 10%.
Okay, all right. How are you leaning to the fact that VAT will be included? And maybe who knows, currency as well, right? I mean, they feel currency is undervalued in many trading partners. Japan has been mentioned, China, and so what's your sense? Is that
look? I think that's why we said the numbers could be actually much higher, because as you entirely correctly pointed out, Prashant, there is the product level sort of tit for tat sort of tariff matching. On top of that, there is the non-tariff measures. On top of that, there could be sort of VAT. And then there is the currency undervaluation in some cases, and India obviously checks that box as well, as per sort of US administration. And then there is the additional news flow that they just mentioned in terms of countries that are importing oil from Venezuela. They could also be subject to additional tariffs. And obviously there are other countries, China, EU, which are kind of more impacted from that, but India at the margin is also there. And so there are some multiple layers on top of the pure reciprocal level product by product tariffs, which could come in. I think all of those things actually point to the same conclusion, which is that the initial number could be a little bit higher than what the market is anticipating, which is partly the reason that we also think that it makes sense to be a bit sort of more cautious on the markets in the near term because of this sort of impending risk.
But if it is, you and I are talking about it, and people around dealing rooms and in institutions are talking about this, you are talking to clients as well. So in a way, if this becomes the view that, well, start with a big number and then walk back, will markets react in a very negative way? Maybe we get a bit of a dip globally, and then that gets bought into?
Yeah, I mean, that's a great question, Prashant. I think the way this has been sort of getting asked in our conversations is that, is April 2nd the clearing event in that sense? Is that, okay, so they announce stuff and then the market sort of looks beyond it, so now it's already announced and that's a clearing event for the markets. Our sense is that it could still be an initial shock, as I said, because the numbers will be higher than what the market is currently anticipating. And then there is a room for negotiation. There's a window for each country, in which case I think there will still be sort of uncertainty in the market. So I think the way we sort of think about it is that you probably continue to have some uncertainty related to tariffs over the next sort of 30 days before things start to get 30 to 60 days before things start to get clearer in terms of what the final tariff rate would be for each of the countries. And so I think this will be something which will be an overhang for us for the next couple of months.
Here in India, there have been some news reports. Reuters reported that India is looking to cut tariffs on half of its imports, US imports into the country. So it's fluid out there, right? I mean, so this is also obviously a little bit of posturing. I mean, showing the other side that we're willing to work even before, I mean, preempting some of this. So any thoughts there?
Yeah, I mean, exactly as you said. I mean, as we know, the U.S. Commerce Ministry was in Washington a couple of weeks back, and obviously there have been talks with India, similar to the other countries as well. So I think it's all a part of the deal or the negotiating tactics, as we just mentioned, Prashant. And so, I mean, it could very well be that, as you said, India would reduce tariffs on some of the imports well ahead of this. Or even sort of post the actual announcement, because the announcement, as I said, the implementation would be delayed, right? So India could still kind of implement these things post the April 2nd announcement. They could sort of also increase the purchases of sort of defense, energy related imports from US. And so I think each of the country will probably try to negotiate, probably try to lower tariffs in some categories where it's too high compared to what US is charging. And then also sort of increase some of the spending in areas of defense, energy, which US is keen on. And so all of this will be probably part of the countries showing US that they are willing to work with US and come to a more reasonable deal.
Is it possible to form a view on the markets with all of this uncertainty? Do you have one? The 1st of April, we'll also have these middle-class tax cuts which come into force, effect perhaps a few months later. 9th of April is the RBI, maybe a rate cut. What's the view on the market itself here?
Look, I think, Prashant, as you may recall, so we had sort of downgraded the market from overweight to market weight back in October, so about 6 months back. And the view there, and it was largely on the back of the cyclical growth slowdown, right? So fast forward, we already seen markets have come off, valuations for the large caps have come off. But our general sense is that on the domestic side, your growth has kind of bottomed out, but it's still sort of going to be a gradual recovery in here. You still have policy, especially on the fiscal side, which is somewhat restrictive. We still have earnings cycle, which is still seeing more downgrades than upgrades. So we still think there is a couple of quarters of downgrades left. We still know that small and mid caps have much higher valuations, and the positioning there is still not cleaner, especially within the domestic funds, right? So there is still sort of more risks on the domestic side, even though I think the worst is behind us. But then on top of that is what we were discussing on the global side, which is that you have the impending reciprocal tariffs that would come and hit us, which will be with us for a while before things stabilize there. And so because of all of this, we still think it may be a little bit too early to take broad-based exposure in the market. So we are somewhat sort of cautious in the near term. I think we are kind of much more sort of alpha focused, looking at companies and sectors where you got sort of higher earnings visibility, more stronger balance sheets, and sort of more quality bias.
All right, Sunil, we'll leave it there. Thank you very much for joining us. Good conversation. And I hope to speak with you once we have the tariff announcements on the 2nd of April to get a sense on what to do from there. I mean, I think it'll be an interesting week one way or the other. Thank you very much, Sunil.
Thank you so much, Prashant. Thank you.
Contrary to many beliefs, my belief is that a stronger VIL is better for both those companies than a weaker VIL. For a simple reason that a weaker VIL will resort to pricing and discounting. VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here, because in March of 26 they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening: a sharp sell-off on the Lal Street. The Sensex loses nearly 1,400 points and Nifty gives up over 350 points. All sectoral indices, barring media, end in the red.
The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
President Trump says he settled on country-based reciprocal tariffs just a day ahead of the 2nd April deadline, but stopped short of revealing the details. Trump claims India is going to drop tariffs substantially. The Indian government's sources tell us that the US is encouraged by the proposed tariff cuts and describe the trade negotiations as very positive. New Delhi is hoping for a temporary reprieve from the proposed reciprocal tariffs. Motown ends FY25 on a high. M&M, TVS, Ashok Leyland, Royal Enfield sales exceed expectations in March. Maruti Suzuki meets estimates even as it lags behind competitors on sales growth. Vodafone Idea shares rally after the government converts dues into equity, taking government shareholding to 49%. Brokerages welcome another lifeline to the company but remain cautious on cash flow and AGR dues, which is still pending. The Supreme Court upholds Piramal Capital's resolution plan for the bankrupt Dewan Housing Finance, scraps the NCLAT order, which had termed it illegal. The Apex Court directs that any recoveries from fraudulent transactions must flow to the resolution applicant, which is Piramal Capital, and not to DHFL's creditors. ChatGPT maker OpenAI is set to raise $40 billion, valuing the company at $300 billion. SoftBank alone invests $30 billion in what was the largest private tech funding deal on record. The Met Department warns of a heat wave, predicts above normal temperatures for most parts of India this summer, also warns of unseasonal rains and thunderstorms this week across Maharashtra and MP, which could damage crops. The Reserve Bank of India marks its 90th anniversary with President Murmu and cabinet ministers in attendance. RBI Governor Sanjay Malhotra says the next decade is crucial in shaping India's financial architecture. Well, let's start with the market action. A down day on the Lal Street, no other way to describe it. The Sensex lost nearly 1,400 points and the Nifty was down over 350 points after what was a broad-based sell-off. Mid-caps, bank stocks, everything down in the red today. 730-point cut there on the Nifty Bank. The mid-cap index losing 450 points. And, of course, a 1390-point cut there on the Sensex, 350 points lower on the Nifty. Except for media, everything else in the red. Surbi standing by to take us through the market action. Surbi, we were closed yesterday on account of Eid. We've opened and closed terribly today ahead of the tariff countdown. Is that what is spooking the markets?
Well, it was a tariff-induced turbulent Tuesday, if I could call it that, alliterating on all the T's out there, thanks to Donald Trump. The market basically had to play catch-up. There was no escaping the Monday global mayhem. We thought we were shut for trade on Monday, so we could escape it. That wasn't the case. And the market actually ended close to the lows of the day. Today was an interesting session because the selling did not, see too many buyers. So basically, the dip was not getting bought. The Nifty and the Bank Nifty, they fell about 1.5%, falling more than the mid-cap index and ended, like I said, towards the lows of the day. What led the fall? Actually, all sectors, but largely IT and financials were very weak. Real estate stocks, particularly the ones that are based out of Maharashtra, they took it on the chin because the state has increased the ready reckoner rates. Let's talk about the major Nifty movers. And as you can see in the heat map, it's far more red than green. And it's cutting across sectoral lines. Of course, IT was weak. HCL Tech, Infosys, TCS, large stocks falling anywhere between 3.5%. Financials, HDFC Bank, ICICI Bank, Bajaj Finance, Shriram Finance. You can see it's not just banks, but even in large NBFCs, they were all down together. The big boys, the heavyweights, couldn't do much to support the Nifty. So whether it was L&T, Reliance, big names like Lever, all of them were on the downside. So where was the green on the Nifty? Well, in few places, IndusInd Bank had an interesting session. It was an outlier, up 5%. Trent found some takers because the company detailed its store expansion plan both for Zudio and Westside. The market liked that. And some of the two-wheeler names were doing well as the auto sales numbers for the month of March have been trickling in. So Bajaj Auto and Hero Motor both managing a gain of about 1% each. Let's talk about the mid-cap market. The good news here is that there were more number of stocks advancing than declining. That's one. And like I said, the index was down just about 1%, doing better than the Nifty itself. Let's talk about the newsmakers. And Vodafone Idea, as one would expect, lots of action, high trading volumes on the stock, and finally up almost 18-19%. Indus Towers getting a leg up as well, 5-6% up there. HAL started the morning on a song with that big, huge, massive order, over 62,000 crores for the light combat aircraft, but finally it tapered down. And HBL Engineering, on the back of coverage orders, also did really well. Realty, as I said, was weak. So Godrej Properties, Oberoi Realty, Macrotech, Prestige 2%, 5%, 5%. Those are the kind of cuts that we're talking about. However, all was not lost. So while there were stocks on the way down, Info Edge, PB Fintech, some of these internet companies were seeing downside pressure. Lemon Tree, Restaurant Brand Asia, pretty heavy price and volume action on the upside on these stocks as well. So mid-cap, some still select stock picking going on. Finally, of course, we are awaiting clarity on the tariff issue. But beyond that, also looking out for the FPI flows once again very carefully, because Friday was a bit of a disappointment. We had a big FPI sell number on Friday, 4,350 odd crores. So investors will want to see if that was a one-off or whether that selling spree has resumed by foreign investors.
Surbi, many thanks for joining us. Well, as Surbi was pointing out, the big global story that is impacting markets worldwide. US President Donald Trump will unveil reciprocal tariffs on the 2nd of April. Now, President Trump has said that he's settled on country-based reciprocal tariffs. However, he has stopped short of revealing the details. Speaking to reporters at the Oval Office, Trump also claimed that India will drop its tariff substantially. The US president was touting a flat 20% tariff on all imports into the US, but in the last few days, US trade officials have been signaling a tailored approach with different tariffs for different countries.
You're going to see in 2 days, which is maybe tomorrow night or probably Wednesday, you're going to see, and they're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. We have a lot of countries, friend and foe. I always say friend and foe, but the friend in many cases is worse than the foe. They took advantage of us, and we are going to be very nice by comparison to what they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
President Trump has offered another indication, an indication only, that the U.S. may not impose reciprocal tariffs on India, at least as heavily as contemplated earlier. Trump said at a press meeting at the White House on Monday that someone had just told him that India is going to be dropping its tariffs. Now, that could mean that India could be offering further concessions ahead of the big tariff announcement that is due on Wednesday, offering concessions right up to the last minute. Or it could mean that Trump had only just been briefed about India's intentions and plans. But either way, it would appear that the Indian move to drop tariffs beyond those lowered already is substantial enough to have moved beyond negotiations to take the shape of a proposal that has been presented to Trump. This follows, of course, the trade talks that have been held in Delhi through all of last week. President Trump made his remarks on India, and this was straight after remarking that the EU has dropped tariffs on cars to 2.5%, which would then make that level of tariffs more or less the same as the US tariffs on European cars. But going by Trump's remark, of course, it's not just India, but other major trading partners of the US that are making exceptional efforts and huge concessions really to the US in order to duck the worst of those threatened reciprocal tariffs. Trump, we know, had said earlier on board Air Force One on Sunday that the tariffs would not be applied to all countries. Trump said also that he would prefer a deal to the other options, which would not be pretty. A deal certainly is what India appears to have offered, and we will know Wednesday with what success.
We say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. Now, for India, given that exports to the US are less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's that's not what I would worry about the most. I know it will affect a certain set of companies a lot.
I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if US matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT.
Well, reactions there coming into the potential impact of the Trump tariffs. Now, Indian government sources have said that the US is encouraged by the proposed tariff reductions. The US also described the negotiations for a bilateral trade deal between India and the US as positive. Now, New Delhi is hoping for a temporary reprieve from the proposed reciprocal tariffs. Parikshit is standing by with more. Parikshit, what should we expect now come the 2nd of April?
Sources tell CNBC-TV18 that the US believes that talks with India on the bilateral trade agreement have been very positive. In fact, the US side is encouraged by India's offer of reductions in tariffs and non-tariff barriers and is now considering a pause on reciprocal tariffs on India by a month or so. Reciprocal tariffs are likely to be applied for all nations, including India, but a temporary reprieve is under consideration. US officials believe substantial progress has been made in talks of market access in all areas except for agriculture and dairy. India's removal of 6% equalization levy and also the reduction of tariffs on cars and motorcycles in the union budget and also tariffs on bourbon whiskey has been welcomed by US authorities. India's Commerce Ministry has said that India and US have broadly come to an understanding on the next steps towards a mutually beneficial multi-sectoral BTA. The ministry said that both India and the US have expressed satisfaction with the outcomes of the meeting.
Parikshit, many thanks for joining us. Now, China, Japan and South Korea have agreed to boost regional trade amidst US President Trump's tariff threats. Now, this comes after the three countries held their first economic dialogue in 5 years. The three sides have agreed to strengthen supply chain cooperation and engage in more dialogue on export controls. Meanwhile, the European Union says it has a broad range of options to retaliate against Trump's reciprocal tariff strike. European Commissioner Ursula von der Leyen told the European Parliament that the EU is open to negotiations, but it will approach them from a position of strength. Von der Leyen said, and I quote, "We do not necessarily want to retaliate, but if it is necessary, we have a strong plan to do so, and we will use it." End of quote. There are also a number of unknowns contributing to the uncertainty around the imposition of tariffs. Prashant is here with more. Prashant, what are the unknown unknowns?
Well, lots of them, right? I mean, the focus is squarely on those tariffs tomorrow. And why not? We've heard Trump talking about them nonstop. And even after we've heard so much from him, we know very little about what actually is going to happen. Will Trump's tariffs be a bigger than expected blow, more disruptive than what is commonly believed? To be able to provide answers to that question, we need answers to a few questions, answers we don't have right now with us. So let me actually then put this in the context of 4 questions really about the announcement tomorrow. And, as I said, they remain unanswered, we'll know. Now, the first, of course, is the issue of timing. Timing of these tariffs really, right? Here, the simple point is, how will these tariffs go into effect? Will Trump, if he can move things along, will Trump put these, will he go forward and use the tariff law requiring a mandatory review period, or instead use emergency powers that allow tariffs to take effect immediately? My guess is that Trump aims for the latter. There is also the potential for tariffs to be phased in. For example, if he wants to impose 20, he says does 10 now and does 10 later. And if it is indeed so, it should take out some of the initial sting from the announcements. The second question is the size. Not long ago, the consensus worst case was a universal tariff near 10%, with China tariffs specifically being higher. Now, these estimates have all risen, and depending on who you ask, they stand anywhere between 15 and 20%, some even going to up to 25%. For many countries with few carve-outs in the first round, I mean, markets don't expect carve-outs. At least they're not pricing that in right now. It'll be a relief if it were to happen. Now, third is the question of which countries are impacted. We had the Treasury Secretary, Scott Bessent, who essentially talked about the dirty 15. At that point, he didn't name countries, but EU, Switzerland, Japan, South Korea and India are likely included on the list, along with, of course, Canada and Mexico. Now, this likely 15 perhaps would make up some 80% of US imports. Finally, there's the question of how other countries respond. Now, if you go back 3-4 months, the consensus was, actually, ever since President Trump took charge, the consensus was that countries would use restraint in their response to these tariffs. Can we be absolutely be sure of that? Unlikely now. Many countries are openly saying that they will impose retaliatory tariffs on US reciprocal tariffs. Now, these are the 4 reasons. There are many more, but these are the 4 big reasons why there remains an enormous amount of uncertainty around what is coming in the next 36 hours. Let's zero in on India and the potential impact as well. Now, here I'm using calculations from JP Morgan economists. The tariff differential, simply put, what India imposes on US, what US imposes on India, is about 8% on a weighted average basis, according to JP Morgan calculations. Now, the number rises substantially, as you heard Neelkant and Sunil Kaul earlier point out as well, if the Trump administration decides to include VAT of 18%. JP Morgan says if it's only 8% weighted average, the GDP impact is 20 basis points. If the weighted average plus VAT is included, the impact on GDP could be about 50 odd basis points or so. Now, let's just also look at sectors, right? Individual sectors, and the table will come up on your screen, which gives you a sense of what I'm talking about. This again from JP Morgan economists. Very simply put, these are various sectors: exports to US as a percentage of Indian GDP, tariffs imposed by US on India, tariffs imposed by India on the US. The way to look at this is exposure to Indian GDP, and of course, you just deduct tariffs imposed by India minus tariffs imposed by the US. The 3 sectors which come on the radar very clearly are chemicals and pharma, textiles and clothing, and agri and meat products. These are the 3 sectors where the differential tariff is the highest and exposure is not small. It's not, it's not negligible in that sense. And this is essentially what we'll have to find out. What exactly will they do? The question for markets, of course, in the very near term, and we've seen the reaction today, is will this Liberation Day, as President Trump has been describing it, be a risk shock in the sense that even though he's spoken about it non-stop, are markets adequately pricing it in, or are they underpricing? Or will it be a bit of a clearing event that now we got clarity and the sort of, classic sell the rumor, buy the news kind of thing works out? It's been exhausting, I guess, Shireen, for markets, for us as journalists to track and chase these headlines. The only thing is we don't have to wait now very long. Even though we may not know the full extent of what they plan to do, at least we will know what's on their mind tomorrow, which is actually early Thursday morning. Back to you.
Well, the countdown is underway, but it's clearly not done, Prashant, and it's promising to be a long night, not just tonight, but for the next few days as this unravels. But thanks very much for joining us. President Trump has hinted that the Department of Government Efficiency, that's DOGE, headed by Elon Musk, might shut soon. Speaking at the Oval Office, President Trump said that Musk wants to return to run his companies. This comes a day after Musk had said he intends to step down from his cost-cutting role in May. Take a look.
He's got a big company to run, and so at some point he's going to be going back. He wants to.
You just want to keep him around.
But I'd keep him as long as I could keep him. He's a very talented guy. A lot of the people that are working with DOGE are the secretaries, the heads of the various agencies, and they've learned a lot, and they're dealing with the DOGE people. I think some of them may try and keep the DOGE people with them, but at a certain point, I think it will end.
Well, Musk's return to the companies he runs, quitting DOGE perhaps shortly. The Chinese Foreign Ministry said Xi Jinping and Indian President Draupadi Murmu exchanged congratulatory messages on the occasion of the 75th anniversary of diplomatic ties between the two nations. As per the Communist Party-run Global Times, the Chinese Foreign Ministry said that the history of China-India relations demonstrate that becoming partners who achieve mutual success and realizing the dragon and elephant dance is the right choice for both sides. So a reiteration of an earlier message. In stock-specific news, Vodafone Idea shares rallying in trade after the government decided to convert its dues into equity, not all, but some. With this, the government's stake in the company is now at 49%. Brokerages welcomed what they called another lifeline for the company, but the street remains cautious on cash flow as well as the pending AGR dues. That, of course, is an outstanding issue. Real estate stocks under pressure after the Maharashtra government increased the ready reckoner rates. On average, the rates have gone up by 3.9% across the state. In Mumbai, the ready reckoner rates have been hiked by 3.4%. The Maharashtra government is expected to earn at least 10,000 crore rupees in this new financial year from stamp duty and registration charges. Now, Motown has ended FY25 on a high. M&M, TVS, Ashok Leyland and Royal Enfield sales have exceeded expectations in March. Maruti Suzuki met estimates despite lagging behind competition. Sudarshan is standing by with the Motown report card. Sud.
So the number of companies reporting sales better than estimates for the month of March is higher than the ones which have disappointed the street. We'll start with two-wheeler companies. First one is Eicher Motors. It has reported sales for Royal Enfield, which was more than 1 lakh units against our estimate of 91,000 units, much higher than the estimates. Also, TVS Motors numbers were 7% higher than estimates. But for two-wheelers, one thing that has to be factored in is emission standard norm, which has come into effect from today. And that was the reason that these companies saw pre-buying in the last week of March. So numbers were looking elevated for most of the two-wheeler companies. Now coming to the tractor segment, both Escorts Kubota and M&M Tractor reported numbers that were much better than estimates. For Escorts Kubota, numbers were higher by 34% year-on-year. And both the companies said because of festival like Chat Navratri, the last week of March saw higher growth. But good part is both these companies are saying that momentum will continue even in Q1 FY26. And remember, this is one segment which has been outperforming over the last few months, and it's expected that this segment will continue to outperform going forward. Next is commercial vehicle segment. Here, Ashok Leyland has reported a strong set of numbers, while for Tata Motors, CV sales have dropped by 3%. In the parallel, Ashok Leyland's M&CV segment was higher by 15%. Last is passenger vehicle segment. Again, M&M continues to lead, and the reason is SUV performance, where for M&M, SUV growth was 23% against 6% growth for utility vehicle of Maruti, that is also called SUV, and for Tata Motors, passenger vehicle segment has seen a growth just of 3%, and that was dragged by electric vehicle, which was down by 21%. But overall, more positives than negatives for the month of March as far as auto sales are concerned.
All right, so many thanks for joining us. We will take a break, but up next, the Supreme Court upholds Piramal Capital's resolution plan for the bankrupt Dewan Housing Finance, scraps the NCLAT order, which had termed it illegal. That and more when we return.
Take care of their capex requirements in the immediate future. So, so they're not completely out of the woods.
મારું યાત્રા
GST collections in FY25 have risen more than 9% compared to last year. The collections in March stood at 1.96 lakh crore rupees. This is nearly 10% higher year on year. The mop-up in March is also the second highest monthly collection so far this year. That's how we closed the year for GST. Coal production in the month of March is down just over 3% as per Coal India, which informed the stock exchanges. Coal India has set a full-year target of 838 metric tons of coal, but it managed to achieve only 781 metric tons, which is 93% of its full-year target. Gas stocks in focus today. This after the government hiked the prices under the administrative price mechanism by 4%. This is the first hike in APM gas prices in 2 years. The revised price is now set at just under $7 per unit of gas until September this year. That's when the next review is likely to take place. British aerospace manufacturer H.R. Smith Group has strongly refuted allegations that it transferred sensitive technology to Russia via India's Hindustan Aeronautics. Refuting a report in the New York Times, the company said the alleged products were used in a satellite-based search and rescue network. The group said they were not provided any evidence to support the claim that its products were shipped to Russia. The Supreme Court has upheld Piramal Capital's resolution plan for the bankrupt Dewan Housing Finance. The Apex Court has scrapped the NCLAT order, which held that the plan was illegal. Ashmit is standing by now with more details. Ashmit.
Well, a bit of a mixed bag as far as Piramal Capital is concerned. Up front, what the main takeaway here is from the Apex Court judgment is that the Piramal Capital resolution plan for DHFL has been upheld. So that definitely comes as a breather, specifically after the NCLAT order, which had held this resolution plan to be illegal. The rationale that the NCLAT had given is that only a value of ₹1 had been ascribed to 45,000 crore rupees of avoidable and fraudulent transactions, and any recoveries would then flow to Piramal Capital, and that was a concern that had been raised by the various bondholders in this matter. The new formula that has been given now by the Apex Court as of this judgment, as of this morning, is that as far as this entire issue of avoidable and fraudulent transactions are concerned, adding up to 45,000 crore rupees, that is an issue that now the NCLT will decide. And importantly, the distinction that the Supreme Court has drawn is that recoveries from avoidable transactions will now flow towards the lenders. So that definitely comes as a big boost as far as lenders are concerned. However, recoveries from the fraudulent transactions will flow exclusively to Piramal Capital as a successful resolution applicant. So that to a small margin, a bit of a hit, a bit of a setback coming in for Piramal Capital. As earlier the condition was that all recoveries from the whole of 45,000 crore rupees, if any, would have gone to them. Back to you.
Ashwat, many thanks. The government is facing a liability of more than 1 trillion rupees for outstanding sovereign gold bonds, that at the current gold price. In a reply to Parliament, the government revealed that outstanding sovereign gold bonds have an underlying gold of 130 tons. Manisha standing by with the details. Manisha, a problem for the government?
Well, yes, absolutely, Shireen. And we did hear a similar kind of a statement in the last month as well in the Parliament itself. And when you look at the gold prices in last 1 month, we've seen prices gain up by 10%. If you look at the previous quarter, the gold prices have gained up by 18%. And we've started this financial year on a record high as well. So when you look at the calculations that we have been doing in the office today, RBI did issue 67 tranches. And the first tranche was put out in 2015-16. And the total tranches that were put out, that comes to 146.9 tons. Now, 6 of these tranches have been paid off, have been redeemed, but 61 tranches still remain and 130 tons of redemptions still remain as well. So when you look at the gold prices right now, the outstanding, if we calculate that to today's price, today's price really comes in at around 9,284 per gram. Now, when you multiply that to 130 tons, the outstanding that the government has to pay to the Indian investors is to the tune of 1.2 trillion rupees. And we are only taking the prices of today because as and when these tranches will continue to come in, you will have to pay them as per the gold price that day. And with the way the gold prices have been moving higher, this number perhaps can go higher as well. Now, just to give you a sense that the last tranche that the government put out was in Feb 2024. So the last of the redemptions will come in 2032. So we still have those years left by, and the gold prices, the way they have been moving, you could be looking at higher prices as well. Another thing is that the government also is paying 2.5% to the investors as per their investment, and this is paid bi-yearly to them. So this is an added calculation as well. The finance minister in the parliament did say that they are maintaining a gold reserve fund where everything is accredited in time, but clearly this 1.2 trillion rupees that stands outstanding as of today is only going to grow going forward.
All right, Manisha, appreciate you joining us. That's the latest there as far as the sovereign gold bond liability is concerned. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned. The news will continue right here on CNBC-TV18. We're back in a moment with more.
यहाँ जामनगर हमारा घर थी द्वारकाधीश सुधी અને બસ આ બધાના આશીર્વાદ રહે અને શ્રીજી બાબા દ્વારકાધીશના બધા ઉપર કૃપા રહે આ જ મારી પ્રાર્થના છે અને અમે હમણાં પદયાત્રામાં 5 દિવસથી ચાલીએ છીએ અને 2-4 દિવસમાં પહોંચી જશું. દ્વારકાધીશનું કૃપા રહે અને બધા શ્રીજી બાબા બધાને સંભાળીને રાખે ને બધાને આશીર્વાદ આપે. બધા યુવાને ભગવાનના પ્રતિ પ્રેમ રાખવું જોઈએ અને બધા યુવાને સનાતન પ્રતિ પ્રેમ રાખવું જોઈએ અને બધા યુવાને બસ એ જ મારી બધા યુવાને એક મેસેજ મોકલાવું છું મારા ભાઈઓ અને મારા મિત્રોને કે આપ બધા શ્રીજી બાબાના આશીર્વાદ લઈને આગે વધો અને જ્યારે ભગવાન છે તો કંઈ ચિંતા નહીં કરવાનું.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Ritu Singh joining us from the Bangalore studio. These are the top headlines from the startup world. ChatGPT maker OpenAI set raises $40 billion, valuing the company at $300 billion. SoftBank alone invests $30 billion in what was the largest private tech funding deal on record. Workforce mobility platform Border Plus acquires Germany-based Onia Care, marking its first acquisition in Germany and paving way for Indian nurses to work in Germany. It further sets aside $10 million for merger and acquisition activities in India, Germany and other destination markets. AI platform Entwin AI secures 5 crore rupees in funding from Y Combinator. This funding will enable expansion of AI capabilities and accelerate customer acquisition among mid to large pharmaceutical companies globally. EdTech unicorn PhysicsWallah is in advanced talks to acquire civil services coaching institute Drishti IAS for nearly 2,500 crore rupees as per Tracker. This comes at a time when PhysicsWallah prepares to hit the IPO market. Online food delivery platform Zomato hands over pink slips to over 600 customer support associates within a year of hiring them, as per Money Control. This comes amidst a slowdown in growth in its core food delivery vertical, rise in losses in its quick commerce arm Blinkit, and increase in AI investments. San Francisco-based Chef Robotics lands $43.1 million in investments in its Series A funding round led by Avatar Ventures. The AI-enabled meal assembly systems company aims to accelerate production deployments of its robotic systems with this fundraise. Managed workplace solutions company IndiCube gets approval from market regulator SEBI for its 850 crore rupee IPO. The company filed for its DRHP in December last year. A major portion of the proceeds from the IPO will be used for capital expenditure. Those were the headlines that we're tracking for you this evening. But on what's brewing today, rural fintech Navadhan has raised 111 crore rupees in a Series A funding round led by NAB Ventures, the venture capital arm of NABARD. The company has said that the funding will be used to fuel business growth and enhance its Accent Tech platform. It already has over 700 crore rupees of debt lines available from more than 25 banks or NBFCs onboarded on its platform, with whom Accent enables API integrations. The fintech NBFC has grown its presence in 700 PIN codes across 5 states so far and plans to go deeper in geographies and diversify its loan offerings. For more on this, joining me now is Nitin Agarwal, the founder of Navadhan. Nitin, thank you so much for taking time out and being here with us on Startup Street. You know, if you could start by talking to us about the latest 111 crore rupees that you've raised in the Series A funding and how it will be strategically allocated to enhance your Accent Tech platform as well as drive business growth.
Right. Thank you for having me. I think we have a very calibrated growth plan in terms of what we want to do with the money. We have actually, this is not the first fundraise, this is a Series A, and we've done a bunch of fundraisers earlier. Through this calibrated plan, we are building the Ascend Tech platform. And this platform is very critical to serve the rural small businesses. And through these rural small businesses, we end up then making working capital loans to them, getting the funding from banks and NBFCs, which operate on these platforms. So the plan is to continue to do this calibrated growth, both in terms of building the platform, adding more partners, going to newer geographies, going deeper in geographies, adding more loan variants, and continuing this journey.
All right. And you claim to have grown about 12x in the last 3 years, right? While maintaining good asset quality. Are you seeing any signs of stress in rural MSME segments that you operate in? And how confident are you of continuing to grow at this pace as the size of the business grows?
Well, this year has been particularly tough for overall retail lending space. We've also experienced troubles in our space. Luckily for Navdhan, we have rather been less worried about it because of two reasons. One is that we do very deep underwriting. We have only 15% approval rates. And this deep underwriting has helped us select the right kind of customers and serve the right kind of working capital needs. Secondly, as we built our Ascend Tech platform, we were very clear that serving the customer and being sensitive to the customers is going to be equally important. Hence, we have both people and tech on ground. Having customer fulfillment centers and officers on ground has also helped us maintain better portfolio qualities. And we hope, like you asked, as we grow, we should be able to maintain the traction both on the growth as well as on the portfolio qualities go forward.
Right. So hoping to maintain that. But, you also have over 700 crore rupees of debt lines available from more than 25 banks, NBFCs onboarded on your platform, right? So how much of this has been disbursed and what are the loan dispersal targets for the coming year or so?
Well, so far we've done about 500 odd crores of disbursements. And we hope to maintain the traction on disbursements as well as we go forward. I think we've been rather blessed on the lenders side. We have almost 27 of them on the platform. I think amongst me and my 3 other co-founders, all of us come from financial services, NBFC and banking space. So all the relationships, and we have sensitivity towards knowing what these banks need. Well, the banks do want to serve the segment, and MSME is a priority both for the government and the banking space. But it's difficult to reach out the underbanked and the small MSMEs. That's where we have stepped in. Therefore, we have a strong belief that we will continue to get that benefit. Additionally, all our loans are also classified as priority sector loans. So that gives them an additional impetus. And then if you have an asset getting created for these NBFCs and banks and you have a good portfolio quality, and these are priority sector classified and there are reasonably decent margins, there is no reason why we should expect the banks not to continue to support us.
All right. So you expect that support to continue. But, what are your expansion plans for the next 12 to 24 months, right? And how will you deepen your presence in existing geographies? Do you intend to continue focusing on the 5 states that you're currently in? Or are you also looking at moving into newer geographies?
Well, in the immediate priority, our focus is to move deeper in these 5 states. We are right now present only in 700 pin codes. I think we'll first get to about 3,000 odd pin codes within these 5 states. And as we move forward, we will then expand to more states. So we have a very calibrated growth plan in that sense in terms of which states, which year we want to enter. We'll probably go with that plan.
Right. And are there any plans for an IPO in the near future? And what milestones would you need to achieve before considering going public?
Well, IPO is a very critical milestone for Navdhan, and we are definitely building towards one. But that's definitely not a destination because we are building it for a 20-year story, at least, if not less. Therefore, the idea is that IPO would be a critical milestone in this journey to both, becoming a more responsible and visible player in the market, as well as giving exit opportunities and liquidity to our existing investors. In terms of what prep we are doing, I think we have built our company with a thought that eventually we'll go for an IPO. Hence, we are a very compliance-first, regulation-first business. So the internal processes are built in such a way that it becomes a little bit of a glide path for us. Having said that, I think at a stage when we have substantial capital absorption capacity, say 1,000 crore or so, and we have stable metrics in terms of predictable metrics getting offered, we should go in for an IPO because as you know it better than me, public market investors would like to see predictable metrics if they have to bite a bullet on an IPO.
All right. And, what do you make of the RBI's recently revised priority sector lending guidelines with the enhanced loan limits for various categories, including housing loans? They also broadened the criteria under which loans can be classified as renewable energy for PSL purposes, right? So do you see it giving a meaningful boost to the segments that you operate in?
Well, yes, I would say in general, yes, this would give a meaningful boost to overall economy and overall segment. Particularly for us, not as much, because we are already a priority sector classified lender in the sense that we lend to MSMEs, which is a priority for both the government and RBI. So there are some other criteria in which we get classified as PSL, including weaker section exposures, exposure to women entrepreneurs. We also have about 4% of our portfolio in the renewable side. So multiple classifications already exist. This is going to be, in general, a more of an enabler for banking sector to expand the priority sector segment for them.
All right. And, if you could quickly, are you considering foraying into any other segments besides MSME? What are the longer term plans for Navdan?
Well, MSME itself is a very, very large space. And within MSMEs, we have chosen to be in the rural small businesses loans, which are rather on the informal market side. And as you know, as India's demographic changes are happening, the informal markets are getting more and more formalized. I think we want to play a role there. In terms of how we want to grow, I think we'll stick to our MSME space. We'll stick to the underbanked and the missing middle part of the MSME space. But within that, we want to continue to enhance both our geographical diversification and geographical outreach and the number of loan variants that we offer. So we are, in fact, multiplying our loan variants and our service offerings, but we'll stick to the segment.
All right, Nitin, thank you so much for outlining your plans there with Navdan. But we're completely out of time on the show. Thank you so much for joining us.
Thanks for having me. Thank you.
And moving on the hot seat, deep tech startup Astrom Technologies secures $10 million in funding. With these funds, it aims to advance its innovative wireless connectivity technologies, scale operations, expand product lines, and enter the satellite communication market. Now, this fundraise will help the startup venture into the thriving SATCOM market, which recently gained momentum after SpaceX entered India in partnership with top telecom players in the country. We are now joined by Venkatesh Kumaran, the president of Astrom, to discuss their road ahead. Venkatesh, thank you so much for taking time out and being here with us on Startup Street. You provide E-band long-distance communications solutions. If you could sort of explain to us what it means in layman's terms, and your flagship product is the Giga Mesh. Can you take us through what it does?
Okay, great. Thank you so much for having me here. So our first flagship product, as you rightly said, is Giga Mesh. And we actually, before I can really talk to you about the product, I want to talk to you about the technology that we actually developed 8 years ago, where we are one of the first companies in the world to have actually built a phased array flat panel antenna technology in a very high frequency, what we call millimeter wave frequency, between 70 and 80 gigahertz. So we are the first company in the world to have developed E-band radio that can actually drive longer distances, number one. Because conventionally, if you look at E-band radios that have been in vogue for the last 2 decades, there's no significant innovation that has happened in backhaul radios. Astrom has been a pioneer in innovating flat panel antennas, and we have kind of integrated that entire antenna inside one box. Now, just to give an analogy of what is the incumbents technologies, they have external parabolic antenna sitting on the tower. We have done away with the parabolic antenna and taken that entire electronics and put it as a flat panel inside the box, thereby reducing OPEX expenses by over 75% to service providers. Now, why does that happen? It happens because link alignment is such a very important piece in radios, and especially backhaul radios. So when the link misaligns, the customer, the end user, does not get any signal, does not get any broadband connectivity. So what we have done is we call them self-aligning antennas. So even if the link breaks for whatever reason, it could be very high winds in that particular area, or very, very high rain in that particular area, our patented technology, what we call electronic beam steering and beam forming, in E-band self-aligns itself without the need of a human intervention. And that's the main reason why operators and service providers save a lot of OpEx, and they can keep their SLAs to customers at a very high degree.
Absolutely. And, if you could quickly tell us, right, we're running out of time. You want to drive innovation and create solutions that enhance connectivity on a global scale, as you just, mentioned to us. Can you sort of take us through the kind of clients that you're currently working with and the sort of impact that you've created?
Absolutely. The first vertical that we've addressed is rural broadband infrastructure market, both in India and the world. We've been successful in India, thanks to, I would like to kind of call upon a name, Ashwini Vaishnav, the then Telecom minister, who actually supported us by, had faith in the technology, and we have proved it pretty well in the market. So rural broadband infrastructure is the first vertical market. So telecom operators are our customers. The second market that we have cracked is defense communications. So our customers are primarily defense forces, the Indian Army, and the Indian Navy at this moment.
All right. And, you're also looking to enter the satellite communication market with the funds that you raised, right? If you could take us through your plans on this front and the opportunity you see here, and how do you see the space heating up with the entry of SpaceX?
Oh, yeah, sure. I mean, let me answer the last question first. We're not too worried about SpaceX or any of the satellite operators entering the Indian market because we are an infrastructure player. So satellite operators, be it SpaceX, be it Kuiper, or be it OneWeb, be it SAS, whoever, would actually take our technologies and integrate as part of that entire infrastructure rollout. Because we also make ground user terminals at a significantly lower cost than what they can produce by themselves, number one. Number two, we also are able to kind of put the entire ground to air from a communications perspective for any enterprise today, right? And provide and beam high bandwidth connectivity to the remotest corners of the world. That is
right.
That is second one on, I'm sorry.
Yeah, please go ahead.
Yeah, the second, the 10 million that we raised, a significant portion of that is going to go into business development, expansion of our sales offices, as well as deepening our roots in our core competency, which is technology. We will start to innovate so that the incumbents are like 3 years away from what we are doing in both in space tech and the wireless technology. Of course, a lot of money is being spent in terms of new product introduction into both the terrestrial market as well as the space tech market.
Right, absolutely. And for the fiscal year ending March 2024, according to reports, you saw your losses reduce and revenues came in at a little over 8 crore rupees, right? If you could sort of take us through your targets for this year, and what about profitability?
Yeah, so what we intend doing is, our forecast is to kind of, increase that to 5 to 7x in the next 2 to 3 years, both in the terrestrial market as well as the space tech market. And we would definitely strive to become EBITDA positive in the next couple of years.
All right, Venkatesh, thank you so much for joining us on the show, but we're completely out of time and we wish you all the best on this journey going forward.
Thank you so much. Thanks for having me here. Thank you very much.
Absolutely. On that note, it is time for us to head into a short break. But coming up on the other side, Indian lab-grown diamond jewelry brand Firefly Diamonds has raised $3 million in a seed funding round led by Westbridge Capital. On the other side, my colleague Ritu Singh speaks to Ardit Bhansali, the co-founder of Firefly Diamonds, to discuss its road ahead.
Quarter of a century, zillions of designers, and orders of style later, Lakme Fashion Week is back to rock the ramp. This year's collection promises to showcase modern sophistication with effortless elegance. The showcase is set to be bold, reflecting a connect between beauty and style. Let's take a look at the showcase straight from the runway. How do you think beauty and fashion empower young women like you in today's world?
So I think beauty and fashion, if you have fun with it, can be very, very empowering.
Well, Indian lab-grown diamond jewelry brand Firefly Diamonds has raised a seed round of $3 million led by Westbridge Capital. The investment is going to accelerate the brand's retail expansion plans, bolster its digital presence and fuel R&D. Founded in December 2023, Firefly has stores across 4 cities currently and plans to expand to over 20 locations in the next 2 years. For more on this, joining me now is Adit Bhansali, who is the co-founder of Firefly Diamonds. Adit, welcome to Startup Street and thanks very much for your time here. Start by telling us very briefly about this young brand that you're building and the opportunity that you see for the lab-grown diamond market in India.
Yeah, absolutely. So thanks so much, Ritu, for having me on. So I wanted to share a little bit about Firefly. So we started the brand around 1.5 years back, and my brother and I are the 2 co-founders. And the brand was basically built on a legacy of around 60 years in the jewelry industry, starting with my grandfather, that my parents have kind of continued into the same business. And they have an entire background in jewelry design and manufacturing. So what my brother and I saw was a huge opportunity in moving into lab-grown diamonds, which we feel like is going to be one of the most exciting segments of the jewelry market in India, which we all know is one of India's largest markets. And what we bring into that is we bring this jewelry design and manufacturing expertise so that the products that we're bringing to our customers through Firefly are the products that are of the highest quality, highest level of craftsmanship, and beautiful designs that are unique and help us stand out.
Well, Adit, you're essentially saying your family comes from a diamonds business, which I assume will be natural diamonds. So you're essentially betting against the family business and putting your money on its competitor.
Yeah, so I wouldn't say betting against it. I think the way we see it, I think both segments are going to, exist today and will continue to exist even as lab-grown continues to become bigger. The reason is I think there's always going to be some segment that will have that emotional attachment to having a natural mined diamond. But as I was saying before, there's going to be a much bigger new segment that's going to be coming in for whom lab-grown is going to be the majority of the focus. So I think we see both things will continue to grow. And I think, the Indian jewelry industry is going to go from strength to strength.
Okay, and how do you plan to deploy this $3 million of seed funding that you've raised now?
Yeah, so I think there's a few different aspects to this. I think the first and most important one is we want to build a brand that's going to stand out and is going to be doing something distinctive. So for that, we're going to actually allocate a significant amount of the funding towards research and development of kind of different unique product collections that haven't been seen before in India. There are things that you can do with lab-grown diamonds that traditionally people might not have done with natural diamonds. So I think we're going to try to bring and create that distinctive product collection. Second is we're going to be using it for retail store expansion because that's the best way for people to see, touch, and experience the products. And then the third one is going to be into marketing because I think bringing a celebrity on board and other marketing initiatives to kind of get word out there, I think is going to be very important for us as well.
Okay, and speaking of retail expansion, so far you've been in all the 4 metros. Where will these next 20 locations be and how will you balance the physical retail with the digital growth?
Yeah, so that's a great question. I think for the 20 new locations, I think there's a couple, it's like a 2-step plan. I think the first is going to be now to deepen our reach within the existing cities where we are present. So we're currently in Mumbai, Pune, Bangalore, and Hyderabad. And I think we're going to continue to deepen our presence there because there's customers that are reaching out from different areas in those cities that are interested in purchasing, but are not able to physically make it into the stores we're in today. So we'll add more stores there. Then there's another market in other tier 1 cities, such as Delhi, where we know there is a large market and again, demand for the product. So that would be kind of the second step. And then the final step would be slowly starting to expand into tier 2. But that's where I think the online part will play a big role because we launch online our website will be going fully live in around 2 weeks from today. So once that goes live, we'll be available across most of India, and that'll help us gauge demand for the brand in smaller cities. And then that'll help us figure out where do we want to set up the next set of stores.
What kind of sales and average spend per customer trends are you seeing currently? And what are your projections for sales, revenues and profits in the next 2 to 3 years, especially keeping in mind that lab-grown diamond prices have fallen sharply recently?
Yeah, so I think the sales numbers have honestly been really impressive so far. I think we've been very happy since the Mumbai store first launched in October. So it's been around 6 months there, and I think we've seen a very steady ramp up of sales. In terms of the average customer order value, I think that has also been higher than actually we anticipated. It's coming close to around 70 to 80,000 per customer. So that's showing that we have a large volume of people who are coming in for kind of lower priced gifting products that might be in the range of 20 to 40,000. But we are also seeing, customers coming in for that solitaire diamond ring or for a diamond bracelet or, solitaire earrings. And those prices can be north of even 2 lakhs. So I think that's kind of what this numbers are looking like today. I think what we're expecting over the next couple of years is, I think, one, for jewelry, existing customers are a big part of what your future sales look like. So as we continue to build that customer book, I think we'll be seeing a lot of repeat purchases. We've already seen that just in 6 months. And in terms of, same store sales growth, I think we'll be expecting a good amount of that, even month on month. And then in terms of profitability, I think our stores are already, operationally, profitable at a store level. I think then marketing is obviously going to be a big cost expense that we'll have to kind of manage and be smart about.
All right, Adit, that's all the time we had. But thank you very much for your time here today. And we wish you all the very best with your business.
And moving on, Ayurvedic beauty is going luxe with India's luxury skincare market set to hit $4 billion by 2035. Homegrown brands are stepping up their game. CNBC-TV18 Shivani Bazaz brings you an exclusive sneak peek into Karma Ayurved's premium makeover as it gears up to take on global giants.
A new look, new prices, new products for a new India. This is Karma Ayurveda's refreshed store in Mumbai, and for Karma, this is just the beginning of a new phase, where it takes the battle to some of the biggest players in India's glowing skincare market.
Well, the luxury skincare market is booming in India, and it's already valued at $1 billion and is set to grow at a 12% CAGR, expected to touch $1.6 billion by 2028, according to industry estimates. And it's not just the global giants. Ayurvedic beauty is having a moment too, growing at an even faster rate of 27%, according to industry estimates. Now, Karma Ayurveda, one of India's most recognized Ayurvedic skincare brands, is making a bold move, elevating its brand image, pricing, and product innovation to compete at a global luxury level.
But it's not just about turning up the luxury dial by putting old wine in new bottles. The new logo, the swankier stores come with revamped formulations as well. The company says its premium pricing rivals brands like Kiehl's and Clinique, all aimed at catering to the Indian consumers' rising aspirations and evolving tastes and preferences.
When we started the brand, we only thought of quality. The hair oil was some 400 or something rupees, when everything else was 40 rupees. This new generation is willing to pay extra if the product delivers. And it's all natural.
But Karma is adamant that premium does not mean expensive. Not every product sports a higher price tag. The stores themselves are also no longer just outlets, but a place people can experience Ayurveda as Karma expands beyond skincare into holistic wellness. Its new stores will offer Ayurvedic consultations and treatments. It also already offers this in London, and its treatment rooms at Harrods and Notting Hill are already fully booked.
One is obviously this consultation space, okay, with the therapist, with the doctor who will come and consult with you, specifically tell you what you want to. There are nice stools over here. You can sit down and actually try the products out. Earlier it was standing only, so you can sit down and try the products out. And then in the bigger formats, once you have a larger space, like we have one in Delhi, but it'll be expanding, I think, around the country, is treatment rooms. So basically face treatments, hair treatments, and body treatments. So you can physically come in, get a doctor's consult, figure out what you need to do, and then get a physical facial, hair treatment, body treatment.
With global brands investing in Indian Ayurvedic companies to global brands making a beeline to enter the Indian beauty market, it's evident that the world recognizes the potential of India's beauty industry. Pharma Ayurveda's transformation is not just about elevating a brand, it's about setting new standards in luxury skincare, both locally and globally. In Mumbai, this is Shivani Bajaj.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Dressing very casually, I like being very chilled out. I don't play too much with like colors and stuff, and that makes me feel very empowered and very beautiful. So I think it can be used as a tool to
Hello and welcome to this special edition of Market Editor. The markets may be our starting point today, but we are diving deeper into a space that's buzzing with opportunity. India's emerging dominance in the CRDMO space, we call it CDMO, contract research, development and manufacturing. And to help us decode this theme is none other than seasoned investor and market veteran Madhu Kela.
That's right. Over the next 30 minutes, we'll spend a few minutes on Madhu's current take on the market, but the spotlight is firmly on a sunrise sector where he sees immense long-term potential. We'll also be joined by the managements from Laurus Labs and OneSource Pharma, two companies at the heart of this CRDMO story, with Madhu turning interviewer, asking them the key questions on scale, strategy and science.
Well, from investment insights to industry deep dive, this promises to be a power-packed half hour. Let's dive straight in. Madhu, welcome to the program. Thank you very much.
Thank you so much.
And we can take a back seat today.
No, absolutely. We'll all do it together.
Hum aaram karenge, aap kaam karenge.
We'll all do it together.
But I think you've done so much work on the entire CDMO space. You and your team have really done fabulous. I mean, we'll try and get at least a fraction of it on the air as we go forward. But since we have you with us, Madhu, I want to start with just a quick view on the markets per se and where we are. We've come a long way from the lows. What is your perspective now?
Prashant, I think from a big picture perspective, we have spoken this many times. I would once again request that people must not extrapolate what has happened post-COVID in terms of return, in terms of finding multi-bagger opportunities where money has gone from 10 to 100 times, right? Because the lows were so drastic, the returns were fabulous, right? So I don't think that we must expect those kind of returns. Having said that, I am not in a camp that the bull market is over and this is the beginning of some bear market, and you can take the number reference from wherever you want. So if you take the reference from COVID low, then the returns will look very, very attractive.
Correct.
And hence the next 5 years may look very dim. But if you take the same base from 2013, where the market was at a low, then it is again average return which the market has delivered, including the last 5 years. So my point is that India is and will always be a bottom of a stock pickers market, wherein the broad indices may give you nominal returns. But because of the volatility and the fluctuation, and because there is choice of so many sectors, you have the opportunity to make, in my view, 15 to 20% kind of return is still in these markets. And you see what has happened in the last 2 months. Take, for instance, the financial sector. There are so many NBFC companies, even smaller banks, even large banks. While the markets have gone up only 7%, but a lot of these companies have gone up like 20, 30, 40, 50%. Right? So that is the market which we are going to be seeing from now on.
Very disaggregated, maybe stock specific, right?
Exactly.
Within sectors, not everything, but...
Exactly. You have to be betting not only the right sector, but the right company. So we are back to basics.
You turned cautious, I think, around the time that the market topped out. I mean, September, October last year.
Exactly. And we had a detailed interview on
Absolutely.
that.
So one sector which you're very bullish on, and you have been, is pharmaceuticals.
That's right.
I mean, we're going back 7-8 years back, and you've spoken about stocks like Divi's Laboratory. So first, the big picture. Pharma has done well, if you look at it over the last 5 or 10 years. But you're bullish on it for the next 5-10 years. What do the numbers tell you?
It is, when we did, and thanks to the CNBC team, you made me a student again. So I think we actually did some numbers, and numbers is so heartening. In 2005, the total industry size of pharma was 28,000 crores, including API, local, everything put together, and profit were 2,500 crores.
And we have those graphics which will come up, which will very starkly put out. Please.
This, Prashant, has gone to 6 lakh crores. And this year, the profit will be 80,000 crores. So after IT, this actually is one big industry which has got developed in the last 20 years. So many great companies, Divi being obviously one of the most biggest wealth creator, but so many great companies have come. And from where we started, merely as a API supplier, that's how we started. We went into generic, then we went into complex generic, then we went into, local markets have grown. And now the CDMO opportunity. So the margin which used to be 10 years back, the overall industry margin which used to be 15% has now gone to around 23%. And you look at the change, right? Today, in the total FDA facilities in the world is only 1,425, out of which 396 plants are there in India. So you are talking about 28% market share in US FDA plants, while our market share in terms of global CDMO or global pharma is still very minuscule, right? Total size of the global pharma industry is $1.5 trillion, and we are still, let's say, 6 lakh crores.
Yep.
So it is still very small. So I am quite positive that over the next 5, 10, 20 years, this industry has a lot of leg. And what came out clearly was, obviously you need, it's a very long gestation industry. So you need to make upfront investment. So the size of the profit of the industry still was so small, even 10 years back, that kind of investment was not possible to be made. But now, with the size of profit increasing, like this year, cash flow will be 1 lakh crores of all pharma companies put together. And the size of the whole industry 20 years back was 28,000 crores. So I think once this cash flow starts getting on the ground, the opportunity will
That number is very stark. And again, I mean, those graphics will come up again. 28% of global FDA-approved facility was 4% of sales.
Exactly.
Is that because of scale? Plants here are much smaller. Is it because of the kind of products which are manufactured?
And also, it is also because of that, it's a transition. Pharma is a very sensitive thing. So quality, when you look at it, there is still inspections which happens in Indian plants where they are still able to have quality issues. It is also got to do with scale. And also, let's not forget, when N-1, N-2, we are still dependent on China for basic stuff like solvent, starting material. When all of that shifts to India, which I think will happen in the next 3-4 years, because see, if you are a global major and if you are placing your bet on India, India is still sourcing those material from China. So that to that level, your cost competitiveness is not established. But Prashant, this is all work in progress, in my opinion, and we are in the right direction. What is most startling, in my view, the global CDMO industry, which is, let's say, roughly $200 billion, we are only 8 billion, which is 4%. So our market share in FDA-approved facilities is 20%, and there it is only 4%. And it is like, everyone knows that the cost of manufacturing in the US and UK, which is 65% of the total global CDMO industry, is very, very high compared to what it will be in countries like India and China. So if you take a 5-10 year view, incremental growth definitely will shift, and some amount of market share will shift to countries like India and China.
Got that. So that sets the base for the next leg of the conversation. We'll take a break, Madhu, and on the other side, Madhu will turn interviewer, and he'll be speaking with two companies from the space, and he'll ask them the size of the opportunity, which he believes to be strong. But we'll really get into it. Borosil Laboratories and OneSource Specialty Pharma, the two companies you'll hear from Mr. Chava and Mr. Sharma are with us.
Welcome back. You're watching our special edition of Market Editor. We're in conversation with veteran investor Madhu Kela, and his belief is that time for India CDMO has come. That's the big theme he's betting on for the next decade. And before we invite our corporates on the show, Borosil Laboratories and OneSource Specialty, let me just put up the standard disclaimer. The stocks that Madhu may talk about, he may hold it, his team may hold it, and these may be stocks and companies that he has personally recommended to. But let me now invite on the show Satyanarayan Chava, founder and CEO of Borosil Laboratories. Madhu, all yours.
Thank you so much.
Go on, Madhu.
Go on.
Straight up.
Good morning, sir. How are you?
Good morning. Good morning, everyone.
First of all, thank you so much, Dr. Chava, for accepting this invitation. Deeply appreciate it. You are one of the few person we have been following the pharma industry. I have really highest amount of respect for. And the way you have navigated Dr. Saab Borosil Lab from being 5 years back, a few years back, just being a main ARV supplier to now being a top leading company in the CDMO space, and going forward, you are talking about biopharma, you are talking about gene therapy. What goes in your mind when you formulate this kind of strategy and you are years ahead in the game?
Thanks for asking very broad and interesting question. The industry is going through significant transformation, and India is at the right place and right position right now to capture this opportunity. You are saying the amount of opportunity in front of Indian pharmaceutical companies in CRDMO is multi-billion. Your number says it is over 8 billion in the next 3-4 years. The opportunity in, I would say, fragment this into two buckets. One is research and development, and the second one is development and manufacturing. The development and manufacturing needs significant investments. Assuming the 8 billion, if you take half goes to research and development and half goes to development and manufacturing, then that 4 billion opportunity in the next 4 years, people have to invest $3-4 billion capex to capture that $3-4 billion opportunity. So the opportunity is very large, provided our investments are also very large, not only in capex, but also in technology, also in recruitment of people and training them to deliver products. I would say the current situation is there is business, there is money, but the opportunity can be realized provided if we recruit right talent and train them very well.
We had the Eli Lilly global CEO with us 2 days back, and they said the cost of development of a new drug from right from scratch is about $4 billion. You put those in percentage terms. As a percentage of sales, about 5% of the value of the drug was they're able to monetize. Just to come back to the earlier question, Mr. Chava, you said that those numbers that we put up, it's about $6 billion in opportunity over the next 3 years. You said we need to invest $3-4 billion to be able to capitalize on that opportunity. Is that the correct way to look at it as an industry?
I took an industry benchmark, assuming you have a 2 times asset turnover ratio. That means every dollar you invest, you get $2 revenue. That means you divide $1 billion extra opportunity for any company. They have to invest at least $500 million in capex to capture $1 billion revenue. I took a number. See, two asset turnover is very, very high in the industry. I took very high number. If I take 1 to 1, then for every $1 billion revenue opportunity, they have invested $1 billion. So somewhere between $500 million to $1 billion, people have to invest to capture $1 billion. So that's the number I gave. So capex intensive, and it also takes a lot of time. By the time you put facility and you get the commercial opportunity, it takes 3 years. So you have to invest money well ahead of the curve to capture the opportunity.
Thank you, sir. Neeraj, good morning and welcome to you. Deeply appreciate you joining us for this show. Neeraj, I think you guys have just created a company which is like OneSource, which is purely focused on this space, while you merged a lot of your group entities and created. So if you can run through what is the strategic intent of getting all of these businesses together, and what are you looking at in this entire very large opportunity in the CDMO space? And the second point, Neeraj, the work which I did clearly says that quality concerns is one of the reasons why the business is moving very slowly to India. People are still concerned about the US FDA audits and the kind of quality Indian companies have done, specifically in the last 10 years. Your group has had a phenomenal track record of 19 years of having a spanky clean track record with US FDA. So how important is quality, and how did you manage it at your group?
Yeah, thank you, Madhu, for having me here. And to your first question around what was, let's say, the inception philosophy around OneSource. So it's basically started with the need of our customers to reduce complexity in their supply chains, and their need for having a one-stop shop solution in terms of CDMO partners. And that's where we come in by having our multiple offerings. So we reduce their complexity in their supply chain, and in turn get a much higher share of our customers' wallet. So to just tell you a little bit around what OneSource is and why we are one of a kind. One of the points you already mentioned around compliance, but not just our key differentiation which we offer is around our capability, which we are today of having one of the widest offering in the CDMO industry, right from biologics, drug substance, drug device combinations, sterile injectables, oral technologies around soft gelatin capsules. So across this, it is a very wide offering and a real one-stop shop solution for our customers. That's our capability. Around our capacities, we offer some of the largest capacities, industry-leading capacities in drug device combination cartridge filling, for example, where it's all isolator-based technology. Soft gelatin, we are among global leaders in that area when it comes to capacity. And finally, what really differentiates us along with the capability and capacities is our compliance status, which is what your question, your key point which you mentioned. So our compliance record has been stellar, and yes, this is important in pharma more generally, but in CDMO it is absolute critical, because that's what customers, global customers, Indian customers, any customer comes to a CDMO for really their compliance track record. And we in the group, and that's been the group's DNA, with a very, very clear focus on quality and compliance, and that has brought us where we are as a really CDMO partner of choice for our global customers.
Neeraj, can you elaborate a little bit more on this GLP opportunity, the capacity of 40 million units which you have set up, and strategic intent is to increase that many-fold. And I, based on my work, the work for this started in 2016, and now you are about to get some revenue, right? So it has like taken you 8-9 years to actually come to the customer level. So why is it so difficult? On the face of it, it looks so simple that you have a device by which the drugs will get delivered. So if you can, the people watching us are not experts. So if you can, simple words, just explain why is it this entry barrier so high, and why OneSource is the only supplier in India and only approved facility in India to make these cartridges which deliver these GLP drugs?
Sure, Madhu. See, for us, Madhu, all our service offerings, I mean, you mentioned one of those, but all our service offerings are around this, niche and complex capabilities. Whether in terms of development, in terms of manufacturing, and finally in terms of compliance. I mean, starting with specifically drug-device combination, and GLP-1s are part of that. We are fairly unique as we offer. We are among the very, very few, even globally, offering end-to-end solution for drug-device combination, including GLPs. So not just the fill-finish part of it, but also the assembly of cartridges or PFS or pre-filled syringes into pens and auto-injectors, which is specifically for GLPs, the most complex part of the value chain. And this, as you rightly mentioned, this capability has not happened overnight. We have taken, it's been almost a decade where we have added, we have invested, we have built, we have learned, we have executed multiple projects, multiple customers, and that's where we are. It has taken us a decade to be in a position where we are, let's say, our leaders when it comes to drug-device combination in India. So this is the reason it is tough is because it is an area which is complex. The interface between drug and device is complex because eventually what a patient takes is not the cartridge or the pre-filled syringe. The patient uses the actual pen or the auto-injector. And it is all about self-administration. I think that's where the key is. Our expertise in self-administration, that is what makes it complex. What makes it complex is if you want to start a new investment today in capacity, it's a 5 to 7 year cycle, right from ordering these complex equipment to making regulatory submissions to getting your inspections done and so on and so on. It's a very long cycle and it requires a lot of learning, learning through failures, learning through customers.
I'll come back to you. Thank you so much. I'll come back to you.
If I can just, Madhu, just take one question. Neeraj, your supplies to Eli Lilly as well. I was saying we had the global CEO with us here on the channel 2 days back. And of course, they were talking about Mounjaro, which is also an injectable. But at the margin, do you think this opportunity will move more and more to the oral side, which is easier, I'm assuming? Or that's not is that a risk at all?
So orals definitely have a role to play, Prashant. Absolutely, orals will be important. But in these products, the challenge with orals is, of course, the efficacy of orals is nowhere compared to injectables. And orals require very high drug, which obviously means that the side effects profile of orals is significantly worse than injectable. And remember, these injectables today are once a week. Once a week is an easy one rather than a daily tablet.
Sorry for asking you this question. I'm apologizing in the beginning itself. But, I see that you are fairly ambitious. And as you said, you put up a lot of your bandwidth and capex in the last 4. So right now, our size is 1,500 crore. Do you think it is in the realm of possibility? And I'm not asking for any guidance. This is only aspiration. Is it in the realm of possibility that the Laurus CDMO business will be of $1 billion in times to come in the next few years? Only we are talking of, yeah.
No, I don't want to put any timelines in place. But
no, I didn't even ask for timelines. I said in times to come.
Opportunities are there. I'll leave this question at that stage.
Okay, thank you so much. Neeraj, just coming back to you.
You face the same problem we face sometimes. We ask for numbers.
But he has answered it.
No,
he doesn't want to put $1 billion, but he has answered the question. Neeraj, just coming back to you, you have guided for a $400 million top line in the next 3-4 years. 1 year is already passed. So we are hoping that it will happen in 3 years. But what is stunning is the margin guidance of 35-40% on that kind of number. So can you speak a little bit more on the path to achieve this 400 and life beyond $400 million? And what is the optionality which is not included in this guidance?
Sure, Madhu. See, we have said, right, we have given this guidance that we'll be a 400 million company in the next 3 to 4 years. And here, there are multiple legs to our business which will help us achieve. Obviously, the key growth driver, one of the key growth drivers will be our biologics drug device combination business. As many of these now GLP, especially semaglutide, comes off patent in some of the key markets, which will really be driving. So our first market which comes off patent in Canada is in January 26 is Canada, which incidentally is the largest market outside of GLP-1s outside of the US. Then the largest market outside of North America is Brazil, which comes off patent in March, along with other large markets like China, India, Latin America, and so on.
I want to thank both of you. We are really running short of time. We could have gone on for another half an hour, but the time is short. So thank you so much for joining. Deeply appreciate both of you.
I want to thank Mr. Chava and Mr. Sharma, both of you. Thank you very much from us as well. For sort of educating all of us. It's a precise business, it's a tough business, but I think as both of you said, the opportunity size is large. Execution, of course, will remain key. Madhu, I want to thank you as well for taking us through a very well-researched segment. Yeah, and I must say you're a natural, so do this more often and give us a break.
No, absolutely. Thank you, Prashant. I think it was quite interesting, and as we can see, both of them have affirmed that the opportunity is large globally, and there is a really reasons for this to shift to India. And now the profit pool of all Indian companies is large enough for them to make investments.
Right.
So let's hope, some companies will really make it big out of India as well.
Absolutely. And, just to wrap up with a disclaimer as well, Madhu, of course, is an interested party.
Yeah,
in terms of course, looking for opportunities, having been invested in the space as well. So do your own research. This was meant as an educative program, and I think we did learn a lot. Thanks once again, Madhu.
Thank you so much.
Thank you.
Welcome to Indianomics. This show is geared to preparing us for April 2nd when reciprocal tariffs may be imposed by the US. We seek to understand which Indian products or sectors are in danger and hence how should we negotiate the bilateral trade agreement. First, we're going to be joined by agri-experts, Ramesh Chand, the member agriculture from the Niti Aayog, and Harish Damodaran, the agri-affairs editor at the Indian Express. Thereafter, on non-rural issues, we will be speaking with Ajay Srivastava, head of the Global Trade Research Initiative. But first, let me welcome Dr. Ramesh Chand and Harish Damodaran. Thank you very much, gentlemen, for your time. Dr. Chand, to you first, sir. Which Indian crops will be impacted if we cut tariffs on US imports? And do we have to cut tariffs for all countries or only US?
Lataji, I feel before jumping to specifics, we should talk a little bit about wider implication of what President Trump is seeking in trade from other countries.
Okay.
You see, now reciprocal tariff means that if every country has to have same tariff, then you lose the opportunity to take advantage of trade. Second is that these things are agreed under WTO, under multilateral trading agreements. So if Mr. Trump goes his way, I think that will unsettle this multilateral trade agreement, and every country will be forced to have two kind of situation, one in response to what US demands, and second is in general what we have committed under.
If they pump in more capex into their business, then Indus Tower gains definitely, because they'll get better tenancies and they will also get newer towers with that capex. And the last stakeholder is Bharti Airtel. and Jio. They are stakeholders to this as well. Contrary to many beliefs, my belief is that a stronger VIL is better for both those companies than a weaker VIL. For a simple reason that a weaker VIL will resort to pricing and discounting. VIL has taken care of its spectrum dues till FY27, and this will allow them to borrow money from the market and pump it back into capex, which allows them to stay competitive in the market. That's immediate gain that they have. The issue is that the problem doesn't get completely solved here, because in March of 26, they'll be due for their AGR dues, and their current EBITDAs do not allow them to cater to that fully, although there'll be some growth in the ARPU, etc. But for now, the money is available with them on their cash flows are not good enough to take care of their capex requirements in the immediate future. So, so they're not completely out of the woods.